Hi guys, this is much awaited advanced accounting marathon for CA Inter part 1, which is going to be for 12 hours. Wait, don't jump into the timestamp and start watching. Introduction must and should you watch. This marathon is going to be completely based upon our new advanced accounting colorful material, which is a super crisp and clear material where you write the matter as it is, whatever given in this material in exam. By the way, most important point, this material is just 230 pages. Entire advanced accounting conceptual material, including accounting standards, 230 pages material. Guys, believe me, you will get a clarity like that you don't get anywhere. Such a kind of amazing clarity our Sai Babu sir gives. Yes, this marathon is going to be handled by our faculty, Sreshta faculty, Sai Babu sir. This is Sai Babu sir, very dynamic faculty for advanced accounting. Those of you who are not aware of Sai Babu sir, he is having amazing experience, close to, if I tell you the number of batches he taught, his experience, you will shock. Close to 200 batches he taught. Close to 180 to 200 batches approximately he taught for CA Inter accounts. Imagine the kind of experience he'll have. More than experience, what I personally believe is it's not about experience or number of batches. More than that, the kind of subject knowledge Sai Babu sir has, the kind of command that he has over schedule 3, over consolidation topic, all this amazing knowledge that you are going to witness through this marathon. I request every one of you to watch the marathon. Initial 1 hour, just watch it. You will only understand the kind of clarity that you're going to get through the marathon, which you generally won't even get in a regular class of many other institutions. That kind of assurance I'm giving you. And one more big statement I want to make today. Down the line, 6 months to 1 year, advanced accounting synonymous Sai Babu surname will appear. Mark my word. I am giving as an introduction to the marathon. Means imagine you look at the material. Before that, just 2 minutes, kindly 2 minutes, spare with me the introduction. Do not skip it. You know, I'm just guiding you where you can download this material, which I showed you right now, right? This PDF you can download at free of cost. We don't charge you a single rupee for the PDF. Okay, so you can download this PDF, you know, from our website. I'll show you from where you can easily download, and we call this as Power Notes. Accounts, Advanced Accounting, CA Inter Power Notes. You see the index, you see the page numbers, accounting standards, all the accounting standards, exactly ICA index we followed. And you know what? Part 1, which is going to be for almost 12 hours, is going to occupy 70 to 80 marks syllabus, guys. Spend 12 hours. Imagine the kind of clarity that you get within the next 12 hours over 70 to 80 marks portion. Part 2 marathon will come in April 1st week. Now we are uploading part 1 marathon, which is almost for 12 hours. Sir, all that is fine. What topics you are going to cover in part 1 marathon? Here itself I wrote. Except branch accounts, you see here, part 1 marathon. What are all the topics that we covered? Financial statements of companies, you know, cash flow statement, not consolidation. Consolidation we covered here. Consolidated financials, yes, it is included as part of this 12 hours. Cash flow statement, buyback, amalgamation, internal, consolidation, 4 accounting standards, 2, 7, 12, 17. Don't worry, below timestamps will be there. Once entire streaming is over, you will find timestamps. And this particular concept book, sir, from where we can download this concept book? You can download it from our Sreshta website. I'll just right away show you. You know, here you come here, Sreshta website, free resources. Here just to look at here, advanced accounting new, free resources. By default CA Inter will be there. So advanced accounts, Power Notes you can download here. Further, sir, I want to order this book, sir. So just to go to books, CA Inter EVO fast track, you click on this. Here you can order this particular concept notes, 469. You can see here the deliveries will begin from 1st April or 2nd April onwards. Okay, so 1st April onwards deliveries will begin. We already ordered this particular material. We have to receive the stock from Delhi, all that. Fine. See, more than all this, what Sai Babu sir will give you, he will give you amazing conceptual clarity. See, you may hear this word conceptual clarity at multiple places many times. You have seen my class, income tax you saw. You have seen my auditing. You know what true conceptual clarity means. Such a kind of conceptual clarity I will guarantee you with the Sai Babu sir advanced accounting, this particular marathon. I made a very big statement at the beginning. I hope you understood that. It will turn out to be true because you will truly enjoy, you will only recommend. And I request you all, please give your valuable feedback, whatever you felt after watching the marathon. I know you will feel tremendously happy. Just share your feedback as a comment also, appreciation, whatever the appreciation, because we are doing a lot of work here. Okay, that appreciation really motivates us a lot. That's it. All the introduction, entire introduction I spoke. You see, for example, the beauty of this material. For example, some standard I'll randomly take. For example, what is one tough standard? 15 employee benefits. That is something, one of the tough standard. You see, AS 15, for example, is in 5 pages. It is given 151 it starts, and 16 starts in 156 in 5 pages. This entire material is in 230 pages. AS 15. Let us go and see AS 15. Briefly, we will see. You see, employee benefit expenses. Okay, employee benefits. You see the kind of clarity with which Sai Babu sir has done the material. You already saw my income tax rate, almost the same theme we all followed uniformly. You see the kind of, the precision in the book writing, everything, redrafted, taking from ICA material without missing any single point. We redrafted everything and made this amazing book. We have done our 100% hard work from our end. It is now your turn to use this marathon, to use this particular book, and may attempt September or January, whoever is planning for whatever the exam, get exemption and share your success with us. Continue watching. All the very best.
Hello everyone, welcome to the revision classes of Advanced Accounting for May and September 2025 examinations. Our first chapter for revision is preparation of financial statements of a companies. Very important chapter, sir, for examination purpose. And this chapter will give you the basic knowledge relating to the preparation of financial statements of companies, which helps you in so many other chapters. For example, you take buyback. So in buyback, they will ask, after buyback is completed, prepare the balance sheet of a company. So how can you prepare the balance sheet of a company without having basic knowledge relating to Schedule 3? So this chapter will give you a basic knowledge relating to the preparation and presentation of financial statements of companies, which you can use in so many other places. And also, sir, if you take accounting standards, one of the main predominant objects of accounting standards is what, sir? To enhance the truth and fairness of financial statements. Whatever the disclosure requirements are there in the accounting standards, we will make it in the financial statements. So such is the importance of the financial statements of companies, sir. So therefore, this you cannot see as one single chapter, sir. This is the chapter which you come across in so many other places. Not only buyback, sir, in amalgamation, internal reconstruction, cash flow statement, even for that matter, consolidation of financial statements. In so many other chapters, the knowledge of this chapter will help you. Okay, so that's why this is very important chapter for examination purpose, and you need to cover it in detail. Okay, sir, basically this chapter I have divided into 3 parts, sir. See, this is the classroom material, sir, which I have given in the classroom, this notes. I will make sure that this notes is available to you so that you can use it while you are revising this chapter. And also I have prepared this exclusive revision material relating to the chapters, all the chapters, and I will make sure that this material is also available to you. And by using these resources, you can easily revise all the chapters in an effective manner. Okay. See, this chapter we can divide it into 3 parts, sir. First, the basic concepts, sir, where we will try to understand what is company, how a company will maintain the books of accounts, what are financial statements, when companies wants to prepare the financial statements, what are the instructions they will follow, all these things, like a theory topics we learn in the first area, sir, that is basic concepts. Now, the second thing, the most important thing we are going to focus on this chapter is Schedule 3 of Companies Act 2013. Now, this Schedule 3 will give you the general instructions for preparation and presentation of financial statements. So, by following the instructions, following the format which is given in the Schedule 3, companies will try to prepare the financial statements. And the last concept is dividend concept, which is also quite regularly they are testing in the examinations. So now let us try to understand the basic concepts. First, what is company? See, we are not here to discuss what is the meaning of the company. Now you have come across, you crossed all those levels. So basically what is company? It's a business organization which is registered as per the Companies Act, or before Companies Act 2013, if any other act is there, Companies Act 1956. Now, if you are registered under that, then you will be generally called as company. So not much discussion is required relating to what is the meaning of the company. Now come to the next concept, maintenance of books of accounts. Sir, the basis for preparation of financial statements is what, sir? Every company has to maintain proper books of accounts, documents and papers. Now section 128 of the Companies Act 2013 says it is a mandatory requirement for every company in India that they need to maintain proper books of accounts, documents and even financial statements for every financial year. So every company has to maintain proper books of accounts, documents, papers, financial statements for every financial year. Every financial year it is requirement as per section 128. And when you are maintaining these books of accounts, sir, make sure that they will give you true and fair view. Otherwise, what is the use, sir? If you are presenting wrong information, if you are maintaining books of accounts with wrong information, there is no use. So that's why section 128 categorically saying that your books must represent fair view of state of affairs of the company. And accrual basis and double entry system. Section 128 says, sir, any company when they are maintaining books of accounts, they need to follow accrual basis of accounting and also double entry system of accounting they need to follow. So accrual and double entry system, they are very, very important, and they will enhance the true and fairness of financial statements, and now they have the legal backup. So that's why whenever any company has to prepare the books of accounts, they need to follow accrual and double entry system. And sir, relating to a particular financial year, how many years the company need to retain the books of accounts? 8 financial years. Because suppose this is financial year 24-25. Now relating to this year, we maintain books of accounts, papers, documents, financial statements. Now in future, if any department like income tax department, GST department or any CBI, any department wants to see the financial statements of company or wants to see the books of accounts of the company, they must be readily available, right? So that's why the act says, so at least 8 financial years, you need to keep the books of accounts of every financial year in a good condition, so that in future if there is any requirement to verify these books of accounts, easily anybody can verify. And sir, where we need to look at these books of accounts, sir? You said as per section 128, it is mandatory requirement for every company to maintain proper books of accounts, documents and papers, financial statements. Where they will keep all these things, sir? At registered office, at a principal place of business. So books of accounts and financial statements, so kept at their registered office. Now statutory books. See, as per the different sections of the Companies Act, sir, every company has to maintain certain statutory registers like register of investments, register of charges, register of members, register of debenture holders, register of minutes, register of directors and key management personnel and their shareholding, register of loans and investments by company, all these things, register of share application and allotment book, share call book, register of members book, share transfer book, dividend register, all these registers. See, it is more of a legal provision. So it will, you come across all these things in the law, company law. So therefore not that much important here. Very less chances that they are going to be tested in the advanced accounting paper. But nevertheless, they are there in the study material. That's why I have given here. Next, annual return. See, this is also a legal provision. Every company, once the financial year is completed, so they need to prepare the financial statements, and once the AGM is completed, within 60 days, they need to file one return called annual return to the ROC. So that is annual return concept, sir. So the companies must prepare annual return, and which is signed by the directors and company secretary. If you are a one-person company, small companies, which is signed by company secretary or director, anyone. And these returns must be filed with the register within 60 days of the AGM. And then the most important part is final accounts. This is what for we are learning this chapter. First of all, sir, as per section 2 clause 40 of the Companies Act, financial statement include the following. What are financial statements? Financial statements of company include the balance sheet at the year end, P&L account for the financial year, and if you are a non-profit organization, income and expenditure account. Third, cash flow statement for the year. Fourth, statement of showing changes in equity or statement of equity changes if applicable, that is also part of financial statements. And also any explanatory note incorporated in any document. Now relating to balance sheet, P&L account, cash flow statement, statement of equity changes, if you have prepared any additional notes, so additional information, that is also part of financial statements. But one thing, sir, if you are a one-person company, dormant company like inactive company or a small company or a private companies, especially startup private companies, so for you, cash flow statement is not mandatory. No need to prepare the cash flow statement. So financial statements includes these things. Now, there is a section called section 129, sir, which exclusively talks about financial statements. Now, this section says, whenever a company wants to prepare the financial statements of company, they should keep in certain points in mind. Points to consider the financial statement, points to be considered for preparation of final accounts of a company. Whenever you want to prepare the financial statements of company, sir, always you need to keep in mind Schedule 3. Schedule 3 of the Companies Act, it is gives you the general instructions for preparation and presentation of financial statements. Now you need to follow it, first thing. Second thing is, you need to follow accounting standards, which is notified by Ministry of Corporate Affairs. Any accounting standards which is notified by the government, those are you need to follow when you are preparing the financial statements of a company. And the next thing is that any other statutory requirements, as per law, if there is any other requirement, that is also I need to follow when I am preparing the financial statements of a company. And also, sir, any ICI statements and guidance note. So our Institute of Chartered Accountants of India will regularly gives you the guidance note in relating to any particular accounting area. Now those guidance note is also we need to follow when you are preparing the financial statements. So whenever you are preparing the financial statements of a company, as per section 129, you need to follow the schedule 3 requirements, you need to follow the accounting standards, you need to keep in mind the statutory requirements and also ICI guidance note. All these things you need to keep in mind when you are preparing the financial statements of a company. Now in all these things, sir, accounting standards we learn separately. And now in this chapter we are going to cover the schedule 3. Other statutory requirements, ICI guidance note, not there in the syllabus. So okay, of course, other statutory requirements means suppose as per the Companies Act or any other act, if there are any legal requirements or statutory requirements, we will follow them. Okay, but the predominant focus is this one. So that's why in our syllabus in this chapter we have schedule 3, and of course we have accounting standards also, section accounting standard 1 to 29. And sir, one more important thing, sir, whenever you are preparing the financial statements of a company, sir, one of the major requirements of section 129 says your financial statement should reflect true and fair view. So the financial statement should give you the true and fair view of state of affairs of the company. Of course, this is very subjective thing, but they have specified categorically in the standard in the section itself. So therefore, how much important it is to see, look at presenting the true and fair information in the financial statements is very, very important. Because if this point is not there, sir, so you see so many companies by presenting false information, wrong information, they are misleading the users of financial statements. It should not be like that, which is actually prohibited as per the Companies Act. Okay. And also, sir, one of the important point section 129 says is, it is the responsibility of the board of directors must lay down the financial statements in the annual general meeting. So every year company will conduct a meeting called AGM. In that meeting, the financial statements, nothing but the current year performance, the current year position, whatever the financial statements they prepared, no sir, those financial statements must lay down before the shareholders of the company in the annual general meeting. So that is the responsibility of board of directors. So this point is also there in the section 129. And see, suppose if you are a insurance company, banking company, electricity company, no sir, for you specific act is applicable when you are preparing the financial statements, because for a banking company, insurance company, or for electricity companies, there are respective acts. So in those acts, they will prescribe the formats of preparation of financial statements, instructions. So we will follow them. But if you are not an insurance company, if you are not a banking company, or if you are not a electricity company, obviously you are subject to schedule 3 of the Companies Act whenever you are preparing the balance sheet and P&L account of the company. Okay. Now the final conclusion is, whenever you want to prepare the financial statements of a company as per section 129, your financial statement should give you true and fair view, and you should comply with the accounting standards which is notified under section 133, and also it should be in the form which is prescribed in schedule 3. Schedule 3. So that's why now we need to learn Schedule 3 of the Companies Act, because it is one of the mandatory requirements you need to keep in mind whenever you are preparing the financial statements of company. Okay. So the major part of this discussion is Schedule 3. See, first 13 minutes, it's only a basics of this chapter, just a theory concept. You just listen and leave it. But now, Schedule 3, very, very important. You try to, remember everything relating to Schedule 3. Okay. Sir, what is this Schedule 3 is all about? See, whenever you want to prepare the financial statements of companies, sir, one of the major requirement is Schedule 3. Schedule 3 is basically what? General instructions for preparation and presentation of financial statements. In Schedule 3, sir, we have 3 divisions. Division 1 is companies which are required to comply with normal accounting standards. They will follow Division 1. Division 2, companies which are required to comply with Indian accounting standards, Ind AS. Division 3, NBFCs, non-banking financial companies, which is required to comply with Ind AS. Of course, you know, we don't have Indian accounting standards in our syllabus relating to CA Inter. We have only normal accounting standards. So Schedule 3, Division 1, we need to learn. In that, Part 1 talks about balance sheet format. Part 2 talks about P&L account format. Okay. So, Division 1, 2, 3, sir, Schedule 3. In that, Division 1, Part 1, Part 2. So, now see, first we will focus on the balance sheet of a company. See, whenever you want to prepare the balance sheet of a company, remember guys, balance sheet had 2 parts. Balance sheet had 2 parts. Part 1, balance sheet. First, you will write the name of the company, then balance sheet asset. Suppose you are preparing the balance sheet at the end of the year, 31st March 2025. Now, always when you are preparing the financial statements, sir, current year figures, previous year figures also you need to report. Practically speaking, always you need to make this comparison, current year versus last year. But for academic purpose, sir, in so many problems, we don't have the last year figures. In that case, no need to prepare. Suppose even in the question, suppose if they have given any previous year figures, sir, don't waste your time presenting the last year information. So only current year information is what required. But practically, if you see the financial statements of company, along with the current year, previous year figures are also there. Okay. Now, in the balance sheet, sir, there are 2 major heads. First, equity and liabilities head. This is part 1. Second part is assets. First part is what, sir? Equity and liabilities part. Second part is assets part. In equity and liabilities, sir, we have 4 heads. 4 heads. In assets, we have 2 heads. First, learn the main heads. First, equity and liabilities. In equity and liabilities, the first head is shareholders funds. Second, share application money pending allotment. Third, liabilities. Liabilities are non-current liabilities, current liabilities. Now coming to assets head, only 2 heads, sir. Non-current assets, current assets. Now according to Schedule 3, sir, the assets and liabilities are classified as current, non-current. Of course, on what basis this classification is done, we are going to discuss it. Wait. So first try to focus on the main heads of the balance sheet, how the presentation will be done. So first you come to the equity and liability side. In equity and liability side, we have 4 heads. First, shareholders funds. Second, share application money pending allotment. Third, non-current liabilities. Fourth, current liabilities. Now, when it comes to the asset side, sir, there are 2 heads, non-current assets and then current assets. Non-current assets and current assets. Okay. Now, first, shareholders funds. Shareholders funds means what? Share capital, reserves and surplus, money received against share warrants. So there are 3 items in the shareholders fund. One is share capital, guys. Another one is reserves and surplus. Reserves and surplus. Third one is money received against share warrants. Share application money pending allotment, we don't have any further breakup. Now coming to non-current liabilities, there are 4 items. One is long-term borrowings, another one is deferred tax liabilities net amount, next one is other long-term liabilities, next long-term provisions. So long-term borrowings, deferred tax liabilities, other long-term liabilities, long-term provisions. When it comes to current liabilities, we have 4 current liabilities: short-term borrowings, trade payables, other current liabilities, short-term provisions. So this is the total equity and liability side. So equity and liabilities, 4 heads. First head, shareholders fund. In shareholders fund, A, share capital, B, reserves and surplus, C, money received against share warrant. Second head, share application money pending allotment. Third head, non-current liabilities. In non-current liabilities, A, long-term borrowings, B, deferred tax liabilities, C, other long-term liabilities, D, long-term provisions. Coming to current liabilities, 4 heads, 4. First, short-term borrowings. Second, trade payables. Third, other current liabilities. Last one, short-term provisions. Short-term provisions. So this is the equity and liability side, sir. Now come to the asset side, sir. Asset side, I told you, non-current assets, current assets, sir. First, non-current assets. In non-currents, there are 5 items, sir. 5. A. In A, we have 4 items, sub-items. So non-current assets, A, 1, property, plant, equipment. That is nothing but tangible fixed assets. Next, intangible assets, intangible fixed assets. Next, capital work in progress. CWIP, capital work in progress. And then any intangible assets under development. Any tangible assets under development stage, capital work in progress. Intangible assets under development, we need to show separately. So this is the first breakup in the non-current assets. So non-current assets, A, in that 1, 2, 3, 4. First, property, plant, equipment. Second, intangible assets. Third, capital work in progress. Fourth, intangible assets under development. Next, non-current investments. All long-term investments, non-current investments. Next, deferred tax assets. Deferred tax assets. Next, long-term loans and advances. Next, other non-current assets. So, non-current assets are A, in that 1, PPE, 2, intangible assets, 3, capital work in progress, 4th, intangible assets under development. B, second item, non-current investment. C, deferred tax assets, net. D, long-term loans and advances. Loans and advances we have given because this is asset, long-term loans and advances. And last one, other non-current assets, residuary category. And now come to the current assets, sir. In current assets, we have 6 items, sir. 6. In current assets, we have 6 items. What are those? Current investments, inventories, trade receivables, cash and cash equivalents, short-term loans and advances, other current assets. So current investments, inventories, trade receivables, cash and cash equivalents, short-term loans and advances, other current assets. So this format is very, very important, sir. First, try to remember the entire format, sir. Try to remember the entire format. And when you are solving the balance sheet of a company, sir, so first you try to write the format. But of course, don't write the entire format. Only relating to this problem, what are all the items are there, those items you quickly present, sir. Then try to fill the amount so that you can prepare the balance sheet quite easily and you can save a lot of time. So therefore, number of times you need to revise this format. Then only it will fit into your mind. So okay, come on. What is schedule 3? First, we are discussing about schedule 3, format of the balance sheet. Now balance sheet, 2 parts, equity and liabilities, assets. In equity and liabilities, there are 4 heads. First, shareholders fund. In shareholders fund, A, share capital, B, reserves and surplus, C, money received against share warrant. Second, share application money pending allotment. 3, non-current liabilities. In non-current liabilities, we have 4. A, long-term borrowings. B, deferred tax liabilities net. C, other long-term liabilities. D, sorry, what is it? Wait 1 second. So other long-term liabilities, long-term provisions. Okay. Now come to current liabilities. In current liabilities, we had what? First, short-term borrowings. Second, trade payables. Third, other long-term liabilities. Last one, short-term provisions. Asset side, you see non-current assets. In non-current assets, we have 5. A, in that 1, property, plant, equipment. 2, intangible assets. Third, capital work in progress. Fourth, intangible assets under development. B, non-current investments. C, deferred tax assets. D, so long-term loans and advances. And the last one, other non-current assets. Now come to the current assets. We have 6 items. A, short-term borrowings. B, inventories. C, trade receivables. D, so short-term loans and advances. So D, cash and cash equivalents, next one. And then other current assets. So these are the 6 items in the current assets. Okay, this is the total format of the balance sheet, sir. Now, sir, let us try to understand. See, this is the major format of the balance sheet. Now, within this, each item, how it has to be disclosed, there is a separate requirement, sir. If you see the schedule 3, suppose take share capital. In share capital, what information we need to disclose in the notes to accounts? That is also there in the schedule 3. Those are also very, very important. Now, next, reserves and surplus. Relating to reserves and surplus, what is the breakup we need to give? All these things are there. Now, first, sir, we need to focus on the classification of liabilities. Sir, according to schedule 3, the assets and liabilities are classified into 2 categories, right? Current, non-current. Now, what is the criteria to classify any asset as current asset, any liability as current liability? If you look at the schedule 3, they have given the classification criteria. Now, first we will talk about the current liabilities, sir. Current liabilities. When we say any liability as current liability, see, the standard says there are 4 criteria. If any one of the criteria is satisfied, then we say it is a current liability. A liability is classified as current if it satisfies any of the following criteria, any of the following conditions. If it is satisfied, sir, then we can say it is a current liability. First criteria, the liability is expected to be settled within the normal operating cycle. Any liability, if you are expecting to settle within the normal operating cycle, that is current liability. Sir, what is normal operating cycle? Simple. How much time it has taken to convert the raw material into cash or cash equivalents? To convert the raw material into cash and cash equivalents, how much time it has taken? That is called normal operating cycle. Suppose, for example, I am a bakery. So I will produce cakes, bread items, different kinds of pastries I will do. Now, how much time it has taken for me to convert the raw material into cash or cash equivalents? Maybe 2 days, 3 days. Now the 3 days, for example, 3 days to convert the raw material, basic ingredients into the cash. 3 days time it has taken. So 3 days is the normal operating cycle for me. Now if I am settling any liability within the 3 days, that is basically current liability. So any liability expected to be settled within the normal operating cycle. And any liability which is held primarily for trading purpose. Like for example, any derivatives, options, futures, any kind of financial assets we had for trading purpose, they are also called as what? Current liabilities. Because see, basically these investments, these financial assets are held for what? Trading purpose, not for long-term investments. So they will be classified under current liability. Next, any liability due to be settled within 12 months after the reporting date. So reporting date means year end. Now current year end, whatever the liability you are going to settle, due to be settled, you are not settling, but actually it is due for settlement in the next 12 months from the reporting date, that is also classified as current liability. Okay. And the last one, no unconditional right to defer settlement of the liability for at least 12 months after the reporting date. Suppose, sir, you don't have the unconditional right to defer the settlement of liability for at least 12 months after the reporting date. That means suppose there is a liability, you cannot postpone this liability. You cannot defer the payment of this liability for at least 12 months. You don't have the rights. You don't have the unconditional right. For example, company issued debentures to the debenture holders. Suppose it is due to be settled within the next 12 months. Now, can a company on its own defer the settlement of this liability? Answer is no. They have to consult with the debenture holders. On their own, they does not have the right, unconditional right to defer this liability for at least 12 months after the reporting date. Therefore, it will become a current liability. For example, any loan which is repayable on demand. For example, company has taken a loan from the bank. Now, whenever bank demanded the payment, you need to make it. That means you don't have the right, unconditional right to defer the settlement of liability for at least 12 months. So then automatically that kind of liability will become current liability. Where 100% you have the right to defer the liability for settlement beyond 12 months, then you cannot classify this as a current liability. But basically any liability on your own, you cannot defer it. Defer means postpone it, postpone the payment beyond 12 months. Then obviously it is considered as current liability. Of course, the terms of the liability that provide an option to the holder to take shares for settlement of liability, that could not affect the classification of liability. The terms of liability that could, at the option of the counterparty, result in its settlement in issue of equity shares, does not affect the classification. For example, company issued convertible debentures. Now, some of the debenture holders may exercise the option of, cash. Some of the debenture holders may exercise the option of shares. Now, whether that will affect the classification? No. So, it will not affect the classification. Whether finally you end up with paying cash or shares or doesn't matter. So, if you don't have the unconditional right to defer the settlement of liability for at least 12 months, then obviously you have to classify this as a current liability. So, when a liability will be classified as current liability, the schedule 3 says there are 4 criteria. If any one of the criteria is satisfied, then that liability is called current liability. First thing is that liability is expected to be settled within the normal operating cycle. Second, it is held primarily for the purpose of trading. Third, which is due to be settled within 12 months after the reporting date. Fourth, you don't have the unconditional right to defer the settlement of liability for at least 12 months after the reporting date. Where the terms of the liability provides an option to the holder that if he wants, he can take the shares. That does not affect the classification of liability. Even then, the liability has to be classified as current liability. And any liability, if it is not satisfying any of the above criteria, basically is what? Non-current liability. Non-current liability. See this. So, first thing is a liability which is expected to be settled within the normal operating cycle. For example, I am a bakery. So, to convert my raw material into finished goods, 2 days it has taken. Now, these finished goods, to make the sale, another 2 days, total 4 days time it has taken. So that is my normal operating cycle. So basically normal operating cycle is to convert the raw material into cash or cash equivalents, how much time it has taken. Suppose if you are a manufacturer, raw material, work in progress to finished goods, then sales, then cash. So for this cycle to complete, how much time it has taken? That is called NOC. Now if you are expecting to settle any liability within this cycle, so obviously that is a current liability. Sir, for some organizations, it may not be possible to determine the NOC. Then schedule 3 says you can assume 12 months. Therefore, any liability to be settled within 12 months basically is a current liability. And also, sir, I told you any liability which is held primarily for the purpose of trading. Like for example, any options contract, future contracts, derivative contracts, which are financial assets to you. So they are all always be classified as current liabilities. And also any liability due to be settled within 12 months after the reporting date. For example, you have taken a bank loan. So in that bank loan, in the next 12 months, how much amount becomes due for settlement? That will be your current liability. Next, I told you this is a very important point. Once they have asked a question in old syllabus relating to the last point of this standard, current liability classification, this one. No unconditional right to defer the settlement of liability for at least 12 months. Okay, even if the liability is settled by issue of equity shares at the option of the other party, that will not affect the classification. Now, hope you understood what is current liability now. So, next to what is current asset, sir? When we say an asset is called current asset, like current liability, sir, even for current assets also, Schedule 3 has prescribed 4 criteria. An asset is classified as current if it satisfies any of the following criteria. First one is any asset is expected to be realized or consumed in the company's normal operating cycle. Just now I explained what is normal operating cycle. What is the time between the acquisition of assets for processing and their realization into cash or cash equivalents? If you are unable to decide the operating cycle, then 12 months. So therefore, anything is expected to be realized within 12 months or within the normal operating cycle, or consume, which you consume within the normal operating cycle. For example, any raw material you purchased, the raw material you consume within the normal operating cycle. So therefore, raw material is what is always a current asset, and also expected to be realized. What you are expecting to realize within the normal operating cycle, maybe debtors. Debtors are part of normal operating cycle, which you are expecting to realize within the normal operating cycle. So therefore, obviously, debtors is also current asset. And any asset which is held primarily for the purpose of trading. Sir, please understand, sir, when I am explaining the current liability definition, I told you any, asset point of view, I might have explained you. Any optional contracts, any future contracts, any derivative investment. If it's a financial asset, then it's a current asset. It can be a financial liability also. If any liability which is held primarily for the purpose of trading, like how options, futures, derivatives will be your financial assets, there can be financial liabilities also. If they are financial liabilities, then current liabilities. If they are financial assets, then they are current assets. Okay. And also any asset expected to be realized within 12 months after the reporting date. So anything you are expecting to realize within 12 months from the reporting date. So in the next 12 months, whatever the amount you are expecting to realize, obviously it's a current asset. And also cash and cash equivalents. Generally, cash and cash equivalent is always which asset? Current asset, unless restricted from being used for at least 12 months after the reporting date. Suppose, for example, this cash or cash equivalents have any restrictions that you cannot utilize them for the next 12 months for settlement of any liability, then you cannot consider them as part of cash and cash equivalents. So therefore, if any one of the criteria is satisfied, then that asset is called current asset. So can you tell me what is current asset? An asset which is expected to be realized or consumed within the normal operating cycle. Second, it is held primarily for the purpose of trading. Next, which is expected to be realized within 12 months after the reporting date, and also cash and cash equivalents. And any asset, if it is not satisfying the above criteria, that is called non-current asset. Non-current assets. So this is classification criteria relating to the current and non-current assets and liabilities. Now come to the schedule 3, sir. First, shareholders funds. In shareholders funds, what is the first item, sir? Share capital. Now relating to share capital, what items we need to present in the financial statements as per schedule 3? Look at this. Disclosures required for various items. First, share capital. Very, very important, sir. You can expect a practical question relating to these disclosure requirements. Many of the students thinking that, or not only students, sir, many of the faculties are under the opinion that this chapter is only just the format. No, sir. Actually, if you look at the deep of this chapter, format at the same time relating to each item, what information we need to disclose is also very, very important, sir. And if you master this chapter properly, sir, even in other papers like auditing paper, your job will be very easy. So therefore, this knowledge, the knowledge of this chapter is very, very important, sir. Like for example, you take share capital, sir. In the balance sheet, shareholders funds, we show share capital. But relating to share capital, what information is the minimum information we need to disclose in the notes to accounts is also prescribed here. So first, when you are presenting the information relating to share capital, the total number and value of shares authorized. First, authorized capital you need to present. That's why when you look at any solution relating to balance sheet, first they will show you authorized capital. Because schedule 3 says first, what is the total number of shares, value of shares, which are authorized in nature. Next, shares issued, subscribed, fully paid. Subscribed but not fully paid also we need to show. So, issued capital, subscribed capital, paid up capital. First authorized, then these things. Next, whenever you are presenting information relating to shares, sir, suppose we present like this, 10,000 equity shares of 10 each, the 10 for par value or fair value also we need to present. And also, whenever you are preparing notes to accounts relating to share capital, sir, you need to prepare shares outstanding at the beginning and end of the period. What is the opening number of shares? What is the closing number of shares? What changes happened in the shares, number of shares? You need to prepare one statement. And also, what are the rights, preferences, restrictions on each class of shares? Now, company will issue equity shares. Within the equity shares with the different rights, different preferences, different restrictions relating to dividend limitations, capital repayment restrictions. So, you need to disclose in the notes to accounts relating to each class of shares, what are their rights. So, relating to dividend, relating to voting rights, what are the rights, what are the restrictions they had, you need to disclose in the notes to accounts. And also, sir, any shares held by the parent company, holding company, ultimate holding company, and their subsidiaries or associates, how many shares we had in our associates, subsidiaries, all these things we need to disclose. And also, the points which is given in the red, very, very important, sir. So, chance that they might test in the examinations or even at least MCQ. Now, whenever you are presenting information relating to share capital, sir, shareholders owning more than 5% of the shares, you need to give details, sir. In the notes to account, sir, you need to prescribe the name of the shareholder, number of shares he held. The criteria is you should have more than 5% of the shares with their shareholding numbers. Suppose Mr. X is having more than 5% shares in a company. We need to present separately in the notes to accounts. And also, sir, any shares company reserved for issue under any options, contracts, or any other commitments, including terms and amounts. Under any contract, under any commitment, or under any options, company wants to issue any shares, reserved any shares for issue. So those things are also we need to present, sir. And this is very, very important, sir. Schedule 3 says, sir, relating to share capital, in 3 circumstances, 3 situations, we need to prescribe aggregate number class of shares. So this aggregate number class of shares, aggregate number class of shares, aggregate number class of shares. So what are the 3 circumstances? We need to prescribe aggregate number and class of shares for if we are issuing any fully paid shares without payment being received in cash. If company issues any shares for consideration other than cash under any contract, how many number of shares are issued? What is the class of shares? We need to disclose. And also the aggregate number and class of shares allotted as fully paid shares by way of bonus shares, fully paid bonus shares. Sir, if any company issued fully paid bonus shares, so aggregate number class of shares, and also buyback of shares. If any company bought back any of the shares, aggregate number class of shares. So here the criteria is 5 years. So we need to disclose this information for 5 years, sir. In any particular year, if company has done any of these 3 things, like issue of shares for consideration other than cash, or issue of fully paid bonus shares, or buyback of shares. If any one of these 3 things happen, sir, we need to disclose what, sir? Aggregate number class of shares, aggregate number class of shares, aggregate number class of shares, aggregate number class of shares we need to disclose. If any one of these things happen for a period of 5 years, we need to disclose. Okay. Now here how questions will be tested, I will show you, sir. In study material we had one question relating to this. I will show you. One practical question is there. Yeah. See the question number 1, sir. Suppose a company is there, sir. They are preparing financial statements for the financial year 11-12. Alpha Limited has mentioned in the notes to accounts that during the financial year, 24,000 equity shares of 10 each were issued as fully paid bonus shares. Now, one company, Alpha Limited, is there. They have issued fully paid bonus shares, 24,000 equity shares of 10 each. They mentioned that point in the notes to accounts. However, the source from which these bonus shares were issued has not been disclosed, but they have not mentioned the source from which these bonus shares have been disclosed. Is such non-disclosure a violation to the Schedule 3 to the Companies Act? Comment. See, this is the question. Tell me, how can you answer this question without having basic knowledge of Schedule 3? What are the Schedule 3 requirements? How can you answer this question? So, it is not a common sense. Please understand. Many of the students believing that, see, the moment they, suppose if they don't have the knowledge relating to Schedule 3, the moment if I ask them the question that a company issued bonus shares, but they have not mentioned the source from which these bonus shares are issued in the financial statement, is this correct? If I ask now, they will say, no, how can company will do that? They have to disclose the source. But in fact, just now we have come across that as per Schedule 3, whenever you are presenting any information relating to share capital, especially when any company issued fully paid bonus shares, so they need to disclose for a period of 5 years the aggregate number class of shares. Is there anywhere they mentioned that we need to mention the source also? No. Therefore, here disclosure of the source is not mandatory as per Schedule 3. Therefore, it is not violation of Schedule 3. So, Schedule 3 does not require a company to disclose the source from which bonus shares have been issued. Therefore, non-disclosure of source from which bonus shares have been issued does not violate Schedule 3 to the Companies Act. So, this is how they will frame the question, sir. So, understand. So, therefore, relating to share capital, whenever a company issued any shares for consideration other than cash, whenever they have issued any fully paid bonus shares, or whenever they have bought back any shares, they need to mention aggregate number class of shares for a period of 5 years. And like that, any unpaid calls on shares are there, you need to show them separately, including the unpaid amount by directors and officers, and also original amount paid on any forfeited shares. Suppose if any shares are forfeited, what is the original amount already paid up on those shares? We need to disclose. At least try to remember the points which I will put a star mark, sir, relating to this. So 4 points are there. So whenever you are presenting the information relating to share capital, issued capital, subscribed capital, paid up capital, and also face value, and also shareholders holding more than 5% shares, So you need to disclose them separately. And also, if any one of these three things, that is shares are issued for consideration other than cash, fully paid bonus shares, buyback of shares, if any one of these three things happen, sir, so for the 5 years we need to disclose the 2 points: aggregate number, class of shares, aggregate number, class of shares. So this is the first item in the shareholders fund, that is share capital. What is the second item? Reserves and surplus. All the reserves and surplus we need to disclose in the notes to accounts one by one, sir. Like for example, capital reserves, capital redemption reserve, securities premium, debenture redemption reserve, revaluation reserve, share option outstanding account. See, sometimes people will mislead that the moment they see outstanding account, they will thought this is liability. No, share options outstanding account. Actually, it will come in ESOP chapter, employee stock option, which is not there in your syllabus. According to the guidance note which is given by ICI, whenever a company wants to issue shares any under ESOP option, so whatever the expenses, whatever the losses company is going to incur in that option, so they will transfer this to our outstanding account, and this outstanding account they will get cancelled when employees exercise their option. So by the time employees exercising this option, this outstanding account will appear in the balance sheet in reserves and surplus. So therefore understand, share option outstanding account is part of reserves and surplus, not part of liabilities. And then any other reserves. So you need to classify all the reserves. And also, sir, any reserve shown by earmarked investment is called fund. Suppose there is a reserve, sir. In respect of that reserve, if there is any investment, corresponding investment, then we call it as a fund. Like for example, debenture redemption fund, sinking fund. Why we use the word fund instead of reserve? When any reserve has specific investment, earmarked investment means the investment which is made particularly from the specific fund. So then we call it as fund, not reserve. So that point also explained. And also in this is the important point, sir. Suppose P&L account balance, sir. P&L account debit balance. Sir, generally P&L account debit balance means what, sir? Losses. Now if there is a debit balance in P&L account, will you show in reserves and surplus? The answer is yes. You cannot present reserves and surplus. I mean, you cannot present debit balance of P&L account on the asset side. Previously, sir, these kind of practices are there. Suppose for example, P&L account debit balance is there, now they will show under the asset side, miscellaneous expenditure not written off, like that they are showing under one head. But as per schedule 3, it is not allowed. Schedule 3 says don't consider balance sheet as a dustbin. Don't mislead the users of financial statements by presenting wrong way. So your liability, your weakness cannot be your strength. You cannot show the debit balance of P&L account on the asset side. So therefore schedule 3 says even if you have lost debit balance in P&L account, you need to present in reserves and surplus only with negative symbol. And because of this, the total reserve may become negative. No problem. It has to be presented under the head reserves and surplus only with a negative symbol. So if there is a debit balance in P&L, it will be shown as a negative figure under surplus. If the total reserves and surplus after adjusting any negative surplus may also show a negative balance, nothing wrong. You can. So relating to this, I think there is one question, sir. In the study mat, I will show you that question. See this question. Suppose there is a company, Futura Limited, sir. Now they had the following items under the head reserves and surplus in the balance sheet as on 31st March 2011, sir. Securities premium 80, capital reserve 60, general reserve 90. These are all credit balances. The company had an accumulated loss of 250 lakhs as on the same date. P&L account debit balance, which it had disclosed under the head statement of P&L as asset in its balance sheet. Tell me, sir. Debit balance in P&L account, can I show it on asset side? Answer is no. How can you present it as an asset? Comment on accuracy of this treatment in line with schedule 3. This treatment is incorrect. As per schedule 3, if P&L account is having a debit balance, we need to present under reserves and surplus only. Now, if I present this 250 lakhs as a part of reserves and surplus, the total reserves may become negative. The total reserve may become negative. No problem. Because total reserve till here you see. So 80 plus 60, 140, 140 plus 90, 230. This is 250 minus 20. No problem. Still it has to be presented under reserves and surplus only. So here the company, whatever the presentation they are following, this is incorrect. So this is one question relating to reserves and surplus, sir. And what is the next item in the shareholders fund, sir? We have completed share capital and then reserves and surplus. What is the next item? Next item is money received against share warrant. What is this money received against share warrant? Money received against share warrant. This is money received against share warrant. Sir, Suppose I will show you, sir. Wait, see. Money received against share warrant. What is the share warrant, sir? See, share warrant is a financial instrument, sir, which is gives the holder the right to certain number of shares, but not the obligation to purchase shares of a company in future at a specific date within the specific time period. So share warrant is kind of a certificate, sir, instrument. If I have this instrument, so that means I have the right to subscribe some shares of the company at a specific price. But I am not the shareholder, sir. Please understand, I am not getting ownership, but I have the right to subscribe some shares of the company in future. So this share warrant is a certificate, sir, which gives me the right to subscribe certain number of shares in the company. But I'm not going to get any dividend. My name is not there in the register of members. Once I become a shareholder, my name is entered in the register of members, then I am the real owner. But if I am a share warrant holder, that means I have the share warrant with me. If I want, I can exercise this warrant. And I can purchase shares of the company. So this warrant gives that right to me. So if I want to transfer this warrant to somebody, I can transfer it. So share warrant is a financial instrument which gives you the ownership if you exercise for certain number of shares at a specific price. That gives the holder the right but not the obligation to purchase shares of the company in future at a specific date with a specific time period. Therefore, can you tell me, suppose a company issued share warrants, received the money from the share warrant holder. Now, whether that money can be included as a part of share capital. Share capital means what? Amount received from the shareholders and their name is entered in the register of members. So that means whatever the amount received from the owners of the company, we will generally call it a share capital. But here we received money against share warrant. Share warrant holder is not a owner of the company. In future, if we exercise the shares, if we purchase the shares, then he will become the owner of the company. So therefore, any amount received against a share warrant, sir, that's why we will not keep as a part of share capital, but we will keep separately in the shareholders fund. Money received against share warrant. Now in future, suppose if the share warrant holder exercise the option, in future if share warrant holder exercise the option, this amount will be credited to share capital. So till that time you show under shareholders fund only, but don't include it as a part of share capital. So either the holder will exercise, or if he transfer the share warrant to somebody else, they will exercise the option to purchase the shares of the company. When any person exercise the option by submitting the share warrant to the company, then company will allot shares to that person and his name will be entered in the register of members. Then he will become the shareholder. Then the amount received will be transferred to share capital. Till that point of time, you kept it separately. Next, share application money pending allotment is a second head, sir. What is the share application money pending allotment? Sir, suppose a company issued shares, received the application money. Now year end came. No allotment done. That means application money already received, but no allotment has been done. Therefore, can a company consider this application money as a part of share capital, as a part of shareholders fund? Because without allotment of shares, how can it becomes shareholders fund? So therefore, at the end of the year, if any money received against issue of shares, but no allotment has been done, that will be shown separately. That is share application money pending allotment. Next, company when allotted the shares, then again the share application money pending allotment will be cancelled and this will also go to share capital. Next, non-current liabilities, sir. Sir, liabilities basically four categories, sir. Two categories. One is non-current, another one is current liability. In non-current liabilities, what is the first one? Long-term borrowings. Relating to long-term borrowings, what are the requirements? See this. Schedule 3 says long-term borrowings classification, sir. First, bonds and debentures. So bonds and debentures is always long-term in nature. You cannot find bonds and debentures issued for 1 month, 2 months. No, they are long-term capital, long-term finance. And any term loan means a loan which is taken for, more than 1 year. Basically term loan they call it as, from banks or from any other parties. And also deferred payment liability. Deferred payment liability means any liability which you are going to settle over a period of time is called deferred payment liability. Deferred payment liability. So suppose for example, you are a company XYZ Limited, sir, and GST department is there. Now you have some arrears of GST liability around 50 crores. Suppose over the last 5 years or 10 years, you are assuming that for you GST is not applicable, so you are not paying GST. But one fine day, GST department send you a notice that no, for you GST is applicable. Please pay last 10 years GST liability of 50 crores. Now you approach the GST department, ask them, sir, at a time 50 crores, our company will be gone. We went into the liquidation. We don't have the capacity to pay 50 crores at a time. Please make some restructuring. Please, agree for some arrangement. Then department said, no problem. This 50 crores you pay over a period of 10 years. So can I call this as deferred payment liability? Answer is yes. So deferred payment liability is basically what? A liability which is going to be settled over a period of time. That is called deferred payment liability. Now, if any kind of deferred payment liability is there, which you are going to settle over a period of time, then you show it under long-term borrowings. And also any deposits you have taken from the public for long-term, more than 1 year. And also any loans and advances from related parties. Who are related parties here? Your subsidiaries, associates, joint ventures. Any loans and advances taken from the parent company, from your related parties. Accounting standard 18 is there, which talks about related parties. So from that related parties, if you taken any loans and advances, show them separately. And also any long-term maturities of finance lease obligation. Finance lease. As per accounting standard 19, sir, leases are basically classified into two. Finance, operating lease. If you take any asset under finance lease, now according to that lease, whatever the lease rentals, whatever the liability arises to you to pay to the lessor, the owner. Now that is basically long-term maturities of finance lease obligation that will be shown under the head long-term borrowings. Other loans and advances. So these are the items generally will come in long-term borrowings. So bonds and debentures, term loans from banks, from other parties, deferred payment liabilities, deposits for long run, loans and advances from related parties, long-term maturities of finance lease obligations, other loans and advances. Now schedule 3 says, sir, liabilities basically are classified into, borrowings are basically classified into two types, sir. One is secured and another one is unsecured, sir. So borrowing shall be classified as secured and unsecured. If they are secured, sir, then nature of security in each case we need to specify. Suppose for example, we have taken a debentures and we have given plant and machinery as a security. Now clearly we need to specify what is the nature of the security we have given. And sometimes, sir, any loans and advances taken by the company are guaranteed by the directors and others. Then in that case, we need to clearly specify in the notes to accounts what is the amount for each head. So relating to these borrowings, how much is guaranteed by the directors' offices on behalf of the company. And also suppose if company issued any bonds and debentures, they need to disclose what is the interest rate we are paying, what is the redemption or conversion details. So when we are going to redeem, list by latest date first. So what are our redemption dates? So earliest date first we need to disclose. And also if you are paying in installments, use the first payment date. So as the maturity date, and then you start disclosing about these payments. And also, sir, any term loans and other loans. Suppose if you have taken any term loans and other loans, what are the terms of these loans you need to disclose. And also suppose if any loan defaults is there. For example, if company is not paying any borrowings, any loans taken, term loan taken, not properly we are paying, we need to clearly specify the period and amount of continuing default as on the balance sheet date for both loans and interest. If there is a continuing default, sir, if there is a continuing default, from which period there is a default, what is the amount of default relating to the loan and interest, we need to disclose properly. So this is disclosures relating to long-term borrowings. So in the shareholders, in the long-term non-current liabilities, long-term borrowings, then deferred tax liabilities, as per accounting standard 22, if it is any deferred tax liability is there, the net amount we need to present. And then we have other long-term liabilities, long-term provisions. So what items will come in other long-term liabilities? See, in other long-term liabilities, sir, trade payables, others. See, this trade payables is what? Long-term trade payables. If any trade payable fit into the definition of current liability, that we will not take here. So trade payables. So here actually if you see the current liabilities, sir, we have trade payables. But these trade payables which we consider in other long-term liabilities, they are basically not fit into the current liabilities. Then they will comes under other long-term liabilities. So don't confuse. Trade payables, why sorry saying under current liabilities we have trade payables. Under other long-term liabilities also trade payables. How it is possible? See, basically we have discussed the criteria to be classified as current liabilities now. So sometimes if the trade payables are not fit into the current liabilities, then they will be classified under other long-term liabilities. Next, long-term provisions. Any kind of provisions which are of long-term nature, then you present under non-current liabilities. And what is provision? Basically, we have discussed in Accounting Standard 29, sir. So provision is basically a liability, sir, which is measured by substantial degree of estimation. Liability is what, sir? Present obligation arising from past event, the settlement of which requires outflow of resources. Any provision for warranty, any provision for, generally provision for tax is a current liability, current provision, sir. I mean short-term provision. Short-term provision. Because it is required to be settled within 12 months. Any provision for guarantee. So all these provisions we will show under which head, sir? Long-term provisions. And sir, see, any provision we created on assets, AS 29 says provision is basically a liability. If you create a provision on liability, then you will show in the balance sheet under the head equity and liabilities, either as a long-term provision or short-term provision. If the provision is for the long period, more than 1 year, the liability to meet after 1 year, it's a long-term provision. If it is to settle the liability, if it is to meet the liability within the next 12 months, it is short-term provision, basically short-term provisions. But sometimes you create any provision on the assets, like for example, any provision for doubtful debts you create on the debtors, any provision for depreciation or any provision for diminution in the value of investments. See, these are all provisions which are created against assets. So when you create any provision against asset, sir, what you need to do is you need to show them as by way of deduction from that particular asset. You cannot show them as a part of liabilities. So they will be shown as a reduction from the concerned asset, not on the liability side. Understand this. So that's why, sir, provision for doubtful debts we will show. From debtors we will reduce it. We will not show under the head long-term provisions or short-term provisions. Okay. So actually you will discuss, I mean you will understand more about the provisions in Accounting Standard 29. But as of now you remember provision is a liability basically. Provision is a liability. Only provision created to meet the liability will come under here in the liability side. If you create any provision on the asset, that will be shown by way of deduction from that particular asset. Don't show it as a long-term provision or short-term provision on the liability side because they are not liabilities. They are created on assets. Now come to current liabilities, sir. In current liabilities, what is the first one? Short-term borrowings. So short-term borrowings means the classification. So short-term borrowings are classified like loans repayable on demand from banks, from other parties. Any loans repayable on demand, whenever other party demanded, we need to pay. Those are obviously short-term borrowings. Any loans and advances from related parties. So if they are not fitting into non-current, then current liabilities. Any deposits taken from public for 12 months or below. Any other loans and advances. Now the same points which is applicable for long-term borrowings, even for short-term borrowings are also applicable. Like even short-term borrowings are also classified as secured, unsecured. If they are secured, we need to specify what is the nature of security we have given. And if any of the short-term borrowings are guaranteed by directors, what is the aggregate amount of such guarantee given by them? And if there is any default in payment of any short-term borrowings, what is the period and what is the amount of default, including interest, we need to disclose. And also, sir, here one of the most important is current maturities of long-term borrowings. Disclose current maturities of long-term borrowings separately. Under that, short-term borrowings. Listen to me carefully. Suppose there is a liability, sir. That liability is basically which liability? Long-term borrowings. For example, debentures. Suppose a company issued debentures, 10% debentures, 100 lakhs for 5 years. So basically this is what? Long-term borrowings. But suppose it is due to be settled in the next 12 months. Then this is called current maturities of finance lease, current maturities of long-term borrowings. Say this. So these current maturities of long-term borrowings we need to show as a part of short-term borrowings. Important. And also suppose company has taken a loan. In that loan, whatever the amount due to be settled within the next 12 months. For example, company has taken a loan. Total 10 installments. Every year we need to 2 installments are due. So that means from this year end, next 12 months, 2 installments due. Each installment is 10 lakhs. So therefore 20 lakhs is what, sir? Short-term borrowings, which is current maturities of long-term borrowings. Basically that's a long-term borrowings. But in that long-term borrowings, what is the amount due in the next 12 months? Current maturities. That is comes in short-term borrowings. So this is very, very important, guys. Please understand. So how short-term borrowings are classified? This is the manner. So any loans repayable on demand, any loans and advances from related parties, deposits, even if you find loans and advances from related parties in long-term borrowings also. But you need to see the period. If it is for 12 months, then here. More than that, then there, long-term borrowings. And additional points are same. But the most important point is this. Any long-term borrowings, if it is, what is the amount due to be settled within next 12 months? So that comes under this current short-term borrowings. And next, any trade payables, total outstanding dues of micro, small enterprises, total outstanding dues of creditors other than micro and small enterprises, so separately. And short-term provisions, any provision you made for to meet the liabilities in the next 12 months. Any provision for tax, provision for warranty, next 12 months. If it is for a long period, it will comes under long-term provisions. And then other current liabilities. So what items will come in other current liabilities? Very, very important, sir. Other current liabilities is a residual category, sir. Say this. Current maturities of finance lease obligation. Suppose if you taken any asset on finance lease, in according to that lease, whatever the liability you need to pay. So long-term maturities of finance lease obligation, where we will show? Long-term maturities of finance lease obligation, we will show as a part of long-term borrowings. But current maturities of finance lease obligation, where we will show? We will show as a part of other current liabilities. Actually, I don't know what is their intention, sir. They have made one change, but they have forgot to make another change, sir. Actually, what they are saying, any current maturities of long-term borrowings, you need to treat it as a part of short-term borrowings. That's correct only. But when it comes to lease obligation, finance lease obligation, whatever the current maturities are there, they are still classifying under other current liabilities only, which I think which they are going to change later. So as of now, the position is current maturities of finance lease obligation, other current liability. Don't consider it as a part of short-term borrowings. Current maturities of long-term borrowings, they will comes under short-term borrowings. And long-term maturities of finance lease obligation comes under where? Long-term borrowings. But current maturities of finance lease obligation comes under other current liabilities. So this is the important point you need to remember. This current maturities. So lease payments, if it is finance lease, basically long-term borrowings. Suppose if the payments, whatever we are going to pay within next 12 months, then current maturities of finance lease obligation, other current liabilities. Suppose if it is bonds and debentures, basically long-term borrowings. If they become due for payment in next 12 months, then they will be considered in short-term borrowings as a current maturities of long-term borrowing. Next, any interest accrued but not due on borrowings. Interest accrued but not due. That means by the end of the year, interest accrued but due date not yet came. For example, company issued debentures worth of 10 lakhs and interest is payable on two times in a year, 30th June, 31st December. Okay, due dates. Now you are preparing financial statements for 1st April 2024 to 31st March 2025. Now, when you are on 31st March 2025, sir, when you prepare the financial statements, already interest is accrued for 3 months. Because last time interest was paid on 31st December. So January, February, March, already 3 months are over. Now for the 3 months, if I calculate the interest, it is 30,000. What is this 30,000, sir? Interest accrued, sir, but not due. Interest accrued but not due. That means by the end of the year, whatever the interest accrued but not due, so that will comes under where? Other current liabilities. Interest accrued and also due. By the end of the year, interest already accrued and due date also came. That is also other current liabilities because you have not yet paid. Next, any income received in advance. Suppose from customers, if any income is received in advance, but no delivery of goods taken place. So by the end of the year, whatever the income received in advance, say liability to you, other current liability. Any unpaid dividends, any dividends which is not paid by the company, unpaid dividend, part of other current liabilities. And also any application money received for allotment of securities and due for refund and interest accrued. Sir, suppose we have received application money, sir, but allotment not yet done. Allotment already done, sir. And whatever the excess money we received, sir, we need to refund it back to the shareholders. Or for example, application money received, sir, and but only we have done the proportionate allotment. Therefore, the applications we have rejected, application money relating to that, we need to refund it now. So any kind of that application money due for refund at the end of the year, so show it as other current liability. And also unpaid mature deposits and interest accrued there. Unpaid mature deposits already matured, due date came, and you have not yet paid, other current liability. And also any interest accrued on them. And also unpaid mature debentures and interest accrued. So all these things are part of other current liabilities. Other current liabilities. Okay, so this is I think we have completed the entire discussion relating to liabilities. So liability side we have completed, sir. Next, come to asset side, sir. Non-current assets, first property, plant, equipment, then intangible assets, then capital work in progress, then intangible assets under development. Next, non-current investments, deferred tax assets, long-term loans and advances, other non-current assets. In the current investments, we have current assets, we have current investments, inventories, trade receivables, cash and cash equivalents, short-term loans and advances, other current assets. Let us see the asset side one by one. What are the requirements as per schedule 3? First, property, plant, equipment. Land, buildings, plant and equipment, furniture and fixtures, vehicles, office equipment, all these things we need to disclose separately. Suppose if you take any asset under lease, so that is also to be disclosed separately. See, in accounts, sir, we don't see the legal ownership. We will see the substance or form. That means even if an asset is taken on lease basis, still we can recognize it as our asset, because you have to see the substance. Who is enjoying the control over that property? Who is controlling the benefits of that asset? If the entity is controlling the benefits, then that asset will be our asset, we will recognize in the books. That is what substance over form, which is discussed in accounting standard 1. That's why you may get a doubt, sir, why an asset is taken on lease will be our asset? Because you need to see here, even though asset is taken on lease, we don't have the legal ownership, but we are able to control the future economic benefits. If you read the framework chapter, there they have defined what is asset. What is asset? Asset is a resource controlled by an enterprise from which we are expecting future economic benefits. So therefore, if any building is there, I have taken on lease basis. Now, physically that building is there with me. I am enjoying the risks and rewards of that building. I am controlling the future economic benefits of that building. I am controlling the use of that building. Therefore, it is my asset. Even though legally I am not the owner. So therefore, when you are presenting schedule 3, you need to give backup of all the assets one by one. And also, sir, in schedule 3, you need to give the reconciliation, sir. That means for each asset you take, each class of asset you take, what is the opening gross value, what is the opening net value, what changes happened during the year, like additions, sales, any depreciation, any impairment, and also revaluation, and also what is the closing gross value, closing net book value, all these things you need to present separately. So in schedule 3, that's why relating to each class of assets here, we need to present the entire reconciliation statement. Reconciliation of the gross and net carrying amounts for each class of assets. Like what are the additions happened during the year? What are the disposals? Business combination acquisition. Business combination means amalgamations, mergers. See, in India, they call it as business combinations. Actually, in India, the name for amalgamation is business combination. So if you acquire any assets and liabilities by way of acquisition from another company, so they are also additions now. So they will also be included to that particular asset. So that will also be part of the reconciliation statement. And what are the revaluation changes? If any asset is subject to revaluation. So if it is 10% or more of the net carrying value, if the revaluation impact, then that need to be presented separately in the gross reconciliation statement. Any other adjustments like depreciation, impairment losses, so related depreciation, impairment losses, reverses, including all these things relating to each class of asset, we need to present the reconciliation statement as per schedule 3. And also now come to the intangible assets: goodwill, brand, trademarks, computer software, mastheads and publishing titles. What is masthead? Title of the newspaper. So the publishing titles, nothing. Title of the newspaper, publishing titles. These are all intangible assets for that particular company. Any mining rights, any copyrights, patents, other intellectual property rights, any recipes, formulas, models, designs, prototype. Prototype is initial model which we have designed. Any licenses and franchises. All these, whatever the intangible assets we had, we need to give a breakup in the schedule 3. And similar to tangible fixed asset, in relation to each intangible asset, each class of intangible asset, we need to prepare a reconciliation statement reconciling the gross and net carrying amounts at the beginning and at the end, showing all the additions, disposals, business combination, acquisitions, any revaluation changes, any other adjustments, show related depreciation, impairment losses and reversals, all these things. Now comes to non-current investments. Non-current investments. Investments are basically two types, sir. One is current investment, another one is non-current investment. We have separate standard also according, accounting standard 13. So trade investments, other investments, sir. Okay. So trade investments, other investments, and which are classified as investment property. What is investment property? Investment in land or buildings, not for the purpose of using in the business, but for the purpose of capital appreciation or for the purpose of getting benefits. That is investment property. That will become our investment as per accounting standard 13, investment property. So investment property is always non-current investment. So here investment property means investment in land or building, not for the purpose of business use. Sorry, not for the purpose of enjoying so investment property means land or building, sir, for the purpose of using in the business. No, for the purpose of getting the benefits out of it, income. That equity, preference, government or trust securities, debentures, bonds, mutual funds, partnerships, wherever we have investments, all the investments we need to classify. And suppose if you have any investment in a company, corporate body, what is the name of the company? What is the relationship type? Whether it is our subsidiary, associate, a joint venture, a controlled special purpose entity. What is the nature and amount of investment in each company? And separate details of partly paid of investments. So we need to disclose. In respect of investment in partnership firms, every company has to disclose what is the name of the firm, who are all the names of the partners, total capital of the firm, each partner share in the capital, we need to disclose. Why, sir? Because see, here schedule 3 is trying to, they want company to disclose investments where they are putting their money. For example, look at the partnership firm. Suppose a company invested in a partnership firm. Why this company has invested in this partnership firm? What is the reason for this investment? Maybe managing director's son or managing director's relative is there in that partnership firm. So the company is investing in that particular partnership firm. Maybe this is not that much beneficial. It is not in the, beneficial interest, in the best interest of the company. There is a chance. Suppose a company invested in another company, but in that another company, maybe managing director's wife is also one of the director or one of the main person there. That's why we have invested in that company. Maybe this is not beneficial to our company. So there is a chance that a fraud might happen here. So the biggest internal control is disclose. So that's why schedule 3 says whatever the investment you are making, so from your company to another company or in a partnership firm, we want this information to be disclosed. Like for example, name of the firm, which firm you are investing, what is the name, and name of the partners, who are all the partners of this partnership firm. Then people will get to know, users will get to know, oh, these are the people involved in this partnership firm. MD son is there, that's why they are investing. Is it in the best interest of the company? See, schedule 3 is not saying that investment in partnership firm where MD or company, directors related parties are there. They are not saying it is wrong, but they are saying that it's an internal control. You need to disclose it. That's it. Whether some fraud happened or not, that's a secondary issue. But at least you try to disclose all these things. Total capital of the firm and what is the share of the each partner. And suppose if you are carrying any investments other than at cost, what is the basis for valuation? On what basis you are valuing these investments other than at cost? You need to disclose it. And also you need to make some additional disclosures in the financial statements relating to investments, like what is the aggregate quoted investments and market value thereof, listed company investments if you make, and what is the aggregate cost of this quoted investments and what is the market value. If it is an unquoted investment, just aggregate unquoted investments. Market value is not required here. And also what is the provision for diminution in the value of investments. Suppose if your company has created any provision relating to the value of investments because your investment value is falling down, you created a provision, disclose that provision. So these are all the points we need to make disclosure in non-current investments. Okay. And then long-term loans and advances, any loans and advances which is given by the company, like capital advances, loans and advances to related parties, other loans and advances. Sir, relating to capital advances, sir, first of all, what is capital advance? See, capital advance means any advance which is given by the company for acquisition of capital assets, like fixed assets. For example, a company wants to purchase a plant and machinery, sir, and this plant and machinery is 10 lakhs cost, sir. So they paid an advance of 10 lakhs. Now, where they will show this 10 lakhs? As a part of long-term loans and advances, capital advances at the end of the year. So capital advances to bank, when actually plant and machinery was acquired, plant and machinery to capital advance to bank. Okay, this is capital advances. So long-term loans and advances include capital advances, loans and advances to related parties, subsidiary, parent, associates, joint venture. If any loans and advances given by us, we'll disclose it, and also other loans and advances. And now, sir, most important thing, sir, Schedule 3 says the long-term loans and advances. The long-term loans and advances are subclassified like this: secured considered good, unsecured considered good, doubtful. Subclassification: secured considered good, unsecured considered good, doubtful. If you see Schedule 3, sir, asset side, long-term loans and advances, other non-current assets, which also comes in non-current assets, trade receivables, debtors, which comes in current assets, short-term loans and advances. For all these 4 items, assets, what are all? Long-term loans and advances, other non-current assets, trade receivables, short-term loans and advances. Same subclassification is applicable. What is that? Secured considered good, unsecured considered good, doubtful. What is secured considered good? Suppose you are giving loans and advances, you have taken any asset on security basis, and you are expecting payment from the party, other party. That is called secured and and good. Next, unsecured but considered good. That means, see, you have given loans and advances, but you have not taken any loans and advance. You have not taken any asset as a security, but you are expecting payment from the customer based on the previous history of that customer. That is called unsecured but considered good. Last one, doubtful. Doubtful means whether it is secured or unsecured or put aside, we have a doubt whether the payment will be collected from the other party or not. That will be categorized as third. Therefore, understand, in respect of long-term loans and advances, other non-current assets, trade receivables, short-term loans and advances, this is the subclassification we need to do. Very, very important. Secured, considered good. How much is secured and good, considered good? How much is unsecured but considered good? How much is doubtful? We need to disclose. And also, sir, relating to other long-term loans and advances, if any bad and doubtful debts is there, relating to that, any allowance for bad and doubtful loans and advances is there, you please disclose them separately. Any loans and advances which become bad, so which you are doubting whether they will be collected or not, so just create a provision. That provision you write separately. And also any loans and advances owed by directors or officers. For example, company has given a loans and advances to any of the directors, any of the officers, any amount is owed by them at the end of the year, we need to disclose separately. So loans or advances owed by the directors or other officers should be listed separately. And also, most important point, sir, amounts due from the firms or private companies in which a director or a partner is a director or a member should also be shown separately. See, any amount of loans dues from a partnership firm or a private company, here only private company, in which director is a partner, our director is one of the partner in that partnership firm, or a director In that company, our director is also one of the director or a member. We need to disclose separately. For example, our company ABC Limited, sir. For example, yeah. Suppose our company is ABC Limited, sir. In our ABC Limited, one of the ABC Limited, our company, in that our MD is Mr. A. Okay. Now, Mr. A is also a director in XYZ Limited. XYZ Limited. And Mr. A is also one of the director of this XYZ Limited. Now, this ABC Limited has given a loan to this XYZ Limited. Will you disclose it separately? The answer is no, because it's a public company, XYZ Limited. Here they are saying only private companies. So, any private company in which your director is also a director or a member, if you given any loans and advances, you need to disclose them separately. Or a firm, partnership firm. Any partnership firm in which that partnership firm, your director is also one of the partner. From them, any amount is due to you. So you need to disclose separately. Okay. And then other non-current assets. In current assets, we have first, so PPE, intangible assets, capital work in progress, intangible assets under development. Next, non-current investments. We have seen the investments breakup, deferred tax assets net, then long-term loans and advances. Next, other non-current assets. In that long-term trade receivables, basically trade receivables is part of current asset. But if it is long-term in nature, any receivables on deferred credit terms, then it comes under other non-current assets. Basically, see, trade receivables is part of current asset. But if it is not satisfying the definition of current asset, if it is long-term in nature, then long-term trade receivables will come under non-current assets. In non-current is where other non-current asset, that is what? Other non-current asset. Any security deposits made by the company will also come under other non-current asset. Same subclassification. Like long-term loans and advances, I told you, other non-current assets also, secured considered good, unsecured considered good, doubtful. Any allowance for bad and doubtful debts, we need to disclose separately. Any amounts, debts owned by directors or other officers, we should disclose separately. Any debts owed by the firms or private companies in which our director is a partner or a director or a member, we should disclose separately. Okay. Next, sir, come to current assets, sir. Current assets, first one is what, sir? Current investments. So current investments, see this. Current investments are equity, preference, government or trust securities, debentures, bonds, mutual funds, any partnership firms, any other investments, same name of the company, type of investment, nature and amount of investment, and separate details if investment is partly paid up, what is the basis of valuation, any quoted investment, that means if you invested in any listed company securities, what is the amount and market value of investment, unquoted, no need of market value, just the total amount, cost of investment, any provision for diminution you created, what is the amount for depreciation or loss of value. Suppose if you invested in a partnership firm, what is the name of the firm, partners names, total capital of each partner share in the firm, all these things you need to disclose. And then inventories, sir, which is also part of what, sir? Current assets. Inventories, basically, raw material, work in progress, finished goods, stock in trade for trading. Suppose if you are a trader, whatever the goods you are purchasing and selling, that is stock in trade. So that is also part of your current assets, inventories. Any stores and spares, any loose tools. So all these are what, sir? Inventories you need to disclose. And goods in transit, sir. If any goods are in transit at the end of the year, that is also our inventory, sir, but we need to disclose it separately. And we need to disclose in notes to accounts what is the mode of valuation we are following for inventories, like how the inventories are valued. Generally, we will value the inventory by AS2, cost or NR, whichever is lower. Now, trade receivables. Basically, trade receivables, I told you, will come in current assets. If it is long-term trade receivables, it will come in other non-current assets. Sir, relating to trade receivables, sir, every company has to prepare a aging schedule. See this. Trade receivables aging schedule, very, very important, sir. See, relating to trade receivables, sir, you need to classify the amounts into less than 6 months outstanding, 6 months to 1 year, more than 1 up to 2, more than 2 up to 3, more than 3 years. Like this you need to classify. So less than 6, sir. 6 to 1 year, sir. 1 to 2, 2 to 3, more than 3. These are the periods, and classification is like this. So undisputed, considered good. Undisputed, considered doubtful. Disputed, considered good. Disputed, considered doubtful. So remember this classification, guys, relating to trade receivables. So tell me, what is the classification relating to trade receivables? Undisputed trade receivables but considered good. Next, undisputed trade receivables but considered doubtful. Next, disputed category. First, there is no dispute regarding the amount and we are expecting the payment. That is first combination. Undisputed, considered good. They are undisputed. There is no dispute between the parties and we are expecting the payment also. And they are undisputed, but we are expecting, they are doubtful whether the amount will be collected or not. And then period. See, for how much period they are outstanding. This category, this you need to prepare. This is called debtors aging schedule. And also doubtful, disputed trade receivables but considered good. See, there is a dispute whether this will be dispute with the particular customer, debtor, but we are expecting the payment. Considered good. Dispute is there but doubtful. So like this 4 categories we need to classify, and we need to prepare the aging schedule relating to trade receivables as per schedule 3. And also, sir, cash and cash equivalent, sir. This is also part of current assets. So you need to classify balance with the banks, checks, drafts on hand, cash in on hand, others. Specify the nature and other cash equivalents, and any earmarked balances with banks. Like for example, any amount specifically there in the bank account for a specific purpose, those are called earmarked balances with banks. Those are also we need to show separately. For example, separate statement for earmarked balances like unpaid dividend. For example, as per the Companies Act, sir, if a company declares the dividend but it has not paid the dividend, so any unpaid balance is there, that will be kept in a separate bank account, that is unpaid dividend account. So that means there is a cash balance in the bank account, but that is kept for particularly for one purpose, that is called earmarked balance. So that we need to disclose in the notes to accounts. And also any balance held as margin money or security. See, generally when you take any loans and advances from the bank, sir, bank will ask you to deposit certain security amount or margin money. Now, any kind of margin money or security money is there. Your money is there with the bank as a margin money or security money, that we need to disclose separately in the notes to accounts. So, separate disclosure for balances held as margin money or security against borrowings, guarantees, all these things. Any repatriation restrictions. Repatriation restrictions means, suppose for example, any cash balance, any amount in the foreign country, and if there is any restrictions, repatriation restrictions means restrictions for bringing the amount back to India. So if there are any restrictions are there, we need to disclose those restrictions. For example, we have a branch account, we have a branch in Ukraine, for example. In the we have a branch in Ukraine, sir. There in the bank account we have, suppose for example, 1 lakh US dollars, for example. Now, if there are restrictions relating to that 1 lakh dollars, so which is our money only, our cash only, but there is a repatriation restriction. So therefore, any repatriation restrictions are there, we need to disclose separately in the notes to accounts. So, and also bank deposits with 12 months maturity. So separate disclosure for bank deposits with maturity greater than 12 months. So any money is there with the bank with a maturity of more than 12 months. So that we have to disclose it separately. So our money is there in the bank account which is matured for more than 12 months. So that is to be disclosed as a part of cash and cash equivalent. So these are the points we need to disclose, sir. Now short-term loans and advances, same. Any loans and advances to related parties, any other loans and advances. And sub-classification also, secured, considered good, unsecured, doubtful. Any bad and any allowance for bad and doubtful loans and advances we need to disclose separately. And any loans and advances owed by directors or officers, so disclose them separately. And any loans and advances owed by the firms or the private companies in which our director is also a partner, or our director is also one of the director or member. Now those kind of disclosures also we need to make. And finally, other current assets. In current assets category, we have specific, like for example, current investments is there, inventories is there, trade receivables is there, cash and cash equivalent is there, short-term loans and advances is there. Now, apart from that, if any other asset is there, then you include in the other current assets. If you observe, sir, liability side, asset side, there is a specific category called others. It's a residual category where you will disclose all the residual items which are not fitted into the specific category. They will come under others category. And then contingent liabilities and other commitments, sir. Contingent liabilities. Accounting standard 29. Sir, contingent liability means a liability which does not have a present obligation. So, which may become a liability in future, which we don't know. That depends upon the future events, which is not in our control. For example, any claims against the company not acknowledged as debt. Anyone filed a case against our company claiming some amount. But as of now, we don't know whether it will be a liability or not. Depends upon the court judgment. So, it's a contingent liability. Generally, contingent liabilities are not part of financial statements. And also any guarantee is given. For example, I am a subsidiary company, I am a parent company. We have given a guarantee to any bank on behalf of subsidiary. Now, suppose if in future subsidiary company does not pay the amount, we need to pay the amount. So, liability may come or may not come. As of now, we don't know. That's why it's a contingent liability. And also any other money for which the company is contingently liable. And then there is a concept called commitment. See, please understand contingencies and commitments. What is this commitment? Commitment means company has given a promise or company has planning to do some kind of investment in future. That is called commitment. It is not yet done. These are the future commitments. For example, company wants to open a branch or company wants to spend 100 lakhs for acquisition of plant and machinery. These are all commitments. The things which company will perform in future. So any kind of commitments is there. They are also be disclosed in the notes to accounts, but they are not assets. Please understand. First, estimated, see this, estimated amount of contracts on capital account remaining to be executed and not provided for. Any, what is the remaining promises we need to do under any contract. Any uncalled liability, this one is important. Uncalled liability on partly paid up shares for shares and other investments partly paid up. Please see, students will confuse in this point, sir. What is this uncalled liability on partly paid up shares for shares and other investments partly paid up? See, for other investments partly paid up, see, here they are talking about if our company invested in any other company, if our company invested in shares of any other company, if that other company calls the amount, we need to pay now. So that is called commitment. That is called uncalled liability on partly paid up shares. For example, we purchased 1 lakh shares in other company, 10 rupees. 5 rupees only paid. Remaining 5 rupees, whenever that company calls, we will pay. That is called commitment. So, or other shares and other investments partly paid up. So, when we invest in any other company, relating to those investment, whatever the unpaid balance is there, when other company calls, we will pay. So, that is called commitment. So, these are contingent liabilities and commitments, sir. So, this is complete balance sheet, sir. Next, come to P&L account, sir. Quite easy, sir. You know, P&L account consists of two parts, incomes, expenses. First, revenue from operations, then other income, then total income, then expenses. You see, first, cost of materials consumed, purchase of stock in trade, changes in inventories of finished goods, work in progress, stock in trade. So, first 3 items are relating to what? Inventories. Inventories, sir. So, whenever you are preparing the financial statements, P&L accounts, sir, very, very important thing is inventories. Say this. Suppose if I am a manufacturer, sir, you know, you have raw material, you have work in progress, you have finished goods. Suppose if I am a trader, I have stock in trade. If I am a trader, I have stock in trade. Because if I am a trader means what? I will purchase the items and I will sell it. I don't manufacture. So therefore, if you are a manufacturer, generally you have raw material, work in progress, finished goods. But if you are a trader, you have only stock in trade. So therefore, suppose we are talking about a manufacturer. You have raw material. Now relating to raw material, we have what? Opening balance of raw material, purchases during the year. Raw material will be purchased during the year, closing balance. Therefore, relating to raw material, we can find out the cost of materials consumed. How much is the raw material we consumed during the year? That will be shown in the P&L account. How to find out this consumption? Simple. Opening plus purchases minus closing. You will get consumption. So this is the first item. Say this. In the P&L account, First item is cost of materials consumed. That means they are talking about raw material. Raw material consumed. How much is the raw material consumed? Opening stock plus purchases minus closing balance. Now next, work in progress finished goods. So relating to work in progress finished goods, we have opening balance and closing balance. Because we don't have purchases now, because I am a manufacturer, I will produce the goods. At the end of the year, if the goods are completely finished, we call it as finished good. If they are under process, we call it as work in progress. So relating to work in progress and finished goods, we have opening balance, closing balance, opening balance, closing balance. So any difference between opening and closing balance is called change. Change in inventories of finished goods, change in inventories of work in progress. See this, change in inventories of finished goods, work in progress. And now we completed about manufacturer. So if you are a manufacturer, relating to you need to present raw material, work in progress, finished goods. Relating to raw material, you need to show consumption, cost of material consumed, opening plus purchase minus closing. Relating to work in progress and finished goods, you need to show the difference between opening and closing. So because see, in as per schedule 3, you are not preparing T-shaped balance sheet, trading account, debit side purchases, opening balance, credit side closing balance, not possible. So that's why directly the difference between opening and closing we are showing directly as change in inventories of work in progress and finished goods. Now come to the trader. If you are a trader, sir, that means you have what? You have opening balance of stock in trade, purchases during the year, closing balance. Show the purchases separately. So that's why in schedule 3 you see purchase of stock in trade is there. You see this. This is absolutely applicable to whom? Trader. And now in the stock in trade, purchases we will show separately. The difference between opening stock in trade and closing stock in trade, we will show it as change in inventories. So that is about inventory, sir. Now you got the clarity. Manufacturer, trader. If you are a manufacturer, raw material, work in progress, finished goods. If you are a trader, only stock in trade. Relating to stock in trade, purchases during there show separately. And the difference between opening and closing show separately. Change in inventories of stock in trade. See this. And if you are a manufacturer, raw material consumption, you show first item. Changes between the finished goods, work in progress, you show separately. And after that, employee benefit expenses, all kind of payments made to the employees, finance cost, interest, depreciation and amortization expenses. Then other expenses, total expenses. So total revenue minus expenses, you will get profit before exceptional, extraordinary items and tax. Exceptional items, adjust, then profit before extraordinary items and tax, extraordinary items, profit before tax, then tax expenses, current tax, deferred tax, and then finally you will get profit or loss for the period. Then EPS, basic EPS, diluted EPS. And when you are preparing the financial statements of a company, sir, some additional information is there. Any item, either income or expenditure, if it is exceeding 1% of revenue or 1 lakh, whichever is higher, exceeding 1% of revenue or 1 lakh, disclose it separately. Very, very important. And any payments made to the auditors, disclose separately. Any CSR expenditure, disclose separately. Any exceptional, extraordinary items, disclose separately. Prior period items, disclose separately. We need to give detailed breakup of manufacturing, trading, service companies inventory. Any work in progress, give the breakup. And any major expenditure items like stores, power, fuel, rent, repairs, insurance, rates and taxes, disclose separately. Any dividend received and provisions for losses from subsidiary companies, disclose separately. Any cryptocurrency or virtual currency investments, disclose separately. Okay. And see, we have one practical question, sir. This question is, they have asked it so many times, sir. What is this question? Say this question. The management of Loyal Limited contends that work in progress is not valued since it is difficult to ascertain the same in view of the multiple processes involved. Their opinion that the value of the opening and closing work in progress should be more or less the same. Accordingly, management had not separately disclosed work in progress in its financial statements. Comment in line with Schedule 3. First of all, try to understand the area belongs to this question. Which area this question belongs? They are talking about work in progress. Work in progress means inventory valuation. If you are a manufacturer, you need to show what relating to work in progress. Just now I told you, relating to work in progress, we need to show the change. Change means change in opening and closing balance of work in progress. But here they are saying that this work in progress balance mostly there is no difference between the opening and closing. So that's why they are not disclosing it separately. Whether they are correct, correct only. Schedule 3 says you need to present the change in inventories of work in progress. That means what is your opening work in progress? 10 lakhs. What is your closing work in progress? 20 lakhs. So the difference of 10 lakhs is there. You disclose it. Suppose if the difference is not there, if the difference is immaterial, then no need to disclose separately. So Schedule 3 to the Companies Act does not require that amounts of work in progress at the beginning and at the end of the accounting period to be disclosed in the statement of P&L. Only change in inventory, change in inventories of work in progress need to be disclosed. Schedule 3 never says disclose opening work in progress, closing work in progress separately. No sir, only directly the difference we will show separately. And that too, the difference should be there. Na? Suppose see, non-disclosure of such change in the statement of P&L may not amount to violation of Schedule 3 if the difference between the opening and closing work in progress is not material. So if the opening and closing work in progress is not material, then what is the need to disclose it separately, sir? And also, sir, see this question. Suppose there is a company Sumedha Limited, sir. They have taken a loan from the bank 10 lakhs, settled within 5 years in 10 equal half-yearly installments with interest, sir. First installment is due on 30th September 2011, 1 lakh. Determine how the loan will be classified in the preparation of financial statements of Sumedha Limited for the year ending 31st March 2011. See this, 31st March 2011 according to Schedule 3. Sir, I told you any current maturities of long-term borrowings will be shown under the head short-term borrowings. So totally how many installments? 10 equal installments, half-yearly installments. So that means every year 2 installments are due. Now you are at the end of 31st March 2011. So by the end of next year, 31st March 2012, how many installments become due? 2 installments. Therefore, current maturities of long-term borrowings. Basically, this 10 lakhs is a long-term borrowings because you have taken loan for 5 years. In that long-term borrowings, how many installments are fall due in the next 12 months? 2. Therefore, 2 installments into each installment 1 lakh rupee. So therefore, 2 lakhs will be what? Short-term borrowings. Sir, what about remaining 8 lakhs? Remaining 8 installments. 8 installments into 1 lakh. They are long-term borrowings. Long-term borrowings. So therefore, in the balance sheet on 31st March 2011, 8 lakhs long-term borrowings, 2 lakhs short-term borrowings. Okay. So that's it, sir. And there is a one question relating to provision, sir. This also I have discussed. And also a question relating to trade receivables aging schedule, sir. I told you, no, sir, debtors aging schedule we need to prepare. And how debtors will be classified? Secured, considered good, unsecured, considered good, doubtful, all these things. And now the dividend concept, sir. See, company can give dividend from the current year profits or from the previous year profits. But important, sir. Whenever company wants to give dividend from the past profits, there are certain rules, sir. Declaration and payment of dividend rules. Important. Listen to me carefully. They may ask a question from this. There is a question relating to it. See, whenever company wants to give dividend from the past accumulated profits, sir, Companies Act has some conditions relating to it. What are the conditions? First, the rate cannot exceed the average of the last 3 years. Last 3 years rate cannot exceed, sir. Whenever company wants to give any dividend from the past accumulated profits, so the rate of dividend cannot exceed average of the last 3 years. Yeah. So whenever company wants to give dividend from the past accumulated profits, so what are the first conditions, sir? Rate cannot exceed average of the last 3 years. First condition. Second condition, how much amount company can use from the past accumulated profits? The amount to be drawn should not exceed, see this, 1/10 of the paid up share capital plus free reserves as per the latest audited financial statements. So whenever company wants to utilize, for example, company wants to give dividend from general reserve. So the amount cannot exceed, the amount to be utilized cannot exceed 1/10 of paid up share capital plus free reserves. And also one more condition, sir, the balance in the reserves after such withdrawal cannot exceed or shall not fall below 15% of paid up share capital. So these are the 3 points you need to remember, sir. You need to apply while solving the question also. So one is the rate of dividend cannot exceed average of the last 3 years. and the amount to be withdrawn from the past profits cannot exceed 1/10 of the paid up capital plus free reserves as per the latest audited financial statements, and the balance in the reserves after such withdrawal shall not fall below 15% of the paid up share capital. You see, in the study material we have one illustration 1, sir. In that question, if you see, company wants to give dividend from the general reserve, that means past profits. Why company wants to give dividend from the past profits? Maybe current year profits are not sufficient or current year profits are not there. But in spite of that, company wants to give dividend from the past profits. So that's why they are putting restrictions here. See, in the name of dividend, you cannot, divert all the funds of the company, right? So therefore, actually, if you are suffering losses or if you are not earning proper adequate profits, but still you want to give dividend to the shareholders, we will put restrictions. Otherwise, the company funds will be misutilized. Now, in that question, company wants to give dividend from the general reserve. How much dividend they want to give? 8 lakhs. But net current year profit is 3 lakhs. And in this 3 lakhs, first, if you have any preference shares, you need to give preference dividend. In that question, there is a preference dividend. So we give preference dividend. Then we left with only 1,42,500. That means 8 lakhs is the dividend requirement, but we have profits of 1,42,500. Therefore, how much amount I want to withdraw from the past profit? 6,57,500. Now I need to check whether it is allowed or not. First condition I will see. Rate of dividend. The rate cannot exceed last 3 years average. In that question, sir, the rate of dividend declared is less than the average rate of last 3 years. So condition 1 is satisfied. Condition number 2 says, sir, how much amount you can withdraw from general reserve is 1/10, that is 10% of the paid up capital plus free reserves. In that question, the paid up capital plus free reserve. Paid up capital means equity plus preference both, and free reserves. It will be 12,25,000. But I want to withdraw only 6,57,500. So condition number 2 is satisfied. And last condition, what is the balance in reserves after such withdrawal? See, actually, general reserve 25 lakhs is there. If I withdraw 6,57,500, the balance is 18,42,500. And if I calculate 15% of my paid up share capital, it comes to 14,62,500. That means the balance in my general reserve after withdrawing 6,57,500 is 18,42,500, which is minimum of 15% of paid up share capital. Therefore, condition 3 is satisfied. Therefore, here all the 3 conditions are satisfied. Therefore, company can withdraw 6,57,500. So this is the dividend concept, sir. So whenever a company wants to give dividend from the past profits, the rate cannot exceed the average of the last 3 years, and the amount to be withdrawn cannot exceed 1/10 of the paid up capital plus free reserves, and the balance in reserve after such withdrawal shall not fall below 15% of the paid up capital. See, these 3 conditions are practical and relevant conditions. Okay, that's it. So this is the dividend concept, sir. If at all they will ask a question, they will ask this question, sir. Illustration 1 is there, sir. Same kind of questions they will ask. So that's it, sir. That's it. Financial statements of company chapter. So major thing is schedule 3, sir. Learn the format, and relating to each items, what disclosures we need to make, learn it. So this chapter will be done. So I have touched each and every point, sir. You just listen to this 1 hour 50 minutes video. You will get the entire clarity. And this much is sufficient, sir. You directly solve the questions which is there in the study material. Don't try to solve all the questions, sir. So try to solve 3 or 4 questions relating to the balance sheet. Maybe one question relating 2 or 3 questions including P&L account, balance sheet, and relating to dividend 1 or 2 questions is there. Solve it. That's it. Instead of leaving this chapter completely, sir, it is better you cover this 1 hour 50 minutes video. So, and then use it. Actually, in the regular class, it will take around 15 to 20 hours to complete this chapter. So we completed it in 1 hour 50 minutes. Okay. Hope you are enjoying this class. So please, communicate what your feedback is relating to this chapter. Okay. Thank you. Now let us begin cash flow statements chapter. Accounting standard 3, which is exclusively deals with cash flow statement. If you see the past examination papers, sir, from this chapter they are asking a very basic level questions. Last time also they have framed one case scenario based question which you can easily answer even if you have the basic knowledge relating to cash flow statement. So a very scoring chapter, so you have to listen to me carefully. It won't take much time. So let us begin discussing cash flow statement. First of all, what is cash flow statement? You know, cash is one of the crucial item for any business organization, right? So therefore, proper analysis must be done in relating to the cash flows. So that we will do through a statement called cash flow statement. So basically the cash flow statement contains all the inflows and outflows of the cash. And here we are going to group all the cash flows into three categories: operating, investing, financing. And by categorizing them into these three categories, we will try to analyze the cash flows. So basically cash flow statement is what? Cash flow statement is an additional information that contains the inflows and outflows of the cash of an enterprise during the particular accounting year. Sir, why it is called additional information? Because see, every organization will have a cash book, cash account. There all receipts and payments will be there. But is it sufficient for decision making? No, because they're all directly receipts and payments we are going to write, but no categorization, no segregation of information for decision making. So in cash flow statement, what we will do is we will group the cash flows. Flow means here either inflow or outflow, cash inflow or cash outflow. We will categorize them into three categories: operating, investing, financing. And of course, that is very important for decision making. So that's why cash flow statement is one of the important statement for decision making for the business organizations. And you know, one more important point, cash flow statement is also one of the components of financial statements of a company. Like balance sheet and P&L, cash flow statement is also very important. Is also one of the component of financial statements. You know, when any company wants to take a decision, they will take balance sheet, they will take P&L account. Of course, they will take cash flow statement also. That's why cash flow statement is also included as a part of financial statements. In fact, it has to be learned in financial statements of companies only, but we are going to learn, we are learning this as a separate chapter. Okay. And basically CFS shows the changes in cash and cash equivalents by categorize them into operating, investing, financing activities. What is operating, what is investing, what is financing? Of course, we are going to cover. Very important. Sir, purpose. Sir, why we are preparing the cash flow statement? Sir, in order to determine the liquidity position of the organization, in order to know the solvency position of the organization, in order to know how much an organization is generating cash and cash equivalents, and what is the ability of the organization to meet its future requirements. See, for all this analysis, cash flow statement is important. That's why we are preparing this, right? So to evaluating the company's liquidity position, whether it is in a position to meet all of its expenses, earnings quality. See, this is very important. To determine the quality of the earnings. For example, I will show you. I will give you one example, sir. Suppose, there is a company, its opening and cash and bank balance is 50 lakhs. Closing cash and bank balance is 100 lakhs. Now tell me, by looking at this, what is your impression? Opening cash and bank balance 50, closing cash and bank balance 100 lakhs. So that means there is an increase in cash and bank balance by 50 lakhs, right? Net increase. But you don't know for which reason this 50 lakhs has been increased. Simply because of increase in the cash balance. Can you say this company is performing better? No. So by looking in the balance sheet, you know the opening cash and bank balance, we know the closing cash and bank balance. By comparing them, can you get any useful information for decision making? The answer is no. So for that, you need to make little bit analysis. So that is possible only through cash flow statement. So to decide the earnings quality, suppose for example, here in this case, the company has taken a bank loan. Because of that bank loan, the closing cash balance has increased by 50 lakhs. This 50 lakhs, whatever the cash and bank balance increased because of the bank loan, not because company is generating any profits. So therefore, quality of earnings. Suppose if you don't earn the profits, if there is no quality earnings for the organization, how long an organization will sustain? So therefore, this cash flow statement will give you a clear-cut idea. What is the earnings quality of the organization? What is the sources from which the company is generating the sufficient cash? Is it through our operations? Is it through our borrowings? So is it through share capital? So that you will know through this cash flow statement. So that's why to decide the quality of the earnings, cash flow statement is important. And also the solvency, whether company is in a position to meet all of its liabilities. So all these things we know through cash flow statement. That's why cash flow statement is very important. And sir, AS3 requirements. See, understand, This cash flow statement is not required for small entities, sir. It is required for big companies, like for example, non-SMCs, other than small and medium-sized companies. And also, whereas a non-corporate entities is concerned, it is applicable only for level 1 enterprises. So, AS3 is mandatory for non-SMCs and level 1 enterprises. But for others, it may be encouraged. If they want to prepare, they can prepare. Nobody is going to stop them. And important things, sir, exemptions. If you are a OPC, one-person company, small company, dormant, inactive company, and private companies, startups, you are not supposed to require to prepare the cash flow statement because we don't want to burden you. So you are an initial startup company or a small company, one-person company, your cash flows are very less. Then what is the need to make analysis? For you, cash book is sufficient. Whatever the receipts and payments you are writing in a cash book, you look at that, take the decisions. You are not required to group them into operating, financing, and investing and take proper decisions. That much analysis is not required because you don't have that much cash flows. That's the idea. Now, this changes in eligibility, sir. Sir, suppose for example, last year I am eligible, sir. I am eligible because I am either level 1 entity, non-corporate, or corporate. I am a non-SMC, so I require to prepare the cash flow statement. Suppose this year I may not require to prepare the cash flow statement because I am not in the eligible category. So I am not required to prepare the cash flow statement. Now the question is whether I can enjoy automatic exemption from preparation of cash flow statement. The standard says no. Last year you were eligible to prepare compulsorily. This year suppose you may be exempted, but we are not giving exemption straight away. So once you from eligibility to non-eligibility, 2 years you need to continue to prepare the cash flow statement. So if the company is required previously but no longer qualifies, they must continue preparing the statement for 2 consecutive years. Understand? And also, sir, suppose last year I am not required to prepare the cash flow statement. Sir, this year I am required to prepare the cash flow statement. Definitely you have to prepare the cash flow statement. But whether I need to give comparative information, no need to. No need to give any comparative information because when you are preparing the financial statements, balance sheet, P&L account, cash flow statement, generally along with the current year data, we need to present the previous year figures also. But for you, this year only you got eligibility to prepare the cash flow statement. Last year you are not eligible to prepare the cash flow statement, so no need to present the previous year data. So if company was not required, prepare the cash flow statement in the previous year but qualifies this year, no need to show previous year data. What are the benefits or uses of cash flow statement? So we discussed it now. So in order to, determine the solvency position, liquidity position of the organization, and also what is the ability of the organization to generate cash and cash equivalents, and what are the future requirements of cash and cash equivalents, what is the amount, timing, and certainty of the future cash flows an organization is generating, and especially what are the historical changes happening in the cash and cash equivalents, and compare the operational efficiency. So suppose for example I am Zomato, I want to compare with my Swiggy, right, my competitor. So therefore I will see the cash flow statement of Swiggy. I will compare with Zomato. How much is the cash flows from operating activities? How much they are generating from the operations? Suppose they are generating much more than me. Now they will analyze where they are getting benefited, where they are generating more cash flows. So where they are doing better. So where I am lacking. So for that operational efficiency I can compare. So I can easily compare my efficiency with other enterprises by looking at the cash flow statement also. See, most of the students or most of the professionals doesn't know how to use cash flow statement for decision making. Actually, they will take only P&L account and balance sheet. For me, if you understand properly, sir, instead of P&L account and balance sheet, if you look at the cash flow statement, sir, straight away you can understand the operational efficiency. Straight away you can judge the performance of the company better, because the real cash, how much inflow, outflow are generated by this organization, and because of the which activities. This will give you the clear cut picture where you are lacking behind when comparing with your competitors, or where you are move forward better than the competitors. So these are the benefits or uses of cash flow statement, and it's an excellent planning tool, sir. So whenever you want to plan any cash budgets, suppose a company wants to go for any expansion, or they want to replace the existing plant and machinery, how much cash they require, how much present they are generating, all these things they should know now. For that, this is a planning tool. So cash flow statement will help you as a tool for making your plans for the future. And Meaning of the important terms used in cash flow statement. Sir, in the cash flow statement, we are going to use certain terms. First term, cash. What is cash? See, cash includes cash in hand, demand deposits with banks and other financial institutions. So whatever the cash right now physically is there in the organization, that is cash. And also demand deposits. What is demand deposits? Deposits which can be withdrawn any point of time. So without any prior notice, without required to pay any penalties. I can withdraw anytime without any prior notice. So with banks or with other financial institution, demand deposits. So whenever I demand, I can get it. Right? That is also cash. For example, an organization is having a bank account. In that bank account, some cash is there. So it's a cash because it can be withdrawn any point of time. So therefore, cash includes cash in hand, demand deposits. Demand deposits are those deposits which can be withdrawn any point of time without any prior notice. Now, one more important keyword which we use in cash flow statement is cash equivalent. So wherever cash word used, we will use cash equivalents also. Cash and cash equivalents. So this standard has considered even cash equivalents are also at par with cash. So both basically cash and cash equivalents are considered in the same bracket, same group. Okay, first of all, what is cash equivalent? Understand carefully. They are saying that cash equivalents are short-term, highly liquid investments which are readily convertible into known amounts of cash, subject to insignificant risk of change in value. So what is cash equivalents? Cash equivalents are short-term, highly liquid, that are readily convertible into known amounts of cash and subject to insignificant risk of change in value. So this, not significant, insignificant risk of change in value. That means your principal is not in danger. So there is no risk of change in your value. That is called cash equivalent. So basically cash equivalents are what? Investments. Which investments? Short term. Here short term means 3 months or less. So maturity within 3 months of the acquisition is called short term. Highly liquid. Highly liquid means anytime I want to sell in the market, ready-made market is available. So highly liquid investments, readily convertible. If I want, I can convert into what? Cash. And is there any risk, sir? Absolutely. Subject to insignificant risk of change in value. So there is no risk of my principal. So what is cash equivalent, sir? Investment. Which investment, sir? Short-term investments. Short-term means maturity period of 3 months. Highly liquid, sir. Anytime I want, I can convert into cash. Readily convertible into known amounts of cash, subject to insignificant risk of change in value. Now I am going to ask one question. You have to tell me. Suppose I invested in equity shares. Investment in equity shares. Can you tell me, is it cash equivalent? Investment in equity shares, is it cash equivalent? The answer is yes or no. See, for example, we purchased equity shares of a company, sir. Our intention is to hold it only for 1 month. So very short term. Short term means 3 months. Here only 1 month we want to hold. Whenever I want, I can easily sell these shares in the market. Ready-made market is available. But the question is it subject to insignificant risk of change in value? The answer is no. Because shares you are purchasing now always subject to risk. Especially equity shares are subject to significant risk of change in value. Today morning I invested 1 lakh. By the time 3 o'clock the trading closes, it becomes 80,000, 20,000 gone. That means significant risk of change in value. Therefore, it is not a cash equivalent. So the intention of the standard is very clear, sir. What is cash equivalent? Risk-free investment, that too for very short period of time. You can convert into any point of time. That is called cash equivalent. Like for example, treasury bills, money market instruments, any short-term bonds with a maturity period of 3 months or less, government securities, money market instruments. So these are all what? No risk of principal, very short term, right? 3 months or less. Then you can consider them as a part of cash equivalents, and it is at par equal with cash. That's why cash and cash equivalents. So understand, Because when we are discussing about investing activities, all the investments made by the company will generally categorized into investing activity, except if it is fit into the category of cash equivalent, they say. So therefore, first you should understand what is cash equivalent. Basically, cash equivalent is what? Investment only. But that investment characteristics are what? Maturity 3 months or less. Insignificant risk of change in value. Then instead of considering it as an investing activity, show it as a part of cash equivalent. Okay. Next note, investment in shares are not cash equivalents because uncertainties associated with them as to the realizable value. So obviously investment in shares, especially equity shares. I'm not saying preference shares. Maybe preference shares, for example, you purchased. Suppose if they are going to mature within the next 3 months. So highly liquid. So insignificant risk of change in value generally. Then they can be classified as cash equivalent. Next, CFS exclusion. Sir, when you are preparing the cash flow statement, sir, the important thing is there must be cash involvement. Suppose there are certain items, there is no cash flow, there is no inflow, there is no outflow, then you should not consider it. Best example is depreciation. Depreciation is what? Non-cash items. So therefore, it will not come in cash flow statement. So in cash flows, we consider only the inflows and outflows of cash and cash equivalents. But any transaction does not result in cash flow should not be reported in the CFS. Common sense. And sir, suppose movements between the cash and cash equivalents, they are also not cash flows. For example, amount to deposit in the bank, amount to withdraw from the bank. So that means whether cash in hand, cash at bank, both are cash only, na? So there is a cash inflow, there is a cash outflow. No, movements between the cash and cash equivalents are not considered as cash flows. So movements between the cash and cash equivalents are not cash flows. Suppose cash deposited into bank are not cash flows. So these are the important definitions here. So two important definitions. One is cash, another one is cash equivalents. So hope you understood the definition of cash equivalent. Okay, next. The most important thing in this chapter cash flow statement is classification of cash flow activities. Listen to me carefully. Sir, as I told you, in cash flow statement, all the cash activities, cash flow activities are grouped into 3 categories. One is operating, another one is investing, another one is financing. So this classification is given in accounting standard 3. Say this. Classification of cash flow activities: operating, investing, financing. Like this, they have divided into 3 categories. Now let us understand the one by one activity. First, operating activity. Sir, what is this operating activity? These are principal revenue generating activities of the enterprise. Principal revenue generating activities of the enterprise, and also any cash flow activities which is not fit into the investing and financing also comes under operating activity. So operating activity is basically two things. One is principal revenue producing activities. Second one is residuary category. Suppose there is a cash flow which is not fitting into the investing activity, which is not fitting into the financing activity, then you consider it under the operating activity. So what is operating activity? These are principal revenue generating activity. Sir, what is your principal revenue generating activity? Suppose I am a pharmaceutical company. Manufacturing medicines and selling them is my principal revenue generating activity. Suppose I am a furniture manufacturer. Manufacturing the furniture and selling them is my principal revenue generating activity. So your principal revenue generating activity will come under this operating activity. Not only that, any other activity relating to cash that are not investing or financing activities, sir, which is not financing, which is not investing. Sir, which items will come? That you will understand only you know about investing and financing. So let's wait. So first we complete the other 2 also. Then we will know which items are not fitting into the investing and financing. Obviously, see, in examination, suppose if you are unable to decide this activity belongs to operating and investing or financing, damn sure either it must be investing or financing. So if you are confident, then you classify under the respective activity. Suppose if you are unable to classify it, obviously take it into the operating activity because it's a residual category, right? So operating activities are principal revenue generating activities of the enterprise and any activities that are not investing or financing activity. See, I have given some examples also. Say this, for example, cash from sale of goods and services, So we are selling goods and services, sir. Obviously, sale of goods and services is a cash flow from operating activity. And any cash from royalties, fees, commission, and other income. Any royalties. Generally, royalties are associated with what? Associated with our intellectual property rights, our manufacturing rights. So therefore, they are also operating activities. Any fees, technical fees we collect, commissions we receive, and other incomes, generally they are all operating activities. And also any cash paid to suppliers for goods and services. Understand, here cash flow means either inflow or outflow, both will be covered. And any cash paid to the employees, we are paying salaries to the employees. Why we are paying salaries to the employees? So definitely since they are engaged in the operating activities of the organization, so we are paying the cash. So salaries and wages we are paying to the employees. And any cash from insurance premiums, claims, annuities, and other policy benefits we are receiving. And any cash paid or refunded for income taxes unless linked to investing or financing. Very good. Sir, tax expenses, sir. You paid tax, the company paid tax. Which activity? So generally operating. Suppose if the tax is relating to investing and financing activity, then you classify under the respective category. But nothing told, just told income tax paid, operating. Then cash from futures, forward, options, swaps for trading purposes. See, for example, I'm a trader. I entered into the forward contract, option contract, swaps, futures. So for me, all these are my operating activities. And also cash from buying or selling securities held for trading. See, suppose I'm a trader. What I will do? I will purchase and sell the shares and securities. So for me, whatever the amount collected, whatever the amount paid for purchasing and selling of the shares is my operating activity. And also cash advances and loans provided by financial institutions as a part of their core business. For example, I'm a bank, sir. I have given loans. So which activity? Operating activity. So on the loan, we have received the interest. That is also operating activity. For example, I'm NBFC, sir. I have given a loan. Operating activity. Right? So please understand. So for what is your principal revenue activity? From that activity, whatever the cash flow is there, that is categorized under the operating activity. Not only that, if you are unable to classify any cash flow under investing and financing, then obviously it has to be fit into the category of operating activities. Next, investing activities. What is investing activities of the enterprise? Listen to me carefully. See, investing activities are nothing but acquisition and disposal of long-term assets and other investments that are not classified under cash equivalents. So basically in investing activities, we cover what? Purchase and sale of assets and purchase and sale of investments also. But understand, they will not be classified as cash equivalents. Suppose if any investment is classified as cash equivalent, then it will not be classified under investing activity. Right? So please understand. That's why cash equivalent definition we understood now. Short-term highly liquid investments which is readily convertible into known amounts of cash, subject to insignificant risk of change in value. So suppose for example investment in money market instrument, treasury bills, all these I told cash equivalents, right? So once any investment is fit into the cash equivalent definition, then it cannot be classified under investing activity. So say this, investing activities are what? Acquisition and disposal of what? Long-term assets and other investments that are not considered cash equivalents. For example, purchase of plant and machinery, sale of plant and machinery, purchase of furniture, sale of furniture, self-construction of asset, anything relating to the assets, fixed assets, either inflow or outflow comes under this category. Not only that, investments. For example, a company invested in shares of other entity. Obviously, that is not cash equivalent. Therefore, it comes under investing activity. Now, from the shares, the company received dividend. That is also investing activity. Please understand. If a particular activity belongs to a particular category, the corresponding revenues and expenses of that activity will also categorized under the same category. For example, investment in equity shares is investing activity. From that equity shares, if dividend is received, that is also investing activity. That is also investing activity. So, for example, we invested in debentures of other company. Investment in debentures. Which activity? Investing activity. From the debentures interest received, that is also investing activity. So therefore, investing activity basically means our resources is going out. Our resources basically going out. See, when we put our money in other company securities or other securities, that is investing, or in assets, that is investing activity. And from that investment, whatever the income we are generating, that is also investing activity. So all kinds of acquisition and disposal of long-term fixed assets and also other investments which are not fitting into the cash equivalents, then they comes under the investing activity. Suppose any cash payments to acquire fixed assets, including intangible, self-constructed, capitalized R&D expenses, R&D assets, any asset, fixed asset, any cash received from selling property, plant equipment, intangibles and long-term assets, any cash paid to acquire equity, debt instruments or interest in joint ventures, excluding cash equivalents or trading instruments. See this, cash paid to acquire equity, debt, interest in joint ventures, even investment in joint ventures is also investing activity. Any cash received from selling equity, sale of investments, debt instruments and also interest in joint venture. Of course, if they are classified as cash equivalents or trading instruments, then they will not be considered, because if it is for trading purpose, that investment comes under operating. Okay, if you are a trader, you make any investment, that is your part of your operations, that is not investing for you. Now, any cash paid to loans and advances to others, important sir. Suppose sir, company has given a loans and advances to other entity, that is also investing activity now. Of course, if I am a bank or a financial institution, giving loans and advances is my principal revenue generating activity. So therefore, it comes under operating activity for me. Next, any cash received from loans and advance repayment. For example, parent company has given a loans and advances to subsidiary company. Now, investing activity. Subsidiary company repaid the loans and advances. That is also investing activity. Any loans and advances. Suppose, sir, one company has given loans and advances to employees. Sir, giving loans and advances to employees is part of operations. So, it's a operating activity. Please understand. And any cash paid for futures, forward options, swaps, except when held for trading or financing. Understand. Suppose a company entered into forward contract, future contract. I am not a trader. I am not doing in the course of trading. Therefore, for me, it is an investing activity. And similarly, any cash received from sale of those futures, forwards, options, swaps. If I am not held it for trading or financing, then it comes under investing activity. So basically, what items will come in investing activities, sir? Any purchase and sale of fixed assets, purchase and sale of investments. From these investments, whatever the incomes, dividends, interest we receive, everything will be covered under this investing activity. Okay. Basically, you need to remember whether resources are going out, yes, then it's an investing activity. Now, the last one is financing activity. See, what is financing activity? Accounting Standard 3 says, financing activities are those activities which result in change in the size and composition of owner's equity, including preference share capital and borrowings of the enterprise. To put it simply, sir, all kinds of borrowing activities, whether it is shares, whether it is debt, whatever, all kinds of borrowings, all kinds of share related activities, cash involvement relating to this comes under financing activity. So any activity that results in change in the size, amount and composition of owner's capital, say this, including preference share capital. That means all activities involving cash relating to shares and borrowings of the enterprise comes under this category. For example, a company has taken a loans from bank. Which activity? Financing activity, because it's a borrowings. Borrowings. For example, a company issued shares. Which activity? Financing activity. See, understand. A company invests in other company shares. That is investing. A company issued its own shares. Issued shares. Financing activity. And suppose buyback of shares. Financing activity. Issuing of shares, financing. Buyback is also financing. For example, a company issued preference shares. Financing activity. A company purchased preference shares of other company. Investing activity. Now, company redeemed the preference shares. Which activity? Financing activity. Because issuing preference shares, financing. Redemption, financing. Please understand. Sir, when one item comes under the particular category, the reversal will also comes under that activity only. Please understand. So here students are confusing, sir. That's why I'm stressing here. Listen to me carefully. Sir, please understand. When You are the company. You are issuing shares. That means you are collecting the money from outside. So it's a financing activity. When you invest in other company, suppose you purchase shares of other company, it is investing. Your money going out. So understand the difference between investing and financing. In investing, our resources are going out. In financing, sir, basically we are collecting the resources from outside. How? By issuing shares. Equity shares, preference shares. Maybe company issued debentures. Issuing debentures, which activity? Financing activity. Debentures is a borrowings, right? Company issued debentures, somebody subscribed it, they paid the amount to the company. So it's a financing activity. Suppose your company invested in debentures of other company, then investing activity. Your money is going out. And also, for example, sir, very, very important point. You invested in shares of other company, sir. That company declared the dividend, so you received the dividend. Which activity? Investing activity. Suppose you issued the shares, it is which activity? Financing activity. On your shares, you paid the dividend. Which activity? Financing activity. So therefore, dividend paid by the company, financing activity. Because dividend is paid to whom? Our shareholders. We pay dividend to our shareholders, right? So if you are the shareholder of other company, then for you, that is investing activity, dividend received from other company. But you declare dividend to your shareholders, paid dividend to other shareholders, then definitely it's a financing activity. Financing activity. Please understand. So basically financing activities are what? Any activity that results in change in the size and composition of owner's capital, including preference share capital. Company issued preference shares, financing activity. Company redeemed preference shares, financing activity. Company received dividend from preference shares. Received dividend means how you receive dividend? When you make investment, right? So it's an investing activity. Suppose company declare dividend to its preference shareholders, financing activity. Financing activity. And borrowings of the enterprise. Suppose company taken a bank loan, which activity? Financing activity. On that loan, company paid interest, financing activity. Suppose company repaid the loan, financing activity. So I think now you should be able to clear-cutly distinguish between investing and financing. So here students are lacking clarity. That's why I'm stressing these points. So when you invest your money outside, when your resources are going out, investing. So dividend received, investing activity. Dividend paid means to whom you pay dividend? Your shareholders. So collecting share capital, issuing shares is a financing activity. Obviously paying dividend is also financing activity. Loan taken, financing. Repayment of loan taken, financing activity. Right? So therefore, understand this. So look at these examples. Suppose cash received from issuing shares or other equity instruments. Suppose a company issued shares or other equity instrument. Cash paid to owners to acquire or redeem the entity shares. Suppose redemption of preference shares. Buyback of shares. These are all financing. Cash received from issuing debentures. Suppose company issued debentures. Financing activity. Loans. Financing activity. Notes, bonds, mortgages, any kind of borrowings, financing activity. Cash repaid on borrowed amounts, financing activity. Cash paid by lessee to reduce the outstanding liability on finance lease, financing activity is a borrowing. Any asset is taken under finance lease, AS 19 says it's a liability to you. As a lessee, it is my liability. That's why at the inception of the lease, if it's a finance lease as a lessee books, if you understand AS 19, so initial recognition, you need to recognize the asset as well as the lease liability, right? So that means it's your liability. So liabilities comes under which activities? Financing activities. So this classification is very, very important. So tell me, as per accounting standard 3, so cash flow activities are divided into how many categories? 3 categories. What is the first one? Operating activity. What is operating activities? These are the principal revenue generating activities of the enterprise. Any activity which is not fit into the investing and financing activity. Next, investing activity means any activity involves acquisition and disposal of long-term fixed assets and other investments not classified as cash equivalents. Then financing activities. What is financing activity? Any activity that results in the change in the size and composition of owner's capital, including preference share capital. That means any activity which is changing either the amount or the composition. Composition means mix. Capital structure is changing. That is also financing activity. And borrowings, financing activity. So therefore, these are the important. Now, sir, you tell me, in the operating activity, principal revenue generating activities, and also any activity which is not fit into the investing and financing is also comes under these other activities, right? So can you tell me now, what are the examples they will come here? For example, a company paid a penalty for violation of law. Penalty paid for violation of law. Which activity? Operating, investing, financing? Sir, penalty paid for violation of law by the company, not investing, not financing. It is not relating to acquisition and disposal of fixed assets. It is not relating to capital and borrowings. Obviously, it is operating. So that's how you need to classify. So therefore, if a particular item is there, if it is not investing, if it is not financing, then fit into the category of operating. Because see, they are given only 3 categories, right? So there may be some items which may not fit into any one of these definitions. Obviously, they have to classify under one residual category must be there. Like in the P&L, in the balance sheet as per schedule 3, you see non-current liabilities, we have others, other non-current liability. Current liabilities, you see, you have other current liability. Why they use the word other category? Because they know they can categorize only some specific items, specific heads. But there could be number of heads, number of expenses a business organization may incur. So it is not possible to provide specific heading for each and every item. That's why they included in assets as well as liabilities other categories there. Similarly, in cash flow statement also, there can be n number of cash flows. Cash inflow or outflow can be because of different transactions. See, nowadays, the business enterprises are entering into so many kind of different transactions never imagined 20 years back, 30 years back. Because the complexity of the business now, because of the technology, because of the latest developments, the way the businesses are carrying now, so the complexity of the transactions are increasing day by day. That's why the role of the chartered accountant is also very important here. Okay, now, so we have discussed the different cash flows. Now, special items I am going to discuss, sir, because when you are solving the question, these special items are very helpful. First, loans and advances given and interest earned. See here, I have categorized into 2 categories: non-financing, financing. Non-financing, financing. Non-financing means I am not into the business of financing business. Financing entity means the company which is engaged in financing, like banks, financial institutions. Their main job is, principal business is giving loans and advances, making investments. Those are called financing entities. Suppose I am not a financing entity, I am a normal commercial entity. Like for example, Tata Motors, Reliance Industries Limited, like that, non-financing entity. Now think from the point of view of non-financing entity as well as financing entities. Okay, first, any loans and advances given and interest earned on them. Basically, the topic is what? Loans and advances given. Please understand. Loans and advances given and interest earned on them. Loans and advances given and interest earned. Okay. In the ordinary course of the business, tell me, suppose if you are a financing company, okay, suppose you are a bank. In the ordinary course of the business, whatever the loans and advances you have given, which activity? Operating activity, because this is principal revenue generating activity, right? For example, if you are a non-financing entity, okay, say this, loans and advances given and interest earned on them. If you are a non-financing entity, in the ordinary course of the business, you are not going to give loans and advances because that is not your principal activity. But still, suppose if you are a non-financing entity, you are giving loans and advances to other entities. Possible. Different things are possible. See, you can give loans and advances to other entities. Like in the, previously I told one example, a parent company has given loans and advances to subsidiary. It's an investing activity generally. For a non-financing entity, giving loans and advances and earning interest on them is a investing activity. Okay. Suppose the same thing is given here. See this, loans and advances given to subsidiaries and interest earned on them. Which activity? Investing activity. Investing activity. And also suppose loans and advances given to employees and interest earned on them. Sir, tell me, sir, why company will give loans and advances to employees? Definitely it is part of the organization policy, operating activity. So therefore it's an operating cash flow. Everybody, see, please understand, if you are a financing entity or non-financing entity, giving loans and advances to employees is an operating activity. Advance payment to suppliers. For example, a company paid advance to its suppliers, either for goods or for services. Definitely it's an operating cash flows for every entity. For example, I am Tata Motors, I am purchasing tires, right? MRF tires I am purchasing. So that means I have given advance for my supplier. So which activity? Operating activity. Suppose I am a bank, for example. We have given advance payment for the classmate for stationery purchase. Now that is also what? Operating activity. For a bank, giving advances to its suppliers and see, maybe you may earn interest on advances you have given. That is also comes under which activity? Operating activity. Because suppliers is part of the operating cycle. And similarly, sir, any interest earned from customers for late payments. Suppose we sold goods to customer, they're giving 3 months credit period, sir. But he has taken 5 months time. That means 2 months extra he has taken and we charged some interest. So therefore, whatever the interest earned from the customer, operating activity. Because sale of goods, which activity? Operating. Interest earned for late payment by the customer, operating activity. For a bank or for non-financing or financing activity, whatever. It's an operating cash flow. And also suppose, sir, if you are giving loans and advances, if you are a non-financing entity also, it's an investing activity. For example, SBI is there, parent company. Suppose it has given a loans and advances to its a subsidiary company. Tell me which activity? Investing activity. Sir, you told bank given loans and advances, operating activity. Now you are saying investing activity. Come on, yaar. This is in the ordinary course of the business. In the ordinary course of the business, bank given a loans and advances is an operating activity. But not in the ordinary course of the business. Whether parent company will give loans and advances in the ordinary course of the business to subsidiary company? Might be, but see, here that is not the intention. The intention is these are not given loans and advances in the ordinary course of the business, like how the bank is giving to its customers. So the loans and advances given by the bank to its customers is an operating activity. But any loans and advances given by the bank, because bank is also one kind of one company, sir. Suppose it's a parent entity, it has given loans and advances to subsidiary, that is comes under investing activity. So what are the notable points here you need to understand? If you are a financial entity, any loans and advances given by you is a operating activity in the ordinary course of the business. And if you are a non-financial entity, generally loans and advances given by you is a investing activity. But understand, if loans and advances given to employees, operating, loans and any advances given to suppliers, operating, any interest received from the customers, operating. Because debtors, creditors, employees, they're all part of the operating cycle. And of course, needless to say, when a particular item is classified under the particular category, the interest corresponding will also classified under that category only. Next. So loans and advances given, completed. Loans and advances taken. Interesting. Come. Loans and advances taken. When you take loans and advances, you pay interest also. Okay. Suppose if you are a financing entity, bank, they're giving loans and advances, taking loans and advances in the ordinary course of the business. See this. Loans and advances taken and interest paid in the ordinary course of the business by a bank, by a financial institution, operating activity. Sir, I am not financial institution, sir. I am a normal company, normal commercial entity. I am not doing any financing business. Now, for me, whatever the loans and advances you have taken, it's a borrowing. So it's a financing activity to you. Financing cash flow. Okay, sir. Sir, I am taking loans and advances from my subsidiary, sir. Subsidiary. Sir, if you are a parent entity taking loans and advances from your subsidiary, whether you are a financing entity or non-financing entity, doesn't make any difference, sir. It's a financing activity. It's kind of a borrowings. And any advance taken from customers. From customers, we'll take advance, sir. Which activity? Operating. And for financing entity, taking advances from the customers may not be possible. How banks will take advance from customers? Is there any possibility? Of course, maybe, I don't know. So operating cash flows. That's why I have given only for non-financing entity. So any loans, any advance taken from the customers and interest paid on them. It's a operating activity. And also any interest paid to suppliers for late payment. So operating. And also interest taken as a part of inventory cost in accordance with A16. Very, very interesting point, sir. Sir, if you read accounting standard A16, sir, they are talking about qualifying assets, right? What is qualifying asset according to A16? Qualifying asset is an asset which takes substantial period of time to get ready for intended use or sale. So sale, they have used the word sale also. That means you produce inventories for sale, right? Therefore, inventories can also become a qualifying asset if it takes substantial period of time to get ready for intended use or sale. So if your inventory is a qualifying asset, A16 says borrowing cost directly related to acquisition, construction, production of qualifying asset is capitalized. Therefore, if interest is included in the inventory cost, obviously it is an operating cash flow. Are you understanding what I am speaking? See, interconnection with accounting standard 16. If you learn accounting standard perfectly, sir, see, in my classroom, I have explained it in a detailed manner. So understand, suppose there is an inventory. For example, you are a manufacturer of a car, for example. Now, suppose your car is taking substantial period of time to get ready for intended use or sale. It's a qualifying asset. Therefore, whatever the borrowing cost which is directly related to acquisition, construction, production of your inventory will be capitalized. Sir, tell me, if interest cost is included as a part of inventory, that means you are considering it as a part of operating activities only, because inventory is part of your operations. So therefore, operating cash flows. So therefore, what are the notable points here? Any loans and advances taken and interest paid. So if you are a financing entity, in the ordinary course of the business, whatever the loans and advances you have taken, operating activity in the ordinary course of the business. And for a non-financing entity, taking loans and advances in the ordinary course is not there. Whenever they require, they will take loans and advances. It's a financing activity for them, borrowings. And suppose you have taken loans and advances from subsidiaries, always financing for any category of organization. Advance taken from customers, operating for any kind of organization. Interest paid to suppliers, operating for any kind of organization. Of course, here there can be inflow or outflow. If the money is going out, outflow. If the money is coming, inflow. But definitely it's a cash flow. Under which category? Respective category. You need to understand that. And suppose any interest which is already included in the part of inventory cost, operating activity, because inventory is part of operations. So that means 2 important special items we have completed, sir. Next, investment made and dividend earned. Very interesting, sir. Listen to me. Sir, I am a financing entity. I will make investment in the ordinary course of the business. For example, I am investing company. I will purchase shares, debentures, I will invest in bonds, whatever. Investments in the ordinary course of the business, whatever the investment I will do. It's an operating activity for me. And for non-financing entity, is it in the ordinary course of the business they will make investments? No. So for them it is investing cash flows. So any investments made and dividend earned on them, it's an investing cash flow. For example, we invest in shares. One company invested in shares of other company. If it is not fit into cash equivalent, then it has to be categorized under investing activity. Which activity? Investing activity. But for a financing entity, making investment is their principal activity. Therefore, for them, it is operating. And suppose you invested in subsidiaries and dividend earned on them. Obviously, we know now investment in subsidiaries is a investing activity. Any loans and advances given to subsidiaries also investing. Loans and advances taken, financing. Similarly, any loans, any investment in subsidiary, purchasing shares in subsidiary and dividend earned, it's an investing cash flow. Very interesting, sir. Dividend paid. Here students confusing, sir. Sir, I told you. Remember, sir, dividend paid means to whom you are paying the dividend. Your shareholders. Issuing shares, which activity? Financing. That's it. It is always financing, sir. Always financing. Sir, I am a financing company, sir. I am bank. I paid dividend. For what? What the difference? Tell me. If you are a bank, you also pay dividend to your shareholders only, na? So bank, suppose SBI is there, sir. State Bank of India. It has issued shares. Which activity? Tell me. Financing activity. Issuing shares is a financing activity. On that shares, they have paid the dividend. Which activity? Financing activity. Sir, SBI invested in other company shares, sir. Which activity? Investing activity. Sir, from that other company shares, we receive dividend, sir. That is investing. See, you pay dividend to your shareholders only. So, it's a financing activity for any enterprise. Even your principal objective is investing in other company. Suppose, students are confusing here. Sir, suppose I am ICICI Bank, sir. Okay, ICICI Bank purchased. Okay, ICICI Bank issued shares. Now, this ICICI Bank paid dividend on its shares to its shareholders. Which activity? Dividend paid. Financing activity. You cannot say, sir, ICICI Bank is a financing entity. For them, investing in shares is their principal activity. Whether they are investing here, they are issuing shares. It's a financing activity. Basically, it is not investing activity. So, therefore, when you pay dividend, the meaning is when you are paying dividend means you are not paying dividend on investment. How can you pay dividend on investment here? Common sense. You receive interest from dividend. Correct. When you make investment, you receive the income, either dividend or interest. So dividend paid means you are paying on your shares. So always it's a financing activity. Remember, income tax, sir, which activity? Generally operating. But if you are able to classify under investing or financing, then you need to classify under the respective category. For example, you are selling the asset. Sale of asset, fixed asset, which activity? Investing activity. Suppose on that sales you paid capital gains tax, income tax. So the tax is also which activity? Investing activity. Investing activity. So therefore, suppose for example, you are taking a bank loan, or for example, you issued debentures, right? And to debenture holders, you are paying interest. At the time of payment of interest, you are deducting tax. So that means tax is here relating to what? Financing activity. Because you are deducting tax on the interest payment to debenture holders. So therefore, interest paid is which activity? Financing activity. So therefore, that's what here I have given. If segregation of income tax is possible, classify it accordingly. If segregation not possible, then operating activity. Obviously, operating. Next, insurance claim received. Sir, suppose for example, there is a loss of stock, sir, or there is a loss of fire, sir, and we have received insurance claim, sir. Which activity? Operating. Because loss of stock is part of operations, and also loss of profits, which is also directly linked to operating activities of the enterprise. Operating. Sir, suppose fixed assets destroyed, sir. We have received insurance claim. Fixed assets basically which activities? Investing. So insurance claim received against loss of fixed assets is also investing. And there is a concept called extraordinary items. If you look at AS5, we have a concept called extraordinary items. So what is extraordinary item? Basically, extraordinary items means any incomes or expenses which is arising from activities which is clearly different from the ordinary activities of the enterprise. That's why they are called extraordinary. They are not expected to occur regularly, and definitely whenever there is an extraordinary item, we need to show separately so that users of financial statements will perceive the financial position. I mean, how the financial statements are getting affected by these items, we need to present separately. So that's why AS5 says you need to present extraordinary items into extraordinary items separately so that users will understand the impact of these items in the financial statements. Similarly, when you are preparing the cash flow statement, sir, if any cash flow is relating to the extraordinary items as per AS5, you also make an effort to show them separately so that users will understand the impact of these extraordinary items perfectly. Sir, why they need to be disclosed separately? Because these are extraordinary. Extraordinary means something which is not happening in the ordinary course of the business. So they are once in a while activities. Therefore, you make an effort and disclose them separately so that the impact will be understood. Because next year, whether this impact may not be there. For example, every day you are making sales. So it's not an extraordinary activity. But for example, fire happened, you received insurance claim. So happening fire, receiving insurance claim may be extraordinary. Or for example, you received any government grant, may be extraordinary. Something which is not happening in the regular course of the business. Or maybe you are giving refund of the government grant. And if you see extraordinary items, we have discussed elaborately in accounting standard 5. So AS3 requires separate disclosure of extraordinary cash flows, separate disclosure, inspired from accounting standard 5. Okay. So that's it. These are the special items. So now presentation of cash flow statement. So ultimately we have understood what is cash flow statement, why cash flow statement, and we also understood in cash flow statement the cash activities are divided into 3 categories: operating, financing, investing, financing. Then we need to understand how the cash flow statement will be presented. Okay, look at this cash flow statement, sir, how the presentation happening, and this is the major presentation, sir. First, cash flow from operating activities, one category. Second, cash flow from investing. Third, cash flow from financing activity. Like that, 3 categories. And then find out the net increase or decrease in cash and cash equivalents. A plus B plus C. Suppose cash flow from operating activities 100 lakhs. Cash flow from investing activities minus 50 lakhs came. Why minus 50 lakhs? Maybe outflows are more than inflows. Possible. Obviously, negative amount will come. Cash flow from financing activity, for example, 70 lakhs. So therefore, can you tell me what is the net increase or decrease? 100 lakhs, 70 lakhs, 170 minus 50. 120 lakhs is what? Net increase in cash and cash equivalents. So during the year, because of the cash flow activities, there is an increase in cash and cash equivalents of 120 lakhs. And what will be the opening cash and cash equivalents? For example, opening cash and cash equivalent is 70 lakhs. Or for example, opening cash and cash equivalents is 80 lakhs. 80 lakhs. So what will be the closing cash and cash equivalents? 200 lakhs obviously. 200 lakhs. Because see, in the current year, there is a change of 120 lakhs. Your opening cash and cash equivalents is 80 lakhs. Obviously, it will be 200 lakhs. Is cash and cash equivalents at the year end. So this is how the presentation will be done. First, we will write operating, investing, financing activities, and we will find out the net increase or decrease. And for that, we will add the opening cash and cash equivalents. Then automatically you will get closing cash and cash equivalents balance. So cash flow statement, sir, whether you got the correct answer or not, in the examination itself, you know, sir, because the net increase or decrease, if you added with opening, obviously your closing balance should come. So in the question, they will give you opening balance and closing balance. So these things, how you are going to categorize and how much you are going to get in the net increase or decrease in the cash and cash equivalents, that will decide your fate, sir. That will decide your fate. Sir, I will do one thing, sir. 200 lakhs closing given in the question, 80 lakhs. This is also given in the question. That means 120 lakhs is the net increase or decrease. Yes, this is also I can know. So I will try to adjust them accordingly. Okay, you try. So if luck goes well, maybe you are right, but may not be, because the person who is giving the question, he is smart enough. So students will going to do all these tricks. So he will give in such a manner that at least one or two items, so he will twist. But see, nowadays, as I told you, cash flow statement, straightforward questions only they are asking, sir. Okay, so even if you prepare, this much revision, more than sufficient to get full marks from this cash flow statement. That's what I feel. Okay. Next. Now, so therefore, in the cash flow statement, we have cash flow from operating activities, we have cash flow from investing activity, financing activity. Now here, most important things are cash flow from operating activities, because the cash flow from operating activities are prepared in two ways. There are two methods to determine the cash flow from operating activities. An enterprise can determine the cash flow from operating activities either direct method or indirect method. Direct method, indirect method. Sir, what is this direct method, indirect method? Sir, in direct method, we will try to identify all the inflows and outflows of operating activities from the information given in the question, or he will give information in such a manner you are able to calculate all the inflows and outflows of cash and cash equivalents relating to operating activities. But indirect method of presentation is what? By taking net profit from the P&L account, we will try to arrive the cash flow from operating activities. So it is like you take the P&L account and they will give you the balance sheet. They will give you some additional information also. Now, by taking P&L account as the base, you try to arrive the cash flow from operating activity. Sir, out of these two methods, which method is more accurate and which is very popular? Indirect method is very popular, sir, not direct method. It is not advisable also. Why? Because, sir, if you are a big company, for example, you are a Reliance Industries Limited. Very difficult for identifying each cash inflow and outflow relating to operating activity. It's not practically possible. So what are the inflows, what are the outflows, everything relating to operating activities one by one may not be. Of course, nowadays, because of the technology, because of the software, everything is ready-madely available. So I can't say this, it is not possible. But indirect method is more accurate, and I think easily we can arrive at the cash flow from operating activities. So that's why this is very popular. Okay. So apart from the popularities, they are asking only, see, if you observe, I think previous attempt, not this attempt, previous attempt. So I think they have asked a direct question relating to, cash flow, preparation of cash flow statement. Directly they have given a cash book and they're given receipts and payments. They ask you to prepare the cash flow statement on direct method only. So set the, popularities besides, sir, understand. So cash flow from operating activities can be arrived either by direct method or indirect method. See, this direct and indirect method is not applicable for investing and financing. It is possible only for, it is applicable only for operating activities. So first we will see the direct method, sir. What is this direct method? In direct method, we will take the gross receipts from sales, amount collected from customers, whatever the other operating inflows are there. We will take all the inflows relating to operating activities and we will deduct all the payment to, gross payments for purchases, creditors, other expenses. All the cash outflows relating to operating activities we will deduct. So inflows, outflows relating to operating activities. Then obviously you will get what? Cash flow from operating activities. Okay. Suppose, sir, accrual to cash. See, one of the most important thing you need to understand is when you are preparing the cash flow statement, sir. Obviously, cash flow statement, only cash must be involved. Either inflow or outflow, cash involvement should be there. But generally, they will give you P&L account, balance sheet. And we know we are going to prepare the financial statements on accrual basis. So whatever you are seeing in the P&L account, it is prepared on accrual basis. It is not prepared on cash basis. So therefore, in order to convert accrual basis into cash basis, there are certain adjustments which is required. Like for example, cash received from customers. Any amount received from the customers during the year is an operating activity. It will come in cash flow statement. But you don't know directly how much is cash received from the customers. So what you need to do? You need to prepare the ledger account of the customer and try to arrive the cash received from customer as a balancing figure. So for example, what is the credit sales during the year? What is the opening debtors minus closing debtors? Opening debtors plus sales minus closing. Then you will get cash received from the customers during the year. That you will take directly in the cash flow statement. Operating activity. Similarly, cash payment to supplier. How much you pay to the suppliers? Because that is also comes in cash flow statement. How much amount you pay to the suppliers? Simple. What is the opening creditors? Balance. Add credit purchases minus closing creditors. Then obviously you will get. See, these are all basics. You know this. And also, for example, I want purchases. How much purchases we have made during the year? So cash cost of revenue from operations, how much? And cost of goods sold, nothing but opening inventory plus closing inventory. And also I want cash expenses. How to get expenses? See this. Expenses on accrual basis. What is the expenses of the year on accrual basis? 10 lakhs. For example, opening prepaid expenses. Sir, prepaid expenses means expenses already paid but not incurred. So last year you have paid but not incurred. Therefore, they will become current year expenses. So add opening prepaid expenses plus closing outstanding expenses. What is outstanding expenses? Expenses incurred but not paid. That means they are accrued during the year. Therefore, they are part of the current year expenses. So add closing outstanding minus these two are minus opening outstanding expenses minus closing prepaid expenses. Because closing prepaid expenses means they are not belongs to this year, but paid they are not belongs to this year. So I want to know the cash purchases, cash expenses during the year. So this is how I need to arrive cash expenses, how I am going to get the cash expenses during the period. Of course, see, the point here you need to understand is depending upon the information given in the question, you have to find out the way to arrive the inflows and outflows relating to cash and cash equivalents. Belongs to operating activity. And obviously when you are preparing the cash flow statement, direct method, so ignore non-cash items like depreciation, discount on shares, so they should be written off. And investing or financing activities don't consider, like for example interest received, dividend received, because they comes under investing and financing activity. They will be classified as investing or financing and they should not be considered, because here we are focusing only on what? Cash flow from operating activities. So how the cash flow from operating activities under direct method we will prepare, sir? See this. First, cash received from sale of goods, cash received from debtors, trade receivables, cash received from sale of services, any payment for cash purchases, payment to trade payables, payment for operating expenses like power, rent, electricity, payment for wages and salaries, payment for income tax, and any extraordinary items are there, adjust it. Then you will get the net cash flow from operating activities. Very simple, direct method. Okay. Next, indirect method, sir. I think this is very, very important, sir. Indirect method. This is where students, little bit confused. So understand carefully. I'm going to explain it. What is this indirect method? Sir, I want cash flow from operating activities. Say this. I want cash flow from which activities? Operating activities. So my goal is I want cash flows from operating activities. Operating activities cash flows I want. but my starting point is net profit or loss. Net profit or loss before tax and extraordinary items. Obviously, before tax you need to take. See, this net profit or loss before tax and extraordinary items, you will take from P&L account. They will give you P&L account, or they will give you the net profit or loss before tax and extraordinary items from the P&L account. You take this. Now, my goal is I need to reach cash flow from operating activities from this net profit or loss before tax and extraordinary items. So what adjustments if I do to this net profit or loss before tax and extraordinary items, I will reach my goal, that is cash flow from operating activities. Understand, I want cash flows from operating activities. But my starting point is what? Net profit or loss before tax and extraordinary items. Now everybody think this net profit is arrived from P&L account, and you know P&L account is prepared on accrual basis, but I am preparing cash flow statement, so cash basis is important for me, and that too I want operating activities, that too involving only cash items I required, but I am starting with the net profit or loss. While arriving this net profit or loss, we have considered all the items on accrual basis. So therefore, what adjustments if I do to this net profit or loss before tax and extraordinary items, I am going to get the cash flow from operating activity. That's how you should think. What adjustments if I do to this net profit or loss before tax and extraordinary items, I will get cash flow from operating activity. Simple. See, here 3 major adjustments. First adjustment is non-cash items. Non-cash items. Because I want cash flows from operating activities, but while arriving this net profit or loss, they have followed accrual basis. That means even non-cash items are also there. Suppose depreciation debited to P&L account. That means while arriving net profit, this depreciation has been deducted, but this depreciation does not affect my cash flow statement. Therefore, what I need to do? I need to eliminate the effect of this depreciation from the net profit. While arriving net profit, this depreciation is already deducted now, so you add back. So therefore, whatever the non-cash items already debited to P&L account, add back. Whatever the non-cash items already included in net profit, deduct. That means you need to eliminate the effect of non-cash items. What is the logic? Because I am starting with net profit, which is prepared on accrual basis. But I want cash flow from operating activities. I want only cash items. So therefore, whatever the non-cash items, if they are already debited to P&L account, now the debited to P&L account means they are already deducted while arriving the net profit. Now I need to add back because I need to eliminate the effect of that item. If they are already included in net profit, now I need to deduct. If they are already deducted while arriving the net profit, I need to add. So therefore, non-cash items either you add or less. If they are already debited to P&L account, they are already deducted while arriving net profit. Now you add. That means the effect is eliminated. They are already included in net profit. Now you deduct. The effect is eliminated. That means you are one step closer to the cash flow from operating activity. Sir, understood, sir. That means you are saying that net profit or loss prepared on accrual basis, but we want cash flow from operating activities which is prepared on cash basis. Therefore, non-cash items effect is already adjusted in the P&L account in the net profit. Therefore, we need to eliminate the effect. Yes, exactly. Okay. If that one is done, sir, we reached the cash flows from operating activities. No. Next adjustment, what we need to do? Sir, I want operating activities, sir. But in the P&L account, they have considered all kinds of activities. Even the items relating to investing, financing also considered. I need to eliminate the effect of non-operating items. Non-operating items also. For example, P&L account is debited with interest. Interest paid. For example, interest expenses. But generally you tell me interest expenses debited to P&L account. So if interest is paid, it comes under which activities? Operating, investing, financing. Interest we pay on borrowings. Therefore, it's a financing activity. It is not part of operating activity. But in this, while arriving this net profit, this interest is already deducted now. So you add back now. You add back now. For example, interest income credited to P&L account. But generally interest received is which activity? Investing activity. So it's a non-operating other than operating. Because I want operating activities. But in P&L account, even non-operating items are also included. So I need to eliminate the effect. If they are already debited to P&L account, add. If they are already credited, now you deduct. Because I don't want non-operating activities, non-operating items. I want only operating activities. In order to arrive operating activities, investing and financing, which are non-operating, I need to eliminate the effect. Understood? Important. So first, I will eliminate the non-cash items. Then non-operating items, I will eliminate. Sir, that's it, sir. I will get cash flow from operating activities, sir. See, most of the students will understand these two things. It makes sense for them. Non-cash items, correct, accurate. Because SAR is saying that we are preparing cash flow from operating activities. Non-cash items, definitely we have to eliminate. Yes, we eliminated. Second one is non-operating items. Definitely we have to eliminate because we want cash flow from operating activities. How can we include items relating to investing and financing? We need to eliminate. Okay, non-operating items. Yeah. That's it. Any other adjustment? See, this is the most important adjustment. The most important adjustment is changes in working capital. Changes in working capital. Even the changes in the working capital, that is, changes in current assets and current liabilities, is also to be adjusted. Changes in current assets and current liabilities will also to be adjusted. That is, in shortcut, we call it as changes in the working capital is also to be adjusted. Sir, what is this changes in working capital, sir? The changes in working capital is nothing but working capital means what? Current assets, current liabilities. The difference is nothing but change in working capital. Sir, whatever the changes happening within the current assets and current liabilities, they are also to be adjusted. Sir, why we need to adjust changes in current assets and current liabilities? Because I will tell you. Suppose, sir, you take, I will give you two examples so that you will understand. For example, you take debtors, sir. Debtors. Suppose the opening debtors balance is 10 lakhs, sir. Closing debtors balance is 15 lakhs, sir. Now tell me, what is your analysis here? Opening debtors 10, closing 15. Sir, there is an increase in debtors, correct? 5 lakhs. Tell me how debtors balance will increase? Definitely, there will be credit sales. That means sales during the year. Of course, we have received some cash from the debtors, but the net sales is more than the collections. I mean, the increase indicates that there will be definitely sales, credit sales, much more than the cash we collected. That means this 5 lakhs indicates what? Increase in debtors. How increase in debtors is possible? Because of credit sales. Now tell me. That means credit sales means it is part of P&L account. Sales we will consider it as a part of P&L account. That means our net profit is increased by this 5 lakhs. But tell me whether this 5 lakhs is actually collected in cash? No, because it's a credit sales. Then is it relevant for cash flow statement? No. Therefore, we need to eliminate this. Since this 5 lakhs is already included in net profit, but it is not realized, there is no cash inflow. Therefore, what we need to do? Minus. So therefore, increase in current asset. What we need to do? Minus. Why? Increase in current asset indicates that there is a increase in the benefit, but that benefit is not collected in cash. Increase in current asset. Closing debtors is more than opening debtors. That indicates that there is credit sales much beyond the cash collected during the year. So to that extent of increase is reflecting my credit sales. That is included in my net profit. But it is not yet collected. Therefore, it is not relevant for cash flow statement. Because cash flow statement means only cash inflows and outflows. Okay. And suppose, for example, inventory you take. Another example I will give you. Inventory. Suppose inventory opening balance 10 lakhs. Closing balance, suppose 15 lakhs. Tell me what it indicates. Increase 5 lakhs. Increase means maybe inventory purchased during the year is more than the amount paid to suppliers. That means this 5 lakhs indicates what? amount not yet paid. But this 5 lakhs is included in net profit now, because you will take closing stock 15 lakhs, opening stock 10 lakhs, the difference 5 lakhs, change in inventories. What you do? Expenses side, changes inventories of finished goods, work in progress, stock in trade, opening stock minus closing stock minus 5 lakhs you will write. That means incomes minus plus. This 5 lakhs will be added to your net profit. There, when closing stock is more than opening stock, that increase is added to net profit, sir. That means this 5 lakhs is already included in net profit. But tell me, is there any cash inflow? No. Therefore, how can it comes in cash flow statement, sir? Because cash flow statement considers only cash inflow and outflow. This 5 lakhs is not yet realized. Therefore, don't consider it in the cash flow statement. So that's why always understand increase in current assets has to be deducted, because that increase was already included, but there is no cash flow. That is not relevant for cash flow statement. That's why we need to deduct. Okay. Similarly, sir, there can be decrease also. There can be decrease. For example, opening debtors 10 lakhs, sir, closing 5 lakhs. That means, tell me how debtors will decrease, because there is a cash paid to the debtors. Amount paid to the debtors is 5 lakhs. Obviously, amount paid means what? Amount paid means it is a cash outflow. It has to be considered in cash flow statement. But tell me, cash, suppose for example, opening debtors 5 lakhs, 10 lakhs, so closing 5 lakhs. So how much decrease? 5 lakhs. Why this decrease? Because cash paid. Whether cash paid is affecting my net profit? No. Therefore, this 5 lakhs is not yet adjusted in net profit. But I need to consider now, because it's part of cash flow statement. But I'm starting with what? Net profit, which is taken from P&L account on accrual basis. So therefore, whatever the net profit I'm taking, in that net profit, this 5 lakhs outflow is not there. That's why I need to deduct now. That's why, see, decrease in current asset, always what we need to do? We need to cash outflow. I think 10 has become 5. So therefore 5 lakhs has been decreased, right? 1 second, sir. See here, I have given, see this. Decrease in current assets, we need to add. Okay. Increase in current assets, we need to deduct, minus. Increase in current assets. Correct only, na? We have discussed that. When the current assets increases, that means the amount is not yet collected, but it is, the effect is already included in net profit. Therefore, we need to deduct. So decrease in current assets means current assets was decreased. Sir, suppose, sorry, here debtors 10 has become 5. That means 5 lakhs not paid, collected from debtors. Sorry, 5 lakhs collected from debtors. That means cash inflow. It has to be included, right? So that's why add, decrease in current assets. And suppose current liabilities are decrease, minus, increase, add, sir. The logic is similar. Like current assets, current liabilities also. For example, creditors you take. Current liability, suppose creditors is there. Opening 10, closing 15. Tell me how much increase? 5 lakhs. Creditors increase means this increase not yet paid, but it is already, the effect is already there in the net profit. This 5 lakhs credit purchases is already included in net profit now, debited to P&L account. That means your net profit has been decreased by 5 lakhs. But these 5 lakhs actually you paid? No. So therefore decrease in current liabilities. What we need to do now? Deduct, minus. Why minus, sir? Because in P&L account, sir, credit purchases you have taken, sir. That means this 5 lakhs is already debited. That means while arriving net profit, this has been deducted. But whether this 5 lakhs actually cash paid or not yet paid. Why? Because increase in creditors indicate that the cash was not yet paid. Now, if it is paid, then how it will increase, sir? Suppose if we 5 lakhs during the year, we purchased and we paid the amount. That means the closing creditors are also 10 lakhs only, na? So understand the logic. So decrease in current liabilities minus increase in current liabilities, add. So therefore here the conclusion is decrease in decrease in current assets. Decrease in current assets, why we are adding? Because decrease in current assets indicates that so amount has collected from the, amount has been received from the current assets. Increase in current assets indicates that what? There is an increase in current assets. That increase may not yet realized in cash. That's why it was not part of cash flow statement. Decrease in current liabilities means we have paid the amount. Now, obviously, it has to be deducted, cash outflow. But the effect is not there in the net profit. Increase in current liabilities, add. So, therefore, This is the logical way, sir, to understand this increase in current assets, current liabilities. Okay, or in shortcut you can remember like this, sir. So obviously when it comes to current liabilities, increase positive, add, decrease minus. It applies to current liabilities. Negative, reverse effect for current assets. Suppose current assets decrease, add, current assets increase, minus. Why increase? Why minus, why plus also we have discussed. So increase in current assets indicates that the increase is not realized in cash. Therefore, it is not relevant for cash flow statement, but the effect is already included in net profit. Okay. Decrease in current assets means it was realized in cash, but the effect is not there. Now we need to give the effect. Current liabilities also same. Decrease in current liabilities means cash paid, but the effect is not there. Increase in current liabilities means that increase is already affected in the net profit, but there is no cash outflow. So that's why the effect has to be eliminated. So decrease in current assets. What is the indicate, sir? So decrease in current assets means cash not realized. Okay. But effect in net profit. Already net effect is there in the this one. Sorry, here cash realized. Sorry, decrease means cash realized, but no effect in P&L. In net profit. That's why I need to add down, because cash realized na inflow. Inflow means positive. Increase in current assets. So cash not realized, but effect in net profit. Similarly, come to decrease in current liabilities, sir. So decrease in current liabilities, increase in current liabilities. Current liabilities decrease means cash outflow, but not affected in net profit. Increase in current liabilities. Increase in current liability means no cash outflow yet, but effect is there in net profit. Now you need to adjust. That's it. Okay. So creditors balance increase. That increase means credit purchases. Credit purchases debited to P&L account. Because of that, net profit decreased. So, but there is no cash outflow. But net profit is already affected. Now we need to eliminate the effect because it is not considered for cash flow statement. Similarly, see the increase in current assets. Debtors balance increase. That means there is a credit sales. It is already affected in the net profit. But there is no cash inflow. Therefore, it is not relevant for cash flow statement. So therefore, understand, sir. Common sense. So when I want to reach cash flow from operating activities from net profit before tax and extraordinary items, I need to make 3 adjustments. Non-cash items I will eliminate first. Non-operating items I will eliminate first. Next, changes in working capital also I will eliminate. Why changes in working capital will be eliminated? Because these changes in working capital, changes in current assets and current liabilities is either affected in my net profit, but there is no cash inflow outflow. Maybe they are not affected in my cash flow net profit, but there is a already cash inflow outflow happened. That's why I need to consider them. Understand here logic. So therefore, the increase, the change in current assets, the change in current liabilities. Okay, see, the change in current assets can be increase or can be decrease. See, the increase is affected my net profit, but no cash flow. Therefore, I should eliminate it now. I should eliminate it. Since it is already included in net profit, I need to deduct. That's why increase in current assets, deduct. Decrease in current assets, no effect in net profit. But there is a cash flow. Therefore, I need to consider it now. Because it is not included in my net profit, the inflow I need to add back. That's why decrease in current assets, now I need to add. Similarly for current liabilities also. Hope this explanation, so you understand it. So I have gone in-depth explanation, sir, for this. But at the end of the day, sir, most of the students, what they will do now, so they will remember this. Current assets increase, add, decrease, less. Very safe. Of course, you understand the logic. If you understand the logic, that's good enough. Suppose in examination, if you have a little bit of time, use your common sense. So if it is current liabilities, same effect. Current liabilities, opposite effect. Sorry, current assets, opposite effect. Current liabilities, same effect. Current liabilities increase, add. Decrease, minus. Current assets increase, minus. Decrease, add. Like that. Okay. Then you see how the presentation has been done now. See this. First, I started with net profit before tax and extraordinary items. So I told you now, first non-cash items I will adjust. Then non-operating items I will adjust. Non-operating items. So if they are already debited to P&L account, I will add back because they are already deducted while arriving net profit. If they are already included in net profit, minus. Then I will get operating profit before working capital changes. Then for this working capital changes also I will do. Then I will get cash flow from operating activities before tax and extraordinary items. Then any income tax paid. Tax paid. Most of the students again here confusing. Tax paid only you should consider. In examination they will give you provision for tax. Tax paid you consider. Now relating to tax, sir, of course certain situations are there relating to tax. Yeah. See, relating to tax, suppose they will give you opening, closing. Suppose they have given you provision for tax. Opening 1 lakh given. Okay. Closing 2 lakhs given. That's it. No, nothing mentioned. Opening 1 lakh, closing 2 lakhs. Okay. So how much is the income tax paid? 1 lakh is the tax paid. This 2 lakhs, assume it as a current year provision. Current year provision. We want tax paid. Obviously, last year opening, last year closing will be paid in the current year. So that's why 1 lakh is the income tax paid. Don't take 2 lakhs, please. Sometimes what they will give you is, suppose in the question they will give you provision for tax, opening, closing, and they will tell you tax paid in the additional information, tax paid. Suppose tax paid is 1 lakh. Then straight away take 1 lakh. No argument. Opening, closing, they have given. Nothing to do with provision. Tax paid given, take it directly cash flow statement. Okay. And see, suppose for example, any advance tax paid given, advance tax, whatever, tax only, na, take it directly. Advance tax paid, take it directly. So whatever the advance tax given, that is paid only. Advance tax means it is paid during there. So take it as a part of cash flow statement. Okay. Now see, sometimes what happens is, they will give you provision for tax. Suppose opening provision for 10, closing they will give you 12. So current year tax liability they will give you. Suppose current year tax liability is 5 lakhs. They will give. So you need to do simply, what is the opening? 10 lakhs. What is the current year liability? 5 lakhs. What is the closing liability? 12 lakhs. So how much tax paid? 3 lakhs. Simple logic, sir. What is the opening provision? 10. What is the current year liability? 5 lakhs. What is current year liability? Every year you calculate the taxable income and tax liability, you will decide, na, that is 5 lakhs. This is current year. So that means you have total 15 lakhs. Opening 10, during their 5, 15. But closing it has become 12. That means how much you paid? 3. So take 3 lakhs as the tax paid during the year. Opening plus current year liability minus closing. Okay. That's it. Next, any extraordinary items is there, give the effect, then you will get cash flow from operating activities. So that's it, sir. So this is the indirect method, sir. Indirect method. So adjustment description also I have given non-cash items. Any non-cash items in the P&L account, eliminate the effect. If they are already debited to P&L account, add back. If they are already credited to P&L account, minus. Investing and financing activities, also same thing. If they are already debited to P&L account, add back. If they are already included, minus. And also change in current assets, current liabilities, working capital changes will also, see, either they have affected my net profit or they may not affected my net profit. If they are already affected my net profit, but there is no resultant cash inflow or outflow, therefore I will not consider them. Sometimes the change in current assets and current liabilities, so they are not affected by net profit, but they have resulted in cash inflows and outflows. So that I need to adjust. Okay. So use of indirect method. Indirect method is the mostly used by companies to determine the net cash flow from operating activity. So other points also given, sir. If you see the study material, see, I have not missed any point. So other points, reporting cash flow on net basis. Sir, can I mean net off and show the net cash flows? For example, 50,000 I spend on machinery, 10,000 received from sale of furniture. And can I show, because both are investing activities only. One is purchase of machinery, another one is sale of machinery. So one is outflow 50,000, another one is inflow 10,000. Because whenever I sell the furniture, 10,000 inflow. This is inflow, right? And this is my outflow. Can I adjust these two? 50 minus 10 and I say net outflow is 40,000, prohibited. Netting off is prohibited as per AS3. That means in investing activities, financing activities, sir, you need to show each item separately. For example, sale of machinery, sale of furniture, purchase of machinery, everything has to be individually shown. AS3 prohibits netting cash flow from investing and financing activities. Cash paid for asset purchases, cash received from asset sales must be shown separately. But there are some exceptions to this netting rule, sir. So netting is allowed when cash receipts and payments are on behalf of customers. Example, cash received and paid by bank against acceptances and repayment of demand deposits. Sir, suppose you are a bank, sir. So customer deposited the amount, customer withdrawn the amount. So netting off allowed or not? If it is not allowed, no, sir. So imagine a bank, how many transactions they will do. So these days, UPI payments and all. So there are a lot of inflows and outflows. So netting is allowed for banks. So if you are receiving any, receipts and payments on behalf of customers. So on behalf of customers, for example, customer is having a bank account, he will deposit the amount, even he will withdraw, he will make the payment. So how many transactions will be there? So netting is allowed if you are receiving or making payments on behalf of customers. And that too, and one more exception, sir, if you have a high turnover, large volume, short maturity items. For example, you are purchasing and sale of investments. Suppose you are an investment company, sir. On daily basis, the stock broking companies, investment companies, on daily basis, they will purchase number of shares, number of company shares, they will purchase and sell. In a day, they may do, 100 sales purchases. So tell me, if netting off is not allowed, how big cash flow statement will come? Everything in it has to be presented, inflows and outflows separate. Not possible, na? So netting is allowed, netting off is allowed. So that means generally netting off is not allowed, sir, but there are two exceptions. One is when you are receiving, making payments on behalf of customers, netting off is allowed. And also if you are having high turnover, large volume, short maturity items, netting off is allowed. And that too, if you are a financing enterprise like banks or financial institutions. So for you, net basis, you can present the cash flow statement on net basis. That means you can adjust the inflows and outflows relating to financing and investing, allowed. When suppose you are accepting repayment of fixed deposits with a fixed maturity date, and placement and withdrawal of deposits with other financial enterprises, any loans and advances to customers, repayments received. So daily basis they will give loans, they will make the repayment, customers will make the repayment. So netting off is allowed, only net amount can be shown, no need to present separately. And also, sir, business purchase. That means when one company acquires another company, when a company buys or sells a subsidiary or business unit, so it has to be shown separately as an investing activity. You know this. No netting off, sir. Suppose cash received from sales, cash paid for purchases has to be shown separately. It not to be combined. Okay. And similarly, any exchange gains on losses, foreign exchange foreign currency monetary items. You know, in accounting standard 11, when you enter any foreign currency transactions, because of that, any foreign currency monetary items generated, sir. So we are revaluing them at the balance sheet date by using the closing rate. If you remember AS 11, so on the closing date, if you are an integral foreign operation, any assets and liabilities, let us say integral or non-integral, that is about foreign operations. If you are entering any foreign currency transaction and on the balance sheet date, whatever the assets and liabilities arising from this foreign currency transaction, it has to be reported by using a closing rate. That means opening rate is different, closing rate is different. So there is an exchange gain or loss, right? So this foreign currency monetary items revalued at the balance sheet date using the exchange rate on the date, and the resulting exchange gain or loss is recognized in the P&L account. It is not part of cash flow statement. And exchange gains or losses on cash and cash equivalents are not considered cash flows. Please understand. So cash flows exclude them, and reconcile note explain the difference. So therefore, foreign any exchange differences arising, inflows or any exchange differences arising, that will not be considered as cash and cash equivalents. That is not part of cash flow statement. So exchange gains or losses on what? Cash and cash equivalents are not considered cash flows. Generally, these exchange gains or losses will be transferred to P&L account. So that's it, sir. So entire cash flow statement we have discussed it, sir. So this is cash flow statement. So try to solve the questions. I will try to upload in my YouTube channel some questions relating to cash flow statement also. So if possible. So but see, concept is very important, right? So you master the concept. Even if you solve a limited questions, you can able to get through. See, understand students, here solving questions is important, but first you should understand the concept. What some students are doing now, the mistake they are doing is, without understanding the concept, they're directly going into the sums and they're trying to solve the questions. Instead, actually they are not solving the questions. They're actually, mugging up the answers. So in examination, don't expect similar questions will come. First, you should have the basic understanding about the concept, reasonable understanding. Then you try to solve the questions. And if you know suppose cash flow statement is there, you should know what is cash flow statement, what are the cash flow activities, how it will be presented, what is indirect method, what indirect method will do. You should have an idea. Then you try to solve one or two questions, study material questions you solve, then that is sufficient. Without knowing the concept, even if you solve hundreds of questions, there is no use. That is my belief. So over the years, with my experience, I can certainly say that understanding anything with a reasonable level of understanding is very much important. You need to get the confidence. See, when you're solving the questions now, suppose you don't know how to make the classification, then how can you are going to present it? Tell me. So how many sums you are going to solve? And that too, these are professional exams. Don't expect same questions will be repeated in the exam. Okay, thank you. Now let us begin buyback of securities chapter. So predominantly what we are going to cover in this chapter, sir. See here, the major focus is on learning the accounting treatment for buyback of securities. So whenever a company went for buyback of securities, what will be the accounting treatment we are going to do in the books of company? That is what the major focus of this chapter. But before going into the accounting treatment, we need to understand the legal provisions relating to buyback of securities. In the Companies Act, there are specific provisions relating to buyback of securities. So those provisions first we need to understand, because those provisions will have a direct impact on the accounting treatment of buyback of securities. So before proceeding into the accounting treatment for buyback of securities, we need to cover all the legal provisions relating to buyback of securities. Of course, in company law, you have exclusively a chapter called share capital. In that, all the provisions relating to shares will be there, including buyback of securities. There you are going to cover all the legal provisions. But here, in the advanced accounting paper relating to buyback of securities, we are focusing more on those legal provisions which is directly impacting my accounting treatment. Okay. Now let us first start with the meaning of buyback. Sir, what is buyback of securities? What is buyback of securities? A company issued shares, right? Now those shares are purchased by outsiders. We call them as shareholders. Now from the shareholders, again company wants to purchase those shares back. So can I call this as buyback of securities? Purchasing of own shares. Now sir, company purchasing its own shares with what intention? Whether company wants to invest in its own shares or whether company wants to cancel the shares which they have bought back from the shareholders. What do you think, sir? Tell me, sir. What do you think? Suppose there is a company A Limited, sir, which has issued 10,000 equity shares, sir. Now these equity shares purchased by outsiders, we call them as equity shareholders. Now these equity shareholders had 10,000 equity shares of A Limited. Now A Limited, out of this 10,000, they wants to purchase back 5,000 shares. Now tell me, with what intention A Limited can purchase these 10,000 shares? With what intention A Limited can purchase these 5,000 shares? Suppose generally, sir, suppose if A Limited purchased the shares of B Limited. Suppose A Limited purchased 2,000 shares of B Limited. Now in the balance sheet of A Limited, asset side we will show investment in shares of B Limited. Investment in shares of B Limited. Suppose these 2,000 shares we purchased for 1 lakh. So this is the investment asset we will show. Now similarly, A Limited wants to purchase its own shares, 5,000 shares. Can A Limited show in its own balance sheet investment in A Limited? It's purchased its own shares, and these 5,000 shares they purchased 10 lakhs they have spent. Can A Limited show purchase of its own shares as an investment in its balance sheet? Because see, 10 lakhs they have spent it to purchase these shares, and this 10 lakhs came from the cash reserves of A Limited only. That means A Limited using its own resources purchased its own shares and wants to show this as an investment. Now tell me, is it make any sense? It is like circling your own money. You earn the profit, you have some reserves. Out of those reserves, again you want to purchase your own shares and you want to show that as an investment. You want to mislead the users of financial statements. So can a company is allowed to invest in its own shares? Can a company purchase its own shares with an intention of investment? Can you say, for example, I have 1 lakh rupee with me, sir. Right now in my pocket, suppose 1 lakh rupee is there. Out of this 1 lakh rupee, 50,000 I put it in the right pocket. And I said, this is my investment. Now tell me, is it make any sense? Is it any real value addition happen to me? The 1 lakh, it is in my hand. Now out of that 50,000 I moved to my pocket. Still I had 1 lakh only. Doesn't make any difference. Have I become a rich person because I made some investment? I just moved the money from one place to another place. Similarly, a company purchasing its own shares with an intention of investment. Does it make any sense? It's my money. I am putting in my own shares. So therefore, Companies Act says a company cannot purchase its own shares unless there is a consequent reduction of share capital. That means a company cannot purchase its own shares with an investment option, but by seeing this as an investment. How can you say my own money, I will put it in my own shares and I will say this is my investment, this is my asset? So isn't it not misleading the users of financial statements? Isn't it not the circulation of money within the organization? And if this is allowed, no, sir, what happens is companies, whenever they want to artificially increase the share price, they want to create artificial demand in the market, they will purchase their own shares and they will keep it with them, and they may increase artificially the share prices. So this could be the possibility. So that's why, sir, understand first of all, what is buyback? Very, very important. Buyback is not just purchasing your own shares, sir. A company is not just purchasing its own shares. With what intention you are purchasing your own shares? Only with an intention of cancellation that is allowed as per the Companies Act. Suppose, sir, I want to invest in my own company, sir, not allowed. You cannot invest in your own company and say it is my investment. Your own money you are circulating, you diverted from cash reserves to investment. So, doesn't make any sense? No. So, therefore, purchasing your own shares with an intention of cancellation is called buyback of shares. So, that means a company cannot see buyback as an investment option. It is not an investment option. If you want, you can purchase shares of other companies. But how can you purchase your own shares and say it is my investment, it is my asset? Doesn't make any sense, right? It is like my money. So in my hand, I put it in my right pocket and say it is my asset. Even if you don't move the cash, still it is there in your hand. It is your asset only. There is no need to say that I put 50,000 in my pocket and it is my investment. Doesn't make any sense. Suppose this 50,000 I put it in the bank account, or for example bank FD, or this 50,000 I purchased shares, then I can say it is my investment, because the funds, the resources have been moved from one place to another place. So to call it as investment, resources must move from one place to another place. But in buyback, what happens? Company, by using its own funds, it is purchasing its own shares. So with an intention of investment, it cannot do so, because it is not allowed as per the Companies Act. Logically also that is correct only. So therefore a company can purchase its own shares only with an intention of cancellation. So that's why, see, buyback of shares means what? Purchase of own shares with an intention of cancellation. That intention should be there of cancellation is called buyback of shares. No company is allowed for buyback of its own shares. Own shares. If you see the Companies Act, it is clearly there. No company is allowed to buy back its own shares unless there is a consequent reduction of share capital. There must be reduction of share capital. That means, suppose company issued 10,000 shares. Now the 10,000 shares is there with the equity shareholders or shareholders. Out of those 10,000 shares, company wants to cancel 5,000 shares. So first of all, those shares must be purchased from the existing shareholders and then it can cancel it. That is called consequent reduction of share capital. So purchasing your own shares and then reducing them, cancelling them. That is what the buyback is. Not just investing in your own shares. Investing in your own shares with the purpose of continuing the investment, with the purpose of continuing it as an asset, is not allowed. So buyback is not an investment option. But a company with sufficient cash may choose to buy back shares. If you have a sufficient cash, you can purchase your own shares and then cancel them. That means you are reducing the burden of share capital. That's it. That's what ultimately happens in buyback. Ultimately in buyback, what happens, sir? Your cash reserves will come down and then your share capital will be come down and it will be reduced. So you understand what is buyback of shares? Buyback of securities is not just purchasing your own shares. Purchasing your own shares with an intention of cancellation is called buyback. So purchase and then cancel. Two things are happening in buyback. And understand, buyback is not an investment option. Okay, sir. Sir, why companies go for buyback? What are the objectives or what are the advantages of buyback of shares? See, there are a number of reasons why a company can go for buyback, sir. And you see, practically also we are hearing these days, companies recently, for example, Infosys company announced buyback, or maybe TCS company announced buyback. So there could be number of reasons, sir. But there are some specific advantages or objectives which is there here. You see, very, very important, sir. Sir, to support the share price when it is undervalued or especially in a depressed market conditions. Suppose if there are depressing market conditions, sir, to support our own share price, what company can do is company can announce the buyback of shares. For example, in the market, sir, our share price is continuously falling down. Now there will be panic in the shareholders, right? Now to remove those, to get over from that situation and to bring the confidence in the shareholders, what company can do is it can announce buyback. It says to the shareholders, don't worry, we are ready to purchase this share at this price. For example, a company announced buyback, TCS announced buyback. Okay. Now they said, for example say I'm saying, we are ready to purchase each share at 1000 rupees, right? Suppose right now the market price of the share is, for example, 1050. Now there are depressing market conditions. Now if the share price continuously falling down, now suppose even if it fall below 1000, shareholders will not panic. Why? Company already announced buyback, saying that we are ready to purchase at 1000 rupees. That means shareholders, you are not worried. Even if the share price is falls below 1000, we are here to purchase our own shares. That means you can sell your own shares to us. We will buy it, not for the purpose of investment. We will cancel it. So for that purpose, company can go for buyback. So in the depressing market conditions, so when the share price is undervalued, to support our share price, a company can announce buyback. Now these companies nowadays, Infosys, TCS, all these companies announced buyback. Okay, so this could be the one reason why companies will go for buyback. Another reason, sir, to discourage the hostile bid to take over the company by increasing promoters holding. Or second and third point are both connected, sir. Increasing promoters holding by cancelling buyback, bought back securities. See, whenever any outsiders wants to take over our company, what we can do is we can use this buyback as a strategy to increase the promoters holding. See, in the company, I'll show you. For example, sir, suppose there is a company A Limited, sir. There are 10 lakh shares are there in that company. Promoters had 60%. We call them as major shareholders. Minority group, small shareholders has 40%, 4 lakhs. Now company announced buyback of 3 lakh shares. Now after buyback, number of equity shares will be total 10 lakhs before buyback. 3 lakh shares were buyback announced. So from 10 lakhs, 3 lakh shares will be cancelled after buyback. Now the number of shares after buyback is 7 lakh shares. Now suppose imagine, company announced buyback of 3 lakh shares, na sir. All the 3 lakh shares are purchased and cancelled from the minority group, minority shareholders. Now the number of shares after buyback is 7 lakh shares, sir. Now promoters holding is same, 6 lakh shares they had previously. Now their percentage went up to 85%. Now before buyback, it is 60% only, because in 10 lakhs they had 6 lakhs. Now the number of shares after buyback is 7 lakhs. In that they had 6 lakhs. The minority interest group is only having 15%, because before buyback they had 4 lakh shares, 40% share. Now out of 4 lakhs, 3 lakh shares were bought back and cancelled. Now they had only 1 lakh shares out of 7 lakhs. That means 15%. That means whenever company wants to increase the promoters holding in the organization, majority shareholders group holding, then they can use this buyback. So company will announce the buyback, and if any shareholders willing to buy, sell the shares to the company will buy it and cancel them. Automatically promoters holding will increase, na? Yes, this could be another reason why company wants to go for buyback. So to increase the promoters holding, because see, for decision making and all, promoters should have the major interest in the company. Otherwise it is very difficult for the company to take the decisions. So that's the reason why company will go for this. And also, sir, so because of the buyback, company can, increase the promoters holding, right? And same manner, when outsider wants to take over the company, so what company can do is, company can announce the buyback, purchase the shares from the minority shareholders, and so that promoters holding can be increased, so that they can, stop the company to go into the hands of the hostile, our competitors. So to discourage the hostile bid to take over the company. This could be another reason why company will go for buyback. And increase EPS if there is no dilution in the company's earning. So because of the buyback, what happens is your earning per share will increase. Earning per share will increase, sir. Especially if there is no change in the earnings. For example, there is a company, sir, 23-24, the company net profit is 100 lakhs. Number of equity shares 10 lakhs. So what is EPS basically? Net profit divided by number of equity shares, 10 EPS. Next year 24-25 also, suppose 100 lakhs is the net profit. But company announced the buyback. Now 10 lakh shares has become 5 lakhs. That means the EPS is increased to 20. That means because of buyback, number of shares are reducing. Suppose if the earnings are constant, because there is a reduction in the number of shares, obviously your earning per share will increase, right? So to increase EPS and thereby the market price of the share. So whenever company wants to increase the EPS and thereby the market price of the share, so they can go for buyback. So this could be another reason why company can go for buyback to increase EPS. So and thereby the market price if there are no impact on the earnings. And also whenever you have any surplus cash and if it is not effectively utilized in the business, no need for business, so company can go for buyback. See, for example, company collected 10 crore rupees by issuing shares. Out of these 10 crores, only 8 crores were effectively utilized for the company. 2 crores, so not at all required for the company. What company can do? It can return back to the shareholders. So buyback is nothing but what? Returning the capital to the shareholders, right? So that's why. So pay surplus cash to the shareholders when it is not needed for business. So these are the advantages or objectives for buyback. So to support the share price, especially in the depressing market conditions, and to discourage the hostile bid to take over the company by increasing the promoters holding, and also to increase the EPS if the earnings are constantly same, and also to pay surplus cash to the shareholders if it is not needed for business. So these are the some of the reasons why the company can go for buyback. Now, sources for buyback. Okay. Now, whenever a company wants to buy back its own shares, sir, what are the sources a company can use for buyback of its own shares? So, Section 68 of the Companies Act says there are 3 sources you can use for buyback of shares. One is free reserves of the company. Another one is securities premium. Another one is proceeds of issue of any shares or other specified securities. Sir, definitely for buyback of its own shares, company require money, right? Funds, resources. Now, they said the following sources you can use. You can use your own profits, that is nothing but free reserves. Or if any securities premium is collected, whenever shares are issued at premium, you might collected any premium amount, right? Securities premium. So that amount you can utilize. Or else what you can do is you make a fresh issue of shares or other specified securities. Suppose company wants to buy back equity shares. Now they can issue preference shares. Whatever the amount collected from issue of preference shares, they can use it for buyback of equity shares. So like this, there are 3 sources for buyback of shares. But here one important rule, sir. Suppose a company wants to buy back equity shares. It cannot issue equity shares and whatever the proceeds collected, so they can utilize for buying back of equity shares. It doesn't make any sense because on one hand you want to cancel the equity shares, on the other hand you want to issue the equity shares. So it is not correct now. So that's why Companies Act says no buyback of shares can be made from the proceeds of an earlier issue of the same type of shares or securities. For example, equity shares cannot be bought back using proceeds of equity shares. For example, a company wants to buy back equity shares. Now the company requires money, right? So they can issue preference shares. Whatever the amount collected from preference shares, they can use it to purchase the equity shares. So that is the one important point you need to understand. And here other specified securities means employee stock options and other securities as notified by the central government. So can you tell me what are the sources a company can utilize for buyback of securities? 3 sources. Its own profits, that is divisible profits. Divisible profits means free reserves. And securities premium, important. Securities premium, even the amount which is collected when shares are issued at premium, that premium portion we can utilize. And also any proceeds of issue of any shares or other specified securities. Suppose if the company does not have its own profits, what they can do is they can make a fresh issue of shares, and from this fresh issue of shares, whatever the amount collected, that amount they can utilize for buyback. And free reserves means, sir, free reserves means any profits which is available in the company which can be used for distribution of dividend. Divisible profits, nothing but. So which can be used for any purpose. There is no specific restriction. So free reserves are the reserves available for distribution as dividend as per the latest started balance sheet, but excluding. See, some reserves cannot be considered as free reserves. Like for example, any unrealized gains, any notional gains or assets revaluation, even if shown as a reserve, suppose assets was revalued, so there is a revaluation surplus. Can I say revaluation surplus is my free reserve? No, answer is no. Revaluation surplus, any notional gains, any unrealized gains, so we cannot call it as free reserves. And also any changes in the carrying amount of assets and liabilities recognized in equity, including profit and loss, including P&L account surplus from the fair value measurement. See, we might measure the assets and liabilities at their fair value. In that process, either we may increase the asset value or we may decrease the asset value. Similarly, we might increase the liability, we might decrease the liability. For example, if I increase the asset value, maybe it is a kind of a gain. So can I call it as free reserve? No. Suppose if I reduce the asset value, it is a kind of a loss for me. So can I call it as free reserves? In the sense, can I adjust it to the free reserves? Can I consider it as a part of reserves? No. Similarly, suppose the liability book value is 10 lakhs and the fair value is only 8 lakhs. So I can reduce liability by 2 lakhs. So this is called a gain resulting from the change in the carrying amount of liability. Now, can I call this 2 lakhs as my free reserves? Answer is no. Any change in the carrying amount of assets and liabilities, okay, because of the fair value measurements. Fair value measurement means the market value or the fair value. So the assets and liabilities we will value at their fair values. So because of that, so the carrying amount of the assets and liabilities now brought to the fair values. In that process, any gains created, those are not considered as free reserves. So free reserves basically means a reserve which can be available for distribution of dividend. But understand, any notional gains, so they are not actually gains. So notional gains, any unrealized gains, any asset revaluation gains, so they cannot be considered as a part of free reserves. And also any change in the carrying amount of assets and liabilities because of the fair value measurements, they cannot be considered as free reserves. Okay. So these are the sources of buyback. So whenever a company going for buyback, these sources they can utilize. Either it's utilize its own profits, free reserves, or it can use securities premium, or it can use proceeds of fresh issue. Of any shares or other specified securities. Only these three sources can be utilized for buyback of securities. But of course, apart from these three, any other source, how it is possible? Tell me, sir. Your own profits, free reserves, securities premium, they are giving the option. And else, if it is not possible, then you go for fresh issue. So what else you had? Tell me. So that means literally they are covering all kinds of sources. Okay. Of course, they are not saying that, see, you can, use your whatever the amount collected from whatever the amount already collected by issuing of the shares. So that amount you cannot utilize. See, they are saying that proceeds of issue of any shares or other specified securities. Now you can issue the shares. Whatever the proceeds came, that proceeds you can utilize. Okay. Now, what are the limits for buyback? Now see, sir, in buyback, what is happening, sir? Company is purchasing its own shares, right? Now, you want to purchase your own shares with an intention of cancellation, but Act is putting some restrictions. Act is saying that there are certain limitations for buyback. We are putting some limitations. Actually, in this chapter, sir, they can coin one question. They will give you details of a company and they will give you the latest balance sheet of the company. And they will say, this company wants to buy back this many number of shares. Now, tell me whether it is allowed as per the Companies Act or not. Is it within the permissible limits? Is it within the limits as per the Companies Act or not? They will ask a question like that. Now, in that case, what you need to do is you need to apply 3 tests. Very, very important, sir. 3 tests you need to apply. So therefore, the maximum number of shares that can be bought back is equal to least of the above test. There are 3 tests, sir. So if they ask a question, whether company wants to go for, whether these many number of shares are permitted as per the Companies Act or not, then you need to apply these 3 tests and the maximum number of shares to be bought back is equal to least of the 3. That means all the 3 conditions must be satisfied. So that many number of shares you can buy back. So what are the 3 tests? First, resource test. Resource test means the amount test. How much amount you can utilize for buyback. See, the Companies Act is saying that the amount of buyback, the amount which you can use for buyback cannot exceed 25% of the total paid up capital plus free reserves. So buyback amount, sir, important, sir. This is amount condition, sir. Amount. How much amount maximum I can use for buyback? So buyback should not exceed 25% of the total paid up capital and free reserves of the company. This is the first condition you need to remember. 25% of the total paid up capital and free reserves. So therefore, by following these conditions, 25% of the paid up capital and free reserves I will find out, and with that amount how many shares I can buy back. Suppose for example 1 lakh shares came. So this is the maximum number of shares I can buy back by using this test, resource test, by following resource test. Next I need to go for shares outstanding test. In shares outstanding test they are saying that if any company buying back its own equity shares, then the buyback of equity shares cannot exceed 25% of the total paid up equity share capital of that financial year. Suppose a company is purchasing buyback of its own equity shares there, then the limit is 25% of the total paid up equity share capital of that financial year. So that means out of the total number of equity shares it's issued, 25% it is allowed to buy back. So buyback of equity shares, remember, buyback of equity shares in any financial year cannot exceed 25% of the total paid up equity share capital of that year. So buyback of equity shares cannot exceed 25% of the total paid up equity share capital of that financial year. Okay. So by following second condition, second test, shares outstanding test, suppose the number of shares to be bought back 1.5 lakhs came. 1.5 lakhs, because you can purchase maximum 25% of the total paid up equity share capital. And the last test, debt equity ratio test, which says the total debt, both secured and unsecured, after buyback cannot exceed 2 times the total paid up capital and free reserves. That means debt and equity ratio. So the debt cannot exceed 2 times of the total paid up capital and free reserves. So this is the condition you need to follow, sir. You need to make sure that the debt of the company after buyback cannot be more than 2 times of the equity of the organization. So here equity means total paid up capital plus free reserves, including securities premium. See here one important thing, sir. Here debt to equity. Equity means not just equity share capital, sir. Here equity means share capital plus free reserves. Share capital plus free reserves. See this, paid up capital plus free reserves. And securities premium also can be included. This is called equity. So your debt should not be more than twice the equity. That is test number 3. So by following this test, debt equity ratio test, how many shares you can buy back? For example, 2 lakhs came. That means see, by following resource test, 1 lakh shares you can buy back. By following shares outstanding test, you can buy back 1.5 lakhs. By following debt equity ratio test, you can buy back 2 lakh shares. That means all the 3 tests, how many number of shares you can maximum buy back, sir? Least of the above 3 tests. Least is 1 lakh. So therefore the maximum number of shares that can be bought back as per the company's act is 1 lakh shares. Sir, why least of the above 3, sir? I will go for highest of the above 3. Suppose highest of the above 3 is what? 2 lakhs. That means you are violating 2 conditions. That is resource test failed, shares outstanding test failed. All the 3 tests must be satisfied, sir. By satisfying all the 3 tests, how many shares maximum you are permitted to buy back? That is called maximum number of shares bought back as per the Companies Act. So therefore Act says, sir, whenever a company wants to buy back, so we are putting 3 limitations. One is resource test. That means amount. How much amount I can use for buyback? 25% of the total paid up capital plus free reserves. That's it. Second, if you are buying back equity shares, make sure that the buyback of equity shares cannot exceed 25% of the total paid up equity share capital of that financial year. And the last is debt equity ratio test. Debt cannot exceed 2 times the equity, okay, after buyback. So therefore your buyback should be in such a manner that the ratio will be maintained. So 2:1 ratio will be maintained. Okay, debt equity ratio will be maintained in the ideal ratio. So therefore these are the limitations for purchase of our own shares. So important limitations that these are, because see, basically Companies Act wants to, they are, why they are putting these restrictions is, at the end of the day, it is in the best interest of the company these things should happen. So in the name of buyback of securities, you cannot unnecessarily, divert the funds of the organization. So that could be the major intention. That's why they are putting all these limitations, saying that, see, you cannot purchase you cannot utilize 25% of the total paid up capital plus free reserves. And if you want to buy back equity shares, it cannot be more than 25% of the total equity capital. Debt equity ratio should be ideally maintained. It should not be disturbed because of the buyback. So it is in the overall best interest of the company you need to do. So that's why these conditions were there in the Companies Act. And apart from that, there are some other legal provisions also, sir. Like whenever a company wants to go for buyback, so they need to, there must be a provision in the, it must be authorized in the articles, and special resolution must be passed. Okay, suppose if the buyback is 10% or less, then board approval, board resolution is sufficient. Then only fully paid up shares must be bought back. And if your shares or securities are listed in recognized stock exchange, then SEBI guidelines also we need to follow. And buyback must be completed within 12 months of passing special resolution or board resolution. And whenever a company wants to buy back its shares, it can purchase the shares from the existing shareholders proportionately, or from open market it can purchase. Or if any shares issued to employees under stock options or sweat equity, they can purchase from them. And every company, before going for buyback, they must file one declaration of solvency with ROC as well as SEBI, which is signed by at least 2 directors. And once the buyback is completed, sir, the shares must be physically destroyed within 7 days of completion. I told you the buyback, once the buyback is completed, the shares must be cancelled. And cooling period, this is called. So that means once the buyback is completed, sir, same kind of shares you cannot issue for the next 6 months, except of course in the form of bonus shares, or to fulfill any obligations like stock options you can issue. But suppose a company purchased equity shares, next 6 months same kind equity shares cannot be issued. Please understand, what's the point? Tell me. On the one hand, you are purchasing your own shares with an intention of cancellation, you are cancelling them. On the other hand, same kind of shares you are issuing. It doesn't make any sense. That's why Act says 6 months is the cooling period. Once the buyback is completed, same kind of shares you cannot issue for the next 6 months. And also you need to file one return after completion of buyback. And suppose if company is not following the provisions, then fines, all these things will be there. So because all these legal provisions are predominantly, main focus is on the legal aspects. But these 3 conditions, limits for buyback, resource test, shares outstanding test, debt equity ratio test, these are, accounting point of view, very, very important. And next important concept in this buyback of securities, sir, CRR concept, sir. Capital Redemption Reserve concept. Very, very important, sir. Sir, we have discussed it, sir. What are the sources company can use for buyback, sir? Free reserves, securities premium, fresh issue of shares. Now, suppose if company depends on its own reserves, like free reserves and securities premium, from the company, existing reserves will be reduced, existing sources will be reduced, right? So therefore, on one hand, you are purchasing your own shares by using your own profits. That means your resources will be reduced in the organization. So creditors not happy. One thing. Second thing is, because of the buyback, ultimately there is a scale down of capital. Scale down of capital. See, in the entire Companies Act, sir, there are, 2 situations. 2 situations. One is buyback of securities. Another one is redemption of preference shares. Redemption of preference shares and buyback of securities. In both these situations, what is the common thing, sir? We are using our own free reserves or securities premium for buyback. In this case, for example, buyback you take. So suppose if company has done the buyback of securities by using free reserves or securities premium, and ultimately our funds, our resources in the organization has been decreased, and also our share capital has been down. That means scale down of capital, because after buyback you are cancelling the shares. So tell me, scale down of capital, is it a positive or a negative thing? Or the reserves of the company decreased, were creditors happy or not? Not happy. Creditors not happy because the amount of funds available to them has been decreased. So therefore, here 2 negative things are happening. One is the existing sources have been decreased. Second thing is there is a scale down of capital. Now, how can you plug out? How can you, overcome these negative situations in this case? That's why Companies Act says they're introducing a concept of CRR, Capital Redemption Reserve. Now, what is the object of creating CRR, sir? One is capital intactness. Second one is to protect the interest of creditors. To protect the interest of creditors. Sir, what we need to do in this concept, in the concept of CRR? Simple. whatever be the nominal value of shares you are buying back, to that extent, you transfer from your free reserves to a reserve called CRR. And again, this CRR reserve, you utilize it for fully paid bonus shares. That means again, it is creating in the form of share capital. That means, see here, from the existing free reserves, you transfer an amount to CRR, and later on this CRR will be used for issue of fully paid bonus shares. That means equity share capital will be created. That means we have capital intactness because of the buyback there is a decrease in the capital. Now the capital is intact. Why you are creating CRR? This reserve will be utilized only for issue of fully paid bonus shares. That means in the future definitely the CRR is going to become our share capital. So that is one thing. Second thing is, once you freeze the free reserves to CRR, what happens is the amount of funds which is available for distribution of dividend has been reduced. That means creditors are also happy because now the funds are available to the the funds available for distribution, the divisible profits have been decreased because free reserves have been transferred to CRR. So that's how creditors' interest is also protected. So why Companies Act is saying you need to create a specific reserve whenever a company went for buyback in case of when they have utilized free reserves or securities premium. The logic is very simple. Because company is depending on its own funds, free reserves or securities premium, because of that there is a scale down of capital ultimately because of buyback, or even if you see redemption of preference shares also the same provision is there. You need to create an CRR whenever you are depending upon your own free reserves. So we want to make the capital intactness one thing. Second thing is we need to protect the interest of creditors. So both things can be achieved through creation of CRR. And that is the reason why company has to create CRR whenever they utilized free reserves or securities premium. See this, when a company buy back shares using free reserves or securities premium, a sum equal to the nominal value of shares of purchase be transferred to CRR, which is disclosed in the balance sheet. Now the CRR can be used only for fully paid bonus shares. Now see, most of the students will ask me, sir, why CRR can be utilized only for this purpose? See, why you created CRR? To make the capital intactness and also to make sure that creditors' interest is protected. How creditors' interest is protected? See, free reserve means what? Which can be utilized for any purpose, including payment of dividend. Now I am freezing this free reserves by transferring to CRR. What is freezing means? That means suppose for example in my free reserves 10 lakhs is there, sir, and you purchase 2 lakhs worth of shares and cancel it, nominal value of shares. Now that means out of this 10 lakhs, 2 lakhs I am separating it and I am saying this is CRR. That means now the funds which is available in the organization is only 8 lakhs. I mean free reserves. Literally, which can be used for payment of dividend, 8 lakhs. That means creditors are happy now because only the funds available for payment of dividend is 8 lakhs. That means company has separated 2 lakhs. Now these separated funds, what they will do? They will give in the form of bonus shares. Actually, this 2 lakhs is also shareholders fund only, but it cannot be given as dividend. If you give a dividend, cash will also flow from the organization. Again, the funds of the resources of the organization will down. That is not the intention here. The act intention is what? So they want to make the capital intactness and at the same time they want to protect the interest of creditors. How they can protect the interest of the creditors? By restricting some of the free reserves. So by freezing some of the free reserves, by transferring to a separate reserve called CRR, by transferring to separate reserve CRR, and then you using this CRR again for the shareholders only in the form of bonus shares. So that is the logic here. Okay. And see, sometimes what happens, sir, company will go for buyback and generally buyback price is more than the face value of the share. For example, buyback price is 30, face value of the share is 10 rupees. That means how much is the premium company is paying, sir, ready to pay? 20 rupees. Now this premium on buyback, what company can do is they can adjust it whenever you're doing the accounting treatment. So the premium on buyback, company can adjust against the securities premium or free reserves of the company. So the buyback premium, that is excess over par value, must be adjusted against either free reserves or securities premium account. And remember guys, revaluation reserve cannot be used for buybacks. Revaluation reserve cannot be because it is not a free reserve. We cannot utilize it. So these are the legal provisions. So whenever a company utilizing its free reserves or securities premium, generally they need to create CRR. But sir, suppose when a company utilizes fresh issue, freshly they went for issue of shares. Now, company, can it need to create CRR? Answer is no. No, not required to create CRR. Why? Suppose for example, sir, company went for fresh issue. Now when company went for fresh issue, what happens? Bank account debtor to share capital created, na? Suppose 2 lakhs, 2 lakhs. Example. Now this 2 lakhs capital is created in the organization. So on the one hand, because of buyback, capital reduced. Since you went for buyback of, you went for fresh issue, capital was, whatever the capital reduced, it was get compensated, get fulfilled by fresh issue. That means capital intactness is there. One thing. Second thing is creditors are also happy because existing funds have not been utilized. Na? Only fresh funds came and those funds have been utilized in the organization for buyback. So therefore, no need to create CRR when a company went for fresh issue. That is the logic. Okay. Now what are the entries generally we will pass, sir? So if existing shares are partly called up and paid up. See, I told you, no, sir, one of the conditions for buyback is shares must be fully paid up. So first, for example, if the existing shares are partly called up and paid up, sir, make it fully paid up. So make the final call. So equity share final call to equity share capital. And you receive the amount bank account data to equity share final call. Then suppose company is going for buyback. Suppose company can issue new shares. If the company issued new shares for proceeds for buyback, so bank account data to preference share capital to securities premium if shares are issued at premium. Sale of investment. See, suppose existing investment can be sold. Sometimes for buyback, company can create a source by sale of its own investment. So bank account data to investment. If it is a profit, credited to P&L account. If it is a loss, debit to P&L account. And then amount due on buyback to equity shares. So equity share capital account data premium on buyback to equity shareholders. For example, we purchased 10 lakhs worth of equity share capital and premium is 20 lakhs. So total amount payable to equity shareholders is 30 lakhs. So what is the due entry for buyback? Share capital account data premium on buyback to equity shareholders account. Okay. And then suppose if you utilize the existing source, sourcing or providing for premium payable on buyback. Securities premium, P&L account, general reserve premium and buyback. Whatever the premium you created, sir, this premium you can adjust against the free reserves or securities premium. Next, whenever you utilize the free reserves or securities premium, you need to transfer the funds to CRR to the extent of the nominal value of shares bought back. So what is the entry? Free reserves to CRR. Free reserves can be P&L account, general reserve, revenue reserve, or any other divisible profits to CRR. And finally, you make the payment to equity shareholders to bank. So these are the entries generally we will pass at the time of buyback, sir. Okay. So therefore, before buyback, if the shares are partly paid up, make it fully paid up. If the investment are sold, write the sale entry. Then amount due for buyback and then adjustment of premium on buyback against the free reserves or securities premium transferred to CRR if the company depends upon its own shares, its own reserves. And then if the fresh issue happened, write the entry for fresh issue of shares also. And then finally payment to shareholders. And along with this, there is one more section in the Companies Act, section 70, sir. The company cannot buy back their own shares or specified securities through subsidiary companies or investment companies. So if there is any outstanding default, company cannot go for buyback. And even after clearing outstanding dues, buyback is allowed only after 3 years. And there are some SEBI regulations also. A company cannot buy back 15% or more of its paid up capital and free reserves. New buyback offer cannot be made within 1 year of the previous buyback. At least 50% of the allocated funds must be used for buyback. So this is the entire concept of buyback of securities, sir. Okay. Now, see here the most important things are questions, sir. You need to solve the questions properly. So what I will do is, in my regular class, whatever the problems I solved, sir, I will put the video in the YouTube. Mostly 2 models. One is finding the maximum number of shares to be bought back. For that, one video, one problem, detailed way I solved it, I will put it. Because see, problem solving is altogether different. Once you listen to the theory, so you 2 or 3 times revise it and then go and solve the questions. So in the YouTube, I will put the problems relating to buyback of securities and you can watch them after completion of this concept so that the entire chapter will be completed. Now let's start amalgamation of companies, accounting standard 14. Accounting standard 14 is the exclusive standard which talks about amalgamation of companies. So usually from this chapter, sir, they are asking one big question, and of course you can expect a 5 marks question relating to calculation of purchase consideration from this chapter, and MCQs, 1 or 2 MCQs are also possible from this chapter. Now let us start amalgamation of companies with accounting standard 14. Now first, meaning of some important terms. See, in amalgamation chapter, sir, 3 important words first you need to understand. What is amalgamation, absorption, external reconstruction? So the 3 words are amalgamation, absorption, external reconstruction. What is amalgamation? 2 or more existing companies liquidated and joined together to form a new entity is called amalgamation. 2 or more existing entities, they want to do business together under one company. What they will do, the existing companies will liquidate their businesses and these businesses will be combined together under the one company name. So this is called amalgamation. So in amalgamation, new company will be formed, right? Now, for example, you see Vodafone Idea, 2 independent companies, Vodafone Idea, Vodafone India, Idea Cellular, 2 companies, sir. And Vodafone Idea Limited formed new entity. That means here what happened? A new entity is formed, Vodafone Idea Limited, which has taken over the businesses of Vodafone and Idea. Now the companies which are liquidating, which are transferring their businesses, are called transferor companies. And the company which is newly formed, which take over the business of transferor companies, is called transferee company. So in this chapter, we are going to learn the accounting treatment in the books of transferee as well as transferor. Okay, this is what amalgamation is. What is absorption? See, absorption is one existing company takes over the business of another existing company. Here no new company is formed. For example, A Limited takes over the business of B Limited. Any new company formed? No. So A takes the B Limited, right? A Limited is called transferee company. B Limited is called transferor company because B Limited is transferring their business to A Limited. So technically now B Limited will no more in existence. It is going to be liquidated and their business will be transferred to A Limited. Now A Limited will continue the business. For example, you see Bank of Baroda has taken over Vijaya Bank and Dena Bank. Both were merged into Bank of Baroda. Now here Bank of Baroda is called transferee company, which will continue after absorption. Vijaya Bank and Dena Bank both are no more in existence. They are transferring their business to Bank of Baroda. So like this, these are the examples. One existing company takes over the business of another existing company is called absorption. Now come to the external reconstruction. Sir, external reconstruction is very simple, sir. A new company is formed to take over the business of existing company is called external reconstruction. A new company is formed to take over the business of existing company is called external reconstruction. Or I can say like this. A existing company transformed itself into a new company. An existing company transformed itself into a new company is called external reconstruction. So what is the difference between absorption and external reconstruction? See, in absorption, one existing company takes over another existing company. That means no new company is formed. But in external reconstruction, one new company is formed to take over the business of existing company. Or existing company transformed itself into a new company. Therefore, definitely new company will be there, which is transferee company, which will continue after external reconstruction. And the old company which is transferring its business or which is transformed itself into a new company is called a transferor company, which is no more in existence. Like for example, LG. So LG, life's good. This company, LG company, previously it was Gold Star. Gold Star has transformed itself into LG, sir. So therefore, this is external reconstruction. So there are 2 types of reconstructions, internal, external. Both we have in syllabus. Internal reconstruction means what? When the organization has internally some problems. Like for example, continuously suffering with excessive, losses. We have huge accumulated losses, maybe overvaluation of assets. So these problems are there. You sort out within the organization, internal reconstruction. Sometimes internal reconstruction may not be possible. Then you go for external reconstruction. So many companies are nowadays are going for external reconstruction. So these are the meaning of important terms which we have used in this standard. So amalgamation, absorption, external reconstruction. Amalgamation, two or more companies liquidated and joined together to form a new entity. Absorption, one existing company takes over the business of another existing company. External reconstruction, a new company is formed to take over the business of existing company. And I have given examples also here, and I have explained the practical examples also. And in amalgamation, minimum how many companies will be involved? 3 companies. 2 existing companies, 1 new company. So minimum 3 companies are involved. In absorption, minimum 2 companies involved. So transferor company, transferee company. In external reconstruction also, only 2 companies are involved. Only 2 here in external reconstruction. But in absorption, at least 2. That means one existing company may take over 1 or more existing companies also. So depending upon the number of companies involved, so it will work out. And number of new resultant companies. Sir, in amalgamation, any new companies formed? Answer is yes. In absorption, no new company. But in external reconstruction, yes, there is a new company. And what is the objective? Of course, I am going to explain the objective also. Wait. So this is the first topic, sir. Meaning of some important terms. But the important conclusion is, sir, as per accounting standard 14, they say amalgamation includes absorption as well as external reconstruction. Even though amalgamation, absorption, external reconstruction, technically they are different, but from the point of view of accounting standard 14, they will collectively be seen as amalgamation only. Therefore, the accounting treatment is equally applicable for everything. I mean, whether it is amalgamation, absorption, external reconstruction, when you are solving the question, you might identify, this is amalgamation, this is absorption, this is external reconstruction. But there is no difference as far as the accounting treatment is concerned as per accounting standard 14. That's why AS 14 says amalgamation includes absorption and external reconstruction. So, but see, we should understand the meaning. But when it comes to accounting standard 14, there is no clear-cut distinction between, I mean, there is no separate accounting treatment for each one of them. All of them will be seen as amalgamation only. Okay. So this is the first topic. Next, types of amalgamation. Before going to the types of amalgamation, sir, out of my interest, so I am going to explain why amalgamation. Sir, why amalgamation will be done very quickly. See, 1 or 2 minutes. See, to face the competition effectively. For example, Idea Vodafone. Why they have combined as one new entity, sir? Because to face the competition from Zio. To face the competition from Zio, so they, joined together and formed a new entity. Otherwise, they won't survive this much time in the market, sir. They have been thrown out of the market because of the competition, heavy competition from Zio on one hand, on the other hand, Airtel. So these 2 big companies are there. Now, what about the Idea and Vodafone? If they are doing business independently, they may not face the competition effectively. So that's why to face the competition, they went for amalgamation. And also to have a global presence. How to have a global presence, sir? You purchase a company in the foreign country. For example, Tata Motors has acquired Chorus company, European second largest steel manufacturer company. Why? Why they purchase? Because global presence. Or to enjoy the economies of large scale production. So if you want to enjoy the economies of large scale production, so amalgamation, absorption, external reconstruction will help you. You can acquire so many companies so that you can produce in large quantities so that there will be savings in the production. And to enter into the new markets. See, nowadays the trend is that when any big company wants to enter into any new market, they are not going to start from zero. They just purchase the company which is already there in that business. So that's it, we enter into that business. For example, Reliance Industries Limited, they want to enter into the pharmaceutical company. What they will do? They won't start from the zero. They will purchase already one of the existing pharmaceutical companies. They will see and they will work out the deal and they will purchase. That means it is an amalgamation. So, and also to have some tax benefits, these amalgamations will be worked out. So therefore, we understood why amalgamations are done. At the end of the day, amalgamation is done for the overall benefit of the organization only. Either to face the competition effectively, or to have a global presence, or you want to enter into the new market, or tax benefits, different kinds of reasons. So amalgamations will be worked out. Now, next important topic is types of amalgamation. Sir, as per accounting standard 14, there are two types of amalgamation, sir. One is amalgamation in the nature of merger. Another one is amalgamation in the nature of purchase. Amalgamation in the nature of merger, amalgamation in the nature of purchase. There are two types of amalgamation. Sir, these types of amalgamation is relevant whenever you are doing the accounting for amalgamation in the books of transferee, not transferor. Because in fact, accounting standard 14 is applicable only for transferee companies, not for transferor companies. Why? Because transferor companies, anyway, they are liquidating, they are transferring their business. So what is there to do in the books of transferor? Just close the books of accounts. So irrespective of the type of amalgamation, the accounting treatment remains the same in the books of transferor company. But when you are a transferee company, then in your books, how the accounting treatment will be done, that depends upon the type of amalgamation. So therefore, amalgamation is here basically divided into two types. One is amalgamation in the nature of merger, another one is amalgamation in the nature of purchase. And this classification is relevant for transferee, especially when you are doing the transferee company books. There are two methods of amalgamation. The method of amalgamation you select depending upon the type of amalgamation. For example, if it is amalgamation in the nature of merger, they say pooling of interest method you need to follow. If it is amalgamation in the nature of purchase, you need to follow purchase method. Like this, there are two methods of accounting for amalgamation in the books of transferee. So for that, which method I need to select depends upon the type of amalgamation. So therefore, understand this type of amalgamation is relevant for transferee, not for transferor. When you are a transferor company, anyway, you are transferring your business to transferee company, so your books of accounts must be closed. Therefore, only closing of books of accounts will happen in the transfer books. Those closing entries we will write. Okay. Now let us try to understand what is amalgamation in the nature of merger. See, if you see the accounting standard 14, sir, they have given 5 conditions. If all the 5 conditions are satisfied, then we say it is amalgamation in the nature of merger. Otherwise, it is purchase. So there are 5 conditions. If all the 5 satisfied, that is called amalgamation in the nature of merger. Now, why they use the word merger, you will understand after these conditions. So see, the standard has used very appropriate words. They use the word merger. Why they have used the merger here? Because depending upon the conditions. See this. What are the conditions? First condition, sir. Assets and liabilities transfer. All the assets and liabilities of transferor company must be transferred to transferee company by virtue of amalgamation. All the assets and liabilities, including reserves and surplus generally, must be transferred of transferor company must become those of the transferee company. That means entire balance sheet of transferor except fictitious assets now will become the part of transferee company. So when you are reading the question, you see whether all assets and liabilities transferred or not. For example, A Limited is taking over B Limited. All assets were taken except cash. That's it. It is not amalgamation in the nature of merger because cash not taken. All assets and liabilities must be taken. This is the first thing. Next thing, last condition, book value of assets and liabilities. All assets and liabilities must be taken over at their book values only. So no changes should be made to the book value of assets and liabilities except for consistent accounting policies, except to ensure uniformity of accounting policies. So when transferee company takes over the assets and liabilities of transferor company, everything will be taken over at their book values only. Book values only. So all assets and liabilities will be taken over, that too at book values. Okay. So when you are reading the question, observe. Any asset and liability is taken other than at book value. That's it. You say amalgamation in the nature of purchase, not merger. Because to become a merger, all 5 conditions must be satisfied. So first condition, all assets and liabilities must be transferred, including reserves. Second, everything will be transferred at book values only, except to ensure uniformity of accounting policy. Suppose if there is no uniformity in the accounting policies of transferor and transferee. Now, as a transferee company, whenever I know that the accounting policies of the transferor is different, now I make some modifications to suit my accounting policies. So that's allowed. That's solely. That is the only thing you allowed to change. Otherwise, you cannot take any assets and liabilities other than book values. If you take in, that is amalgamation in the nature of purchase, not amalgamation in the nature of merger. So these are the 2 main conditions here. Because why I'm stressing these 2 conditions now? When you're reading the question, these 2 conditions only will help you to identify whether it is amalgamation in the nature of merger or purchase. So whether all assets and liabilities are taken over or not, everything will be taken over at book values or not. Suppose for example, A Limited takes over B Limited. They have given in the question, A Limited take over stock of the B Limited at cost plus 10%. That's it. Cost plus 10% means they are not taking at book values. That means it is amalgamation in the nature of purchase. Okay, so these two conditions. Now see the remaining conditions. Shareholders approval. See, very, very important. Listen to me. Sir, shareholders holding not less than 90% of the face value of equity shares of the transferor company. Shareholders holding not less than 90% of face value of equity shares of the transferor company must become the equity shareholders of the transferee company. Here so many of them are not understanding properly. They don't know how to interpret this. See, very simple here. Here they are not talking about number of shareholders. They are talking about shareholders holding at least 90% face value of equity shares. Entire amalgamation condition, sir, they are talking only about equity shares. They are not talking about preference shareholders. Please remember. So here shareholders approval means, suppose I am transferor company. In my company, equity shareholders will be there now. Equity shareholders holding 90% face value of equity shares must agree to become the equity shareholders of transferee company. So my company equity shareholders having at least 90% face value of equity shares must agree to become the equity shareholders of transferee company. See this, shareholders holding not less than 90% of the face value of equity shares of the transferor company must become equity shareholders of the transferee company. So therefore, you have to see in the amalgamation whether transferor company equity shareholders having at least 90% face value, not 90% shareholders, equity shareholders. The shareholders who is having at least 90% face value of equity shares must agree to become the equity shareholders of transferee company. If that is the case, then it is amalgamation in the nature of merger, provided remaining conditions are also satisfied. Now, consideration. This is also very interesting. Sir, just now we have seen shareholders holding not less than or at least 90% face value of equity shares of transferor company must agree to become the equity shareholders of transferee company. Now for them, the purchase consideration will be given only in the form of equity shares by the transferee company. Sir, listen to me. In amalgamation, what happens, sir? One company basically taking over another company. Now, why another company will give you freely their business, sir? You have to pay some consideration. To whom you pay consideration? To the owners. Who are the owners of the transferor company? Shareholders. For example, if I purchase a building, so A is the owner of the building. I purchased the building from him. So I need to pay some consideration. Similarly, I am the transferee company. I am taking business of transferor company. So I need to pay consideration. So as a company, how consideration will be paid? It can be in any form. It can be this company can issue its shares, equity shares, preference shares, debentures, cash, whatever. I will give to whom? The owner of that company, transferor company. Who is the owner of transferor company? Shareholders, their shareholders. Which shareholders? Equity shareholders and preference shareholders. But they are talking about here only equity shareholders. Please understand. So therefore, transferor company equity shareholders having at least 90% face value of equity shares, they agree to become the equity shareholders of transferee company. For them, the purchase consideration will be given only in the form of equity shares to become merger. And suppose, for example, purchase consideration is given in any kind, any other form, other than, apart from equity shares, then it automatically becomes amalgamation in the nature of purchase. Of course, see, when you are working out the purchase consideration, sir, if the fractional shares came in fractions, number of shares to be issued by transferee company to the transferor company equity shareholders came in fractions. Shares cannot be issued in fractions, na? So now for that fraction, cash can be paid. That's an exception. That is allowed. So therefore, the consideration must be in the form of equity shares of transferee company to those equity shareholders of transferor company who agree to become the equity shareholders of transferee company, except cash can be paid for fractional shares. So therefore, transferor company equity shareholders who agree to become the equity shareholders of transferee company, for them the purchase consideration totally is given in the form of equity shares only, except cash can be paid for fractional shares. So this is fourth, one more condition, business continuity condition. Sir, the transferor company business must be agreed to be continued by transferee company after amalgamation. So the business of transferor must continue under the transferee company. Now, if all the 5 conditions are satisfied, then we say it is merger. So therefore, quickly, what is first condition? All assets and liabilities of transferor company must become the assets and liabilities of transferee company because of amalgamation. Second, all assets and liabilities will be taken over at their book values only, except to ensure uniformity of accounting policies. Next, shareholders having at least 90% face value of equity shares of transferor company must agree to become the equity shareholders of transferee company. Next, the consideration must be in the form of equity shares of the transferee company to those equity shareholders of transferor company who agree to become the equity shareholders of transferee company by virtue of amalgamation. Of course, cash can be paid for fractional shares, and the transfer company business must be agreed to be carried on by transferee company. So that's why this is called merger, sir, because here there is a genuine pooling of resources. We are taking all assets and liabilities, that too at book values, and your shareholders having 90% face value becoming our equity shareholders, and we are continuing your business. What else you require? So everything, we are completely 100% absorbing your business into us. So therefore this is merger. The word merger means I am absorbing you into me. Therefore my company is absorbing you. Therefore it is amalgamation in the nature of merger. Look at the conditions. So have you selectively purchasing anything from the transfer company? No. Whether your owners of the company is also becoming my company owners? Yes. I am giving equity shares to them. 90% face value. So therefore, and purchase consideration is also I am giving only in the form of equity shares. And your business I am carrying. So there is a genuine pooling of resources. That's why it is amalgamation in the nature of merger. Otherwise, it is amalgamation in the nature of purchase. If any of the conditions not met, the amalgamation is called amalgamation in the nature of purchase. So therefore, this is very, very important, sir. Types of amalgamation. It is relevant for transferee company books. When you in the transferee company books, when you want to do the accounting, there are two methods of accounting. The methods will depend upon the type of amalgamation. So first, you need to identify the type of amalgamation. The type of amalgamation. There are two types: merger, purchase. To become a merger, 5 conditions are there. All the 5 must be satisfied. If any one failed, that is amalgamation in the nature of purchase. So the difference between amalgamation in the nature of merger and purchase I have given, sir. Same points just now we have discussed. Now, one more important concept. In examination, they can ask a separate question from this is purchase consideration. Listen to me carefully. Sir, what is this purchase consideration? Transferee company, which is taking over the business of transferor company, has to pay some consideration to the shareholders of the transferor company because they are the owners of that company. So as per the amalgamation agreement, whatever transferee company is giving to the transferor company shareholders, that is called PC. So PC is what? Aggregate value of shares, securities, cash, kind, whatever given by transferee company to the shareholders of transferor company. So whenever you are calculating the PC, sir, the recipient must be shareholder of transferor company. Mode of form is irrelevant, sir. In what form we are paying purchase consideration, not relevant. Who is the recipient? Shareholders. That's it. It is part of PC. So therefore, PC is what? The total value of shares, securities, cash or other assets. Given by whom? Transferee company. To whom? Transferor company shareholders. See, transferor company, also known as selling company, because they are transferring, they are selling their business to another company. Transferee company is also known as purchasing company, which is purchasing the business of transferor company. So some textbooks, they use the word selling and purchasing company. That is also correct. Transferor and transferee company books, they will use. So whatever you want to use, you can. So, but ultimately, what is the concept? Transferee company means the company which is acquiring the business of transferor company. So transferor company is going to be liquidated, transferee company will continue. So therefore, we need to learn the accounting treatment in the books of transferee as well as transferor. That is what. Now, what is purchase consideration? Purchase consideration is nothing but the aggregate of everything given by the transferee company to the shareholders of transferor company. So therefore, see here, only payments made to equity and preference shareholders, because shareholders means both equity and preference, are included in PC. Suppose, for example, sir, a transferee company taken over the debentures of transferor company, or transferee company discharged the liabilities or debentures of transferor company. For example, A Limited takes over B Limited. In B Limited, 10% debentures are there. Now 10% debentures, 1 crore is there. That 1 crore, that 10% debentures, transferee company has discharged to the debenture holders of transferor company. Will it be considered as a part of PC? No, because PC means only payments made to shareholders. So payments made to debenture holders, creditors are excluded. So students, please understand, PC means only amount paid to shareholders. Recipient is important, not the mode of payment. If you are making payments to debenture holders of transfer company, creditors of transfer company, or if you are discharging any expenses relating to the amalgamation, they are not considered as part of PC. To become PC, it must be paid to the shareholders of transfer company. Okay. Sir, to calculate this PC, there are some methods, sir. There are some methods. So out of these methods, sir, net assets method is very, very important method, sir. But when to use net assets method, that is what confusion for most of the students, sir. So now I am going to, from now onwards, you will have a clear-cut idea when to use net assets method. Simple. See, how to calculate PC, purchase consideration. We have lump sum method, net payments method, net assets method, and we have intrinsic value or share exchange method. Like that, there are 4 methods are there. So first, lump sum method. Lump sum method is one lump sum or fixed amount will be paid by transferee company to the shareholders of transferor company. How they have arrived this lump sum or fixed amount, sir? There is no scientific base. So one company acquiring another company and saying that we are going to pay 100 lakhs to you. That's it. So transferee company agrees to pay a lump sum or fixed amount. So if it is, in the question itself, they have given the PC. Most happy because no need to calculate. Suppose they said A Limited is taking over B Limited for 100 lakhs. So 100 lakhs is PC. That is called fixed or lump sum method. But mostly lump sum method will not be given, sir. So you need to work out the purchase consideration. And scientifically also this lump sum method is not correct. Now come to the net payments method. Listen, what happens in net payments method is, when the information given in the question enables you to calculate each mode of PC which is given by transferee company to the shareholders of transferor company, then what you need to do is you calculate everything and you total it. That is called net payments method. Net payments. For example, transferee company is giving shares, equity shares to the shareholders of transferor company. That is one PC. Transferee company is issuing preference shares to the shareholders of transferor company. Here shareholder means equity or preference, whatever, no difference. So equity shares giving, preference shares giving, cash giving, kind giving, debentures giving, anything. Sir, please understand, transferor company debentures we are discharging. That is not part of PC because payment we are making to debenture holders. But transferee company issued debentures to the shareholders of transferor company. That means who is the recipient? Shareholder. Therefore, it is part of PC. So therefore, when you are calculating the PC, the only question you need to ask is who is the recipient? If the shareholder is the recipient, then PC will be included. So in net payments method, as the name itself is suggesting that whatever the payments made by transferee company to the shareholders of transfer company, you just add everything. Sir, when I need to follow net payments method, when everything is clearly given in the question, when you are able to quantify the each mode of PC, then follow net payments method. So the transferee company makes individual payments to equity and preference shareholders, maybe in the form of cash, shares, debentures, everything. Aggregate all of those to arrive the PC. So in the question itself, everything will be given. Sir, I am unable to work it out, sir. That's your problem. Please understand. So if the information given in the question enables you to calculate each mode of PC, then calculate and add everything, then you will get PC. That is called net payments method. Now, when to use net assets method? See, some students, whatever the problem, they are using net assets method. No. You cannot use net assets method like that. When you have to use net assets method now? When based on the information given in the question, if you are unable to calculate any mode of PC, you are unable to quantify the PC, then you follow net assets method. For example, in the question, they will give like this. A Limited has taken over B Limited. Suppose A Limited, B Limited. Now A has taken over B Limited. Now A Limited has to pay PC. Always PC paid by whom? Transferring to the shareholders of transfer. Now A Limited takes over B Limited. In the question they said A Limited will issue sufficient number of equity shares to the B Limited shareholders. But what is sufficient number of shares? They have not mentioned. Sufficient number of equity shares of rupees 10 each will be given. Like that they will give. What is sufficient? We don't know. That means you are unable to calculate the mode of PC, quantify the PC. Then you follow net assets method. So sometimes what they will do is smartly, they will give everything. Company will issue, transferee company will give 1 lakh equity shares of rupees 10 each. preference shares they will give, but cash portion they will miss. They will say balance will be given in the form of cash, but what is that balance? We don't know. Therefore, net assets method. So when you are unable to calculate any mode of PC, when you are unable to quantify any mode of PC, because see, in order to arrive PC, everything will be added now. For example, shares given by transferee company, cash given by transferee company, debentures given by transferee company, whatever given by transferee company to the shareholders of transfer company, we need to calculate. Suppose, for example, shares I worked out based on the information I know, but cash they have not given in the question. How much cash to given? So therefore, debentures also I worked out. So in order to get PC, I need to add everything, but I don't know cash, so I need to work it out now. So I need to find out PC now, total PC. I know only shares and debentures, but I don't know the overall PC, because to get the overall PC, even cash also I should know. Then you follow net assets method, and in net assets method, whatever the amount you arrived now, that is PC. That is PC. That is PC. For example, I worked out the net assets, it came 35 lakhs. So therefore 35 lakhs is the PC, cash is obviously 15 lakhs. Cash is 15 lakhs. So therefore, when to use net assets method? When based on the information given in the question, if you are unable to quantify any mode of PC, then you follow net assets method. Now, under net assets method, how to calculate net assets? Agreed value of assets taken over minus agreed value of liabilities taken over. Again, when you are calculating the net assets, now so many students are doing mistakes. Clearly understand here, when you are calculating the net assets of transfer company, so you cannot take the book values. You have to take the agreed values of assets taken minus agreed value of liabilities taken. In the transfer company, whatever the assets and liabilities are there, for those assets, if you are taking over them at their agreed values, that means other than book values, that value you have to take. For example, if there is no agreed value, book value itself is considered as agreed value. Okay, there is no problem. So agreed value of assets taken minus agreed value of liabilities taken over. Then you will get net assets. So when you are calculating the PC under net assets method, sir, so some golden rules are there. Golden rules you need to remember. First thing, only those assets and liabilities of transfer company which is taken over by transferee company must be considered. For example, sir, transferee company has taken over all assets and liabilities of transfer company. Take all assets and liabilities. For example, transferee company has taken over all assets except cash and bank balance. Then don't take cash and bank balance. Suppose transferee company has taken over all liabilities except creditors. Don't take creditors. So therefore, when you are calculating the net assets, take only the assets and liabilities which is taken over by transferee company. That too agreed value. If there is an agreed value for any asset and liability, that value you need to take. If there is no agreed value, then take book values. So these are the golden rules you need to remember, sir, when you are calculating the PC under net assets method. In my classroom discussion also, I will show you. Say this. Yeah. In calculation of PC under net assets method, consider only those assets and liabilities of transfer company which are taken over by transferee company. Consider only those assets and liabilities of transfer which is taken over by transferee company. First thing. And also consider the assets and liabilities taken over at agreed values only. Agreed values only. If agreed value not available, then take the book value of assets and liabilities. And if any mode of PC calculation is not quantifiable, follow net assets method to ascertain the PC. So the golden rule is when to follow net assets method. When based on the information given in the question, you are unable to quantify the mode of, you are unable to quantify the any PC, then you follow net assets method. In net assets method, how to calculate purchase consideration? Simple. Agreed value of assets taken minus agreed value of liabilities taken. Only those assets and liabilities which are taken over by transferee company from the transfer company take, and that too at their agreed values, not book values. And the last method, intrinsic value or share exchange method. Sir, what is intrinsic value? Intrinsic value means the true genuine value of the share. Now sometimes between transfer and transferee companies, they will work out purchase consideration based on the intrinsic value of their shares. For example, there are two entities, sir, A Limited, B Limited. Now A Limited is the transferee company which is taking over B Limited transfer company. Now we will work out the intrinsic value. They will give in the question, intrinsic value of A Limited is, for example, 50 rupees. And intrinsic value of B Limited is 100 rupees. Generally, there are so many methods to calculate this intrinsic value. So discounted cash flow method, maybe net assets method. Net assets method means all assets minus liabilities divided by number of equity shares. So you will get intrinsic value. There are so many ways to calculate intrinsic value. See, here our focus is not on calculation of intrinsic value, but based on the true value of the shares, sometimes PC will be worked out. A Limited I am taking over your business. So how much PC I need to give to you? Depending upon the share values. For example, see, A Limited intrinsic value is 50. B Limited intrinsic value is 100. That means, see, I will give 2 shares for every 1 share of yours, because my share intrinsic value is 50 rupees, but your share intrinsic value is 100. Therefore, 2 shares of mine is equal to 1 share of yours. So depending upon that, I will calculate the PC. That's why this is called share exchange method. So we will exchange shares. That means we will exchange purchase consideration based on the value of the shares. So very simple. They will give you in the question itself the intrinsic values. Based on these intrinsic values, you decide. So in this method, we calculate PC based on the intrinsic value of shares. And how to determine the intrinsic value? Dividing the total share capital of the transferor company by its total number of shares. Nothing but net assets. Assets minus liabilities. Divided by number of shares. Nothing but share capital plus reserves and surplus, or assets minus liabilities. Both are net assets only, sir. And the ratio of the shares to be issued is calculated based on the intrinsic value of both the companies. So you decide the ratio. And the purchase consideration is derived by multiplying the share exchange ratio by the intrinsic value. For example, in this case, A Limited is having an intrinsic value of 50. B Limited is having an intrinsic value of 100. That means for every 1 share of your company, we are going to issue 2 shares. So therefore, we worked out the ratio. So based on that, we will decide the purchase consideration. How many shares to be issued at what value? We will calculate. So like this, there are 4 methods are available. But out of these 4 methods, the net assets method is the most important method, sir. Please see this. Okay, so we have completed the PC calculation also. Now, most important part is accounting for amalgamation. So the main object of this chapter is to learn the accounting treatment in the books of transferor as well as transferee. Now, first we are going to see the transferor company books. As I told you, for a transferor, AS 14 is not applicable. Is not applicable. AS 14 is not applicable for him. Because I told you, there is no transferor company. Basically, what we are going to do is, we are going to close their books, because this company is no more in existence after amalgamation. So the transferor company ceased to exist after amalgamation. So hence books must be closed, obviously. And AS 14 is not applicable. And one more important thing, sir. There is no distinction is made between amalgamation in the nature of merger and purchase. We have discussed the types of amalgamation. Amalgamation in the nature of merger, amalgamation in the nature of purchase. That types is not relevant if you are a transferor company. Irrespective of type of amalgamation, anyway you need to close the books of accounts. So therefore, whether it is amalgamation in the nature of merger or purchase, entries are similar in both the types of amalgamations. So therefore, see, if you are a transferor company, we need to close the books of accounts. And here the important point is, when you want to close the books of accounts, you need to take the help of one account called realization account. And with the help of realization account, so we will try to close the books of transferor company. See, here what I observed is, so many students are struggling to understand how to close the books of transferor company, because the reason is they are not learning in a systematic manner. So understand, I am going to explain this. Suppose, sir, you are a transferor company, sir. Transferor company. And this is your balance sheet. So in balance sheet, we have assets, we have liabilities, share capital, reserves and surplus. In share capital, you know, we have equity, we have preference. Generally, these are the broad items, right? Assets, liabilities, share capital, reserves and surplus. Now listen to me carefully. I am transferor company. Suppose I am B Limited. Now I am liquidating. I am transferring my business to A Limited. Okay. Now I need to close the books of transferor company. What is meaning of the word? What is closing of books of accounts? Closing means assets, liabilities, share capital, reserves and surplus, everything will be closed from the books. How you are going to close? With the help of an account called realization account. Sir, whenever a partnership firm is dissolved, dissolve means come to an end. What we are going to do? We are closing the books of accounts, we are settling the partners' accounts with the help of realization account. Same thing will happen in transfer or company books. Here we will close the books of accounts with the help of realization account. Of course, the main purpose of realization account is to ascertain whether we are on the profit side or loss side because of this entire episode of amalgamation. And ultimately that profit or loss has to be borne by whom? Again, equity shareholders. So transfer or company books must be closed, and first realization account we will open. Through realization account we will try to close the books of accounts, and ultimately we are going to close the shareholders accounts also. That is what we are going to do. So therefore, in the transfer or company books, the object is close the assets, close the liabilities, close the share capital, equity as well as preference we need to close, reserves and surplus we need to close. So everything must be closed. Now that has to be learned in a systematic manner. Understand? First, sir, how to close the books of accounts. You remember this order which I am giving. First, come to the assets. Assets of transfer or company. First come to the assets. First priority, this one, assets. Entry number 1. Assets taken over by transferee company. From the transferor company, whatever the assets are there, which is taken over by transferee company, close them first. How? By transferring to realization account. Close it. Next, assets which are not taken over, you sell. Assets taken over by transferee company will be closed by transferring to realization account. Assets which are not taken over will be sold. Whatever the profit or loss came, that is transferred to realization account. So that means entire assets are closed now. Whatever the assets are there in the transfer company, you are going to close it. How I am going to close it? Simple. The assets which is taken over by transferee company, transfer it to realization account. That's it. They will be closed. That is entry. Assets generally will have a debit balance. If you want to close, credit. So realization account debt are to assets. That's it. Now the assets which are not taken over by transferee company, you sell them. When you sell the asset, what is the entry? Cash or bank to assets. Whatever the profit or loss came, that is transferred to realization account. That means all assets are closed. Now come to liabilities. Simple. The liabilities which is taken over by transferee company, close them by transferring to realization account. That is liabilities account data to realization, because liabilities will have a credit balance. Now your closing means debit it. So liabilities account data to realization. And the liabilities which are not taken over by transferee company, then discharge them, settle them, discharge it. Because you are closing the books of accounts, anyway your company is no more in existence, definitely you have to settle the liabilities which is not taken over by transferee company. Of course, the liabilities which are taken over by transferee company, they will look after those liabilities. We are not bothered. But the liabilities which are not taken by transferee company, we have to discharge it. So the liabilities will be closed. So assets, liabilities closed. So assets taken over by transferee company, liabilities taken by transferee company, close them by transferring to realization account. Assets not taken over, sell directly. Liabilities not taken over, sell directly. I mean discharge directly. That's it. And when you are selling the assets, when you are settling the liabilities, any profit or loss came na, that will be adjusted to realization account. Now come to the share capital. Only share capital and reserves and surplus remaining na? Share capital. Equity share capital transferred to equity shareholders. Belongs to them. Preference share capital transfer to preference shareholders. It is belongs to preference shareholders. Reserves and surplus transfer to equity shareholders. That means all the items are closed. Assets closed, liabilities closed, equity share capital closed, preference share capital closed, reserves and surplus closed. Now that means all the items of the transfer company closed. Now once you close all these things, whatever the PC received from the transferee company, write that PC, and this PC give it to the shareholders, equity and preference shareholders, so that their account will be closed. And before doing that, one more important thing what you need to do is, you need to prepare realization account. And before discharging the equity equity shareholders, prepare the realization account. Whatever the profit or loss you got, that profit or loss also you transfer to equity shareholders. Because of the entire episode of this closing books of accounts, whether we are on the profit side, loss side, we need to calculate. So understand, Anna, very simple. Transfer our company books, transfer our company, no more in existence, their books must be closed, and there is no accounting standard 14 is applicable for transfer our company, and therefore there is no type of amalgamation which is going to affect the transfer company books. So when you are closing the transfer company books, always remember transfer company assets, liabilities, share capital, reserves and surplus, everything must be closed. How they are going to be closed? The assets and liabilities taken by transferee company, transfer them to realization account. Liabilities not taken over, assets not taken over, you sell yourself, you discharge yourself. In that process, whatever the loss or profit came, that is adjusted to realization account. And also equity share capital transferred to equity shareholders, preference share capital transferred to preference shareholders, reserves and surplus transferred to equity shareholders. And then whatever the PC due from the transferee company, receive it, and that PC discharge it, so that their accounts will be closed. And one more thing, before discharging the equity shareholders, what you need to do is, you open the realization account, you close the realization account. From the realization account, I find out the profit or loss. And that here, one more interesting point is there that I will tell you. Wait. So what are the journal entries for closing the books? What are the journal entries for closing the books of transfer or company? Yeah. What are the journal entries for closing the books of accounts of transfer or company? First, sir, transferring assets to purchasing company. Whatever the assets of transfer or company, transferring assets which is taken over by transferee company or purchasing company. Purchasing company or transferee company, both are same. I told you. Transferring assets to purchasing company. So I told you, you close them by transferring to realization account. So realization to various assets. Yet what value? Book value. Book value. Realization to various assets. Book value, book value. Important. Here students will confuse. Sir, suppose transferee company taking over the assets and liabilities of transfer company. Suppose one asset is there in the transfer company balance sheet, plant and machinery, and the book value is 100 lakhs. But transferee company has taken over, that is agreed value is 90 lakhs only. So therefore, as a transfer company, I need to cancel this plant and machinery at 100 lakhs and 90 lakhs. Common sense. In your books, 100 lakhs is there. So transfer at 100 lakhs only. So that's why book value. Irrespective of the value at which transferee company taken over the assets and liabilities of transferor company, try to close them at their book values, because then only that asset will be closed in your books. So therefore, as a transferor, whatever the assets taken by transferee company, I will close them by transferring to realization to various assets at book values, not at agreed values. Suppose assets not taken over should not be transferred to realization account. Assets which are not taken over, see this. Entry number 5, disposal of assets not taken over. Bank account debtor to asset. So amount received, book value of the asset. The difference is either profit or loss. Suppose if the sale value is more than the book value of the asset, profit. Transferred to realization account, credit. Suppose the sale value is less than the book value, loss. Realization account will be debited. Okay. So this is assets related. Next, transferring liabilities to purchasing company. Whatever the liabilities are there in the transfer company, that is transferred to transferee company. That is because they are taken over by transferee company. So the entry is liabilities to realization at book values. And liabilities not assumed with the purchasing company are excluded. Any liabilities which is not taken over by transferee company, we have to discharge ourselves. Discharge of liabilities not taken over. What is the entry? Liabilities to bank. In that process, either we may get a profit or loss. That is transferred to realization account. And sir, here relating to assets, one important point, sir. If in respect of asset, if there is any provision, so transfer the asset at their gross value, gross, and transfer the provision along with the liabilities. For example, in transfer company, there are debtors, 10 lakhs. And relating to these debtors, there is a provision, 2 lakhs. So you cannot close at 8 lakhs. You close 10 lakhs separately, 2 lakhs separately. If the debentures, if the debtors are taken over by transferee company. Sir, we are learning the books of transferor. You need to close the books of transferor company. So assets taken over by transferee company. So transfer to realization account, close it. Liabilities taken by transferee company, close it. But in respect of asset, if there is any provision, transfer the gross value separately, provision separately along with the liabilities. Provision along with the liabilities. Please understand. And the assets not taken over, sell it in entry number 5. Liabilities not taken over will be discharged, entry number 6. So that means first entry, second entry, fifth entry, sixth entry, all assets and liabilities are closed. Next, any purchase consideration due from the purchasing company. From the transferee company, whatever the PC due by the transferor company shareholders, you need to write that. Tell me what entry transferor company will write. Purchase consideration is due from whom? Transferee. So amount due from transferee company. So in our books, transferee company will be debited. Realization account will be created. See this. So purchasing company to realization. This is not book value, sir. This is PC. Purchase consideration. Purchase consideration. Purchasing company account data to realization. And then when you are receiving the purchase consideration, so you might receive what? Shares in purchasing company, debentures in purchasing company, bank to purchasing company. So due entry, receipt entry. So due entry is what? Transferee to realization. Then you receive the PC. Whatever the PC you are going to receive from the transferee. It can be in the form of shares in purchasing company account debtor. Debentures you may receive in the form of PC. I told you because PC can be in any form. So debentures in purchasing company, bank account debit to purchasing company account. So therefore entry number 3, PC due entry. Entry number 4, PC receipt entry. So therefore first 6 entries, very, very important entries. So you understand the first 6 entries? Yes. Now come to the 7th entry, liquidation expenses. Sir, transferor company is liquidating, na sir. They are going to incur some expenses, na sir. Now those expenses related. See, simple. Here 3 cases will come. One is these liquidation expenses paid by purchasing company. Sometimes between the agreement between the parties, sir, liquidation expenses are paid by transferee company or purchasing company. Then any entry will come in transferor books, no entry. So liquidation expenses I am not bearing, na sir. I am writing entries in the books of transferor company which is paid by transferee company. So no entry in my books. Second, paid by selling company. That means transferor company itself has paid the liquidation expenses. So you tell me, when I am incurring my own liquidation expenses, what entry I will? Realization to bank. I have opened an account called realization account now. So realization to bank. And then reimbursed by purchasing company. See, sometimes what happen now? Liquidation expenses incurred by selling company, that is transferor company, but later reimbursed by transferee company. Liquidation expenses incurred by whom? Transferor, but reimbursed by transferee. In that situation, when I am incurring the expenses, I know transferee company is going to reimburse. So therefore, transferee company account debtor to bank. So because cash is going from my organization and I know this amount is going to be reimbursed by transferee. So transfer it to bank. And later on, when they have reimbursed the amount, bank account debtor to transferee. That means purchasing company to bank, bank to purchasing company. Literally, there is no effect. There is no effect. In third case. So what is the difference between, first case and last case, sir? First case is directly paid by purchasing company itself. So as a selling company, as a transfer company, I am not writing any entry. Third case, sir, indirectly, ultimately borne, these liquidation expenses are borne by transferee company only. But first I have to pay. So as a transfer company, first I am paying, later on they are giving the amount. So therefore, whatever. But ultimately, here also no effect in my books. Here also no effect in my books. Because purchasing company to bank, later on bank to purchasing company I am receiving. So liquidation expenses, these are the entries. So in liquidation expenses, 3 cases will come. One, liquidation expenses borne by transferee company, no entry in transferor company books. Liquidation expenses borne by transferor company, realization account debtor to bank account. Liquidation expenses borne by transferor, later on reimbursed by transferee. Then what is the entry? So when we are incurring, we know transferee company is going to reimburse the amount. So transferee to cash or bank. When actually they reimburse cash or bank account debtor to transferee. Next. So 7th entry is liquidation entry, liquidation expenses. Next, now come to the shareholders. Because assets over, liabilities over. PC received over. PC due, PC received over. Liquidation expenses also incorporated. Next, amount payable to preference shareholders. Before proceeding into the equity shares, first let us try to close the preference shareholders. First, amount due to preference shareholders. Sir, in the company, what is the amount which belongs to preference shareholders? Preference share capital. Preference shareholder capital is having which balance? Credit balance. So debit. Preference share capital account debtor to preference shareholders. And what is the amount of preference share capital? What is the paid up amount? But what is the amount due to preference shareholders as a PC, purchase consideration? Because PC means amount paid to shareholders, including preference shareholders. So to preference shareholders, what is the amount of due, amount PC due? So it can be different from the capital they contributed. For example, the preference share capital is 10 lakhs, sir, but the amount of PC due to the preference shareholders is 15 lakhs. So therefore 5 lakhs is the premium excess we are paying, right? They are getting excess 5 lakhs. So what is this excess 5 lakhs, sir? So this 5 lakhs excess paid will be adjusted to realization account. Most of the students are not understanding this. So you need to understand, sir, as a preference shareholders in the transfer company, we are also owners of the company. What is the PC due to us? And what is the amount we contributed? The difference we need to adjust it to realization account. Sir, at the time of dissolution, at the time of closing the books, whatever happens, sir, adjusted to realization account only. Any gain, any profit, any loss, adjust to realization account only. Ultimately to the preference shareholders, they contributed 10 lakhs, sir, paid up capital, but PC is 15 lakhs, sir. That means 5 lakhs, obviously, we need to adjust it to realization account. Because when we receive the PC, what is the entry we have written? Shares in transferee company account debtor, debentures in transferee company account debtor, cash or bank account debtor to realization account. Actually, when PC is due, actually, transferee company to realization we have written. That means PC is already created to realization account, right? Now, in that PC, 15 lakhs, in my example, 15 lakhs belongs to preference shareholders, but they contributed only 10 lakhs. That means 5 lakhs we are paying excess, that is transferred to realization account. Sir, suppose for example, reverse, sir. Preference share capital 10 lakhs, sir. PC is only 8 lakhs, sir. That means 2 lakh shortage. That is profit to us. So they contributed, 10 lakhs, but we are ultimately giving PC 8 lakhs. So it's a kind of a profit which is transferred to realization account. Then pay to the preference shareholders. First write the due entry, then payment. Payment means whatever the PC received in entry number 4. In that PC, what is the portion belongs to preference shareholders, give it to them. Therefore, the entry is preference shareholders account debtor to shares in transferee company or debentures in transferee company to bank. Whatever the PC received from transferee company which is belongs to preference shareholders, give it to them. In entry number 4, we have written PC received entry. Now entry number 9, whatever the PC belongs to preference shareholders, give it to them. Their account will be closed. So therefore, entry number 8 to 9 relating to preference shareholders. Now you close the realization account. Now many of the students are not understanding why we are preparing realization account. Sir, simple, sir. If you observe the realization account, if you see realization account, what we have written? First, all assets taken over by transferee company. So realization to assets. So 2 assets we have written. At what value? Book value. And the liabilities taken over by transferee company. What entry we have written? Liabilities to realization. So by liabilities. At what value? Book value. Then whatever the PC due from transferee company, we have written entry. Transferee company to realization. So by transferee company PC. So, and also liquidation expenses if it is borne by transferor company, realization to bank, liquidation expenses. So liquidation expenses. Usually these are the entries, right? Now, if you look at till here, see this. Suppose the book value of assets we are transferring is 50 lakhs. The book value of the liabilities we are transferring is 20 lakhs. So tell me, assets minus liabilities. What is the net assets we are transferring? 30 lakhs. As a transferor company, we are transferring 30 lakhs worth of net assets to transferee company. But how much PC paid by transferee company? Suppose the PC paid by transferee company is 50 lakhs. That means we are transferring 30 lakhs worth of book value of net assets to transferee company. In return, transferee company is paying us 50 lakhs. So therefore, what is the profit here? 20 lakhs. And suppose the liquidation expenses are 5 lakhs. So that means the profit is now only 15 lakhs. This is called realization profit. And this profit we need to calculate and we need to transfer this to equity shareholders. So the main object of preparing realization account is ultimately what is the worth of assets we are transferring, what is the PC we are receiving. The PC is more than the assets, net assets we are transferring. Obviously, we are on the profit side after deducting these liquidation expenses. And also, if the preference shareholders are discharged excess amount, that excess amount, then you will get the realization profit or loss. So you understand now what is the purpose of realization account? The purpose of the realization account is ultimately whether we are in the profit side or loss side. Because at the time of amalgamation, sir, when I am closing the books of accounts, sir, obviously whatever the profit or loss I am getting, sir, that is also to be given to the shareholders only. Equity shareholders, not preference shareholders. Because the equity shareholders are the real owners of the company. So close the realization account. You may get a profit. If you got a profit now, that profit transfer to equity shareholders, credit to them. So, and if you got a loss, debit to equity shareholders. So the entry is realization to equity shareholders to realization. If it is a loss, therefore here realization account is also closed. Now the only thing remaining is adjustment settlement to equity shareholders. Now first write due amount to equity shareholders. So in the company, what is the amount belongs to equity shareholders? Two things: equity share capital, reserves and surplus. So equity share capital account data, reserves and surplus to equity shareholders. And one more thing, sir, here, whatever the fictitious assets are there in the balance sheet of the transfer company, those fictitious assets are also we need to adjust to equity shareholders only. Like for example, any preliminary expenses not written off, any discount on issue of debentures, even P&L account debit balance. Sir, reserves means not just profits there can be losses also, that will be adjusted to equity shareholders only. So therefore entire balance sheet must be closed now. Even in the transfer company balance sheet, there are some fictitious assets, there are P&L account debit balances, losses, everything will be adjusted to equity shareholders. And finally payment to equity shareholders, that is equity shareholders account debtor. In entry number 4, whatever the PC you have received na, in that PC what is the amount which is belongs to transferee company shareholders, equity shareholders, give it to them. So equity shareholders account debtor, 2 shares in purchasing company, 2 debentures in purchasing company, 2 bank, whatever the PC received which is belongs to equity shareholders, give it to them, their account will be closed. Okay, so therefore total how many entries? 13 entries. Guys, very simple, you follow this order, you are not going to get any confusion. When you are closing the transfer company books, you please follow this. 13 entries will come in total. Okay, first, assets, transfer company assets taken over by transferee company. Second, liabilities taken over by transferee company. Third, PC due entry. Fourth, PC received entry you write. PC received entry you write. Fifth, assets not taken over. Sell them. Sixth, liabilities not taken over. Settle them. Liabilities not taken over, settle them. Okay, so that means if you observe entry number 1, 2, 5, 6, all assets and liabilities of transfer company are closed. And remember guys, when you are transferring the assets, book values, close them at book values, liabilities book values. And when you are selling the asset, any profit or loss transferred to realization account. When you are discharging the liabilities, whatever the profit or loss came, transferred to realization account. Now once 6th entry is passed, 7th entry guys, liquidation expenses. Don't confuse, very simple. At the time of amalgamation, any liquidation expenses incurred, you have to see who incurred it. Transfer company incurred, realization to bank, transferee incurred, no entry in transfer books. And third case is incurred by transfer, later reimbursed by transferee. So we know when we are incurring, we know the transferee company is going to reimburse. So therefore transferee company account will be debited to cash or bank. Later on cash or bank account debtor to transferee company. So liquidation expenses. Then eighth entry is what? So preference shareholders guys, relating to preference shareholders, 2 entries will come. One is preference shareholders due entry, preference share capital to preference shareholders account. But amount due to preference shareholders is the PC. What is preference share capital? Paid up value. The difference will be transferred to realization account. So difference will go to realization account. That is important here. Because what is the amount contributed by preference shareholders? What is the amount PC due to them? So the difference will transfer to realization account. And then 9th entry, preference shareholders account will be settled. So whatever the PC received, sir, give it to them. So their account will be closed. So next, 10th, close the realization account here. Realization account, close it. Close. Now, when you are closing the realization account, you may got profit or loss. Transfer it to equity shareholders, guys, because they are the real owners of the company. Because of this entire episode, whether they got profit or loss, so they will be bear this. And then 11th entry is due to equity shareholders. In the transfer company, whatever the equity share capital, reserves and surplus. So transfer to equity shareholders. 12th entry, sir, any fictitious assets in transfer company, how they will be closed? By transferring to shareholders, equity shareholders. Fictitious assets and also P&L account debit balance, See, all these things you transfer it to equity shareholders. Close them by transferring to equity shareholders. And finally settle equity shareholders. So whatever the PC received, sir, in entry number 4, you see, entry number 4 we have received PC. So this PC received, so we will give it to preference shareholders, as well as this PC received, we will transfer to equity shareholders. So therefore now you see everything is closed or not. So entry number 1, 2, 5, 6 assets liabilities will be closed. Entry number 8 preference share capital closed. Entry number 11 equity share capital, reserves and surplus closed. Entry number 12 all fictitious assets, P&L account debit balance closed. What is there? Everything is closed. So I think this is the books of transferor company. See, this is the order, sir. You remember this order, then you never go wrong. Okay, so this is transferor company books I have explained. Now come to transferee company books. Most important books is transferee. Sir, who is transferee? The company which continues after amalgamation is called transferee company, right? So transferee company basically acquiring the business of transferor company. Business means net assets and liabilities of transferor company we are taking over. Okay. Now important guys, listen to me carefully. So as a transferee company, sir, in my books, how I need to do the accounting of the business I have taken over from transferor company. For that, first there are two methods available. As I told you in the beginning, as a transferee, so there are two methods of accounting available here. One is pooling of interest method, another one is purchase method. There are two types available here. Pooling of interest method, purchase method. When we follow pooling of interest method, when amalgamation is in the nature of merger. When we follow purchase method, when amalgamation is in the nature of purchase. So when the amalgamation is in the nature of merger, follow pooling of interest method. When amalgamation is in the nature of purchase, follow purchase method. So which method you need to follow depends upon the types of amalgamation. That's why I said when you are a transferee, AS 14 is applicable to you. AS 14 is applicable to you. And transferor, AS 14 is not applicable. So as a transferee, AS 14 is applicable. Now according to AS 14, which method I need to follow? For that you need to decide the type of amalgamation. How to decide the type of amalgamation? We said na 5 conditions. All assets and liabilities of transfer company must be transferred to transferee company. At book values only they will be transferred. Shareholders holding not less than 90% face value of equity shares of transfer company must agree to become the equity shareholders of transferee company. And the purchase consideration is given wholly in the form of equity shares only. And the business of transfer company must be agreed to be carried on by transferee company. 5 conditions we have discussed now. So you need to apply. Out of those 5 are only 2 conditions. All assets and liabilities including reserves will be transferred or not. They have transferred at book values or not. You see. And you come to when you are reading the question itself, you spot out the differences, whether all assets liabilities are taken over or not, whether taken over at book values or not. So even if single asset is not taken over, even if single asset and liability is taken other than at book value, that is amalgamation in the nature of purchase method. If all conditions are satisfied, that is merger, amalgamation in the nature of merger, follow pooling of interest method. Okay, so therefore as a transferee books, whenever you want to do the accounting, you first do the type of amalgamation and depending upon that you select the method. Now suppose for example, we will discuss both the methods, sir. Very important, sir. Pooling of interest method, purchase method. Now imagine, sir, you are a transferee company, sir. What entries will come in your books? Tell me, as a transferee company. Simple. I am acquiring the business of transfer company. So acquiring business of transfer company means I am taking over the assets and liabilities. Now those assets and liabilities of transfer company, now I need to incorporate in my books. So therefore the assets and liabilities will be incorporated. So business purchase entry, first I will write. And then second entry, I am giving PC to them. So I need to pay PC to the shareholders of transfer company. So that PC due entry and PC payment entry I need to write. So one is incorporation of assets and liabilities, next PC due entry, next PC payment entry I need to write. And one more thing, sir, whatever the liabilities I am taking from transfer company, sometimes those liabilities I will discharge. So whenever the transfer company liability is taken over, discharged, sir, I need to write entry for that. And also, sir, any intercompany transactions are there between the transferor and transferee company before amalgamation. Now, those effect of those intercompany borrowings I need to eliminate. And also, if any sale and purchase of goods taken place between transferor and transferee before amalgamation, now whatever the unrealized profit is there in the stock, that has to be eliminated. And also statutory reserves incorporations, like that some entries will come, sir. So we will discuss one by one carefully, sir. First we see pooling of interest method, purchase method. First entry is due entry for PC. Due entry for PC. Sir, I am transferring company, I am acquiring your business. For that I need to pay some amount. So therefore, first entry is due for business purchase. I am purchasing your business, so I need to pay. So due entry for business purchase. What entry you will write as a transferring company? So business purchase account debit to liquidator of transferor company. Liquidator of transferor company. Business purchase, I am purchasing your business. So I will open a dummy account called business purchase account to liquidator of transferor company. Because transferor company is going to liquidate now. So who look after the liquidation proceedings? Liquidator. That's why it is created to liquidator of transferor company. And this liquidator, he will distribute the PC we have given to the shareholders. That's none of our business. But in our books, what is the PC we are going to pay for business acquisition? So therefore, the business purchase account debtor to liquidator of transferor company. For example, we acquired with PC of 50 lakhs. So therefore, 50-50. Business purchase to liquidator of transferor company. Business purchase to liquidator of transferor company. This is the first entry as a transferee company. Now, the most important entry is this entry. Incorporation of assets and liabilities taken over. Incorporation of assets and liabilities taken over. Sir, listen to me carefully, sir. I am transferee company, sir. First, I have written business purchase entry, business purchase to liquidator of transfer company over at PC amount. That means PC due entry I have written. Next, sir, from the transferor company, I am taking over what? Assets and liabilities. Now, those assets and liabilities I need to incorporate in my books. So, therefore, I will write an entry for that. Incorporation of assets and liabilities taken over. Incorporation of assets and liabilities taken over. Observe the difference between purchase method and pooling of interest method. In purchase method, first I am talking about purchase method. Whatever the assets you have taken over, debit them. Because transferor company assets, now your assets. So, assets account debit. At what value? Agreed value. Because in purchase method, there is a possibility that you are taking the assets and liabilities at other than book values. So therefore, assets account debit, agreed value, other than book value if you have taken over. Suppose there is no agreed value, book value itself you can take. Assets account debit, two liabilities. Transferor company liabilities, my liabilities. So assets account debtor, two liabilities. That means net assets I have incorporated in my books. Whatever the assets I have taken, assets account debit, liabilities taken, liabilities account credit. Now PC. What is the PC I am paying, sir? So that I will credit, sir. In the first entry, I have debited business purchase account, sir. That is nothing but PC. Now to business purchase account. So therefore, I am here comparing net assets with what? PC. So for example, see, assets taken over, agreed value of assets taken 50 lakhs. Agreed value of liabilities taken 30 lakhs. So that means what is the net assets we have taken? 20 lakhs. But PC we are paying 30 lakhs. So therefore, excess how much we are paying? 10 lakhs. So therefore, AS 14 says when amalgamation is in the nature of purchase method, when the PC is more than the net assets taken over, that excess is called a goodwill. So that will be transferred to goodwill as a balancing figure, 10 lakhs. Sir, why goodwill, sir? Sir, what is goodwill? Nothing but, sir, when you are taking any business, you are taking net assets of 20 lakhs. Assets 50, liabilities 30. That means you are taking net assets worth of 20 lakhs. But you are paying 30 lakhs. Why you pay excess 10 lakhs, sir? Because you are expecting some intangible benefit from this business in the future. That we call it as goodwill. Please understand. Otherwise, why you are ready to pay excess, sir? If they are bringing some value addition to you, you believe this company is going to give some intangible benefits in future. That's why I'm ready to spend some 10 lakhs extra. That's why it is called goodwill. So therefore, what is the assets I have taken over? What are the liabilities I have taken over? Net assets. Assets minus liabilities, net assets. Compare with PC. So business purchase, to business purchase. And the difference will go to goodwill. If it is excess, if the PC is more than net assets taken over. Suppose if the PC is less than net assets taken over. For example, net assets taken over 50 minus 30, 20 lakhs. But the PC is only 15 lakhs we are paying. 15 lakhs. That means net assets taken 20, but PC paid 15. That means we are on the profit side. Which profit? Capital profit. So transfer to capital reserve. Because this is not an ordinary revenue profit, sir. So this profit arises at the time of acquisition of business. So transfer to capital reserve. You understand the entry? Incorporation entry under purchase method. Tell me. Assets taken over. Assets account debit. Two liabilities. At what values? Agreed values. If there is no agreed value, book value. Whatever the assets and liabilities you are taking from transfer company, incorporate them. And you compare with business purchase, to business purchase. The difference will go to goodwill or capital reserve. When goodwill, sir? When PC is more than the net assets. When capital reserve, sir? When PC is less than the net assets. So capital reserve. So see this. When PC is greater than net assets, goodwill. When PC is less than net assets, capital reserve. Okay. So this is incorporation entry, sir. Now, in pooling of interest method, how incorporation entry will be written? Purchase method, this is the entry. In pooling of interest method, sir. In pooling of interest method, you know, sir. Amalgamation in the nature of merger, pooling of interest method. You know, all assets will be taken over at their book values only. So therefore, assets account debit, book values. Here agreed values, here book values. See this. All liabilities you have taken over, book values. So assets, liabilities. One more interesting thing, sir. From the transferor company, all assets and liabilities, including reserves, will be taken over. Equity and reserves, equity and liabilities, reserves will also be taken over. Therefore, reserves account debit. And if there are any statutory reserves in the transferor company, they will also be taken over. And we will compare this with PC, purchase consideration. Sir, here, interesting point, sir. Listen to me carefully. The difference in incorporation entries, pooling of interest method, pooling of interest method. In pooling of interest method, sir, first assets account debit. Whatever the assets of transferor company we are taking over, we will write. At what value? Book value. Liabilities account debit. Whatever the liabilities we are taking over, book value. Now to business purchase, what is the PC we are paying? We'll write. And also we will take over the reserves also. Reserves. But here the interesting point is, sir, in purchase method, sir, as a transferee company, I will compare my PC with the net assets. That's what I told you. Assets account debit to liabilities, net assets. I compared with PC. If PC is more than net assets, I am treating it as goodwill. If PC is less than net assets, I am transferring to capital reserve. That means in purchase method, I am comparing PC with the net assets taken over. But in pooling of interest method, sir, in pooling of interest method from the transferor company balance sheet, see here, in this case, in purchase method, sir, suppose this is the transferor company balance sheet, sir. From this balance sheet, assets, liabilities, share capital, reserves and surplus. I am taking assets and liabilities. Generally in purchase method, reserves and surplus, we will not take. So therefore, assets, liabilities we are taking over. Therefore, here we compare PC with net assets. But in pooling of interest method, sir, what happens is, in pooling of interest method, suppose this is the transferor company balance sheet. Now assets will be there, liabilities will be there, share capital is there, reserves and surplus is there. We will consider assets, liabilities, reserves and surplus. Everything we will consider. For example, assets 100 lakhs, sir, liabilities 60 lakhs, sir, reserves and surplus 20 lakhs, sir. That means what is the amount of business worth you are taking, sir? Assets 100, liabilities 60, reserves and surplus 20. So how much came, sir? 20. That is exactly equal to share capital. Na? Share capital value is the balancing figure, correct? Assets minus liabilities minus reserves and surplus is nothing but share capital value. In this case, suppose in purchase method, assets, liabilities, share capital, reserves and surplus. So therefore, assets minus liabilities is nothing but share capital plus reserves and surplus, which is nothing but net assets. So in pooling of interest method, since from transfer company you are taking all assets, liabilities, including reserves and surplus. So whatever the PC you are paying now, that will be compared with the share capital of transferor company. Sir, why purchase consideration is compared with share capital of transfer company? Because that is exactly the worth of business you are taking. So here you need to understand, sir, how much PC we are paying and what is the worth of business we are taking. In purchase method, we are taking assets minus liabilities, so net assets. We compare PC with net assets, excess goodwill, and PC is less than net assets, we call it as capital reserve, capital profit. Fair enough. AS 14 says. Now, when it comes to pooling of interest method, please understand what is the PC you are paying and what is the worth of business you are taking. You need to compare. Suppose here, what is the worth of business you are taking, sir? Assets minus liabilities minus reserves and surplus also. You are taking worth of business 20, which is exactly equal to share capital, na? Because in the balance sheet, assets minus liabilities minus reserves and surplus is obviously share capital. That's why don't waste your time. That's why in pooling of interest method, straight away what you can do is, what is the PC we are paying? You see. What is the share capital of transfer company? You see it. If the PC is more than the share capital of the company, that means you are paying more than the business you are taking. So that is a loss to you. That is a loss to you. Suppose if the PC is less than the share capital, that means you are paying less PC than the business you are taking over. So it's a profit to you. If it is a profit, transfer to capital reserve, like in purchase method. But in case of loss AS 14 says, this loss for the transferee company first adjust against transfer of the company free reserves. You are taking over free reserves of transfer company. Because in pooling of interest method, all reserves of transfer are now your reserves. Adjust against the transfer company free reserves. If they are not sufficient, then adjust against transferee company free reserves. If they are not sufficient, then adjust to P&L account. So very interesting point. So therefore, when you are doing the accounting in the books of transferee company, you need to incorporate the assets and liabilities of transferor company which you have taken over. So in purchase method, assets taken over account debit at book value at agreed values. Two liabilities taken over at agreed value. That means assets minus liabilities, net assets you are taking, compare with the PC you are paying to business purchase. If your PC is more than the net assets taken, goodwill. If PC is less than net assets, capital reserve. But when it comes to pooling of interest method, assets, all assets of transfer company, you written in your books, you have to incorporate in your books at book value. All liabilities of transfer company at book values. You compare this with PCA? No. See, assets account debit, to liabilities account, to reserves and surplus also you need to take. But this accounting standard 14 says, you are taking assets, liabilities, reserves and surplus. That means what is the worth of business you are taking is exactly equal to share capital. So compare your PC with share capital. If PC is more than share capital, that means you are paying excess. That excess is a loss. AS 14 says this loss will be adjusted against free reserves of transfer company. If not sufficient, transferee company free reserves. If not sufficient, debit to P&L account. Sir, profit, sir. Your PC is less than the share capital. That is worth of business we are taking, sir. Transfer to capital reserve. So this is the clarity. Please understand. So from the pooling of interest method, statutory reserves will incorporate reserve fee, balance figure. That's why I have taken. Why I have taken balance figure? Because I know in case of pooling of interest method, as a transferee company, whatever the PC I am paying, maybe more than the worth of business I will take, which is exactly equal to share capital, because I am taking assets, liabilities, reserves and surplus. So I will compare PC with share capital. So here compare PC with the share capital of transferor company. Here PC compare with the net assets. Understood the logic? Because in purchase method, we don't touch the reserves of transfer company. We don't maintain the reserves as it is. But in pooling of interest method, as a transferee company, I will maintain the genuinity of reserves of transfer company. So therefore, here I will compare PC with share capital. See, when purchase consideration is greater than share capital, that means I am paying excess. Excess consideration is adjusted against first free reserves of selling company. That means transfer. Not sufficient, sir. Sir, not sufficient, sir. Free reserves of purchasing company you adjust. Sir, not sufficient, sir. Adjust against the P&L account. Suppose when PC is less than share capital, sir, worth of business I have taken, sir. Sir, I am taking business worth of 100 lakhs, but I am paying only 80 lakhs. 20 lakhs profit, sir. Capital reserve. Got it? This is the main entry. So first PC due entry, then incorporation entry. You understood the difference between pooling of interest method and purchase method, sir? So that's the main trademark, sir. So in purchase method, sir, take assets and liabilities at their agreed values. Don't touch reserves of transfer company. And you compare PC with the net assets, sir. Difference is goodwill or capital reserve. In pooling of interest method, sir, take transfer company assets and liabilities at book values. All assets and liabilities you have to take, because 5 conditions. All assets and liabilities, that too at book values. And here interesting point is, you compare PC with the share capital of transfer company, and if PC is more than share capital, that's a loss. That loss first try to adjust against the free reserves of transfer company and take the balance reserves of transfer company. after adjustment of this. So incorporation entry also done. Next, discharge PC. Entry number 1, you have written the entry na business purchase to liquidator of transfer company. Now discharge the PC. Liquidator of transfer company to whatever the PC you are giving. See, you are as a transferee company, you are giving PC. Suppose you are issuing shares. So therefore in your books, share capital account debit. You may issue shares at premium. Securities premium will also come. And bank account. So share capital, securities premium, bank account, whatever. So PC entry. So first 3 entries, first PC due entry, then incorporation entry, then PC discharge entry. Entry is same. PC, when you discharge the PC, liquidator of transfer company to share capital. See, you are the issuer of the shares. So to share capital. And always remember, share capital will be recognized at face value. And anything in excess of face value will be transferred to securities premium. And whatever the cash you are paying to bank. Entry number 3, transfer or company. So first business purchase, then incorporation, then discharge of PC. Next, cancellation of intercompany owings. Important, sir. Listen to me carefully. Entry number 4, cancellation of intercompany owings. Intercompany owings. What is this intercompany owings, sir? See, between transferor and transferee company, there may be some mutual transaction, mutual debts is there. Suppose, sir, suppose A Limited, one company, B Limited, another company, sir. A Limited is taken over by B Limited. Now, before B Limited, A Limited amalgamated with each other. So this is now transferee. This is transferor, sir. Now, before they are amalgamated with each other, what happened is, in the B Limited balance sheet, liability side, loan taken from A Limited is there. 10 lakhs. Same A Limited balance sheet you take. Asset side, loan given to B Limited is there. 10 lakhs. So loan given, sir. A Limited given a loan to B Limited. So A Limited balance sheet, asset side, loan given is there. B Limited balance sheet, liabilities, loan taken is there. Right? Now, B Limited is taken over by A Limited. Right? So therefore, as a Limited, first I need to incorporate liabilities. Incorporation of liabilities, just now I told you entry number 2. Suppose purchase method. So therefore, assets account debit, 2 liabilities. So I will incorporate all the liabilities of transfer company. In that, loan is there. Loan taken from A Limited. 10 lakhs. I will incorporate. Okay, incorporated. Now tell me, this loan is taken from A Limited. 10 lakhs. So this actually liability of our transferor company. Now it becomes a liability of transferee company. Liability. What is liability? Liability means an obligation we need to discharge. To whom you need to pay this loan? A Limited. You are writing entry and you are A Limited. See this. A Limited you are. Will you pay to yourself? Tell me. Because in your books asset is there, which is loan given to B Limited. And the liability of transferor company, which is loan taken from A Limited, is also now become your liability. That means here the loan liability, loan asset is for the same party, that is A Limited only. See, before amalgamation it is okay, independently they can write, but now amalgamated happened, na? B Limited company is become now A Limited, na? I mean, in the sense the assets, the liabilities now become the liabilities of A Limited, na? So whatever the liability is there in the B Limited now become the liability of A Limited, na? So you have incorporated this liability in your books. But this liability you are going to discharge to whom? To yourself. Therefore, what we are going to do is, as A Limited, I have taken the liability of B Limited, that is loan taken from A Limited. In my books, loan given to B Limited 10 lakhs is there. So they are called mutual debts. I will eliminate mutual debts between the companies. Because that is, I can't pay to myself. I am not be the receiver and payer both the parties. So therefore, what I will do, I will eliminate them. How I am going to eliminate? Simple. Loan given to B Limited. In my balance sheet, asset is there, na? asset, that I will close first. Loan given to B Limited. How much? 10 lakhs. And whatever the liability I have taken, loan taken from A Limited, I will close it. 10 lakhs. That's it. Mutual debts cancelled. Why they will be cancelled? Because both asset and liability belongs to same party. It doesn't make any sense. Loan payable to A Limited, loan receivable by A Limited. Understand? And are you understanding, sir? Because B Limited is no more in existence. So when B Limited is no more in existence, their liabilities now my liabilities. But whatever the debts between them, mutual debts are there, they will become irrelevant. So I need to cancel them. That's why cancellation of intercompany owings. Because transfer company is transferring its business no more in existence. Therefore, whatever the debts due between us, we will cancel in the books of transferring. Similarly, sir, debtors and creditors, sir. So in the transfer company balance sheet, suppose trade payables is there. In the transferee company balance sheet, trade receivables is there. Now in the trade payables, sir, A Limited is there, trade payables 5 lakhs. And here trade receivables B Limited is there, 5 lakhs. What we need to do? We need to eliminate in the books of transferee company, because mutual debts between the parties is 5 lakhs, 5 lakhs. And this B Limited trade payables. Now I will incorporate in my books trade payables 5 lakhs. But this trade payables to whom? A Limited only. So therefore A Limited trade receivables, see this. Trade payables which is came from B Limited, I will cancel. First I will incorporate and then cancel. And whatever the trade receivable is there in my books, 5 lakhs, 5 lakhs. See this. Trade payables came from incorporated from the books of B Limited to A Limited 5 lakhs. First I incorporated. Later I will cancel it with my asset. So between transferor and transferee company, if there are any mutual debts in the form of loans, in the form of debtors, creditors, in the form of bills, so please eliminate them, because transferor company no more in existence. So therefore all the debts, liabilities between you will not become relevant to you. So you cancel them. Next, sir, one more important entry, sir. Elimination of unrealized profit on goods sold by one company to other and the remaining unsold on the date of amalgamation. Elimination of URP, unrealized profit on goods sold by one company to other and remaining unsold on the date of amalgamation. See, this is also one of the area where most of the students are unable to understand, sir. See, very simple, sir. Elimination of unrealized profit. What is this elimination of unrealized profit? I will tell you. For example, sir, X Limited, Y Limited. Suppose X sold goods to Y Limited, sir. And the cost of the goods is 100, sir. And they sold at a profit of 20. So 120. Right? So X sold goods to Y Limited. Now the stock is there with whom? Y Limited. Suppose at the end of the year, there is a unsold stock, 120. That means X Limited sell the stock to Y Limited, no stock has been resold. So therefore there is a total unsold stock of 120. Now for example, at this point of time, suppose amalgamation happened. At this point of time, amalgamation happened, sir. For example, what we are going to do is, suppose X Limited take over Y Limited. X Limited takes over Y Limited. So this. So X Limited is what? Transferee. Y Limited is what? Transferor. Okay, important. Listen to me carefully. So before amalgamation, what happened, sir? X Limited sold goods to Y Limited at cost plus profit. Now amalgamation happened, sir. That means Y Limited is taken over by X Limited. Now see, when they are incorporating the assets and liabilities of transferor company, they know that their inventory includes unsold stock of 120, which actually sold by them only. And they know they have that stock is included a profit of 20, which is not yet realized. So unrealized profit is there. That has to be eliminated. Because see, why unrealized profit has to be eliminated? URP, unrealized profit. Then suppose, see, Who sold the goods? X Limited. Now how much profit they have booked in the books? 20. But whether this profit realized or unrealized? Not realized. Why? Because the stock is still there with Y Limited only. That means it is not sold to outsiders. If it is sold, na sir, profit will be realized. So if it is not yet sold, that means there is an unsold stock of 120. Now, as a transferee company, I know that this 120 is the stock which is held by transfer company, is sold by me. And in this stock, there is a profit element which is not yet realized. Therefore, I need to eliminate from my books 20 rupees profit, because this is not a profit to me. This is not a genuine profit to me. So I need to eliminate this unrealized profit. Sir, suppose for example, out of the stock you sold, sir, the unsold stock is only 60. That means remaining stock was sold. So sold means it was realized. Therefore, in this 60, what will be the unrealized profit? 10 only. Because see, for 120, 20 rupees is the profit. In 60, 10 rupees proportionately. 10 rupees is the profit. So eliminate 10 rupees profit from X Limited. X Limited transfer. Sir, why we need to eliminate from X Limited? Who sold the goods? Seller. Who books the profit? Seller. Now who has to eliminate the unrealized profit? Seller. So always profit will be eliminated in the books who has recognized it, because that profit was not yet realized. So eliminate it. Unrealized profit. 20. So what is the entry, sir? See, if it is amalgamation in the nature of purchase, this unrealized profit will be goodwill or capital reserve account debit. We will adjust to goodwill or capital reserve account debit to stock reserve account. Stock reserve account. Sir, what is this stock reserve? See, in the inventory of Y Limited transfer company, 120 is there na inventory. In that inventory, what is the profit element? 20. So we need to reduce from inventory value also. So stock reserve, or else directly we can write like this: goodwill or capital reserve to stock account. From the stock, I need to eliminate 20 rupees profit. So please understand, sir, before amalgamation, if the transferee company sold goods to transferor company, in that sales, if there is any unsold stock is there in transferor company, that unsold stock includes a profit element which is not yet realized. So therefore, that profit element has to be removed from the books of transferee company. And also, whatever the inventory is there in the transferor company which is sold by transferee company, in that inventory, whatever the profit element is there, you need to eliminate. That means at the time of incorporation entry itself, when you are writing the entry, when you are writing the closing stock, see this, here two ways it can happen, sir. At the time of incorporation entry itself, as a transferee company, if I incorporate the inventory of B Limited, in my example, inventory itself, inventories, I will asset, right? I will debit. So inventory account debit. Suppose from the B Limited, I am taking the inventory. Suppose 120 minus 20, I will take directly at 100. No need to eliminate separately, because right away at the time of incorporation itself, I removed the unrealized profit from the stock and accordingly I adjusted. Therefore, my goodwill or capital reserve will be adjusted correspondingly. Suppose, sir, at the time of incorporation, you have incorporated the unsold stock in the books of transferee, which is sold by transferor. See, please understand, your transferee, sir, we are learning accounting treatment in the books of transferee. So as a transferee, I sold stock to transferor company. Now the stock is there with the transferor company, right? Now that stock I am taking over. I know in this stock there is a profit element. So I have incorporated at 120. And later on I need to write a separate entry to eliminate this 20. That is goodwill or capital reserve account debit to stock account or inventory account. I will write separately 2020. You understand the logic of why we need to eliminate unrealized profit? Because unrealized profit, why we need to eliminate is because the profit is not yet realized. As a transferee company, I sold goods to transfer company. Now transfer company is mine. So the stock is again coming to me only. So 100 rupees worth of stock I have given at 120. That 120 worth of stock is still there in the transferor company only. So I know in my books I have recognized a profit of 20. That profit is now unrealized profit. So eliminate unrealized profit by adjusting to goodwill or capital reserve in amalgamation in the nature of purchase. And also from the inventory value I need to reduce 20. So that's why goodwill or capital reserve to stock reserve. Okay. Sir, suppose if it is amalgamation in the nature of merger, then general reserve or P&L to stock reserve or stock. If it is merger, sir, adjust to directly to free reserves, general reserve or P&L. If it is purchase, sir, adjust to goodwill or capital reserve. Sir, suppose for example, here you said transferee company sold goods to transfer company. What about transfer company sold goods to transferee company? See, suppose in this case, reverse happened. For example, in this case, Y Limited sold goods to X Limited. Then, simple sir, who sold the goods? Transfer company. Profit is recognized in whose books? Transfer company. Now, stock is there with whom? X Limited. Now, in that stock, what is the unrealized profit? They will eliminate. Whatever the unrealized profit is there, they will eliminate, sir. Stock is there with X Limited only, na, transferee company. In that stock, whatever the unrealized profit is there, they will eliminate directly. Okay? So, that's it. So, this is the concept, sir. So, elimination of unrealized profit. So, before amalgamation, if any transfer takes place between the transferee and transferor company, now in that stock, whatever the unrealized profit is there, try to eliminate that unrealized profit. Okay. See, here also I have taken some examples. Suppose A Limited sold goods to B Limited, sir. Cost 1 lakh, profit 20%, 1.2 lakhs. Now stock is there with B Limited. And in that stock, there is a profit of 20,000. That 20,000 profit we will eliminate. So therefore, the inventory value will be considered at 1 lakh. And also in the books of A Limited, there is an unrealized profit that has to be eliminated. Okay. Next is, sir, liquidation or realization expenses, sir. Sir, liquidation or realization expenses, here also 3 cases will come, sir. 3 cases. Purchase method, pooling of interest method. Suppose liquidation expenses incurred by transferee company itself. Incurred by purchasing company, transferee company itself. What is the entry? Goodwill or capital reserve to bank. If it is amalgamation in the nature of purchase. Merger, general reserve or P&L to bank. See, in purchase we are adjusting to goodwill or capital reserve. In merger we are adjusting to general reserve or P&L to bank. Suppose when liquidation expenses or realization expenses are incurred by selling company, that means transferor company, no entry. Similarly, we have discussed in transferor company books. In transferor company books, when liquidation expenses are borne by transferee company, no entry. So your transferee company, when liquidation expenses are incurred by transferor, no entry in your books. And the third entry is, sometimes I told you now, liquidation expenses are borne by transferor, reimbursed by transferee. Liquidation expenses borne by whom? Borne by transferor, incurred, reimbursed by transferee. Now you are transferee, understand? When transferor company incurred the liquidation expenses, you know that you are going to reimburse it. So therefore, when they have incurred, what is the entry we will write is goodwill or capital reserve to selling company. There is a transferor company realization to bank when they incurred liquidation expenses. But as a transferee company, when it is amalgamation in the nature of purchase, I will adjust to goodwill or capital reserve. So goodwill or capital reserve to, I know I need to repay it to transferor. So therefore selling company. And when I actually reimburse, selling company to bank. That means ultimately what is the entry? Goodwill or capital reserve to bank. So as a transferee company, when I am incurring any liquidation expenses, goodwill or capital reserve to bank. So same entry I have to pass for case 3 also. But in case 3 indirectly. First they will incur. When they incur, I know I have to reimburse them. So therefore I will adjust to my goodwill or capital reserve. Goodwill or capital reserve to transferor company. Then when I reimburse them, transferor company to bank. And when it comes to pooling of interest method, instead of goodwill or capital reserve, I will write general reserve or P&L. So when they incurred, so as a transferee company, I know I have to reimburse them. So therefore, general reserve or P&L account debtor to transferor company to bank. So liquidation expenses, 3 cases, very simple, sir. First, liquidation expenses incurred by transferee company, goodwill or capital reserve to bank, purchase method, pooling of interest method, general reserve or P&L account debtor to bank. When liquidation expenses incurred by transferor, no entry in transferee books. When liquidation expenses incurred by transferor, reimbursed by transferee. When they incurred in purchase method, goodwill or capital reserve to transferor to bank when we reimburse. In pooling of interest method, general reserve or P&L account debtor to transferor to bank. Okay. So as a transferee company, first business purchase entry, then incorporation entry, then discharge of PC entry, then any intercompany owings we need to eliminate between transfer and transferee, because transfer company no more in existence, so they will be eliminated. And any unrealized profit is there in respect of unsold stock, that has to be eliminated, and liquidation expenses. And the last entry is incorporation of statutory reserves of selling company. Very, very important entry, sir. Most of the students are not understanding this entry. Listen to me carefully. Incorporation of statutory reserves of selling company. This comes only in the amalgamation in the nature of purchaser. It will not come in amalgamation in the nature of merger. Why? Sir, in the merger at the time of incorporation itself, we have incorporated all reserves and surplus, including statutory reserves. See this. Including statutory reserves, we have incorporated, sir. Again, no need to incorporate separately, sir. Whatever the statutory reserves are there in the transfer company, we have incorporated. But when it comes to purchase, sir, we have considered only assets and liabilities. But now we need to incorporate statutory reserves of selling company. First of all, understand what is statutory reserves of selling company. What is statutory reserves? The statutory reserve means those reserves which are required to be maintained as per the statute, as per the law. In order to get some benefits, you need to maintain certain reserves as per the act. Those are called statutory reserves. Okay, statutory reserves. For example, debenture, what is that? Investment allowance reserve, development rebate reserve, like that. What is that? Export profit reserve. There are some reserves are there which has to be compulsorily maintained as per the act to get the benefits. Now, suppose there is a transferor company. In the transferor company books, there is one statute reserve. Now, that statute reserve has to be maintained for 10 years. Already 5 years is over. Now, you are taking over the transferor company. You are the transferee company. Now, you need to maintain that reserve for next 5 years. And this is amalgamation in the nature of purchase. So, tell me, sir. Understand, sir. Very interesting here. So, there is a transferor company, sir. In the transferor company books, there is a reserve. Suppose there is transferor company. In the transferor company balance sheet, there is a reserve, statutory reserves, that is export profit reserve. Like that, one reserve is there, 10 lakhs, and this reserve has to be maintained for 10 years. Already 5 years gone. Now, exactly this company was now taken over by transferee company. Now, that means the balance 5 years, this reserve is to be maintained by whom? Transferee company. Transferee company has to maintain the export profit reserve. But the problem is, actually this reserve is not belongs to transferee, but they have to maintain as per the rules, as per the statute. In order to get the benefit, this reserve has to be maintained by transferee company. So therefore, transferee company have to incorporate the statutory reserves of transferor company in such a manner that the effect of this reserve will not be there on our reserves. So being a transferee company, in purchase method, I won't take any reserves and surplus of transferor company. But the statutory reserve, as per the law, I have to maintain. So therefore, I need to incorporate the statutory reserve in such a manner that I need to incorporate it in my books, but my reserves don't get affected by it. How can I incorporate a reserve without affecting my own reserves? I need to incorporate. No, sure. For example, see, export profit reserve. Suppose I am transferee company. So therefore, in my books, I need to incorporate the statutory reserve, EPR, export profit reserve. Because reserve is credit balance now, so I need to credit EPR. Suppose 10 lakhs. So if I credit EPR now, my total reserves and surplus will increase now. That means this reserve is affecting my reserves. It should not happen. So therefore, I need to incorporate transferor company statutory reserves in my books without affecting my own reserves. What you do? Simple. You need to create a equivalent and opposite dummy reserve. So therefore, in order to nullify the effect of this statutory reserves of transferor company, in order to don't get affected, my reserves don't get affected because of incorporation of the statutory reserves, what I will do is, I will create a dummy equivalent reserve that is called amalgamation adjustment reserve. So therefore, the entry is amalgamation adjustment reserve account debit to export profit reserve. Amalgamation adjustment reserve account debtor to export profit reserve, 10 lakhs, 10 lakhs I will write. Now you understand the logic why we create this dummy reserve, amalgamation adjustment reserve. See, it's actually a dummy reserve. Why we have created this dummy reserve? Because we don't want the statutory reserves of transfer company get affected our reserves. We have to incorporate it, but we don't want to get affected by it. So therefore, create a equivalent and dummy reserve, that is amalgamation adjustment reserve to statutory reserves. So once the 5 years is over, you cancel it, just reverse the entry. Okay. And this entry will come only in the case of amalgamation in the nature of purchase. In merger, why this entry will not come? Because already you have incorporated everything. So therefore, a dummy reserve created to nullify the effect of statutory reserves incorporation from the transferor company. So this is the logic. So therefore, we have completed the transferee company books also. So transferee company books, see this, first, how many entries will come? First of all, when you are doing the accounting in the books of transferee company, first you decide the type of amalgamation. If it is amalgamation in the nature of merger, pooling of interest method. Amalgamation in the nature of purchase, purchase method. So in purchase method, first what are the entries will come? First, business purchase entry. What is the entry? Business purchase account debtor to liquidator of transfer company, PCPC. Next, incorporation of assets and liabilities. Assets account debit at agreed values, to liabilities agreed value, that means net assets, compare with PC to business purchase. If PC is more than the net assets, goodwill, transfer to goodwill account debit. If it is less than that, capital reserve. Entry number 2 is over. Entry number 3, discharge of PC, liquidator of transfer company. Transfer company account debit to share capital, to equity share capital, to securities premium, to cash, whatever you are giving, to debentures, whatever you are giving, you incorporate in your books. Next, fourth entry, cancellation of intercompany owings. Whatever the intercompany owings is there, one company asset to another company liability, both will be cancelled. Next, any unrealized profit is there in respect of unsold goods. So in case of purchase, goodwill or capital reserve to stock reserve or stock. Liquidation expenses, 3 cases. Incurred by transferee company, goodwill or capital reserve to cash or bank. Incurred by transfer, no entry. Incurred by transfer, reimbursed by transferee. When they incur goodwill or capital reserve to transferor, and when we reimburse transfer account debtor to cash or bank. And incorporation of statutory reserves, amalgamation adjustment reserve account debtor to statutory reserve account. Because we need to incorporate the statutory reserves of transferor company as per the law, but it should not affect my reserves. How can you incorporate a reserve without affecting your own reserves? Therefore, create a equivalent dummy reserve, that is amalgamation adjustment reserve. That's why, see, this reserve is having a debit balance. See this, amalgamation adjustment reserve is a debit balance, statutory reserve is a credit balance, the net effect is nil. So once the period is over, you cancel it. So that's how you incorporate a statutory reserve. Now when it comes to amalgamation in the nature of merger, so same entry, business purchase, same entry. Incorporation entry, assets of transfer company, all assets at book value, two liabilities, book value. But here the important thing is PC you are paying, you compare with the share capital of transfer company, explain the logic. If the PC is more than the share capital, then it is loss. That loss first adjust against the transfer company free reserves. If not sufficient, transferee company free reserves. If not sufficient, then against the, adjust to the P&L account. And of course, your PC is less than the share capital worth of business you are taking. It's a profit which is transferred to capital reserve. Discharge entry same. Cancellation of intercompany owing same. Elimination of unrealized profit. General reserve or P&L account debtor to stock reserve or stock. Liquidation expenses instead of goodwill or capital reserve. So general reserve or P&L account you will write. And incorporation of statutory reserves will not come. Okay. So that's it. So this is the entire discussion, sir. I told you intercompany owings, any intercompany owings between the company. Intercompany debts may exist when one company purchases another company. That is, the purchasing company owes the vendor or vice versa. The amount will be recorded as book debts for one company and trade payables for another company. So trade payables to trade receivables. Any intercompany owings are there between the transferor and transferor. Now transferor company is no more in existence, so therefore these entries will be eliminated. And also adjustment for stock value. I told now any unrealized profit is there in the stock, you need to adjust it. Any intercompany loans also there between transferor or transferee, they have to eliminate. Okay. That's it. Entries at par value, sir. Sir, goodwill and securities premium accounts cannot be adjusted. It's allowed to base entries on par value of the shares, even if the shares are at market value. Goodwill or capital reserve will adjust the securities premium automatically. See, sometimes what happens is, especially when PC is given in the form of shares, they will say that shares will be recorded at par value only, face value only, because they don't want unnecessarily to inflate the So securities premium and goodwill. And that's why goodwill and securities premium accounts cannot be adjusted, sir, always. And it's allowed to base entries on par value of the shares even if the shares are at a market value. Okay. Even sometimes the shares are at market value, but we will write the entry at par value only, because the idea is unnecessarily don't increase the goodwill or securities premium. Okay. So if you do that, what happens is goodwill or capital reserve will adjust the securities premium automatically. Okay. Anyways, not that much important. So this is the entire amalgamation chapter, sir. So you see it. I think once you listen to this concept and now you go and solve the sums, more than sufficient. Now the next chapter for discussion is internal reconstruction. We have actually two types of reconstruction, sir. One is external reconstruction, another one is internal reconstruction. You know, external reconstruction is amalgamation. We have seen in amalgamation chapter, amalgamation includes external reconstruction. So for external reconstruction, accounting treatment is done as per accounting standard 14. What is external reconstruction? A new company is formed to take over the existing company, or an existing company transformed itself into a new company. We can put it like that also. So therefore, if there is a problem within the organization and you decided to liquidate your company so that your business will be taken over by some other new company, that is called external reconstruction. So that is covered under accounting standard 14, amalgamation. But this chapter is about internal reconstruction. That means you don't select the option of liquidation of company. Of course, you have some problems within the organization. Your financial statements are not viable, not looking healthy. There are some issues in the financial statements. Now you need to sort out those problems. You don't want go for liquidation of the company. So you decided to reorganize your financial statements. You decided for reconstruction within the organization itself. That is basically internal reconstruction. So generally, sir, what are the problems? What are the shortcomings of financial statements a company may have? Maybe our assets are overvalued, sir. Liabilities are undervalued. So the one thing is that we have assets, but they are not, they are overvalued in the balance sheet. Of course, we have liabilities, but they are undervalued. That is not the ideal scenario. We need to sort it out, that shortcoming, one shortcoming. Maybe we have huge accumulated losses. Past losses is there. If you look at this balance sheet of A Limited, they have reserves and surplus minus 20 lakhs. That is not the ideal scenario, right? And they have some fictitious assets also. So they need to remove these fictitious assets. So therefore, assets may be overvalued, liabilities may be undervalued, reserves and surplus, there is huge accumulated losses, share capital may be overcapitalization. Maybe the face value of the share is not truly reflecting the worth of the company, the value of the company. And we have some fictitious assets on the way. So this is a kind of unhealthy financial statements. So now I need to make it a healthy financial statements. Sir, we have so many issues within the organization. So of course our financial statements are not viable, very unhealthy. So we won't sustain it for longer period of time. Of course, you have two options. You decide to liquidate, you go for external reconstruction. Some other company will be there, new company, it will take over your company, the game is over. But suppose if you decided that these shortcomings you want to remove, so that process is called internal reconstruction. So you decided to remove the losses, you decided to remove the fictitious assets, you want to reorganize the share capital, maybe you want to ask compromise and arrangements with your creditors, and now you want to make the unhealthy financial statements into healthy financial statements, making them more viable, especially if your financial statements are not, not looking strong, sir. Who is ready to invest in your company? Imagine. So you should have a reasonably good financial statements. Everybody nowadays, they are looking at the financial statements of company. So you won't sustain for a longer period of time with these kind of financial statements. So either you liquidate or you continue by removing all these shortcomings. So if you decided to remove all these things, that process is called internal reconstruction. So why companies will go for internal reconstruction? maybe we have some accumulated losses. We want to remove all those losses. Maybe our capital is not reflecting the true worth. Maybe over capitalization is there. Maybe we have overvalued assets. Maybe we have undervaluation of liabilities. So these are some common problems we had. So we want to sort out all these problems, and the solution is internal reconstruction. So internally you do reconstruction. So internal reconstruction, basically what happens is we reorganize the capital, and we ask the sacrifice from our creditors, and we will properly value our assets, and we will restate all our liabilities. That means we make the financial statements more stronger, viable. So this entire episode, this entire process is called internal reconstruction, right? So what is internal reconstruction, sir? Internal reconstruction is a process where a company revalue the assets, reassess the liabilities, and write off the past losses. Ultimate goal is what? Whatever the weaknesses we had, we want to remove them. With the sacrifices which is made by the shareholders and also the creditors, so we will try to, set off the losses we had. Or we will try to revalue the assets, reassess the liabilities. Of course, this internal reconstruction involves reduction of share capital, maybe modifying the shareholders' right. Suppose, sir, you decided to sort out the internal problems. Who has to step forward and sacrifice? Shareholders, owners of the company, and also creditors. Without cooperation of these people, it is not possible to internally sort out the company. So therefore, generally in internal reconstruction, share capital reorganization is the important element. And what is the object of internal reconstruction? To make our financial statements more viable, healthy. So to reorganize the capital. So to achieve that reorganization of capital, that is the first object of internal reconstruction. Settle with the creditors, and also helping the company to survive, recover without liquidation. Liquidation is not the option we selected. If you select liquidation, external reconstruction. Now generally, what is the difference between internal and external reconstruction? External reconstruction, the company is liquidated. Internal reconstruction, no liquidation of company. The company will continue, but existing capital will be reorganized. Internally, we will reorganize. So no liquidation. And reduction of capital and rights. See, in external reconstruction, there is no reduction of capital, and there is no change in the shareholders' right. But in internal reconstruction, capital may be reduced, liabilities may be adjusted, shareholders' rights may also be adjusted. No reduction of capital here. Legal position. Sir, external reconstruction, sir, section 232. Internal reconstruction, section 61 and 66. Legal formalities, important. Sir, external reconstruction, there is no much legal formalities, sir. No court approval is required. But internal reconstruction, sir, generally approval of the court is required. So whatever the company decided, what decisions company wants to implement under the scheme of internal reconstruction, it requires court approval, sir. Why? Because in the name of internal reconstruction, you don't do any injustice to the shareholders, especially small shareholders, creditors. There is a possibility, sir. See, when there are profits, everybody wants to share. But when the company is in problems, nobody is coming in front and saying that, see, we are ready to sacrifice this much. Maybe the majority shareholders says that it is the minority shareholders who has to sacrifice. And maybe the scheme is framed in such a manner, it is not favorable to only selective people, selective creditors, selective shareholders. So those things may happen in internal reconstruction. So in the name of internal reconstruction, you can't do any kind of injustice. That's why generally what happens is, board of directors, they will conduct a meeting. In that meeting, they decided what are the things we need to execute on internal reconstruction. They will frame one scheme, and that scheme requires the approval of the court, so that the court will see whether this is in the best interest of the company, whether there is no injustice to everybody, everybody equally, sacrificing. So when there is a loss, the loss is equitable to everybody. So they will make sure. That's why internal reconstruction requires court approval, and also some legal proceedings will be there. So now I think you understood what is internal reconstruction. So definitely your company had some shortcomings in your financial statements. You want to set right all those things. For that, you need to execute one plan, that is internal reconstruction. And sir, what methods are there for internal reconstruction? See, there are 5 methods, they say generally. One is alteration of share capital. Second one is variation of shareholders' rights. And third one is reduction of share capital. And fourth one is compromises and arrangements. compromises and arrangements, and the last one is share surrenders, surrender of shares. So like this, there are 5 methods is there for internal reconstruction. So one of the predominant element in internal reconstruction is what? Reorganization of the capital and capital related adjustments. So you see, out of the 5, 4 things are relating to capital only, share capital only. Alteration of share capital, variation of shareholders' rights, next reduction of capital, surrender of shares. Compromises and arrangements, generally we will enter with creditor, of course. So we will see one by one, sir. So when you are solving the question relating to internal reconstruction, sir, you are going to find all these things. Okay. So first one, alteration of share capital. And by the way, sir, alteration of share capital, variation of shareholders' rights, reduction of share capital, compromises and arrangements, all these are legal provisions. Legal provisions. See, look at first alteration of share capital, section 61. See, alteration of share capital. Generally, in the internal reconstruction, the capital will be altered. Share capital will be altered. Sir, what things are covered under alteration of share capital? Section 61 says there are 4 things. Alteration of share capital includes 4 things, sir. One is increase of authorized share capital, increase. Second one is subdivision of shares, consolidation of shares, subdivision, consolidation. Third is converting the share capital into stock and vice versa. Third one. Fourth one is cancellation of unissued shares. Cancellation of unissued shares. So like this, there are 4 things involved in alteration of share capital. What is the first one? Increase of authorized capital. Second one is subdivision of shares. So what is this subdivision of shares? Subdivision of shares means dividing the shares into shares of smaller denomination. For example, 10 equity shares of rupees 10 each is there in the company, 100 rupees. Now company decided to make each share 5 rupees. Subdivide the shares into shares of smaller denomination. Previously it was 10, now it is 5. That means one share they have divided into 2 shares. That means 10 shares will become now 20 shares. Overall capital remains same, but the terms have been changed. This is called subdivision of shares. Subdivision of shares. Now please understand, subdivision of shares. In this case, what is the entry we will write? Old equity share capital account debit to new equity share capital. The old equity share capital is 100. The new is also 100. But the terms changed. Na? Old one is what? 10 shares of 10 each. Now the new one is 20 shares of 5 each. Overall, there is no sacrifice, but the terms have changed. Sir, what is the use of this? See, to make your shares more viable, I mean to increase the liquidity of the shares, maybe you want to align your share prices with the market trends. See, for example, your share face value is 10. You feel this 10 rupees is not properly valued. It is not reflecting the worth of the company. So 5 rupees may be the appropriate value. So maybe, or you decided to increase the liquidity of your shares. So make it reduce. 10 shares have been, 10 rupees share has become now 5 rupees. This is called subdivision of shares. So while reading the question relating to internal reconstruction, sir, you will find this. So you need to write the entry also. Whenever there is a subdivision of shares, old share capital will be cancelled, new share capital will be written. Amount wise, there is no difference. Amount wise, there is no difference. Only terms have been changed. Only terms have been changed. And then one more concept, sir. Consolidation of shares can also be done. For example, sir, 10 equity shares of rupees 10 each. This is the present position. Now the company decided to make each 2 shares as 1 share. Each 2 shares they want to make it as 1 share. That means 10 rupees share. 1 share 10 rupees. 2 shares 20. 1 share 10 rupees, sir. We want to make every 2 shares as 1 share. That means what is the value of the share now? 2 into 10, 20 rupees. So number of equity shares 5. So this 100. This is called what? Subdivision, consolidation of shares. Consolidation. We consolidated. Consolidation of shares. We consolidate every 2 shares into 1 share. So therefore here the entry is equity share capital to equity share capital. Old equity share capital to new equity share capital. What is the old one, sir? Old one is 10 shares of 10 each. What is the new one, sir? 5 shares of 20 each. So total overall same 100. So this is alteration of share capital. So alteration of share capital includes subdivision, consolidation. In subdivision, we will divide the shares into shares of smaller value. In consolidation, we consolidate the shares into shares of larger denomination. Sir, why companies will do this? Because they want to make shares more affordable. Maybe they want to increase the liquidity of the shares. Maybe they want to align with the market trends. So that's why they are going to do this. Next, the third thing in an alteration of share capital is converting the shares into stock and vice versa. Sir, company may decide to convert their equity shares into stock and vice versa. For example, sir, see this. A Limited is there, sir. 1 lakh equity shares of 10 each. At present, 1 lakh equity shares of 10 each is there, 10 lakhs. Now they want to convert this into stock. Equity stock is equal to rupees 10 lakhs. So suppose, for example, generally we will divide the shares into shares of smaller denominations. So we will divide the entire total share capital into shares of equitable value. That we call it as share capital. 1 lakh equity shares of 10 each. So each one is called 10 rupees is the share value, right? Suppose company decided they want to denominate it as single consolidated amount, that is called equity stock, 10 lakhs. So what is the entry here? Equity share capital to equity stock. And when we reconvert the stock into shares, equity stock to equity share capital. So this is also part of, alteration of share capital. And last one, cancellation of unissued shares. If any shares which is not subscribed by anybody, not taken by anybody, suppose you decided to cancel those shares, that is also alteration of share capital. So the first method of internal reconstruction is alteration of share capital, section 61 of the Companies Act. In alteration of share capital, generally 4 things are there. Increase the authorized capital. Second one, subdivision and consolidation of shares. Third one is converting the shares into stock and vice versa. Last one, cancellation of unissued shares. In that, subdivision and consolidation is quite frequently coming in the questions. Next one, variation of shareholders' rights. There is a part of internal reconstruction. What companies will do is they will change the shareholders' rights. Suppose, sir, if you have become the shareholder of a particular company, you purchase this one class of shares, you will get some rights, na? Dividend rights, voting rights. Suppose if company decided to vary your rights, that is called variation of shareholders' rights. For example, company may change your rate of dividend. Suppose you purchased preference shares of a company. Now, at the time of purchase, your shares are 10% dividend. Now, they want to reduce this to 5%. So, companies can modify the rights attached to different class of shares, maybe dividend rate, maybe voting rights. Example, they may change the dividend rates on preference shares, or they may change the one class of shares into another class of shares. They will change the future of the shares, like converting cumulative into non-cumulative shares. Suppose, for example, sir, I will tell you. First one is, for example, cumulative preference shares. Suppose we purchased preference shares, sir. The first one, cumulative preference shares we purchased. Now company decided to convert this into non-cumulative. That is nothing but varying the shareholders' right. So what is the entry generally we are going to write? Cumulative preference share capital account debit to old one, cancelled. New one is non-cumulative preference share capital. Amount wise there is no change. Or maybe, for example, cumulative preference shares originally we purchased is 10%. Now company want to reduce this dividend rate to 8%. So 10% cumulative preference share capital account debit to 8% cumulative preference share capital. So the amount wise 10 lakhs only. Maybe if the company reduces the dividend from 10% to 8%, so in future company is going to save at least 2% dividend. So these things will happen as a part of internal reconstruction, sir. So either change in dividend rate or converting the cumulative into non-cumulative, these things may happen. Whenever these things are happened, so the old capital will be cancelled, new capital will be created. Suppose if they convert cumulative into non-cumulative, cumulative capital will be cancelled, non-cumulative capital will be recognized in the books. So this is also one of the method for internal reconstruction. Because in internal reconstruction, we need to do the reorganization of capital. In the process of reorganization of capital, either alteration of share capital may be done, or maybe we will change the rights of shareholders for a different class of shares. Dividend rights, voting rights, we may change. We may convert the one class of shares into another class of shares. These things will happen. Of course, this is in the best interest of the company only. This is in the best interest of the company only, because we want to make our financial statements more viable. So in that process, these things may happen. And of course, shareholders have to sacrifice because they are the owners of the company. Next, third important method in the internal reconstruction is reduction of share capital. What is this reduction of share capital? Again, section 66 of the Companies Act talks about reduction of share capital. If you look at the section 66 of the Companies Act, sir, they have given certain methods for reduction of share capital. See, basically here, reduction of share capital may happen either by reducing the face value of the share or without reduction of face value of the shares. Without reduction of face value of the share or by reducing the face value of the shares. I will tell you, listen to me. For example, sir, reduction of face value of share. For example, there is a company, in that company equity share is there. The face value is 10 rupees, sir. Face value is 10 rupees. And the paid up value is, suppose, 8 rupees. 8 rupees. So therefore, what is the unpaid amount? Unpaid 2 rupees. Now, for example, company decided that they want to reduce the face value from 10 to 8. That's it. That means company now will not call this 2 rupees. So they will cancel this. This is one reduction of capital. Here in reduction of capital, what happened? They reduced the face value of the share. Previously, the face value is 10. Now the face value is 8. Of course, the shareholders already paid 8. Remaining 2 rupees, we are not going to call because we reduced the face value from 10 to 8. Right? So therefore, here what entry will come? Tell me. Old equity share capital. Already, how much capital we received, sir? 8. So that means in our books 8 rupees is there. That one we will cancel. Don't write 10 because 10 is face value. Till paid only 8 rupees only. So therefore equity share capital 8. 2. What is the new equity share capital? New one. New equity share capital is 8. But see, there is no overall change in the capital. Previously, no. But the face value changes. Previously, the terms were, this is partly paid up. Actually, previously, face value 10, paid up 8. This is the old one. Now, the new position is face value 8 and paid up also 8. That means, here previously it was partly paid up, partly paid. Now it was fully paid up. That is the difference. Fully paid up. Fully paid up. That is the difference. So reduction of shares. So reduction of shares happen by reducing the face value of the shares. This is one way. Or sometimes without reduction of face value. Without reduction of face value. Reduction of capital may happen without reduction of face value. How, sir? For example, sir, there is a company. In that company, one equity share is there. The face value is 10. Paid also 10, sir. Paid also 10. Fully paid. That means it was fully paid. And see, as of now, the company decided that they are not effectively employing 2 rupees. Not effectively employed in the business. Not effectively employed in the business. Employed. What they decided is they want to return this 2 rupees to shareholders. They decided that they want to return this to shareholders without reducing the face value. See, they don't want to reduce the face value. Face value remains 10 only. But they decided that as of now 2 rupees is not required. So therefore they want to return it to the shareholders. Now in this case, interesting thing is what? There is no reduction in the face value. So therefore what entry you will write here? So old equity share capital, actually 10 rupees fully paid up, right? So fully paid up 10. So we will write 10. Suppose One share is only there for your understanding, 10 rupees. But the new one is what? New share capital to be created only 8. Because 2 rupees we want to return it. To whom? Shareholders, equity shareholders. 2 rupees. Now when you return them, equity shareholders to bank. 2. That's it. So therefore ultimately what happened here? Old equity share capital 10, new equity share capital 8. New equity share capital means it was fully paid previously. It was fully paid. Now they make it as partly paid. How they make it partly paid? With the reducing face value? No, they have not reduced the face value, but they return this amount to them as of now. This is also called reduction of share capital. So therefore reduction of capital may happen with reduction of face value, without reduction of face value. So this is there here. So with reduction of face value. So how? The shareholders are not called upon to pay the unpaid amount on shares held by them in future. Or see, when excess capital, paid up capital is paid off. In this case, when it is not possible for the company to employ profitably of its paid up capital, then in such a case, it may decide to refund the excess capital to the shareholders. So that means here in the first case, reduction in face value will happen. In the second case, reduction in face value will not happen. No reduction in face value. Okay. And apart from this, sir, there is one more thing here. When the paid up capital which is lost or not represented is cancelled. So listen to me carefully, sir. So when the paid up capital which is lost or not represented by the available assets, it may be cancelled. Here also, sir, two things, sir. One is reduction in only paid up value. Second one is reduction in both nominal and paid up value. For example, sir, see the first one. There is a shareholder may agree to reduce the paid up capital of 100 rupees share to the paid up value of 10 per share. That means the sacrifice is 90. The sacrifice is 90 straight away. Suppose for example, see, shareholders are there. They decided that they want to reduce the paid up capital. That means they want to sacrifice. So suppose for example, there is equity share which is face value, suppose 100, fully paid up. Fully paid up. Now they want to reduce this as partly paid up. Please understand, partly paid up as 10 rupees. Actually they paid full amount, sir, but they decided that, see, we will assume that it is partly paid up only. That means 90 rupees they are saying that again if you call we will pay. See, here you are not reducing the face value. Face value is 100 only. But we are sacrificing to the company for the benefit of the company because we have some problems. So with this sacrifice you can try to rectify. You can try to overcome those problems. So therefore here what is the entry we will write? See, we know our share capital has been reduced by 100 to 10. So 90 rupees whenever we want we can call it, right? So therefore equity share capital account debit is reduced by 90. That will be transferred to an account called capital reduction account. Sir, in internal reconstruction, sir, we will open one account called capital reduction account. What is this capital reduction account? All the sacrifices made by the shareholders, creditors, all kinds of benefits we will transfer to this account, sir. This may be called as capital reduction account or reconstruction account. And the balance in this account we will try to use to set off the past losses or maybe overvaluation of assets to bring them to the normal position. Maybe we want to reassess the liabilities. For all these things we will use this capital reduction account. And finally in this capital reduction account, whatever the balance is there, that balance we will transfer to capital reserve account. So therefore here the sacrifice made by the shareholders is 1990. So that we will transfer to capital reduction account. See this. So in this case the sacrifice is 90 and the entry will be share capital to capital reduction account. So straight away they sacrifice 90. So number of shares into 90 rupees per share. So that will entirely go to capital reduction account. Here only what changed, sir? Only paid up value changed. So actually 100 rupees share, sir. They paid fully, but their share value has been, paid up value has been reduced from 100 to 10 only. So 90 rupees they sacrificed. Whatever the sacrifice they have done, that is transferred to capital reduction account. But sometimes it is happen like this. Both face value, nominal value as well as paid up values may be reduced. So both paid up capital and nominal value of the shares are reduced. For example, in the same example, sir, suppose instead of making this partly paid up, suppose the face value they have reduced it to 10. Okay, 100 rupees share. So they reduced it to 10. So what happens, you tell me? Old equity share capital 100 and the new share capital is now 10. That means already they paid 100. So what about remaining 90? Capital reduction account 90. See this, share capital old 100 and new share capital 10, because we reduced the face value also. And how much is the sacrifice? Capital reduction account 90. So these are the three ways. So capital reduction of shares. Any one of these things may happen. So when you are solving the question, you have to be very careful. So reduction of capital, which one is happening? Reduction of capital with reduction of face value or without reduction of face value? So suppose for example with reduction in the face value, how? Only the unpaid amount is there, uncalled amount, we will cancel. That is the first case. Second thing is that, see, in this case capital reduction account not involved. Please observe, capital reduction account not involved, because in this example, if you see the first example, what we have discussed, 10 rupees is what, sir? Actually face value is here in this case, first case, face value 10, paid up also 10. This one, yeah, face value 10, paid up value 8. So that means unpaid balance is what, sir? 2. So we decided to cancel this only. So therefore, actually capital reduction, no sacrifice in fact from the shareholders. Generally what happened is, previously the face value is 10, now it has become 8. Since they already paid 8, so it is normal. That's why old to new equity share capital. Second case also same. Excess paid up capital we decided to give back to them without compromise, without reducing the face value. So that's why capital reduction came. Capital reduction did not appear. But in this case, capital reduction appeared here. Please see this. So here what happened is, we reduced the paid up value. See, when you decided to reduce the paid up value, definitely capital reduction will come, because they are sacrificing the real value. 100 rupees share fully paid up, reduce it to 10 rupees partly paid up. That means 90 rupees capital reduction account, it will be transferred. Similarly, 100 rupees share face value fully paid up, they reduce it to 10 rupees face value fully paid up. That means remaining 90 sacrificing capital reduction account. So carefully observe here. And the next method is compromises and arrangements. Sir, internal reconstruction, sir, definitely some compromises and arrangements will be done. For example, we will approach the banker who has given loan to us. So we may ask them, sir, please give some discount, the company is in problems. Or we may ask our creditors, please sacrifice something, or please give us some discount to settle this liability, like that. So those are called compromises and arrangements. So in the scheme of internal reconstruction, there will be compromises and arrangements. So it's an agreement between the company and its members and outside liabilities when the company faces the financial problems. Such an arrangement therefore also involves sacrifices by whom? Either shareholders, creditors, or maybe debenture holders, or by maybe all of them. Sir, see this. What is the accounting treatment? For example, when the equity shareholders give up their claims to reserves or accumulated profits. For example, equity shareholders in the reserves and surplus, actually the equity shareholders has the right. Suppose they want to give up the right to reserves, some portion of the reserves. So whatever they want to give up, reserves to reconstruction account or capital reduction account, we will transfer. And suppose, for example, settlement of outside liabilities at lesser amount. Liabilities such as sundry creditors may agree to accept less amount in lieu of the final settlement. So for example, outside liabilities or maybe any provision amounts. So whatever the sacrifice they have done, with the amount of sacrifice made by the creditors, debenture holders, that will be transferred to reconstruction account. For example, bank loan 10 lakhs, sir. They have given 1 lakh discount. That means 1 lakh is liability account debit to reconstruction account. This is called compromises and arrangements. So when you are solving the question relating to internal reconstruction, sir, you might see. So company may have entered some arrangements and agreements with the creditors, debenture holders. Maybe they will offer some discount. So whatever the liability reduced, sir, whatever the discount they have given us, sir, debit liability account, credit to reconstruction or capital reduction account. And last one is surrender of shares. See, what is this surrender of shares? Very, very important, sir. Sir, sometimes shareholders may voluntarily return their shares to the company. So, surrender of shares, when shareholders voluntarily return their shares to the company, is called surrender of shares. Now see, in the reconstruction, what happens is, when the shareholders surrender the shares to the company, these surrender shares may be used by the company to reissue to them. Again, reissue them and get the money. With that money, company will, sort out the problems. Or sometimes these surrendered shares will be used to settle the liabilities. So maybe, understand, in the process of reconstruction, the company may ask the existing shareholders, please surrender some of your shares. The shares you surrender, either we will reissue them or we will use them to settle the liabilities, so that company will be get over from this situation. So see this, the surrendered shares may either be reissued to the new or existing shareholders, or may be cancelled to adjust against accumulated losses or liabilities. Now see, here three possibilities. I will show you, sir. In my classroom, one of the problems surrender of shares, sir. Surrender of shares concept, sir. So first, sir, when shareholders surrender, when the shares were surrendered, what is the entry? When shares were surrendered means, to that extent share capital will be reduced, na? So share capital account debtor to share surrender account we will credit. When the shareholders surrendered the shares, share capital to share surrender account. And then, important, these surrendered shares may be utilized to reduce the liabilities. When you used the surrendered shares to reduce the liabilities, what is the entry? Important, sir. Liabilities account debit to capital reduction account. Capital reduction account. When you use them to settle the liability, liabilities account debit to capital reduction account. Because whatever the liability is there, that liability was settled by issue of these surrendered shares. So therefore, what is the entry? Liability, when we settle, liability account will be debited. So liability account debit. And whatever the liability reduced because of this issue of surrendered shares, to that extent it is a benefit to the organization. So therefore, we have transferred to capital reduction account. Please understand, here most of the students will confuse. See, when shares were surrendered by the shareholders, the entry is share capital to share surrender. Now, when the reissue surrendered shares were used to settle the liability, so first for settlement of liability, the entry is liabilities to share surrender, liabilities to capital reduction account. And then you are issuing the surrendered shares, na? So for that, share surrender to share capital. Share surrender to share capital. That means here you need to pass two things. One is for settlement of liabilities. Liabilities to entire liability, whatever you settled through surrendered shares, that will go to capital reduction account. Second, when you reissue the surrendered shares for settlement of liability, share surrender account will be cancelled. Share surrender account, share capital will be created. Illustration 7 and one example also I given, sir. Illustration 7 in the study material. Suppose, for example, sir, the surrender shares were unutilized. That means we want to cancel it. Simple. Share surrender to capital reduction account. Because whatever the shares surrendered, that is a benefit to the organization, which we can use it for reducing the shortcomings, removing the shortcomings of the balance sheet. So that's why it is transferred to capital reduction account. So therefore, please understand. On surrender of shares, this is the entry, share capital to share surrender account. Surrendered shares may be reissued by the company. When they have reissued, share surrender to share capital. Suppose they are reissued for settlement of liabilities, one more entry will come, liabilities to capital reduction account. Because here liability was settled without outflow of resources from the company. It is settled through surrendered shares. So that is a kind of benefit to the organization. Liability was totally removed from the balance sheet. We are not paying anything. We are just giving the surrendered shares to them. So therefore, share surrendered to share capital, liabilities to capital reduction account. Important. And suppose you are not issuing the surrendered shares, you are cancelling them. Simple. Whatever the share surrendered, transfer it to capital reduction account. Sir, why capital reduction account? Because it's a benefit, na? Shareholders sacrificed it. Sir, we don't want these shares. You can use them. That means to that extent, there is a benefit to the organization. We can use them to write off the losses of the company. That's it. That's why. Okay. So that's it, sir. This is the share surrender concept. Okay. Then entries. So what entries generally we will pass in the internal reconstruction? First, reduction of share capital. Suppose reduction of share capital happen. Old share capital debit, new share capital credit. Whatever the sacrifice made by them, transfer to capital reduction account. We have seen now in reduction of capital, whenever the paid up capital has been reduced. For example, the old paid up capital is 100, sir. The new paid up capital is 10. That means how much sacrifice they made? 90. That will be transferred to capital reduction account. Maybe reduction of equity, maybe reduction of preference share capital. Preference shareholders also will sacrifice. For example, preference shareholders paid up capital 10. New paid up capital was now reduced to 2. That means they need to pay another 8 rupees. So therefore they sacrificed it. Of course, fully paid. So we reduce it to 2 rupees partly paid. That means 8 rupees sacrifice. Capital reduction account. And suppose reduction of amount due to debenture holders. Whatever the sacrifice made by the debenture holders to capital reduction. Whatever the reduction of amount due to creditors given some discount. So creditors to capital reduction. Suppose asset value has been appreciated, increase. Asset to capital reduction account. Repayment of reconstruction expenses. Sir, to do the entire reconstruction, there might be some expenses will be incurred, sir. So reconstruction expenses to bank. And finally, sir, whatever the balance is there in the capital reduction account, we will use to set off the losses. See this, capital reduction account debit. If you have a losses, past losses, settle it. Any fictitious asset, preliminary expenses, discount on issue of shares, underwriting commission, advertising suspense account, cancel it. Any reconstruction expenses, settle it. And any goodwill, fictitious assets, settle it. Any patents, trademark, fictitious assets, settle it. Any fixed assets overvalued, that will also be set right through this balance of capital reduction account. And any other assets, if you want overvalued. And finally, whatever the balance came, that is transferred to capital reserve account. So therefore, see this, look at this. What happened in internal reconstruction is, we have asked for the sacrifice from the shareholders and also creditors. Whatever they sacrifice, we transfer to capital reduction account. And this capital reduction account, finally, we are using to set off the losses as well as overvalued assets, undervalued liabilities, everything, and even expenses also. And whatever the final balance remaining, that will be transferred to capital reserve account. Okay. And the words unreduced should be added after the name of the company only if ordered by the court. So generally, when you are preparing the balance sheet of the company after internal reconstruction, so balance sheet of A Limited as on unreduced, we need to write. Why unreduced? Because we are reducing the capital of the company. That's why. So that's it. This is internal reconstruction, sir. Sir, please understand, sir. In internal reconstruction, not all transactions will result in capital reduction. Only if the real sacrifice in terms of amounts happen, then it will be transferred to capital reduction account. So this is the concept, sir. You see this concept, 40 minutes came. So you listen to this concept, try to solve the questions. Okay, that's it. Now let us begin consolidated financial statements. In consolidated financial statements, 3 accounting standards are covered: 21, 23, 27. 21 consolidation of subsidiary, 23 consolidation of associate, 27 consolidation of joint venture. Sir, what is this consolidated financial statements is all about? See, at the end of every year, every company generally will prepare their own financial statements. We call them as standalone financial statements. But being a parent company, whether standalone financial statements are sufficient? The answer is no. Because I am the parent entity. Within the group, I have subsidiaries, I have associates, I have joint ventures. Now, all of them together, how my performance is, how my financial position is, that is also very important for the users of financial statements. So that's why, being a parent entity, I need to prepare consolidated financial statements. I need to prepare financial statements for the entire group, considering all the entities in the group as one single economic entity. For example, I am the parent entity, I have two subsidiaries. Now, parent entity plus two subsidiaries, there are three entities. At the end of the year, every entity will prepare their own financial statements. But being a parent entity, I have an extra responsibility to prepare financial statements for the entire group. That means my company, along with my subsidiaries, I will consider it as one single entity and I will start preparing the financial statements. Those are called basically consolidated financial statements. But it is very easy to say, sir, simply what is there? Take the parent company balance sheet, take the subsidiary company balance sheet, add line by line assets, liabilities, everything you add, you will get the consolidated balance sheet. No, sir. There is a prescribed procedure for consolidation of subsidiary in Accounting Standard 21. Now, in accordance with that provision, the consolidation must be done. If you are consolidating the associate, there is a separate standard AS 23 which will prescribe the accounting treatment. If you are consolidating the joint ventures, then separate standard 27. But the major focus is on AS 21, sir, because mostly in examination they are testing AS 21. So first, what is consolidated financial statements? We need to understand, sir. So consolidated financial statements are financial statements for the group, not just one entity. So by considering all the entities in the group as one single economic entity. Now here, as far as AS 21 is concerned, group means parent and its subsidiaries. Okay, because we need to, overall, what is the position of the group? We need to, disclose to the users. We need to give report to the users. So that's why parent company must provide financial information for the entire group, not just itself, by preparing consolidated financial statements. Now AS 21 is the standard which is mandatory to prepare CFS, especially if you are consolidating the subsidiary. Now what is group? Group means parent and its subsidiary. What is parent? Sir, okay, you said parent and subsidiary. So how parent subsidiary relationship will come, sir? See, this you already know, sir. In company law also you have covered. When one company is able to control the other company, that's where the parent subsidiary relationship will come. So parent company is a company which is control one or more subsidiary. Subsidiary company is a company which is controlled by another enterprise. So this control aspect is very, very important, sir, to become parent subsidiary relationship. Sir, how this control will be achieved? See, there are two ways a control can be achieved, sir. One is having more than 50% voting power. So if one company is having more than 50% voting power, either directly or indirectly, then we say that entity had controlling the other entity. Then there is a parent subsidiary relationship. Suppose, let us assume, for example, A Limited, B Limited. Now A Limited had 70% shares in B Limited. That means definitely control is there. So A Limited is the parent entity, B Limited is the subsidiary entity, subsidiary company. So this is through voting power. When one company holds more than 50% of the voting power in the subsidiary, either directly or through other subsidiaries, doesn't matter. This is one way to acquire the control. Another way is having control over composition of board of directors. If one entity can control the composition of board of directors of another company, that is ability to either ability to appoint or remove either all or majority of the board of directors of another entity. Suppose, sir, A Limited, B Limited, two entities are there. In B Limited, suppose there are 10 board of directors. If A Limited can remove all the 10 directors or majority means 6 or more, and it can appoint all the directors or majority of the directors in B Limited, then also we say A Limited had control. So, but mostly in our problems, this will be the case through voting power. If one company is having more than 50% voting power, how voting power will come, sir? Generally by having shares. But also understand, control can be achieved through when one company has the ability to control the composition of board of directors or governing body of the subsidiary. So what is control over composition of board of directors? Ability to appoint or remove either all or majority of the board of directors. So if one company achieve control of another entity, then we say parent subsidiary relationship is there. Consolidated financial statement is prepared only when there is a parent subsidiary relationship. First of all, your company should be parent company. That means you have a subsidiary. Then you can go for consolidated financial statements by applying AS 21. Okay, see, AS 21 says whenever you are preparing consolidated financial statements, definitely you have to follow the provisions of this standard. So you are preparing consolidated financial statements because of the legal provisions or because of any other reason, doesn't matter. But when you are preparing the consolidated financial statements, if you chooses to do so, legal compliance or any other reason, you must follow AS 21. Okay, next. And there is a concept called wholly owned, partly owned subsidiary, sir. If 100% of the voting power is there, that company is called your wholly owned subsidiary. That means in that case, there is no minority interest. Minority interest means other shareholders. Like for example, A Limited had 70% in B Limited, sir. That means in B Limited, remaining 30% held by other shareholders. We call them as minority interest. So in a company, there are two group shareholders, sir. Majority, minority. Majority shareholder is obviously parent company. Apart from parent company, who are the shareholders of the subsidiary company? They are called minority interest. See, if your subsidiary is a wholly owned subsidiary, that means 100% is having the parent entity only. So there is no minority interest. Partly owned subsidiary means you are having more than 50% but less than 100%. So then definitely minority interest will be there. Minority interest means other shareholders percentage. Okay. Now, what are the components of consolidated financial statements? So generally in the standalone financial statements, we will prepare what? Balance sheet, we will prepare P&L account, we will prepare cash flow statement. Same things will be done for consolidated financial statements also. So consolidated balance sheet, consolidated P&L, consolidated cash flow statement, even notes to accounts also we will prepare. And for CFS also, sir, when you are preparing the consolidated balance sheet, consolidated P&L, you, to the extent possible, you adopt the same format which we use for preparation of standalone financial statements, that is as per schedule 3. But of course, certain modifications will be done. So to the extent possible, in the same format as adopted by the parent. Now, sir, why we need to prepare consolidated financial statements? See, there are a number of advantages, sir. So one of the advantages to have a single source document. That means I want to check the overall performance of the company, overall performance of the group. So I will check consolidated financial statements. Otherwise, parent company, financial statement, subsidiary company, each financial statements I will take and I will analyze, sir. Lot of time will be wasted. So that's why I will take the group accounts, group financial statements. Then I will get the overall picture. I will make the analysis and I will make my judgment whether this group is performing well or not. So since CFS provide overall view of the group performance, including parent and its subsidiary, so as an analyst, my job will be very easy. So CFS is a single source document where all the details relating to the group is available for me. Intrinsic value of the share. Sir, I want to find out the real value of the parent company. See, parent company is not just parent company, sir. Along with its subsidiaries, along with its associates, along with its joint ventures, how it is performing, right? That is very, very important. So to find out that intrinsic value of the share, that is real value of the share, so you can use consolidated financial statements. By using the information which is there in the consolidated financial statements, you can find out the intrinsic value of the parent company. And also acquisition of subsidiary. Whenever one company acquires another company, what is the amount it owed to the minority shareholders of that subsidiary company? For example, A Limited acquired 60% shares in B Limited. That means remaining 40% held by minority shareholders. Now to this 40% shareholders, what is the amount due by the parent entity as far as the consolidation is concerned? I'm going to explain it in the consolidation procedure. For that also, this consolidated financial statements is helpful. And also when you want to evaluate the holding company, that means what is the financial health of the holding company for investment or acquisition decisions. So you can use the consolidated financial statements information. Actually, this topic is there in the study material, so they may ask. So these 4 headings you need to remember. Single source document. So that means CFS is all in one. So if you want to know the performance of the group, just go and check the consolidated financial statements. You will get proper analysis. Intrinsic value of the share. If you want to know the real value of the parent company share, the information in CFS is helpful for you. acquisition of subsidiary, whenever we acquire any subsidiary company, what is the amount we due to the minority shareholders, that we can calculate by the information there in the CFS, consolidated financial statements. And also as a holding company, how my performance is, how the valuation is, how I am going to evaluate the parent company. So that decision also I can take by using the information in the CFS. Now the scope of the standard. So this standard will be applied in the preparation and presentation of CFS, consolidated financial statements, when there is a under the control of parent. But there are some exclusions from the standard, sir. What are the exclusions? See, this standard does not cover methods of accounting for amalgamations and their effect on consolidation, including goodwill arising from amalgamation. Sir, even in amalgamation also, goodwill concept will come, right? But even in consolidation also, there is a concept called cost of control. In that cost of control concept, there is a goodwill. So, but don't apply that goodwill which is arising from amalgamation as per AS 21. So this standard not applicable. And also, whenever you are accounting for investment in associates, we have separate standard 23. So we will follow that. And also accounting for investments in joint venture, separate standard 27. So I always used to tell specific standard versus general standard. So when there is a specific standard, follow it. Don't follow the general standard. So for associates and joint ventures, we have specific standards 23, 27. And for goodwill arising on amalgamation, we have specific standard AS 14. So therefore, we will apply the respective standards. Don't apply AS 21. Next, exclusions from preparation of consolidated financial statements. When a subsidiary will be excluded from consolidation, generally every subsidiary will be considered for consolidation, sir. But AS 21 says, sir, a particular subsidiary can be excluded from consolidation in two situations. One is temporary control. A subsidiary should be excluded from consolidation when temporary control. Suppose as a parent company, I am acquiring the subsidiary company shares. Suppose I am acquiring 60% of the shares. But at the time of acquisition, my intention is I don't want to hold the ownership of this company. So whenever in the near future, if the share good price comes now, I am ready to sell these shares. That means here my control is intended to be temporary in nature. Now in that case, don't consider such kind of subsidiaries for consolidation. So if the control is intended to be temporary, such as when subsidiary is acquired for subsequent disposal in near future. So A Limited acquired 60% shares of B Limited, but with what intention? In the near future, I want to dispose the total investment in this company. So that means my control seems to be temporary. Therefore, don't include that kind of subsidiaries for consolidation. Okay. And also severe long-term restrictions. Sir, when my subsidiary is operating under severe long-term restrictions, which significantly impair its ability to transfer funds back to the parent company. For example, we have a subsidiary company in foreign countries. For example, we have a subsidiary in China. Now, there are certain restrictions, either political, legal, whatever economic restrictions are there in my company in China. So it is my subsidiary, for example. I'm parent company is in India, subsidiary is in China. Now, if my subsidiary is operating under severe long-term restrictions, now because of those restrictions, my subsidiary is unable to transfer funds back to the parent. Then in such a situation, standard says no need to include such kind of subsidiaries in the consolidation because there is no point. Because anyway, they are operating under significant, long-term restrictions. So severe long-term restrictions which significantly impair its ability to transfer funds to the parent. For instance, a parent company owns a subsidiary in a country with a capital controls preventing fund transfers for a long period. Then that subsidiary might be excluded from consolidation. So therefore, they can ask MCQ questions, sir. So when a subsidiary will be excluded for consolidation, generally subsidiaries will be considered for consolidation, but there are two situations subsidiary cannot be considered for consolidation. One is when the control seems to be temporary. Second, when the subsidiary is operating under severe long-term restrictions. Understand here, long-term severe restrictions. So because of those restrictions, our subsidiary company ability to transfer funds to the parent will be impacted. So that kind of subsidiary also we cannot consider for consolidation. So till here, the basic theory concepts. So next, consolidation procedure. This is very, very important, sir. Because mostly they are asking a question, sir, big question to, prepare the consolidated balance sheet generally. To prepare the consolidated balance sheet, sir, there is a step-by-step procedure, sir. Okay. So this procedure is very, very important, sir. See, I have divided the entire consolidation procedure into 8 steps, sir. 8 steps. Of course, the 8th step is preparation of consolidated balance sheet. Now see this procedure for consolidation, sir. Steps for preparing consolidated balance sheet. And see, each step will make sense, sir. Each step is interrelated, and each step is logical. Very, very important. Always, sir, first step is determine the date of acquisition. On what date parent company acquired the control of subsidiary company? That is the date of acquisition. We need to first identify. So identify the acquisition date of the parent in the subsidiary. So this helps distinguish between pre and post acquisition profits for accurate profit analysis. Actually, I told you 8 steps, na sir. First, date of acquisition, sir. Second, shareholding pattern in the subsidiary on the date of consolidation. Third, analysis of subsidiary company reserves and surplus. Fourth, apportionment of analyzed profits. Fifth, minority interest. Sixth, cost of control, sir. Seventh, intercompany owings. Okay, cost of control, intercompany owings, and also minority interest, cost of control, 7th, intercompany owings, 8th, reserves for consolidated balance sheet, and last step, 9th step, preparation of consolidated balance sheet. So there are totally 9 steps. Okay. So what is the first step, sir? Date of acquisition. So date of acquisition means on which date parent acquire the control of the subsidiary company. See, this date is very, very important, sir, because the date on which you acquired the subsidiary, till that date, whatever the profits are there in the subsidiary, they are all called pre-acquisition profits. That means before you acquiring the subsidiary, these profits are there in the subsidiary. So therefore, the nature of those profits is pre-acquisition profits. Now, once you acquired a subsidiary, after that, whatever the profits earned by the subsidiary, the profits arise in the subsidiary, they are called post-acquisition profits. So therefore, when you are preparing the consolidated balance sheet, what you need to do is subsidiary company reserves and surplus you need to analyze into pre-post in step number 3. Now for that analysis into pre-post, first you need to know the date of acquisition, because till the date of acquisition, whatever the profits are there in the subsidiary, they are called pre. After that, whatever the profits are, they are called post. So for this analysis into pre and post acquisition profits, the date of acquisition is the first step, which is very, very important step. So therefore, step number 1, determine the date of acquisition. Step number 2, ascertain the shareholding pattern. Ascertain the shareholding pattern on the date of consolidation. On the date of consolidation. So suppose you are preparing the consolidated financial statements on 31st March 2024, sir. Now on 31st March 2024, in the subsidiary company, how much shareholding is held by the parent company? How much shareholding is held by the minority interest? That is called shareholding pattern. Now this step, shareholding pattern, is essential for apportionment of the analyzed profits. Once the subsidiary company profits are analyzed into pre-post in step number 3, sir, they need to be allocated between the parent and minority shareholders, who are the shareholders of the subsidiary company. Sir, who are the shareholders of the subsidiary company? For example, B Limited is a subsidiary company, sir. In this company, A Limited had 70% shares. So that means remaining 30% held by minority shareholders. So these two categories are the shareholders of the B Limited, right? So in the B Limited, whatever the reserves and surplus are there at the end of the year, those reserves and surplus, we need to divide into 2 categories, pre-post. Once you divide into pre-post, the next thing is you need to apportion the parent company share, the minority shareholders. For that, this shareholding pattern is important. So establish the subsidiary shareholding as of the consolidated balance sheet. On the date of consolidation, what is the subsidiary companies, in the subsidiary company, what is the shareholding pattern? Parent company and minority interest. Number of shares divided by total number of shares. You will get the percentage. So this pattern is essential for apportioning the subsidiary profits. So in step number 4, when you do the apportionment, step number 2, shareholding pattern is important. So first step, date of acquisition. Second step, shareholding pattern on the date of consolidation. On the date of consolidation in the subsidiary company, how much percentage of holding held by the parent, how much percentage of holding held by the minority interest. That is step number 2. Next, see, out of all the steps, sir, step number 3 is very, very important step, sir. That is analysis of subsidiary company reserves and surplus. Most of the students are not understanding what is this analysis of subsidiary company. First of all, why we need to do the analysis? Very simple, sir. Listen. Sir, first, understand, as I am the parent entity, for example, I am preparing the consolidated financial statements by treating subsidiary also as my company only. See, that means parent and subsidiary company, we need to treat it as a single entity, right? Okay. So that means in the subsidiary company, whatever the reserves and surplus are there, I need to decide the character of those reserves and surplus. Because see, when I invest in the subsidiary, when I acquire the control, on the date of control acquisition, whatever the profits are there in the subsidiary, those are not my involvement. My investment is not there in the subsidiary. By the time I am investing in the subsidiary, those are there. So therefore, any share of parent company in those profits are what? What nature? Obviously capital nature, capital profits. Even in investments also we have done this. Okay, suppose for example a company declares a dividend set. Now last year you don't have the shares, this year only you purchased. By the time company declares the dividend, you have the shares, so therefore you received the dividend. That means, but according to you, what is the nature of this dividend? Is it revenue or capital profit? Capital profit. Similarly, as a parent entity, I acquired subsidiary. On what date I acquired? By the time I am acquiring the subsidiary, whatever the profits, reserves and surplus there in the subsidiary, according to me, my point of view, those are my capital profits. That's why they are called pre-acquisition profits, capital profits. So to decide the character of those profits, I need to do the analysis. Once I do the analysis, I will do the apportionment. Once I do the apportionment, I will make the appropriate adjustments to my reserves. Because I know subsidiary company, by the time I am acquiring, whatever the reserves are there in the subsidiary company, they are not my reserves. My investment is not there in the subsidiary. But now being a parent entity, I am controlling the subsidiary. That means out of those reserves, certain portion belongs to me. But I need to decide the character of those reserves for further accounting. That's why as a parent entity, what we need to do is, I need to analyze the subsidiary company reserves and surplus into pre-post. So by the time I am acquiring the subsidiary company, whatever the reserves and surplus are there, they are all pre. After that, whatever the reserves arise, those are all post. Now, here important. When you are analyzing the subsidiary company reserves and surplus, there are certain adjustments which is very, very important. What are those adjustments? Suppose in the subsidiary company, you have revalued the assets and liabilities. Especially you have done the revaluation of assets. Because as a parent entity, you are acquiring subsidiary, right? So in the subsidiary company, whatever the assets are there, whatever the values at which these assets are showing now, sir, you may revalue those assets now. It is very common at the time of acquisition. So suppose for example, in the subsidiary company B Limited, balance sheet, there is a plant and machinery 100 lakhs. But parent company, when they are acquiring B Limited, suppose A Limited is acquiring B Limited. When A Limited is acquiring B Limited, so they came to know that this plant and machinery value, fair value is only 80 lakhs. It is not 100 lakhs worth. So what they will do? They will revalue this to 80 lakhs. That means 20 lakhs is reduction in the value of plant and machinery. That will have impact on the subsidiary company reserves and surplus. Definitely. Now that has to be adjusted. Definitely, when you revalue the assets, the depreciation will be adjusted. Depreciation again in turn will affect the reserves and surplus of subsidiary company. And also, suppose subsidiary company has given a dividend. Dividend is given from profits. Which profits? Either it can be pre or post, whatever the profits. Now, because of that, the reserves and surplus of subsidiary company will be impacted. Therefore, that adjustment also we need to consider while you are analyzing the subsidiary company reserves and surplus. And also, between parent company and subsidiary company, before amalgamation, there might be some transactions. For example, A Limited has sold goods to B Limited. Out of those goods which is sold by A Limited to B Limited, some stock is still unsold. In that stock, there is unrealized profit. Now that profit which is included in the parent company books has to be eliminated. And also suppose, for example, before acquisition, subsidiary company sold goods to parent company. Generally, when they make sales, they will include some profit. That means profit is recorded in the subsidiary company books. Now that profit we need to eliminate if it is unrealized at the time of consolidation. So all these are very, very important, sir. Because see, when you are analyzing the subsidiary company reserves and surplus, sir, understand why we are analyzing. As a parent entity, I want to know what is the nature of the profits in the subsidiary company. Reserves and surplus means nothing but profits and profits, right? So what is the nature of the profits? By the time I am acquiring the subsidiary, whatever the reserves and surplus are there, they are all my capital nature profits. So in that profits, whatever the share I am going to get, it is my capital profit. If it's a capital profit, what I will do? Shall I transfer directly to P&L account? In investment account also we have seen, if the profit is of capital nature, what we do? We will adjust to the cost of investment. Similarly, in consolidation also, we will do the same thing. And suppose if the profits, whatever the profits in the subsidiary company after I acquire the subsidiary company, the post-acquisition profits. Post-acquisition profits are generally revenue profits. I will add to my reserve. I mean parent company. So therefore, analysis is very, very important. So analyze the reserves and surplus of subsidiary company on the date of consolidation into pre and post acquisition with the necessary adjustments. For apportionment of profits between pre and post acquisition periods, follow time basis, assuming profits are accruing evenly over the time. So therefore, suppose sir, A Limited acquired B Limited exactly middle of the year. That means 6 months first in a year, first 6 months pre, next 6 months post. So till the date of acquisition pre, after that post. So that means during there, suppose 10 lakhs profit was earned during there. So that means you need to divide it by time basis. You can say out of 10 lakhs into 6 by 12. 5 lakhs is pre, 5 lakhs is post. So 10 lakhs into 6 by 12 and 5 lakhs came. This is called pre-acquisition profits. Sir, how can you say first 6 months they earned 5 lakhs? Assumption. Time basis is the assumption. We assume that profits are accruing evenly over the time. So therefore, in the consolidation, when you are analyzing the profits of subsidiary company, analyzing the reserves and surplus of subsidiary company, so we assume profits accrue evenly throughout the year. Therefore, generally we follow time basis. So on the time basis, we will allocate the profits of subsidiary company into pre and post. And while analyzing the reserves and surplus of subsidiary company, we need to consider the effect of the following items in particular, like revaluation of assets, dividend given by subsidiary company, intra-group transactions between parent and its subsidiary, any bonus shares given by subsidiary company. All these steps are very, very important. So these steps we need to consider when you are analyzing the subsidiary company reserves and surplus. So this is step number 3, sir. Of course, we are going to discuss each of these steps, very, very important. So in this revaluation of assets, dividend given by subsidiary and intra-group transactions are quite frequently they are asking in the examination, sir. If at all there is a consolidation question, definitely one is revaluation adjustment, another one is dividend adjustments. These two you mostly find in the question, sir. So what is the third step in consolidation procedure? Subsidiary company profits, reserves and surplus must be analyzed. Why? Because we need to decide the nature of the profits of the subsidiary company. So depending upon the nature of the profits, the accounting treatment will be different. That's why on the date of consolidation, we need to divide the subsidiary company reserves and surplus into 2 categories, pre, post. So on time basis. Now, once I divide the subsidiary company reserves and surplus into pre, post, sir, what is the next thing? So I need to apportion it. Apportion profits analyzed in step 3 among the shareholders and minority interest in the ratio in step number 2. So what is the profit type? Either it can be general reserve, other reserves, P&L account. What is the pre-acquisition profit? What is the post-acquisition profits? Post-acquisition profits can be either revenue reserve or revenue profit. Suppose if you are analyzing the P&L account of subsidiary company, we call it as what? Revenue profit. Post-acquisition profit is called revenue profit. If you are analyzing the general reserves of subsidiary company, we call it as revenue reserve. Okay. So like this, you need to analyze between the parent. So whatever the subsidiary company reserves and surplus you have analyzed in step number 3 into pre-post. So take pre-acquisition profits, take post-acquisition profits. and revenue profits. Post-acquisition profits are obviously revenue profits and revenue reserves. That's why RRRP. And pre-acquisition profits are only capital profits. Now you get the total. Now you need to find out the share. In this, what is the parent company share? Minority interest share. Suppose parent company is having 70%. So in the subsidiary company pre-acquisition profit, 70% belongs to parent. 30% minority interest. In the post-acquisition profits, what is the share? In the revenue profits, what is the share? So this is step number 4. Step number 4. So apportion profits analyzed in step 3 among shareholders. Shareholders means here parent and minority interest, both of them together. Okay, as per the ratio which is given in step number 2. So this is step number 4, sir. Very, very important. Now next to minority interest. Sir, in consolidation, we need to calculate minority interest. First of all, what is this minority interest? Minority interest nothing but in the subsidiary company, suppose 100% share capital, 100% is there. In that, how much held by parent? The remaining is called minority interest. For example, in B Limited, A Limited had 70%. That means remaining 30% held by minority interest. So being a parent entity, important sir, listen to me carefully. Being a parent entity, I know I am having control on B Limited. I am having 70%, but remaining 30% held by minority shareholders. So therefore, whatever the share of the minority shareholders in the subsidiary company, that I need to calculate and that I need to show in the consolidated balance sheet. Frankly speaking, sir, in the subsidiary company, suppose there are net assets of 100 lakhs. Sir, here two ways to ascertain the net assets. Suppose if you take the subsidiary company balance sheet, sir, you have liabilities, you have assets. I mean, share capital also. Suppose if you take the balance sheet of subsidiary company, assets, liabilities, share capital, reserves and surplus, right? So how net assets will be ascertained? Either assets minus liabilities or share capital plus reserves and surplus. Then you will get what? Net assets. Now, share capital plus reserves and surplus, if you add, you will get net assets, or assets minus liabilities you do, you will get net assets. So in the subsidiary company, in the net assets of the subsidiary company, 70% belongs to parent, remaining 30% belongs to other shareholders. Now, as a parent entity, when I am incorporating the subsidiary for by consolidation, can I incorporate only 70% of the net assets of the subsidiary company? The answer is no. We have to incorporate the total assets. But in that 30% actually belongs to minority shareholders. Na? How can you incorporate the right of the minority interest in your books as your assets? Because I am the parent entity. Since I have the control. So when I am doing the consolidation, I will do 100%. All assets and liabilities of the subsidiary company, I will consolidate into my books. I will not take 70% I am having shares only, I will take 70%, 80% I will take. No, it is not like that. When I am consolidating, I will take 100% of the assets and liabilities of the subsidiary company at their full value. But rightly in that, certain portion belongs to minority shareholders. So that's why being a parent entity, I will calculate what is the share in the subsidiary company net assets belongs to minority shareholders. That I will calculate and I will recognize in the consolidated balance sheet. Indirectly, I am projecting it like, see, the net assets of the subsidiary company is 100, for example, 100. In that 100 I am incorporating, but in that 100, 30%, that is 30 belongs to minority shareholders. That is what the point of minority interest. So minority interest is nothing but minority shareholders share in the subsidiary company. So as a parent entity, I am incorporating 100% of the subsidiary, but frankly speaking, remaining only I am having 70% or 80%, remaining percentage hold by other shareholders. So other shareholders right in the subsidiary company, since I am recognizing 100% in my books only, so I will calculate the minority interest. How I am going to calculate the minority interest? Simple. Minority shareholders share in the net assets of the subsidiary company. How net assets will be ascertained? Either assets plus assets minus liabilities or share capital plus reserves and surplus. Already subsidiary company reserves are analyzed into pre-post. After that, we done the apportionment. When you are doing the apportionment of pre and post acquisition profits, you apportion to parent as well as minority interest. So in that minority shareholders share, whatever is there, you take it. And also in the subsidiary company share capital, whatever the minority shareholder share is there, you take it. So you add these two, then you will get the net assets of the minority interest. That means minority interest is the aggregate of minority share in the share capital. In the share capital of the subsidiary company, what is the minority shareholder's share? For example, the subsidiary company share capital is 10 lakhs. In that, minority shareholder share is 30%. That means take 3 lakhs. So share capital plus reserves and surplus. Already subsidiary company reserves and surplus we have analyzed in step number 4 into pre-post, right? Say this here. So therefore, whatever the minority shareholders share is there here, you add into step number 4. Minority shareholders share in the subsidiary company reserves, analyze the profits pre and post. You add to the minority interest. Share capital. What is the minority shareholder share? For that, you take capital profit, revenue reserve, revenue profit. Add. And also any dividend given by the subsidiary company. So in that dividend, what is the share of the minority shareholders? That will also add. And also less a stock reserve, minority share, if there is an upstream transaction. Next time I'm going to explain, sir. Upstream, downstream transactions. Upstream transaction means subsidiary sold goods to parent. Sir, who is in the, parent will be upper, subsidiary will be below the parent, right? So when subsidiary sold goods to parent, that is called upstream. Upstream. That means goods are flowing from down to up. That's why this is upstream transaction. So when subsidiary sold goods to parent, in whose books the profit was recognized? Subsidiary. That profit is already analyzed between parent and minority shareholders. But suppose on the date of consolidation, out of the goods which is sold by the subsidiary to the parent, in that stock, if there is any unrealized profit, that profit has to be eliminated. That means from the subsidiary company reserves and surplus, the unrealized profit in respect of the goods which is sold by the subsidiary to the parent has to be eliminated now. So in that profit, what is the share of the minority shareholders? That we need to eliminate. Of course, I am going to explain it. Wait. So therefore, this stock reserve is very, very important. Sir, why? So many students, they are not understanding why stock reserve has been reduced. First of all, what is stock reserve? Stock reserve means the profit element included in the stock, unsold stock. When the subsidiary company sold goods to parent company, in that stock, if there is any unsold element, unsold part is there in the parent company books on the date of consolidation, since we came to know that in this stock there is a profit element which is not yet realized, we need to remove it from the stock as well as the subsidiary company books, because the goods are sold by the subsidiary. Profit is recognized in the subsidiary books. So in that profit, so what is this minority shareholders share? Since that profit is unrealized, so you need to remove it. Unrealized profit nobody will include, sir. So you remove it. That's why upstream. Sir, if it is a downstream, suppose parent sold goods to subsidiary, then sir, if parent sold goods to subsidiary, profit is recognized by whom? Parent. That means in the subsidiary books there is no profit. Therefore, no need to reduce, because we are analyzing the subsidiary company reserves, not parent company reserves. Parent company reserves, it will be there like that. Okay, of course, I'm going to explain downstream and upstream when the particular adjustment came. So this is minority interest, step number 5. Now, once the minority interest came, next step is cost of control step. This is also very, very important step, sir. What is this cost of control? Simple, sir. As a parent company, I invested in subsidiary, right? Yes. Now, tell me, if I am preparing the consolidated balance sheet, suppose I am A Limited, sir. In my books, asset side, investment in B Limited, I will write 10 lakhs, right? I am parent company. This is my standalone financial statements. But suppose if I am preparing consolidated financial statements, suppose I am a parent company A Limited. Now I will treat my subsidiary also as my E entity only, as a part of single entity only. Now it means A and B is one entity only. Now tell me whether the investment, whatever I shown in my balance sheet, investment in B Limited 10 lakhs, will this be recorded in the consolidated balance sheet also? That means investment in your own company, it will like in the standalone financial statements, If you invest in B Limited, that is your asset. But in the consolidated balance sheet, as a parent company, along with your subsidiary, both are one entity only. That means you invested in your own company, na? So how can this will be your asset, sir? So therefore, this investment in B Limited will not come in consolidated balance sheet. So that's why what we need to do is, what is the investment, cost of investment we are putting in? Against that cost of investment, so see this, cost of investment we are putting in. Against this cost of investment, what is the share of the net assets we are getting on the date of acquisition? See this, what is the amount invested as a parent company? What is the carrying value in the parent's balance sheet? You take it. And of course, any pre-acquisition dividend received from subsidiary, deduct it. Then you will get the adjusted cost of investment. Pre-acquisition dividend. What is this pre-acquisition dividend? Any dividend given by subsidiary from the pre-acquisition profits. So that's why I said, sir, why you need to analyze the subsidiary company reserves and surplus, sir? Because this analysis will help you to identify what is the nature of the profit. All pre-acquisition profits are capital profits. So if the subsidiary company has given any dividend to its shareholders, that means shareholders of subsidiary is nothing but parent and minority interest. If the dividend is given from pre-acquisition profits, obviously as a parent entity I am receiving dividend from pre-acquisition profits. That means capital profit I am receiving. Therefore, instead of treating this dividend as my revenue reserve, revenue income, I will adjust to the cost of investment. Understand? Pre-acquisition dividend. See this, pre-acquisition. Before I am acquiring subsidiary, whatever the profits are there in the subsidiary company, from that profit, whatever the dividend given by the subsidiary company, if as a parent entity, if I am receiving any dividend from that profits, obviously I cannot treat it as a revenue reserve. Suppose if dividend is given from post-acquisition profits, then I can credit to my P&L account as a parent entity, my share. So pre-acquisition dividend received from subsidiary company, I need to deduct from the cost of investment. Then I will get adjusted cost of investment. And then value of investment. What is the parent share of subsidiary's net assets? As a parent entity, what is my share in the subsidiary company net assets? So subsidiary company net assets means share capital plus pre-acquisition profits on the date of acquisition. See, this cost of control is a one-time calculation, sir. Generally, it is calculated on the date of acquisition. What is the position? Based on that, it will calculate it. And because of the cost of control step, you will get either goodwill or capital reserve. So therefore, in cost of control step, basically what we are doing is, as a parent entity, what is my cost of investment? Now, with this cost of investment, what is the net assets I am going to get from the subsidiary company on the date of acquisition? So if my cost of investment is more than the net assets, that means whatever the excess amount I put, that is called goodwill. Suppose if my cost of investment is less than the net assets I am going to get, that is called capital reserve. It is kind of a capital profit for me. For example, as a parent entity, we invested 10 lakhs. Pre-acquisition dividend received 2 lakhs. So therefore 8 lakhs is my cost of investment. But what is the parent company share in the subsidiary net assets on the date of acquisition? Suppose share capital in that parent company share. For example, 5 lakhs. In that, suppose as a parent entity, my share is 80%. And pre-acquisition profits already you calculated. In the pre-acquisition profits of subsidiary, what is your share? Suppose this is 4 lakhs. In the pre-acquisition profits, your share is 2 lakhs. So total 6 lakhs. So 8 minus 6. So 2 lakhs. That means your cost is 8 lakhs, sir. But the worth of net assets you are eligible on the date of acquisition is only 6. That means 2 lakhs extra you are putting, sir. That is called goodwill. Suppose if your cost of investment is more than the net assets, less than the value of investment, that is parent company share in the subsidiary net assets on the date of acquisition, then it is called capital reserve. So this is also one of the very, very important steps. So basically step number 6 is what? Cost of control. So everybody, when you are consolidating the subsidiary company, you need to calculate the cost of control. Cost of control is nothing but you take the cost of investment as a parent entity. What is your cost of investment? Now only one adjustment to this, any pre-acquisition dividend received from the subsidiary company. Understand, subsidiary company gives a dividend from pre-acquisition profits, then the dividend is capital nature. Therefore, you adjust it to the cost of investment like you have done in accounting standard 13. And now you will get the adjusted cost of investment. This cost of investment you need to compare with the subsidiary company. As a parent entity, what is my share in the net assets of the subsidiary company on the date of acquisition? So generally I told you how to get the net assets of the subsidiary company, share capital plus reserves and surplus. On the date of acquisition in the subsidiary company, what is the share capital, what is the reserves and surplus? Obviously, whatever the reserves and surplus are there in the subsidiary company on the date of acquisition, we call them as pre-acquisition. In that pre-acquisition, what is your share? That's why here pre-acquisition profits. Sir, understand sir, subsidiary company analysis, reserves and surplus analysis will change the entire sum. So this analysis, nothing but deciding the nature of the profits of the subsidiary company. By the time you are acquiring the subsidiary, whatever the reserves and surplus are there, they are capital profits. Since they are capital profits, what we need to do is nothing but, so here these are the things. Okay. So this is step number 6 is our cost of control step, either goodwill or capital reserve. Next, intercompany transactions. Sir, any intercompany transactions are happening between parent and subsidiary. Any intercompany transactions. Like for example, parent company sold goods to subsidiary company, and parent company given loan to subsidiary, or subsidiary sold goods to parent, or subsidiary company provided some services to parent. These are all intercompany owings or debts. Intercompany owings or debts. Any mutual owings are there. What we need to do? Just eliminate them. Eliminate them. Why? Because see, so for example, A Limited, B Limited. Two companies are there, sir. Suppose A Limited asset side, trade receivables is there. 10 lakhs. This trade receivables is nothing but B Limited. That means A sold goods to B Limited, 10 lakhs worth of goods. So 10 lakhs is receivable from B Limited. So we booked in our books as customer, trade receivables. Now obviously B Limited liability side, we have trade payables, 10 lakhs. And this is A Limited, right? A Limited. So that means when you are preparing the consolidated balance sheet, sir, when you are preparing the consolidated balance sheet, in the A Limited, there is a trade receivable 10 lakhs. In the B Limited, there is a trade payable of 10 lakhs. Now suppose from the B Limited, these trade payables you have taken over. So therefore, when you are taking the liabilities of the subsidiary, when the liabilities of the, when you are preparing the consolidated balance sheet, so what you need to do is, you need to take these liabilities into the parent company. For example, parent company liability side. Okay. So trade payables. Actually trade payables to whom? A Limited. And in the parent company asset side, trade receivables is there, 10 lakhs. This is also to whom? B Limited. So that means B and A both are single entity only. When you are separate entities, you can write separately the mutual owings. But when you both become single entity, tell me, so A Limited actually need to receive 10 lakhs from B Limited, but A and B both are same entity. So therefore this trade receivables is not relevant. And similarly, B Limited books, there is a liability payable to A Limited. Now B and A both are single entity only. So this liability is also not relevant. So when you are preparing the consolidated balance sheet, whatever the intercompany owings, mutual debts is there, they will become irrelevant. For the group, see from the group point of view, A, B, two entities, sir, but now they are only one entity. When they become one entity, how can I due amount to myself? Right? How can I receive amount from myself? Both the receiver and giver only one person. Is it possible? So therefore you need to eliminate it. So like this, any debtors, creditors, loans given, loans taken, interest receivable, interest payable, fees receivable, fees payable, dividend receivable, dividend payable. So the adjustment involves reduction of the amount from the aggregate of both receivables and payable. So you take the total debtors minus mutual owings, total creditors minus mutual owings. Whatever the mutual owings are there between the parent and subsidiary, they are not assets and liabilities for the group point of view. You just eliminate it. And also, sir, assets comprising goods or machinery purchased from the other company. I told you downstream, upstream transactions, right? Very, very important. Downstream, upstream transaction. Suppose, sir, listen to me carefully. First, I will talk about downstream. Downstream means what? Parent company sold goods to subsidiary company. Parent sold goods to subsidiary. Suppose, sir, when parent sold goods to subsidiary, suppose the cost is 100, sir, and they have added a profit of 20, and they sold it to 120, sales 120. Okay. Now, in the parent company books, they have recognized 20 rupees profit, correct? Because the seller is parent company. Now the stock is there with whom? Subsidiary, 120. Suppose this stock not yet sold, unsold stock is there. Unsold stock is there, 120. Now listen to me carefully. As a parent entity, when I am preparing the consolidated financial statements, I know that I have sold some stock to subsidiary company. In that stock, certain portion is not yet sold. So therefore, in respect of the unsold stock, whatever the unrealized profit element is there, that profit I cannot recognize as a group profit. Right? See, that means here this 20 rupees profit is there na. As a parent entity, I recognized in my books. But tell me, when I am preparing the consolidated financial statement or consolidated balance sheet, my parent and subsidiary both are one entity only. And whatever the stock I sold to subsidiary, this is not yet sold outside. That means the profit was not realized. Na? So when the profit is not realized, how can you keep in the books of the company? How can you keep in the books of the group? This 20 rupees is not the profit for the group. So therefore, eliminate this unrealized profit. That is the important concept. Therefore, whenever parent company sold goods to subsidiary company, in the parent company books, whatever the profit element is there, now in respect of that, whatever the stock which is held in the subsidiary company, the stock which is not yet sold, in the unsold stock, whatever the unrealized profit is there, since it is not realized, remove it. Suppose, sir, out of this suppose the unsold stock is only 60, then what is the unrealized profit in respect of this 60? The unrealized profit is 10, because for 120, 20 rupees is the unrealized profit, sir. So obviously 60 sold. That means unsold is 60. That means only 10 rupees is there, unrealized profit. That means as a parent entity, I need to eliminate 10, because remaining 10 already realized, because the goods are sold outside, right? So therefore, whatever the unrealized profit is there, unrealized. Why it is not unrealized, sir? Because stock not yet sold. Stock is there within the group only. That's why. Since it is not realized, unrealized, eliminate from the group profit. That's why as a parent entity, I need to reduce the unrealized profit. Okay. Where I will eliminate this unrealized profit? From the parent company reserves. In step number, next, I think 8th step, you prepare the consolidated reserves for consolidated balance sheet. First, you will take the parent company reserves. Now, from the parent company reserves, you reduce this 20. Why? Because this profit is already included in the parent company books. Because goods are sold by whom? Parent. That means profit is recognized by whom? Parent. That means unrealized profit is included in whose books? Parent. Eliminated from the parent company books. Okay. And also one more thing you need to do is, whatever the stock is there, unsold stock, in that stock there is a profit element is there, na? That you need to reduce and take the remaining value when you are consolidating the inventory values for the consolidated balance sheet. That means 20 you reduce, you will get 100. You take inventory value 100 for consolidation purpose, subsidiary inventory 100. That means whenever there is a downstream transaction, two adjustments will be done. First adjustment, parent company reserves unrealized profit eliminate. Second, from the stock profit element eliminate. That's it. This is downstream, sir. Downstream. Next, upstream transaction. Upstream means, suppose subsidiary company sold goods to parent, sir. Subsidiary sold goods to parent. Suppose subsidiary company cost of the goods 100, sir. They have added a profit of 20 and they sold 120. So the sale value is 120. So that means profit is recognized by whom? Subsidiary company has recognized a profit of 20. Now the stock is there with the parent 120. Now you are preparing the consolidated balance sheet. Now at the time of consolidated balance sheet, as a parent entity, what I need to do is, I know subsidiary company has sold goods to me. And in that 120 unsold stock is there. In this 120, what is the profit element? 20. So therefore 100 I need to consider for consolidated balance sheet. Inventory value I need to consider 100. That is one point. Second point, sir, Here, who sold the goods? Subsidiary. Profit is included in whose books? Subsidiary. And you already analyzed the subsidiary company profits into pre-post. That means this 20 is already allocated to the parent and minority interest. That's why now in this 20 unrealized profit of the subsidiary company, if it is already allocated in step number analyzed in step number 3, allocated in step number 4, since this profit is not realized, we need to eliminate it. But already it is apportioned in step number 4 between the parent and minority interest. So that's why in this 20, minority share reduced from step number 5. Parent company share reduce from step number 8. That's it. Once again, I'm telling, sir, upstream, subsidiary selling goods to parent. Profit is recognized in subsidiary company books. You already analyzed and apportioned the subsidiary company profits. In that profit, there is an unrealized profit of 20 also. If it is there, because it is not yet realized, group point of view, this is not profit. Because the stock is still there within the group only. Therefore, in this 20 rupees, this 20 rupees profit, whatever you already apportion between the parent and minority interest, reduce their shares. Where? Step number 5, minority interest. That's why minority interest stock reserve, only upstream transaction. Parent company share, you reduce from the step number 8. That's it. This is the concept. This is the concept, sir. So, here, say this. If the transaction is downstream, that is from parent to subsidiary, upstream from subsidiary to parent. So from parent to subsidiary, downstream transactions, sir, quantum of unrealized profit to be eliminated from the asset inventory, 100% profit we need to eliminate. Whether it is downstream or upstream, eliminate 100% profit from the inventory. Because in the inventory, there is a profit element, unrealized profit, that has to be eliminated completely. Now, another adjustment, parent company reserves. If it is a downstream transaction, 100% profits will be eliminated. 100% of the parent reserves only will be adjusted. Why? Who sold the goods? Parent. That means profit is recognized in whose books? Parent. Unrealized profit is there in whose books? Parent. Therefore, elimination must also happen in parent company books. Minority interest, nothing. Because parent company sold the goods. Parent company only booked the profit. Eliminate from the parent company reserves. In step number 8. Okay. Now, when it comes to upstream transaction from subsidiary to parent, so 100% profit is eliminated from the stock. That is okay. What about adjustment against parent reserves? To the extent of parent share in the subsidiary in step number 8, not 7, step number 8. And from step number 5, minority share will be deducted. So this is one of the important adjustments, sir. Very easy, upstream, downstream transactions. So when the parent company sold goods to subsidiary company, profit is there in the parent company books. And if it is in respect of the unsold stock which is there in the subsidiary, in that unsold stock, whatever the unrealized profit is there, that profit we need to eliminate from the parent company reserves. Because that profit is not relevant for the group point of view. And if it is an upstream transaction, subsidiary sold goods to parent, in the subsidiary company books, there is a profit. Suppose if it is not realized at the end of the year, already subsidiary company profits were analyzed and apportioned. Now you need to reduce from the parent company share in the step number 8, subsidiary minority interest share from step number 5. Suppose while analyzing the profits itself, suppose if you reduce the subsidiary company profits, unrealized profit, then again no need to eliminate separately. See, the idea is very simple, sir. From the group point of view, unrealized profits at the end of the year will be eliminated because it is not profit for the group, sir. As a parent entity, I sold to subsidiary, sir. Stock is there with the subsidiary only. Therefore, that is not profit for the group. Eliminate it. For the consolidation point of view, if subsidiary sold goods to parent, that stock is there within the group only. That means it is not a profit. But the profit is included in whose books? Subsidiary. But that profit is already allocated and apportioned. Therefore, reduced from the corresponding parent company share and minority share. That's it. This is step number 8, sir. Step number 7. So any intercompany owings are there, you need to eliminate. And then reserves for consolidated balance sheet. So for the consolidated balance sheet, you need to prepare the reserves, sir. Capital reserve, revenue reserve, P&L account. See this. Whatever the reserves are there. First, always take the parent company reserves. Parent company reserves you take. And any dividend received from subsidiary out of pre-acquisition profits transferred to investments. Sir, sometimes in the question they will give you, subsidiary company given a dividend from pre-acquisition profits. Sir, tell me, when subsidiary company given any dividend from pre-acquisition profits, what is the nature of that dividend to the parent company? Capital profit. Therefore, it is adjusted to cost of investment. But in the question, sometimes they will give you, parent company wrongly created to P&L account. Now you need to reduce it. Sir, simple sir. Subsidiary company given a dividend from pre-acquisition profit. Okay, that dividend, parent company share in the dividend declared by the subsidiary company, the dividend is what? Capital nature profit. When it's capital nature profit, in step number 6, we adjusted to the cost of investment. But sometimes in the question they will give you, parent company wrongly created to P&L account, then you need to reduce it. And also, sir, any parent company share of post-acquisition reserves and profits of the subsidiary. In the subsidiary company, we have analyzed the profits into pre-post. In that, whatever the post-acquisition profits are there in the subsidiary, in that, what is the parent company share? Add. In the subsidiary company, post-acquisition profits, what is the parent share? Add. Let's reserve for unrealized profit created. So when parent company sold goods to subsidiary company, if there is any unsold stock is there at the end of the consolidation, at the time of consolidation, in that unrealized profit we need to eliminate from the parent company 100%. So that's why reserve for unrealized profit. And then capital reserve. Sir, in step number 6, when we compare the cost of investment with the share in the net assets, either we get a goodwill or capital reserve. If it is a capital reserve, then you take it here, because these are the total reserves. So this step is also very, very important. What is the ultimate thing? See here. For the consolidated balance sheet, what is the reserves? First, parent company reserves. And if any dividend given by the subsidiary from the pre-acquisition profits, but it is wrongly created to parent company, deduct it. And what is the parent company share in the post-acquisition profits of the subsidiary? Add. And when parent sold goods to subsidiary company, in that stock, if there is any unrealized profit, unsold stock, there is an unrealized profit, eliminate 100% from the parent company, less unrealized profit. And in step number 6, whatever the capital reserve came, add back. So therefore, the net result is the value of reserves to be shown in the consolidated balance. So these are the adjustments. And finally, come to the consolidated balance sheet. You need to prepare the consolidated balance sheet. See, when you are preparing the consolidated balance sheet, sir, you know share capital and liabilities first. And when you are taking the share capital, only parent company share capital you need to take. Subsidiary share capital you cannot take. Reserves, step number 8, we have ascertained. Take that. Minority interest we need to show in the consolidated balance sheet, sir. Because I told you the logic also. In the subsidiary, we are having majority holding, but remaining portion held by minority shareholders. But we are incorporating the net assets of the subsidiary company. Therefore, rightly certain portion belongs to minority shareholders. So we need to calculate this minority interest and we need to show this as the part of share capital and liabilities. Of course, this is not part of share capital. We have to show minority interest separately. A kind of a liability, I can say. Because amounts payable to the minority interest. That means minority shareholders share in the net assets of the subsidiary. And any other liabilities, loans, current liabilities and provisions is there. You just aggregate both companies' individual liabilities, less intercompany transactions. Any intercompany transactions are there, you just eliminate. Add both the companies' liabilities minus any mutual owings are there, they are not liabilities for the group, so eliminate it. Now come to assets. Take fixed assets, total of both the companies, adjusted for revaluation and unrealized profit. So both the companies' assets you take, sir, you adjust it for revaluation and unrealized profit. I mean, from the stock, if there is any unrealized profit, we eliminated now. Goodwill came in step number 6, take it. Investments, only outside investments we need to show. Parent company investing in subsidiary, that investment will not come. I told you the logic also. This is investment within the group, not asset for the group point of view. Current assets and liabilities, advances, aggregate both the companies' balances adjusted for intercompany owings. So this is the total procedure, sir. Total 9 steps for consolidation. And important adjustments, sir. First, revaluation of assets of subsidiary company. Now, generally, sir, when you are analyzing the subsidiary company reserves and surplus, So first adjustment is revaluation of assets and liabilities. Sir, being a parent company, when I am acquiring subsidiary company, sir, on the date of acquisition, any of the assets of the subsidiary company may be revalued. So I may take any assets of the subsidiary company at their fair value, right? Suppose you take suppose there is a plant and machinery, PPE in the subsidiary company, sir. Now, initially, on the date of acquisition, what is the fair value of the PPE? What is the carrying amount? The difference is called nothing but what? Revaluation surplus. Either it can be an upward revaluation or downward revaluation. Suppose see, in the subsidiary company, there is property, plant, equipment, sir. Okay. Fair value is 100 lakhs, sir. Carrying amount of the asset is 80 lakhs. That means there is a revaluation surplus. How much? 20 lakhs. Now this is treated as pre-acquisition profits. Pre-acquisition profits. Why this is pre-acquisition profits? Because you are revaluing the assets of the subsidiary company on the date of acquisition. So therefore this is entirely pre-acquisition profits. So therefore fair value minus carrying amount as on the date of acquisition, say this. Either it can be upward revaluation, can be downward revaluation. Suppose if it is an upward revaluation, asset value has to be increased. So asset PPE account data to pre-acquisition profit. See this, pre-acquisition P&L account. That means we need to treat that revaluation surplus as pre-acquisition profit. If it is an upward revaluation. Suppose if it is a downward revaluation. Suppose for example, fair value is 70 lakhs, sir. Carrying amount of the asset 80 lakhs. That means asset value decreased by 10 lakhs, right? What is this? This is loss, right? Downward revaluation. So whenever there is a downward revaluation, P&L account debit, that is pre-acquisition profits will be debited, asset account will be credited. So this P&L account data to PPE. So therefore, whenever you are doing the consolidation of subsidiaries, sir, when subsidiary company assets are taken other than at their book values, on the date of acquisition, you need to see whether there is upward revaluation or downward revaluation. Now, any revaluation surplus arises, treat it as pre-acquisition profits or pre-acquisition. It is part of pre-acquisition profits only. And then subsequent measurement, important, sir. Since you revalued the subsidiary company assets on the date of acquisition, now the asset value changed, sir. If it is a depreciable asset, you need to either provide the additional depreciation if there is an upward revaluation, or you need to reduce the excess depreciation written off if it is a downward revaluation. For example, in this case, you see carrying amount of the PPE 80 lakhs, but you revalue to 100 lakhs in the beginning of the year. That means now onwards you need to provide depreciation on this 100 lakhs, sir. That means you need to provide additional depreciation on the 20 lakhs. Now because of that additional depreciation, your post acquisition profits will be down. Post acquisition profits will be down. Obviously, when your asset value increases, sir, obviously you need to provide depreciation on the additional amount also. Now because of that, additional depreciation will arise. Because of the additional depreciation, your post acquisition profits will come down. Suppose for example, if there is a downward revaluation, that means asset value is decreased. Fair value is less than the carrying amount. That means whatever the excess depreciation you have provided in the current year, it has to be written off. For example, in this case, the fair value is 70, but the carrying amount 80. Suppose you provided depreciation on 80 lakhs. In the subsidiary company, in their standalone financial statements, they will provide depreciation on 80 lakhs. But for consolidation purpose, you have taken the asset at 70 lakhs. Therefore, whatever the depreciation excess provided on this 10 lakhs has to be added back. So therefore, because of the revaluation of assets of the subsidiary company, there are two effects. One, initially on the date of acquisition, whatever the revaluation surplus or revaluation upward or downward revaluation, because of that revaluation surplus arises, sir, treat it as pre-acquisition profits. First thing. Second, subsequent measurement. During the year in the subsidiary company books, because of the upward revaluation or downward revaluation, because of the upward revaluation, asset value increased. Therefore, you might have provided additional depreciation. So that additional depreciation, you need to provide additional depreciation. So provide it. And suppose if there is a downward revaluation, whatever the excess depreciation provided, that has to be written off. So see this. Additional depreciation would arise in case of initial upward, or reversal of excess depreciation would arise in case of initial downward revaluation. Initially, if there is an upward revaluation, additional depreciation will arise. Initially, there is a downward revaluation, then reversal of excess depreciation, and it is going to impact my post acquisition profits. Subsidiary company post acquisition profits will be impacted because of the revaluation. So that's why if there is an additional depreciation, you see this post P&L account debit to PPE they have written. And if it is a reversal of excess depreciation, PPE to post P&L account, that means P&L account was created. That to which profits are which P&L post. That means when you are analyzing the subsidiary company profits, if there is any revaluation happened in the subsidiary company assets on the date of acquisition, the revaluation surplus will be treated as pre-acquisition profits. After that, because of the revaluation, there might be additional depreciation, there might be reversal of excess depreciation that is going to impact your post-acquisition profits. Accordingly, you need to adjust. And also, second adjustment, sir, dividend received from subsidiary. Suppose subsidiary company has given a dividend, sir. Now, subsidiary company given a dividend means who is the shareholders of the subsidiary? Parent as well as minority shareholders, right? So when the subsidiary company given a dividend, sir, you need to see from which profits they have given the dividend. Suppose if the subsidiary company has given a dividend from pre-acquisition profits, then parent company will treat them as capital profit. They will adjust to the cost of investment. Of course, minority shareholders will be added to the minority interest. And suppose if the subsidiary company gives a dividend from post-acquisition profits, then what we need to do, whatever the dividend from the post-acquisition profits, that will be created to the parent company reserves and surplus. So post-acquisition dividend, treatment in case of pre-acquisition dividend. Pre-acquisition dividend means dividend which is given from pre-acquisition profits. See this. First I am going to talk about pre-acquisition dividend. Suppose subsidiary company has given a dividend, pre-acquisition dividend, which is accounted by holding company. Then you need to see whether correctly accounted or not correctly accounted. Correctly accounted as reduction from the cost of investment. If the dividend is received from pre-acquisition profits, that is pre-acquisition dividend, adjust to the cost of investment. And they have done it. No further adjustment is required. Suppose pre-acquisition dividend received by the parent company, but they have wrongly created to P&L account. I told you in step number 8 also. Sometimes they will give in the question, subsidiary company has given a dividend from pre-acquisition profits, but parent company, instead of adjusting to cost of investment, they have created to P&L account. So therefore, in step number 8, when you are finding the consolidated resource of the parent, you need to deduct. And so wrongly accounted by creating to P&L. So what you need to do? So wrongly you create to P&L account, now you need to deduct it. Reverse the entry past and credit the investment in subsidiary. That means two things you need to do. It is already included in P&L. So P&L account has to be debited. And it has to be deducted from the investment account. So P&L account data to investment you need to write. Suppose not at all accounted by the holding company. Now you just account it. That is, adjust the same at the time of consolidation. How? Reduce from the cost of investment. As a parent company, my cost of investment will be deducted by pre-acquisition profits, pre-acquisition dividend. Suppose subsidiary company has not done the accounting, not accounted by subsidiary company. Suppose subsidiary company has given a dividend, but they have not accounted it. What we need to do? Adjust the same at the time of consolidation. Reduce the pre-acquisition profits of subsidiary and then distribute into the holding and minority interest. Also reduce the cost of investment. Okay. So if the subsidiary company has not done any adjustment, now you need to done it at the time of analyzing from the subsidiary company pre-acquisition profits. You just reduce this amount, pre-acquisition dividend. Suppose post-acquisition dividend, which is accounted by the subsidiary company, no further adjustment. Not accounted by the subsidiary company, adjusted it at the time of consolidation. In the books of the holding company, created to P&L account, because post-acquisition dividend is kind of a revenue profit. And any intra-group transactions is there between the parent and subsidiary, you need to eliminate. This I explained. Suppose parent company sold goods to subsidiary, downstream, subsidiary sold goods to parent. So you need to eliminate the unrealized profit. Suppose if it is an upstream transaction, who sold goods to whom? Subsidiary sold goods to parent. So the unrealized profit eliminated from the holding and minority interest, because when the subsidiary company sold goods to parent, the subsidiary profits are already analyzed between the pre and post. Analyzed as pre and post and allocated between the parent and minority interest. So therefore now you need to eliminate from the parent as well as the minority interest. And also you need to decrease from the inventories for consolidation. If it's a downstream transaction, suppose parent sold goods to subsidiary. That means 100% of the unrealized profit eliminated from the parent company reserves. And also reduction in the inventory value. That's it. So, and again, sir, consolidated P&L account, sir. How consolidated P&L account will be prepared, sir? Same, sir. So, consolidated P&L account is very easy, sir, actually. All the items of P&L account are to be added line by line, sir. And any intercompany transaction is there, you need to eliminate. For example, parent sold goods to subsidiary. That means parent sales, subsidiary purchases. From both, you need to eliminate, sir. Like this, any intercompany transactions happen between the parent and subsidiary. For one company, it is sales, another company, it is purchases. So one company, it is income, another company, it is expenses, you eliminate it. And similarly, if there is any stock, goods sold between the parent and subsidiary, in that stock, any unrealized profit is there, that is also you need to eliminate. And also uniform accounting policies. What is this uniform accounting policies? Simple, sir. Sir, suppose parent and subsidiary following different policies, sir. Then how can as a parent entity I will take the subsidiary for consolidation if the policies are different? So therefore, as a parent entity, what I need to do is I need to first prepare the financial statements of the subsidiary in accordance with my policies, uniform accounting policies. Suppose, sir, subsidiary company is following a weighted average cost model. I am following, suppose for example, LIFO model. Okay, as a parent entity. Now, how can I incorporate? How can I say their inventory, my inventory together is reflecting the true value? Because my policies are, as a parent entity, my policies are different. As a subsidiary, their policies are different. So when they are having different policies, what we need to do? Subsidiary company financial statements must be adjusted in accordance with the policies of the parent and then take that subsidiary for consolidation purpose. And we have one question also relating to this in the study material. So both parent and subsidiary has different policies. So whenever you have a different policies, when you are preparing the standalone financial statements, no problem. But when the subsidiary company policies are different from the parent company, at the time of consolidation as a parent entity, what I need to do is I need to change the subsidiary company reserves, subsidiary company items, financial items in accordance with my policies and then take it for consolidation. Okay, that is the concept. So this is AS21, sir, consolidation procedure, sir. So entire consolidation procedure we have discussed. Now let's start accounting standard 7, sir, construction contracts. Very important standard from examination point of view. Quite frequently they are testing from this standard, sir. So what is this construction contract is all about? See, if you are a contractor who is engaged in construction of assets, construction business, now for you this standard is applicable. Now basically in case of construction projects, what is the unique thing is they are all long term in nature. Therefore the challenging part is the construction will go on for number of years, right? How much revenue, how much contract revenue, how much contract cost I need to recognize every year over the construction period. So that been the main challenge of construction business. And that was addressed by this standard, accounting standard 7. So basically accounting standard 7 came to provide you the principles relating to how much contract revenue and contract cost is allocated in respect of each construction project by the contractors. For example, GMR company is there. Now they are specialists in construction of airports. For example, they are constructing one airport for example, UP government. They are constructing one airport and their estimated period for project is 5 years. Now the challenging thing is that they know they are handling one construction project which is very long term in nature, 5 years. Now over the period of 5 years, how much revenue they need to recognize in respect of this construction, how much cost they need to allocate every year. So that's been the main challenge here, and that was addressed by accounting standard 7. So the main object of accounting standard 7 is to provide the principles for allocation of contract revenue and contract cost for construction projects over the construction period, right? So that is what I have given in the objective. So if you first peculiar features of the construction business is they will take more than 1 year to complete. They're all very long term in nature. So therefore another peculiar thing is allocation of revenue and cost to the accounting period in which the construction work is performed. And also one more important thing, sir, we don't know the final outcome because these projects are very long term in nature. Anything can happen. So therefore, that is also one of the important thing here. So therefore, the main object of this standard is to prescribe the criteria for allocation of contract revenue and contract cost to the accounting periods in which the construction work is performed. Now the GMR company is taking 5 years, right? Suppose they accepted project for 1000 crores. Now therefore, every year how much revenue they will allocate, how much cost they will allocate, on what basis they will allocate. So that is that criteria was prescribed in accounting standard 7. So therefore, the focus of this standard is to determine when the contractor should recognize the revenue and cost in the statement of P&L. How much and when. Every year how much he has to recognize as a revenue, as a cost. So that is the main focus of this standard. And remember guys, this standard is applicable only to the contractors, not to the customer. Okay. Suppose in this case GMR company is subject to A7, not UP government. And then this standard is talks about construction contract, right? Basically, what is construction contract? See, construction contract is a contract which is specifically negotiated for the construction of an asset or a combination of assets that are interrelated, interdependent in terms of their design, technology, function, ultimate purpose or use. So here construction means not just construction of single assets, sir. Even construction of combination of assets which are interrelated, interdependent on each other, that is also construction contract. So construction contract is a contract specifically negotiated for the construction of an asset or a combination of assets that are interrelated or interdependent in terms of their design, technology, function, purpose or use. So that means a construction project may involve construction of a single asset like bridge, building, dam, road, ship, tunnel, or it may involve construction of multiple assets, but they are connected in terms of design, technology, function, purpose. Like for example, any contract for building refineries, oil refineries, steel mill, cement mill, so residential complexes, commercial complexes, complex pieces of plant and machinery, that is also construction contract. See, most of the students, they are not understanding the scope of the standard. They are thinking that construction contract is just construction of one apartment or construction of building. No, the scope of the standard is so wide. So it includes different kinds of construction of assets, not just single asset, construction of multiple assets which are closely interrelated in terms of design, technology, function is also covered here. And also, sir, the most important thing is construction contracts also includes any contract of service which is directly related to the construction of asset. So any contract for rendering services which are directly related to the construction of the asset, like for example, services of the project manager or architect is also construction contract, is part of construction contract. For example, we are constructing a building, sir. We have appointed one architect. Now the architect is providing services directly relating to the construction, right? So those services are also included as a part of construction contract. And also suppose for example, you are constructing one power plant, sir, and you have appointed one project manager. So the project manager services which is directly related to the power project is also construction contract, sir. Not only that, sir, any contract for destruction or restoration of the assets and restoration of the environment after demolition of assets. It is not just all about constructing of an asset. Even if you got the contract for destruction of an asset or restoration of the assets, or maybe restoration of the environment after demolition of the asset, that is also construction contract. For example, there is one historical monument, government has given a contract to you to restore that asset. So that is also construction contract. Suppose there is a old planted machinery. Now that company you want to demolish this old planted machinery. In that place, you need to develop or you need to, construct one green park. So that means we need to demolish the existing asset and we need to restore the environment after demolition. So that is also construction contract. So understand the scope of the construction contract. So construction contract, not just construction of an asset, even a service contract directly related to the construction is also part of construction contract. And also any contract for destruction, restoration of the assets and restoration of the environment after demolition of assets is also part of construction contract. Okay. Now, sir, very, very important, sir. Types of contracts, types of construction contracts. Sir, A7 has classified the construction contracts into two categories. Actually, this classification is given only for accounting purpose. So there is no such thing as types of contracts in the practical world. So therefore, there are two types of contracts. One is fixed price contract. Second one is cost plus contract. Simple. In fixed price contract, sir, contractor and customer agreed for one fixed price for a construction of an asset. For example, I am the contractor. I accepted to construct one asset for 50 lakhs. So this is called fixed price contract. So the challenging thing in, the main thing, the concern in fixed price contractor as a contractor is, I have fixed the price 50 lakhs. Suppose in future, the cost may increase, the cost of construction may increase. For example, I want to construct a building. Labor cost may increase, material cost may increase, sand, bricks, iron cost may increase. Na? So therefore, as a contractor, I am on the losing side because the price is already fixed at 50 lakhs. Therefore, in case of fixed price contract, what they will do is they will write escalation clause. In future, if the costs are increasing or decreasing, accordingly, the revenue will also change. So that is fixed price contract. Come to cost plus contract. What is cost plus contract? See, cost plus contract is nothing but we don't agreed for a fixed price, but we will negotiate it like this. See, whatever the cost I am going to incur for construction of the asset, those cost, of course, those cost means only allowable cost. In the, at the time of entering into the agreement itself, they will specifically provide these are the cost I am going to incur. Those cost plus my margin. Because as a contractor, without margin, why I will construct, sir? So therefore, what are all the cost I am incurring plus my profit? So this is cost plus contract. Cost plus my margin. So in fixed price contract, the price is fixed. But in cost plus contract, whatever the cost I am going to incur, those costs, the reimbursable cost, eligible cost, reimbursable, plus my profit. That is called cost plus contract. So the way the contracts was entered, the way the contract price is fixed based on that two types of contract, fixed price, cost plus. So what is fixed price? A construction contract in which contractor agrees to a fixed contract price or a fixed rate per unit of the output, subject to escalation clauses. Subject to escalation clauses. Now generally these fixed price contracts are common for tenders like roads, flyovers, office buildings. So these are, fixed price contracts will be there for this. So such projects have the budget and the public entity does not intend to exceed their tender amount. Okay. Next, cost plus contract, construction contract in which contractor is reimbursed for allowable or defined cost plus a percentage of fixed price. In cost plus contract, sir, you might think, sir, here why customer is enter cost plus contracts? Because whatever the cost incurred by the contractor plus profit. No. See, that's what I said. I am customer, I am not going to repay all the cost, whatever the cost you incurred. And suppose your personal expenditure also, you cannot include it as a part of construction cost. So that's why in the beginning itself, they will enter an agreement. In that agreement, they clearly specify what are the allowable cost. So that's why you see, contractor is reimbursed for all allowable or defined cost and percentage of profit. Okay. So these cost plus contracts generally when they will use it, sir, when there is uncertainty in measuring the cost or completion time. Suppose for example, if there is uncertainty in measuring the cost and completion time, generally they will follow this. Okay. So there are two types of construction contracts, fixed price and cost plus contracts. Now the most important thing is recognition of contract revenue and cost. Listen to me carefully. Sir, what is the object of accounting standard 7? I told you. All the construction projects are long term in nature. Therefore, if you take each construction project separately, how much revenue I need to recognize, how much cost I need to recognize every year over the construction period. That is the challenging thing, right? So to provide the principles for allocation of contract revenue and contract cost over the construction period, this standard came. Now that topic came. That is recognition of contract revenue and expenses. Listen to me carefully. Sir, this standard says how much revenue, contract revenue and contract cost will be recognized for each construction project. You need to ask one question, sir. In respect of each construction project, at the end of the year, you need to ask one question. What I'm saying, in respect of each construction project, each construction project, you need to ask one question. What is it? Whether the outcome can be estimated reliably or not. Whether the outcome of this construction project is estimated reliably or not. The answer may be yes or no. If the answer is yes, then you follow stage completion method, percentage of completion method to recognize the revenue and cost. If the answer is no, then recognize the contract revenue to the extent of cost incurred, provided the recovery is probable. That's it. Once again, I'm telling. In respect of each construction project, as a contractor, at the end of the year, I need to ask one thing, whether the outcome of this construction project can be estimated reliably or not. The answer is yes or the answer is no. If the answer is yes, I can measure the outcome of the construction project reliably, sir. Then you recognize the revenue and cost to the extent of percentage of completion. How much contract has been completed? Proportionately, you recognize the revenue and cost. Sir, I cannot measure the outcome reliably, sir. Then you recognize the contract revenue to the extent of cost incurred provided the recovery is probable. So therefore, outcome of the construction contract can be estimated reliably. Outcome of the construction contract cannot be estimated reliably. This is the question you need to ask. Whether the outcome of the construction contract is estimated reliably? Yes. Then standard says contract revenue is recognized as revenue by reference to the stage of completion of the contract activity. To what extent the construction contract is completed, to that extent you recognize the revenue. Expenses same. Cost associated with the construction contract recognized as expenses by reference to the percentage of completion. Sir, when I am unable to estimate the outcome reliably of this particular construction project, then recognize revenue only to the extent of contract cost incurred, provided the recovery is probable. That means when you are unable to estimate the outcome reliably, that means the standard says, hey, recognize the revenue only to the extent of cost incurred. That too, if you are confident that you are going to recover this amount from the customer. So what about the contract cost? Contract costs are recognized as an expenses in the period in which they are incurred. How much contract cost you incurred, you recognize it. But revenue only to the extent of cost incurred. That too, if the recovery is probable. Now you got it, Anna. Very, very important, Anna. So usually when you are solving the questions, accounting standard 7 questions, okay, if nothing mentioned means outcome is estimated reliably, then you recognize the revenue and cost based on percentage of completion. See, in my YouTube channel, sir, entire all sums of accounting standard 7 I have uploaded. What you will do is, after listening to this accounting standard 7, immediately you go and check all the questions I have solved. Easily you can solve all of them, and in exams, if at all there is a question, you can usually get the full marks. So therefore, this is the main criteria to recognize the revenue and cost. So tell me, in respect of each construction project, what is the question you are going to ask? Whether the outcome is estimated reliably or not. If answer is yes, tell me how contract revenue will be recognized every year to the extent of percentage of completion. How much contract cost will be recognized to the extent of percentage of completion. That is called stage of completion. To what stage the contract is completed, to that extent you recognize the revenue and cost. Suppose if the outcome cannot be estimated reliably, then recognize the revenue only to the extent of cost incurred, provided the recovery is probable. Okay. Now one more important thing, sir, expected loss. Sir, this standard says if at any time, if there is an expected loss, what is the expected loss? If the total contract cost is more than the contract revenue, that is called expected loss. If at any time there is an expected loss on the construction contract, it is recognized as an expense immediately. If the same point is applicable in both the cases, whether the outcome is estimated reliably or not. If there is an expected loss on the construction contract, it is recognized as an expense immediately. So when the total contract cost is more than contract revenue, that is expected loss. If there is an expected loss, recognize it immediately. Okay. So that's it. Now, sir, you said in respect of each construction project, we need to ask one question, whether the outcome is estimated reliably or not. How to know whether the outcome is estimated reliably or not, sir? That is also provided in this standard. See, the outcome of the construction contract can be estimated reliably if all the following conditions are satisfied. Suppose if it is a fixed price contract, these conditions must be there. Then we say outcome is estimated reliably. If it is a cost plus contract, these conditions must be there. So suppose you take fixed price contract. When we say the outcome is estimated reliably, first, total contract revenue can be measured reliably. Can you able to measure the revenue, total revenue of the contract reliably? Next, economic benefits will likely to flow to the enterprise, whether the benefits is going to get from the customer. Next, the contract cost to complete and stage of completion can be measured reliably. Can you able to measure the contract cost to complete and the stage of completion reliably? And also, can contract cost can be reliably identified and compared with prior estimates? So four conditions must be satisfied. First thing is whether can you able to reliably measure the total revenue, and whether economic benefits will likely flow to the enterprise, whether the total contract cost to complete and stage of completion can be measured reliably, and whether the contract cost can be clearly identified compared with previous estimate. So if all the four conditions are satisfied, then we say the outcome is estimated reliably. If it is a cost plus contract, only two conditions. That is, economic benefits will likely flow to the enterprise, and contract cost can be clearly identified and measured reliably. So whether I am able to identify the contract cost clearly, and can I measure them reliably, and whether the economic benefits will flow to me, then I say the outcome is estimated reliably in respect of cost plus contract. And even if you don't remember these conditions, sir, not a problem, because they are not going to test on these conditions. But understand, to recognize the contract revenue and contract cost, so whether the outcome is estimated reliably or not. In the question, when you are solving, nothing mentioned means the outcome is estimated reliably. And then you follow percentage of completion. Sir, you said stage of completion. How to measure the stage of completion? See, there are methods to measure the stage of completion, percentage of completion. But see, out of this, only this one is relevant. Remaining two not relevant. They are only for theory purpose. For academic purpose, when solving the questions, you need to find out the percentage of completion only based on cost incurred. So remember, guys, so when you are finding the percentage of completion, why I need to find out percentage of completion? Because when the outcome is estimated reliably, that particular construction project revenue and cost is recognized based on the percentage of completion. Then how to find out the percentage of completion? So based on cost incurred. So how to calculate this? Percentage of completion is equal to what is the actual cost incurred till the year end. What is the actual cost I incurred till year end divided by what is the total estimated contract cost. Total estimated contract cost means what is the actual cost incurred plus what is the estimated future cost. For example, sir, till now we spend 100 lakhs. That means actual cost incurred till the year end 100 lakhs divided by total estimated cost 100 lakhs plus we are estimating another 50 lakhs to be incurred. So total 150 lakhs. So therefore 100 divided by 150. So therefore 66.67%. That means 2/3 of the contract was completed. Therefore you recognize the revenue to the extent of 2/3. Suppose the total revenue is 1000. 1000 into 2 by 3. 1000 into 2 by 3. So therefore 667 is the revenue we need to recognize. Okay, so how to find out the stage of completion? Based on cost incurred. What is the formula? Actual cost incurred till date divided by total estimated contract cost. What is the total estimated cost? Actual cost incurred plus estimated future cost. And there is another method called survey method also. So to measure the percentage of completion. So percentage of completion is determined through surveys also. Especially in government project, a surveyor is appointed. So to monitor the parameters such as quality of work, materials used, etc. And he will assess the percentage of work completed. And sometimes based on physical proportion also, they will find out the percentage of completion. So this method is used for less complex construction contracts. For example, if the contract involves placing tiles over 1000 square foot, 300 square feet is completed. That means 30% of the work is completed. But I told you, sir, how to find out the percentage of completion? Follow this one. Based on cost incurred. But an MCQ can be asked. Based on cost incurred, survey method, physical proportion method. 3 methods are there. But for academic purpose, only based on cost incurred. That means for solving the questions, only based on cost incurred, you need to find out the percentage of completion. Okay. So this standard is all about what? Recognizing the contract revenue and contract cost. First of all, what is contract revenue? Contract revenue means initially agreed price between the parties. And this initially agreed price may be subject to some changes. So maybe, see, first one is variation in the contract. Variations in the contract, maybe because of that the contract revenue may increase or decrease. That is first one, add or less. Second, escalation clause. This we have discussed in fixed price contract. So in fixed price contracts, generally the price is fixed. Therefore there is a risk that in future the cost may increase. So therefore they will put one escalation clause in the agreement. Now because of that escalation clause, as a contractor, if the cost increases, not to that extent, to the extent of that increase, my revenue will be increased. So therefore I need to charge that amount from the customer. So therefore because of the escalation clause, there may be a chance that the revenue may increase or decrease. See, the cost may increase. If increases, I am going to charge the amount from the customer. Suppose cost decreases, then I need to reduce the revenue amount. Whatever the initially agreed amount, I need to reduce it to the extent of decrease in the cost. So it is beneficial to the customer. So therefore initially agreed price, subject to variation in the contract, subject to escalation clause, subject to claim amount, claim only add, not add or less, only add. And next, incentives. Because of the incentives, the contract revenue may change. So only add. Next, and penalties, less. So therefore you see how many adjustments? 5 adjustments. So they may ask a question relating to this. Please carefully observe. We are discussing contract revenue because construction contract involves 2 things: contract revenue, contract cost. So what is contract revenue? Initially agreed price, subject to changes. How many changes? 5. First one, add or less, variations in the contract. Second, add or less, escalation clause. Third, claim amount only add. Fourth, incentives add. Fifth, penalties less. Now I am going to explain each one separately. What is variations in the contract? Simple, sir. Change in the specifications from the customer side. Sir, once we enter into an agreement, after that customer may change the specifications. So customer will ask for specific requirements, or he may ask modification in the existing contract. Now because of that, as a contractor, I need to do some extra work. I need to make some modifications. That is called variations in the contract. Right? So because of the variations, if the contractor is doing extra work and he is incurring some extra amount, definitely he will increase the revenue to that extent. Because the scope of the work decreased because of the variations, obviously the contract price will be reduced. For example, customer asked for a specific requirement. Now for that, some cost will be incurred, right? Now later on, once the contract is entered, customer says that I don't want that. So that means the scope of the work reduced. Accordingly, contract revenue will also be reduced. So that's why add or less. So what is variations in the contract, sir? Variations in the contract is nothing but, see this, changes in the construction contract due to customer instructions. Maybe change in the specifications or design. So now see, accounting standard 7 says when because of the variations in the contract, the revenue will be adjusted. Two conditions must be satisfied. First thing is that customer approval must be there. I mean, customer approval is probable. It is more likely that customer is going to approve this. Probable means more likely than not. Whatever the variations happening in the contract, it is probable that customer is going to accept it, and the amount is measured reliably. Then if these two conditions are satisfied, then variations can be adjusted to the contract revenue. So you understand what is variations? Variations is nothing but change in specifications of the contract. Customer side maybe change in the specifications, design, everything. Because of that, the scope of the work may increase or decrease. Accordingly, the contract revenue will be increased or decreased. And when two conditions must be satisfied, it is included. It is adjusted to the contract revenue. One is customer. It is probable that customer is going to accept this, and amount is measured reliably. Now second one, escalation clause, you know this. Escalation clause means change in the prices. Either because of that the revenue may increase or decrease. So adjustments in the contract due to change in cost. Either may price increase or decrease. Now based on the agreed terms, adjustments must be measured reliably. No specific conditions are provided, sir. But because of the escalation, if the revenue increases, add, decreases, less. Next, claim amount. This is important, sir. Claim amount. Sir, what is this claim amount? Claim amount is nothing but amount claimed by the contractor from the customer. Because customer side, some mistakes, some specification errors, or maybe some delays happen, right? Now, because of that, as a contractor, I may incur some extra cost. Now, that amount I am going to claim from the customer. That is claim amount, and because of that my revenue will only increase, it will not decrease, because claims are made by contractor from the customer for customer side mistakes. Understand? So claim amount is what? The amount raised for delays caused by the customer, errors in specifications, designs, etc. Suppose for example customer has specified wrong specifications and we constructed. Later on customer said no, I don't want this. So definitely again I need to construct it. So whatever the cost I incurred, now I will claim that amount from the customer. That's a claim amount. Because of that my revenue will increase. See, what is the difference between variation and claim, sir? Variation is customer side change in specifications. But claim means customer side mistakes, delays, errors in specifications. Because of that I may claim some amount from him. But this claim amount, when it is included as a part of contract revenue, standard says negotiations must have reached the advanced stage. And it is probable that customer will accept this and amount is measured reliably. Important, sir. They may ask a question. So because of the customer mistakes, these things happen. So when will you recognize it as a part of contract revenue? You have to write. So negotiations must have reached the advanced stage. That means almost ending. The negotiations between the contractor and customer is happening, already done. Advanced stage they reached. And customer acceptance is probable. Customer said, okay, I'm going to pay the amount. Don't worry. I'm going to give your claim amount. Because of my mistake it is happened now, I'm accepting. Suppose customer is not accepting. The amount is not probable. Customer acceptance is not probable. Don't recognize it. Customer acceptance must be probable and amount must be measured reliably. That is called claim amount. So claim amount also we completed. Next, incentives. What is this incentives? So generally in the construction projects, sir, in the agreement itself, they will write one point that if the contract is finished within the time limit, or if the contract is exceeded these quality parameters, then as a contractor, as a contractee, as a customer, I am going to give you some extra amount. That is called incentive. For example, the original construction period is 5 years. If you construct it within 4 years, we are going to give 10 lakhs extra. That is called incentive. So because of the incentive, only my revenue will increase. It will not decrease. So that's why only add. So therefore, when I will include incentive as a part of contract revenue, the standard says incentives are included in the contract revenue. Only two conditions must be satisfied. It is probable that performance standards will be met or exceeded, and the amount is measured reliably. Important. They may ask a question relating to this. When incentives are included as a part of contract revenue, when it is probable that performance standards are met or exceeded, right? And contract must be sufficiently advanced. See, this point also you have to write. Sufficiently advanced, sir. Sufficiently advanced. Contract must be sufficiently advanced. For example, you entered a contract to construct a flyover, sir. Flyover construction contract. And government said, if you construct this flyover within 4 years, we will give you 10 lakhs extra. The total contract period is 5 years. So the government, in the agreement, they said that if you construct the project within 4 years, we are going to give you some extra amount of 10 lakhs. Now the question is whether this 10 lakhs can be included as a part of contract revenue in the first year itself. Because previously these type of constructions, these type of flyovers, we have done so many. So can we include this 10 lakhs as a part of contract revenue in the beginning itself? The answer is no. This standard says the contract must be sufficiently advanced. So based on the previous track record, you cannot say these conditions I will easily meet. So therefore this I will include as a part of contract revenue in the beginning itself. No, first of all, the contract must sufficiently advanced. That means it has to reach. So suppose for example, 3 years is over. Then you can say, okay, the contract was sufficiently advanced. Now it is probable that we are going to meet the specific conditions. Then we can recognize the revenue. So in the beginning itself, don't be under the impression that based on the previous track record, these type of conditions we already met. So therefore we will recognize this as our revenue. No, that is not correct. So therefore incentives, when we will include as a part of contract revenue, contract must be sufficiently advanced and it is probable that we are going to meet the conditions and the amount is measured reliably. And last one, penalties. Sir, claim amount is what, sir? Delays and errors by customer. What about contractor mistakes? Contractor side mistake can happen. Contractor side delays may happen. Suppose he said construction will be completed in 5 years, but not completed. Then he has to pay some penalty. Therefore, as a contractor, if I need to pay the penalty to the customer, my revenue will decrease. So therefore, penalties is less. So penalties is what? Amount deductions due to delays caused by the contractor. No specific conditions. Penalties are deducted based on the contract terms. So you understand the contract revenue? Tell me. Contract revenue is initially agreed price subject to 5 adjustments. What are the 5 adjustments? Add or less variations. Variations are from whose side? Customer side. When variations are included as a part of contract revenue, acceptance of the customer is probable, amount is measured reliably. Next, add or less escalation clause. Okay, no specific conditions. Next, add claim amount. Claim amount means amount claimed by the contractor from the customer for his mistakes, errors in specifications. Okay, when it is included, sir, negotiations must have reached advanced stage and it is probable that customer will accept this, amount is measured reliably. Next one, sir, incentives. What is incentive, sir? If I meet the specific performance standard, if I complete the contract in time or before time or meet the specific standards, then some extra amount will be given by the customer to the contractor. That is incentive. That will be included in the contract revenue. When contract must be sufficiently advanced and it is probable that customer is going to, probable that we are going to meet the specific performance standards and amount is measured reliably. Next, penalties. Contractor side, if there is any delays happen, so we need to pay penalty to the customer. To that extent, we need to reduce the revenue. So this is one area they can ask. Next, contract costs, sir. See, there are 3 types of costs, sir. One is specific cost. You take any construction project, sir, specific cost will be there. Allocated cost will be there, allocable or attributable cost, and then some other cost which is charged to the customer as per the agreement. First, to specific cost, the cost which is directly related to the construction. Like for example, material cost, labor cost, depreciation of plant and equipment, hiring plant and equipment, design technical assistance cost, third party claims specific to the contract. Third party claims, third party. For example, we are constructing a building in a locality. So surrounding areas are got affected by that. So they are making some claim which is relating exclusively to that particular construction project. That is also directly attributable cost, specific cost. So not directly attributable, that is specific cost, sir. Next, attributable or allocable cost. See, these are the common cost which is incurred by the enterprise, but which is allocated to all the construction projects. Like for example, sir, these are the costs incurred for all contracts, but allocated systematically and rationally based on the normal construction activity. For example, sir, supervisor. Now we have appointed one supervisor, sir, who need to look after all the construction projects. That means whatever the salary we are paying to the supervisor, is it for one particular construction project? No, he is rendering services for all the construction projects. So therefore, this supervisor salary must be allocated to the all construction projects based on the time he is spending in each project. Okay. Or else, for example, a company has taken insurance on all the construction projects, right? The insurance premium they will pay to the insurance company. Now this premium will be allocated to all the construction projects. So these are called attributable and allocable cost, like insurance premiums, non-specific design and technical assistance, construction overheads, example supervisor salary, any borrowing cost. For example, we have taken a bank loan. On bank loan, we are paying interest. Now these loans we have utilized for construction of multiple projects. Borrowing cost also we will allocate to each project. So these are called attributable and allocable cost. So one is specific cost, which is directly relating to that particular construction. Second one is attributable and allocable cost, which is incurred at the enterprise level, which is allocated to all the projects on reasonable basis. And sir, there are some costs, sir, which are chargeable to the customer as per the agreement. Only if they are specified in the agreement, we will include it. Like for example, general administration cost, R&D cost, or any other cost which is specifically mentioned in the agreement. Generally, sir, general admin cost, R&D cost, these things we will not include as a part of construction cost, any construction project, because they are no way connected with construction, right? R&D cost to general administration cost. But if they are specifically mentioned in the agreement, they may include it. For example, we are constructing a project, sir. If that contract is of specific nature, we have to do some extra R&D. We have to incur some extra work. We have to do some extra things. So administrative work, or maybe research work, development work, R&D work, all these things. Then if the customer accepts as per the agreement, then we will include it as a part of contract revenue. And according to the standards, sir, there are some unallocable costs. Generally, these costs we will not include as a part of the construction contract. That is general administration cost, R&D cost, selling cost, depreciation of idle plant and machinery not used for any particular contract. For example, there is a plant and machinery, sir. We are not using for any construction, but still depreciation will come, na, sir. Whether I can include this depreciation cost as a part of construction contract? No. Depreciation on idle plant and machinery which is not used for any purpose, don't include it as a part of construction cost. So general admin cost, selling cost, R&D cost. Sir, you said R&D cost, general administration cost is included only if it is specifically mentioned in the agreement. See this, specified in the agreement. So therefore tell me, contract cost, how many contract costs are there? Specific cost which is directly related to the contract, attributable and allocable cost, and cost which is chargeable to the customer as per the agreement, unallocable cost. So in unallocable cost, don't include general admin cost, selling cost, R&D cost, depreciation on idle plant and equipment not used for any particular contract. And also, sir, one more important, sir, any incidental revenue. For example, there is a construction site, sir. In the construction site, for example, scrap material will be there, unused iron, cut down wood, all these things. So scrap items we sold. So we got some incidental revenue, right? This revenue, can I include it as a part of income in P&L account? Answer is no. A7 says, because of the sale of the wastage in the construction site, whatever the revenue you got, you reduce from the cost, directly attributable cost. So only remaining cost you will take. For example, sale of scrap, you got 5 lakhs. So 5 lakhs you reduce from the construction direct cost. Don't include it as a part of contract revenue. Okay. So we understood the contract revenue recognition principle. We understood the methods of percentage of completion, how to ascertain. We understood what is contract revenue. We understood what is contract cost. And in this standard, sir, there is one concept called segmenting and combining. Listen to this concept. What is this combining and segmenting of construction contracts? See, listen. Combining, segmenting. Sir, first of all, we will see combining, segmenting, sir. What is segmenting? Single contract involves construction of multiple assets. Then construction of each asset can be treated as a separate contract. Single contract, in that contract there are multiple assets. Now construction of each asset can be treated as a separate contract. That is called segmenting. Multiple contracts will be treated as a single contract. That is called combining. So, For example, see this, treating each asset as a separate contract, that is segmenting. Now you may got a doubt, sir, you said it is a single contract. In the single contract there are multiple assets involved, then construction of each asset is a separate contract. Why, sir? Why? Accounting easy. For easiness of accounting, this topic was prescribed. So if you enter a single contract, sir, but in that contract multiple assets are there, then you apply A7 for each asset separately by treating it as a separate construction contract, provided some conditions are satisfied. What are those? See, separate proposals for each asset, separate negotiation for each asset, cost and revenue of each asset can be identified. So three things you have to remember. When within a single contract, construction of each asset can be treated as a separate contract. Separate proposals, separate negotiation, separate proposals for each asset, separate negotiations for each asset, separate, you can identify the cost and revenue separately for each asset. So here the important thing is each asset. Each asset you can identify separately, you can negotiate separately, you have separate proposals, separate negotiations, cost and revenue you can identify each asset separately. Then you can treat a construction of each asset as a separate contract. Now treating a group of contracts as a single contracts. Multiple contracts can be treated as a single contract provided some conditions are satisfied. First of all, group of contracts are negotiated as a single package. So there are group of contracts, they are all negotiated as one single package, and these contracts are closely interrelated and form part of a single project with an overall profit margin. And the contracts are performed concurrently or in a continuous sequence. So suppose for example, sir, with a single customer, we entered a multiple contracts. Then the standard says these multiple contracts can be treated as one single contract for accounting purpose. This is called combining. But some conditions must be satisfied. First thing is all these contracts are negotiated as one package, one single package. Second thing is that they are closely interrelated and they are all part of a single project with an overall profit margin. For example, government has given a contract for you to construct bridges in 5 different places. So you are the contractor, customer is same. So they have given 5 bridges you need to construct. They are all negotiated as a single package. One package government is going to give you single package, and they are all closely interrelated, and they are part of a single project with an overall profit margin. See, all these 5 bridges you are going to construct, they are part of a single project only. Government wants you to construct it. So you don't have the option to select individually. So all are part of a single project with an overall profit margin. Okay, and they are performed concurrently or in a continuous sequence. Either you perform at a time or in one sequence, one after another, systematically. So if these 3 conditions are satisfied, then we can apply the concept of combining. So both segmenting and combining concepts are applied for ease of accounting as per accounting standard 7. So in segmenting, single contract, multiple assets, each asset separate contract, provided 3 conditions. Separate proposals for each asset, separate negotiations for each asset, cost and revenue for each asset is identified. Multiple contracts are treated as single contract and combining, provided some conditions are satisfied. All contracts are negotiated as a single package, they are closely interrelated, they are part of single project with an overall profit margin, and they are all performed concurrently or in a continuous sequence. Now sometimes, sir, treating additional asset as a separate contract. Suppose there is a contract, sir. In that contract, the customer requests for additional asset. For example, there is a contract to construct a building for 4 floors. Now customer asked 5th one also after that. That means treating additional asset. He is asking additional asset, right? He is asking additional asset. Now standard says this additional asset can be treated as a separate contract. As a separate contract provided some conditions are satisfied. What are those? See, this additional asset different significantly in terms of design, technology, function, or price of the additional asset is negotiated separately from the original contract price. Either this additional asset which is requested by the customer is significantly different in terms of design, technology, function from the original assets, or the price is negotiated separately. Then we can treat this additional assets as a separate contract, and accordingly we need to do the accounting treatment. Because when I am talking about the revenue recognition principle, I told in respect of each construction project, I told, right? So that's why. So therefore, in a single contract, Multiple assets will be there. Each asset, separate contract, segmenting. Multiple contracts, single contract, combining. In a single contract, customer asked for additional asset. Now this additional asset can be treated as a separate contract for accounting purpose as per A7, provided some conditions are satisfied. That is, this asset additionally required by the customer is significantly different from the original assets in terms of design, technology, function, and the price is negotiated separately. Then you can treat this additional asset as a part of separate contract. You got the concept of combining and segmenting? Yes, I think. Next, recognition of expected losses. This point I already covered. Anytime, please understand, anytime if the total cost of the project exceeds the contract revenue, you need to recognize the loss as an expense immediately. This is what A7 says. This point we already covered in accounting, recognition principles. See this, recognize an expense immediately when the total contract cost exceeds the revenue, regardless of what? Regardless of the work status, regardless of whether or not work commenced or not, regardless of the stage of completion, regardless of the profits expected or arise from other contracts. They may ask a question. For example, you just entered a contract. Now the contract revenue is 100 crores and the contract cost is, suppose you are estimating 80, but just you now started the construction and there is some unexpected cost may going to generate, which is 30. So therefore it will be 110. What you are going to do? Immediately you have to recognize this 10 lakhs as expenses in the books, because your total contract cost 110, contract revenue 100, so 10 excess loss has to be recognized expenses immediately. Expected loss A7 says don't wait, immediately you need to recognize. Prudence concept, irrespective of whether work commenced or not. Sir, even project not started, sir, if the contract cost is more than contract revenue, recognize immediately. Sir, irrespective of the percentage of completion, irrespective of the profits expected from other contracts, you need to recognize. And then disclosure requirements, guys. If you are a contractor, what kind of disclosures you need to make? So what is the amount of contract revenue recognized? What are the methods used to determine the contract revenue? What are the methods used to determine the stage of completion? In respect of any contracts in work in progress, what is the aggregate amount of cost incurred and recognized profits? What is the amount of advances received from the customers? Amount of retentions, progress billings, advances. The retention means part of progress billings held back until contract conditions are satisfied or defects are rectified. Progress billings means amount billed. See, as a contractor, I done the work, I billed the amount. So that is called progress billing. Work done, bill sent to the customer, progress billings. But in that, whatever the amount is still not yet paid by the customer, that is called retention amount. That means work is done, but amount is not paid by the customer. That is called retention. Advance means the amount received before work is performed is called advances. And this one is very, very important, sir. As a contractor, sir, at the end of the year, in the notes to accounts, I need to disclose what is the gross amount due from customers, what is the gross amount due to customers. Gross amount due from customers, sir, gross amount due to customers, sir. See, when the work done is more than the amount billed to the customer, that is gross amount due from customers. I have done the more work than the amount billed to the customers. That I need to disclose. That is my asset, gross amount due from customers. Whatever the amount due from the customer is an asset, na. And suppose when the amount billed is more than the work completed. Sir, I have done a work of 100 lakhs, but I billed 120 lakhs. That means this is gross amount due to customers. It's a liability. I need to recognize. So if the amount is gross due, amount due from the customers, shown it as an asset. If amount due to customers, show this as a liability. And how to calculate, the formula is also given. For example, what is the cost incurred? What is my recognized profits? Minus recognized losses plus progress billings. You will get the gross amount due from customers. Or recognized losses plus progress billings minus cost incurred plus recognized profits. You will get what is the gross amount due to customers. What is the cost incurred till now? 100 lakhs. What is the recognized profits? 20 lakhs. What is the recognized losses? For example, we don't have profits. Overall, we are in the loss. So therefore, 20 lakhs loss. What is the progress billings till now? Progress billings are only 70 lakhs. So therefore, 100 minus 90. So 10 lakhs is the gross amount due from customers. For example, what is the recognized loss? Till now, the loss is 10 lakhs. Progress billings are only 80 lakhs. What is the cost incurred? Cost incurred is 100. So therefore, 90 minus 100. So 10. Gross amount due to customers. Because here, see this, recognized losses plus progress billings together 90, cost incurred plus recognized profits 100. So therefore, this is the amount billed is more than the amount work completed. So sorry sir, progress billings, you can make this as 100. So 10 plus 100 sir, 110. What is the cost incurred? 100. So therefore the amount of billed is more than the work completed. Okay. So this is accounting standard 7 overall. So accounting standard 7 completed sir. And I have given in my channel sir all the questions relating to accounting standard 7 also. Please solve all those questions. After seeing this, more than sufficient sir. Accounting standard 12 sir, accounting for government grants. Accounting for government grants. Whenever you receive any kind of assistance from the government, what is the accounting treatment we are going to do in the books of business enterprise? Basically, that is what covered under this standard sir. Suppose you are a company in India, A Limited. Definitely you are going to receive so many benefits, assistance from the government. Now when you receive any kind of benefit or assistance from the government, what is the accounting treatment we need to do in the books of business enterprise is what this standard addresses. But of course this standard has its own limitations sir. It may not cover all kinds of government assistances, because first of all the assistance which is given by the government must fit into the definition of government grant which is prescribed under this standard. Then only this standard is applicable. So basically this standard deals with what? Accounting of government grants. And government grant can be called with different names sir. You can call it with subsidy, you can call it as duty drawback, or you can call it as cash incentives, or sometimes you can call it as tax holiday, sometimes you can call it as tax rebate, whatever. Name is not the matter, whether you received the assistance from the government or not. Now the scope of the standard, very important sir. Sir, whether accounting standard is going to cover all the government assistance? Just now I told you no. The answer is no. This standard has its own limitations. Now this standard has prescribed 3 situations, 3 circumstances. You cannot apply this standard. The first one is, this standard does not address accounting for government grants in the financial statements reflecting the effect of changing prices or supplementary information of similar nature. This standard does not address accounting for government grants where in the financial statements reflecting the effect of changing prices. Whenever there are changing prices sir, to reflect the changing prices, what is the accounting treatment we do in the books of accounts? This standard does not address it sir. So basically what they are talking here is, they are talking about higher inflationary economies. When you are a business enterprise operating in a inflationary conditions, sometimes you need to adjust the assets and liabilities to the inflated prices. Suppose you have received any assistance, any government grant in the form of an asset. Now you want to increase that asset value to the inflated price, that is called changing prices. You want to reflect the changing prices. Now whether to reflect the changing prices, for that what is the accounting treatment I need to do in my books? For that also I need to follow accounting standard 12. Accounting standard says no, we are not applicable. Whenever you want to reflect the changing prices for any kind of assets you have received in the form of government grant, we are not applicable. Basically what they are talking about here is, actually sir, in Indian accounting standard, Ind AS, we have a separate standard for higher inflationary economies, financial reporting in higher inflationary economies. So I will show you. In my regular class I have discussed it. See this. Inflation adjusted financial statements, higher inflationary accounting. Suppose a company operates in a higher inflationary a company operates in a country with a high inflation and prepare its financial statements using inflationary adjusted figures. As per Ind AS 29, Ind AS, not normal AS, Ind AS 29, financial reporting in higher inflationary economies, the company receives a government grant of 50 lakhs for purchasing a machinery. Due to inflation, the machinery historical cost 50 lakhs is restated to 80 lakhs. AS 12 does not specify whether the grant should also be restated in proportion to the inflation adjusted value. So the adjustment of grants in higher inflationary economies is handled by Ind AS 29, not accounting standard 12. Actually, what they have done is, first time when they introduced accounting standard 12, so they want to release a separate standard relating to the financial reporting in higher inflationary economies, but that is not possible. They have not released any new standard relating to higher inflationary economies accounting in the normal series, normal accounting standards. But later on, when they developed Ind AS, they have came up with a separate standard. Maybe that is the reason why they have excluded this accounting for government grants in the financial statements reflecting the effect of changing prices, or similar supplementary information, any additional information you want to disclose in respect of these inflationary situations. For example, you have increased the asset value from 50 lakhs to 90 lakhs or 80 lakhs. Now, generally that information we will disclose in the notes to accounts, right? So that is also not covered as per this standard. Next, second one, sir, this standard does not deal with government assistance other than government grant. Sir, when you receive any assistance from the government, if it is not fit into the definition of government grant which is prescribed under this standard, definitely that is not covered under this standard. And the third one, sir, this standard does not cover government participation in the ownership of the enterprise. Even governments also will invest in the shares of other companies, right? Shares of different companies. Now that kind of investment in other companies is not covered under this standard. How to do the accounting of government investment in the shares of a company, that is not covered under this standard. So there are three things which is not covered by accounting standard 12. First one is accounting of government grants in the financial statements reflecting the effect of changing prices. That means when you are operating in a higher inflationary economies, if you want to do any kind of adjustments to the assets for which you have received a grant, so how to do the accounting to reflect the changing prices, not addressed by accounting standard 12. And also this standard does not deal with any government assistance other than government grants. This standard is not applicable. That assistance must fit into the definition of government grant which is prescribed under this standard, then only this standard is applicable. And the last one, government participation in the ownership is not covered under this standard. Now the definitions, sir. Two important definitions, sir. One is government. Sir, here government means what? Government means central, state, local, even government bodies, government agencies, even international government bodies also covered. So here government includes government agencies, any similar bodies, whether local, national or international also. Now what is government grant as per accounting standard 12? Very important, sir. Sir, what is government grant is, government grants are assistances provided by the government in cash or kind, to an enterprise for meeting certain conditions, some conditions. But it excludes those forms of assistance which cannot be valued, which cannot have a reasonable value placed upon it. Suppose when you receive any government assistance but you cannot measure it monetarily, financially, then it cannot be recognized as government grant. For example, you are a startup company, government has provided some services to you, government has given some assistance in the beginning. Now you cannot value it. The support which is given by the government, maybe in the form of managerial services, maybe in the form of structuring your organization initially, government has given some support to you, but there is no reasonable value placed upon it. Then obviously in accounts, sir, when you can't value something, if there is no reliable measurement, we can't bring it to the books of accounts. So therefore assistance excludes those forms of assistance which cannot have a reasonable value placed upon it. And also, sir, any transaction you have done with government which is not distinguished from the ordinary trading transactions. For example, you are a company, you are a furniture dealer, you have sold furniture to the government. Any government department you sold the furniture, can you say it is a government grant? It is an assistance given by the government, so government has purchased the furniture from us, so it's a kind of benefit to us? No. Like normal trading transactions, you have done any transaction with the government, that is also not covered under government grant. So what is government grant? Government grants are assistance, help provided by the government in cash or kind. It must be in cash or kind. Sir, suppose there is no cash or kind, then it is not covered under this definition. For example, in the electricity charges, sir, suppose electricity charges per unit 50 rupees, sir. Government said you pay only 30 rupees. That means they have given a 20 rupees subsidy, sir. Now this 20 rupees, are you receiving in the form of cash or kind? No. Therefore, it is not a government grant as per accounting standard 12. Of course, it's a kind of an assistance, but it is not measured in cash or kind. It is not in the form of cash or kind. Then it is not covered under this standard. For meeting certain conditions, sir, whenever government wants to give some assistance to you, either the conditions you already fulfilled or you are going to fulfill the conditions. Subject to that only government will give you assistance. Very rarely government grants are very gracious in nature. Freely they will give. But majority of the times it is subject to certain conditions. Excludes. Government grant excludes two things. What are those? Those forms of assistance that cannot be valued. When you can't value the grant, assistance given by the government, that cannot be government grant. Or a transaction that cannot be distinguished from the normal trading transactions. When you do any transaction with the government, so which cannot be distinguished from the normal trading transaction. That means like a normal regular course of the business, you have done some transaction with the government. So that cannot be considered as government grant. Okay. Next, what is the accounting treatment of government grant? Sir, Accounting Standard 12 has given two approaches, sir. Basically, whenever you receive any government grant, the accounting treatment, there are two kinds of approaches in the standard. One approach is capital approach. Another approach is income approach. Capital approach says when you receive any assistance from the government, when you receive any government grant, okay, you have to treat it as a part of shareholders fund. And income approach says when you receive any grant from the government, treat it as income. So which approach I need to follow, that depends upon the nature of the grant. When you receive any grant, what is the nature of the grant, we need to see. Depending upon the nature, we need to do the accounting treatment. Whether I will follow capital approach or whether I will follow income approach. Whether I will treat the government grant as an income, I will credit to P&L account as an income, or whether I will treat the government grant as a part of shareholders fund. That means it is part of reserves and surplus. So the grant is treated as part of shareholders fund, suitable for grants similar to promoters contribution. So as a promoter, whatever I contribute for my business, so it is like government grant is also treated like that. So that is called capital approach. Income approach says the grant is recognized as an income over one or more periods, typically used for other grants, other types of grants. Sir, what are the arguments in favor of capital approach? What are the arguments in favor of income approach? Simple, sir. When government is giving any grant to you, if they put any conditions, and to fulfill those obligations or conditions, if you are going to incur any expenses, then you can treat the grant as what? Income. Because income means what? Income is something which is earned. You are earning this amount subject to fulfillment of conditions or already conditions were fulfilled. Therefore, the grant is income and the expenses you are going to incur to fulfill the conditions attached to the grant, the corresponding expenses. So obviously, there is a income means there must be expenses. But capital approach says, when you receive something from the government which is freely, graciously, there is no conditions attached to it, then generally we say these are the grants in the nature of promoters contribution. Like a promoter, so who brought capital to the organization, government is giving something which is very gracious in nature, they are not expected us to repay it back. So therefore, which approach you follow, that depends upon the nature. So the choice of approach depends upon the nature of the grant. Nature of the grant. So whether I will treat the grant as income or capital, so that depends upon the nature of the grant. Okay, but trust me, sir, next I'm going to explain you the accounting treatment of government grants. So when I'm explaining the government grant, sir, you are not supposed to think about this capital approach, income approach. Automatically you will understand. Next, recognition of government grants, sir. Okay, sir, when as a business enterprise I have to recognize the government grant in my books. Sir, Accounting Standard 12 says there are two conditions must be satisfied to recognize the government grant. First of all, there must be reasonable assurance that you are going to receive or you are going to fulfill the conditions attached to the grant. Second of all, there must be a reasonable assurance that the grant will be received. So, two conditions must be there. There must be a reasonable assurance that you are going to fulfill the conditions attached to the grant. For example, sir, you are A Limited, sir. Now government wants to give a grant of 50 lakhs to you, cash assistance. Now, when can I recognize this 50 lakhs in my books? So, government has put some conditions, sir. The condition is, in the next 5 years, you need to provide 10 jobs per annum. Every year, you need to provide 10 jobs. Like that, 5 years, you need to fulfill 50 jobs. You have to create 50 jobs. This is the condition attached to the grant. Now, whenever organization wants to recognize these 50 lakhs in the books of accounts, there must be a reasonable assurance that whether we are going to fulfill the conditions attached to the grant or not. That means top management has to take a call whether we are going to fulfill these conditions, these 5 conditions that every year we are going to fulfill 5 new job opportunities will be able to create or not. If the top management is reasonably assured that yes, definitely we are going to create this, so then first condition is satisfied. Sir, whether reasonable assurance that we are going to fulfill the conditions attached to the grant is sufficient? No. Second thing is that there must be a reasonable assurance that you are going to receive the grant, or the reasonable assurance that the grant will be received. Sir, we have a reasonable assurance that definitely we are going to fulfill the conditions, sir. That is not sufficient, sir. Actually, there must be a reasonable assurance that you are going to receive the grant also. So, government grant is recognized only when there is a reasonable assurance that enterprise will comply with the conditions attached to the grant. And there is a reasonable assurance that the grant will be received. And here, one more important point, sir. Suppose you received the grant, sir, but you don't have the reasonable assurance or confidence to say that we are going to fulfill the conditions attached to the grant. Then the standard says don't recognize the government grant, because both the conditions must be satisfied. Whenever you want to recognize any government grant in the books of accounts, there must be a reasonable assurance that you are going to fulfill the conditions attached to the grant. So therefore, receiving a government grant does not automatically mean the conditions have been or will be fulfilled. Suppose in your bank account, company bank account, 50 lakhs were credited. So since amount is credited, that means government has trusted us. So therefore, can I recognize government grant in my books? Whether government is trusting you or not doesn't matter. What is accounting standard 12 is saying, sir? Standard says government grant will be recognized only when there is a reasonable assurance that you are going to fulfill the conditions attached to the grant. So that means if you receive a government grant, fine, but first condition must also be satisfied. You should have the reasonable assurance. Your top management must be assured that yes, we are going to fulfill the conditions attached to the grant. Then only government grant will be recognized in the books. For example, see, sir, X Limited applies for a grant from a local authority for a social cause. Okay, the grant is conditional and X Limited has a reasonable assurance it will receive the grant. However, if there is an uncertainty about the meeting the conditions of the grant, X Limited should not recognize the grant until it is certain it can fulfill the conditions. So this is about recognition of government grant. The next, the remaining standard is different types of grants, sir. First, non-monetary government grants. When you receive any kind of non-monetary grants other than monetary in the form of assets. Next, presentation of grants relating to specific fixed assets. Then presentation of grants related to revenue, and presentation of grants in the nature of promoters contribution. So in different situations, different nature of grants when you receive, what will be the accounting treatment? So that is the next thing, sir. So see this, I will discuss from my class notes book. So see this, accounting of government grants, sir. Basically, government grants can be divided into 2 categories. You follow this chart, sir. Easily you can understand the accounting treatment of government grants. Government grants are basically divided into 2 categories, sir. One is monetary grant, another one is non-monetary grant. Monetary grant means cash. Non-monetary means other than cash, like land, plant and machinery, etc. First, we will talk about non-monetary grants. See, when government has given any non-monetary grant to you, that means any kind of asset. For example, government has given a land, government has given a plant and machinery. So non-monetary, that means other than cash. It is given in the form of kind, asset. Here 2 possibilities, sir. One thing is, these assets can be given at free of cost, or these assets can be given at a concessional price. So assets are given at free of cost, assets are given at a concessional price. Assets are given at what? Free of cost, sir. Assets are given at concessional price. Suppose government has given a land, okay, worth of 5 crores freely. That is called non-monetary grants given at free of cost. Now the standard says whenever you receive any asset from the government at free of cost, then you need to recognize the asset at its nominal value. Some immaterial value you can recognize. So assets are recognized at a nominal value. Assets are recognized at nominal value. For example, land given freely. When land is given freely by the government, what is the entry? Land account debtor to government grant. That is nothing but it is transferred to capital reserve. Capital reserve. Because entire asset we have receiving freely now. So land account debtor to government grant. That is nothing but created to capital reserve. 100. Some values, sir, we need to recognize at nominal value. Nominal value could be 100, maybe 10, maybe 1000. Some immaterial value. Suppose when you receive any government grant, non-monetary asset at a concessional price, then these assets are recognized at acquisition price. For example, sir, there is a land whose market value is 10 crores, but government given this land at 8 crores. So that means 2 lakhs concession they have given, right? So here government given you at a acquisition concessional price, then you need to recognize at acquisition price. So what is the acquisition price here? Land account debtor to bank, 8 crores, 8 crores. So this is the first non-monetary grant, sir. So in non-monetary grant means assets, sir. There are two situations here. Government can given you assets free of cost or at a concessional price. When government has given any asset at free of cost, you need to recognize at nominal value. So land account debtor to capital reserve in this case. Suppose government has given anything, any asset at a concessional price, then you need to recognize at acquisition price. What is the acquisition? Acquisition price means the price at which you have received the asset. Next is monetary grant, sir. Monetary grant means cash. Now these monetary grants are divided into 3 categories. Sir. One is grants related to fixed assets. Suppose you are purchasing fixed assets, sir. Government is giving some cash to you to purchase the fixed asset, to acquire the fixed asset. For example, you are purchasing plant and machinery, and out of the total cost of the plant and machinery, certain portion is given by the government in the form of grant. That is called monetary grant related to fixed assets. Grants related to fixed assets. Second, grant related to revenue expenditure. Sometimes to meet any expenditure, government may give you some grant. That is called grants related to revenue expenses or revenue nature. Third one, grants in the nature of promoter's contribution. When government is given something which is in the nature of promoter's contribution, so that is another category. So there are 3 categories here: monetary grants, grants related to fixed assets, grants related to revenue, grants in the nature of promoter's contribution. First one, grants related to fixed assets, sir. See, whenever you receive any cash from the government for acquisition of fixed asset, first you need to see whether that fixed asset is a depreciable or non-depreciable. So depreciable or non-depreciable asset you see, sir, first. If it is a depreciable asset, accounting standard 12 says there are 2 methods for accounting of government grant. One is deduction method. Another one is deferred income method. In deduction method, sir, whatever the grant you received in respect of the fixed asset, you reduce from the cost of the fixed asset. You reduce directly from the cost of the fixed asset. In deferred income method, sir, whenever you receive any government grant relating to fixed asset, you need to credit the grant received to deferred income account and transfer this to P&L account over the life of the asset in proportion to its depreciation. So here government grant is reduced from the cost of the asset in deduction method. In deferred income method, government grant received is credited to deferred income and transferred to P&L account over the life of the asset in proportion to depreciation. For example, you are purchasing a plant and machinery, sir. The cost is 10 lakhs. Government grant you received 2 lakhs and the life of the asset is 5 years. So tell me, first when you are acquiring the plant and machinery, what is the entry? Plant and machinery account debtor to bank account. Next, when you receive the government grant, you reduce directly from the cost of the asset. Therefore, bank account debtor to plant and machinery. See this. Plant and machinery was reduced by government grant 2 lakhs. Now, therefore, what is the revised cost of the asset? 8 lakhs. 8 lakhs divided by 5. That means 1.6 lakhs is the depreciation per annum. Now second case, deferred income method. Sometimes whenever you receive any grant relating to fixed asset, if it is a depreciable asset, whenever whatever the grant you received, what you can do is you can transfer to deferred income. That means you cannot credit directly to P&L account at a time. First you transfer to deferred government grant account or deferred income account, and then credit this deferred income, deferred government grant to P&L account over a period of time in proportion to the depreciation. For example, here for acquisition of plant and machinery to bank. And for receipt of government grant, will you directly reduce from the cost of the asset? No. See this, bank to deferred income, deferred government grant account. Then when you provide depreciation will be provided on the original cost, 10 by 5, 2 lakhs, 2 lakhs. And transfer this deferred government grant to P&L account. So deferred government grant to P&L, that is 2 crores divided by 5, 0.4, 0.4. So ultimately the net effect is same under both the methods. Suppose here, when you reduce the government grant from the cost of the asset, sir, what will be the depreciation per annum, sir? 1.6. 1.6 lakhs is charged to P&L account. In second method, suppose if you treat the grant as deferred income method, so how much you have credited to P&L account as a depreciation? 2 lakhs. But how much you have debited depreciation to P&L? 2 lakhs. How much you credited deferred government grant? 1.6. So the net is what? How much? Sorry, 0.4 you credited deferred government grant. So the net is 1.6, which is same. So therefore under both the methods, sir, the net effect is same. Okay. So whenever you receive any government grant relating to depreciable assets, there are two methods available. One is deduction method, another one is deferred income method. In deduction method, you reduce the grant directly from the asset. The remaining asset value is depreciated over the remaining life. Suppose in deferred income method, whenever you receive any government grant, you credit to deferred government grant account and you transfer to P&L account over the asset life in proportion to the depreciation. So the ultimately what happens is the net effect on the P&L account is same under both the methods. This is in respect of what? Depreciable assets. Suppose non-depreciable assets, sir. Suppose we have received any grant from the government to purchase a non-depreciable asset. For example, we are purchasing a land. Cost of the land is 1 crore. Now government has given 20 lakhs for us. 20 lakhs cash to purchase the land. That means these are the grants relating to which assets? Non-depreciable assets. Monetary grant which is received in respect of non-depreciable asset. So here also two conditions, two things, sir. When you receive any grant relating to non-depreciable asset, whether any conditions attached to the grant or not. Suppose no conditions to be fulfilled, then simply grant will be credited to capital reserve. Directly whatever the amount you received now, you credit to capital reserve. Because no conditions to be fulfilled, you are purchasing a asset. In respect of that asset, some amount you have received from the government. So therefore bank account debtor to capital reserve. Suppose if there are conditions to be fulfilled, government has put some conditions. So in that situation, whatever the grant you are receiving, sir, you credit to deferred government grant account and you transfer to P&L account over the period of time. Okay, in proportion to the cost to be incurred to fulfill the conditions. In this case, government grant received is credited to deferred income and transferred to P&L account over the period in proportion to the cost to be incurred to fulfill the conditions. So in the first case, suppose you are purchasing a land, cost 10 lakhs, sir. You have received a grant of 2 lakhs, no conditions. So simply land to bank and bank account debtor to capital reserve. So when you purchase land to bank account, 10 lakhs, 10 lakhs. When you receive a government grant, bank to capital reserve. Suppose in the second case, so land cost is 10 lakhs, government grant 2 lakhs. Conditions, company need to provide 5 new jobs every year in the next 3 years. So the cost of the new job is 1 lakh per annum. Therefore, bank account debtor to deferred government grant 2 lakhs, 2 lakhs, and this 2 lakhs every year we need to credit to P&L account in proportion to the cost which we are going to incur. That means equally over the next 3 years. Therefore, 2 divided by 3. So every year 0.67, 0.67, 0.67 we need to credit to P&L account. This is grants which we received in respect of fixed assets, sir. Depreciable, non-depreciable. So can you tell me what is the conclusion? Whenever you receive any grant from the government relating to fixed assets, first you need to see whether it is depreciable or non-depreciable. If it is depreciable, two options are available. Either you reduce from the asset value or you transfer to deferred government grant and credit to P&L account over the life in proportion to the depreciation. In respect of non-depreciable asset, whether any conditions attached or not, you have to see. If no conditions attached, then directly transfer the grant to capital reserve. If there are conditions attached, then transfer this to deferred government grant and credit to P&L account in proportion to the cost what we are going to incur to fulfill the conditions attached to the grant. Next is revenue grants. What is this revenue grants? Suppose any amount paid by government to meet expenses like salaries, R&D expenses, etc. Suppose for example, we are doing research, sir, R&D. Now for that some amount is contributed by the government. Revenue grant. Suppose for example, we need to pay salaries to the employees, but the company position is not good. The government has given some cash assistance to meet the salaries of the employees. This is basically what revenue grants, to meet any kind of expenses. Now here in case of revenue grants, sir, we have two choices. Either the grant received is deducted from the related expenses, or it may be shown as other income in the P&L account. For example, our company is A Limited, sir. Our salary per annum is 10 lakh rupees. Now we have received a government grant to meet the salary expenses 5 lakh rupees. So therefore, what is the entry we will write? First, when we pay the salary, what is the entry? Salary to bank, 10 lakhs, 10 lakhs. And then for receipt of the grant, bank account data to salary, 5 lakhs, 5 lakhs. That means the salary received is directly adjusted from the expenses. So in the P&L account, salary 10 lakhs, government grant 5 lakhs. So net amount 5 lakhs we will show. Or else there is other way. Whenever you pay the salary to bank. Whenever you receive a grant, bank account data to government grant account. 5 lakhs, 5 lakhs. You credit directly to P&L account. So in the P&L account, credit side, other income you show 5 lakhs, government grant, salary 10 lakhs you show. So which one you need to follow, you take a choice. Either government grant received can be directly reduced from the expenses, or it can be shown as other income in the P&L account. Now sometimes, sir, you receive any government grant to meet, see, current year expenses. This is, suppose already you met some expenses in the past year, sir. Now government has given a compensation to you for the expenses you already met. Government grant is received as a reimbursement for past year expenses. Suppose last year I incurred some expenses, sir. Now as a reimbursement, government has given back that amount to me. For example, we spend 10 lakh rupees. So 10 lakh rupees on the corporate social responsibility. Imagine example. Now government said this 10 lakh rupees we will give refund to you. We will reimburse to you. So refunded it. Now therefore, this 10 lakhs, whatever the amount we spend in the past years, we have received it back from the government in the form of government grant. Now simply transfer this to capital reserve, bank account data to capital reserve. And sometimes, sir, you may receive government grant to meet multiple years expenses. See, when you receive any grant to meet any particular year expenses, either the grant received is directly reduced from that year expenses or treated as other income. Suppose when you receive any government grant to meet expenses for the multiple years, then what we need to do? Simple. Whenever government grant is received, we will transfer that to deferred government grant account. Later on, this deferred government grant either will be directly adjusted from the salary or we will be transferred directly to P&L account. For example, we have received a government grant to meet a salary expenses for 3 years. Okay, 20 lakhs. Now when we receive a grant, what is the entry? Bank account data to deferred government grant 2020. And every year out of this 20 deferred government grant, either we will adjust to salary account or directly created to P&L account. So that means when you adjust directly from the salary in the P&L account, salary 10 minus government grant 6.67, net 3.33 we will show. Or else you can follow other way, that is salary income, salary expenses you will show at gross amount and government grant received will be transferred to other income in the P&L account. Whatever be the treatment you want to follow, you can follow. So this is grants, revenue grants, sir. So what is revenue grant, sir? Any grant which is received from the government to meet any expenses, salary or R&D expenses. Now there are two choices. Either you reduce from the concerned expenses or you show it as a other income. Sometimes for the past expenses you incurred, government has given something, a reimbursement as a past expenses, directly transfer it to capital reserve. Because see, already expenses were incurred. That means last year expenses were recognized. Now for the expenses you have incurred, there is a reimbursement. So obviously that is a capital nature profit. So that's why it is allowed to transfer to capital reserve. Now sometimes if you receive any revenue grant to meet multiple years expenses, then you transfer to deferred government grant. Next year proportionately you either adjust to the particular expenses or you credit to P&L account. Next, government grants in the nature of promoter's contribution. Sir, promoter's contribution, here what is promoter's contribution is when you receive any government grant in respect of total capital investment or total capital outlay. Suppose you are setting up of a factory in a backward area. So government has given some assistance. So government has given some cash to set up this project. That is called grants in the nature of promoter's contribution. So when you receive something, amount received from the government with respect to total capital outlay. Suppose you are setting up of a factory in a backward area and ordinarily no repayment is expected. Those types of grants are called grants in the nature of promoter's contribution. So what we need to do? We need to transfer to capital reserve. So bank account data to capital reserve. So whenever you receive any grant in the nature of promoter's contribution, bank to capital reserve. And finally, refund of grants. Suppose, sir, if you are failed to fulfill the conditions which is attached to the grant, then obviously you need to refund the grant to the government. So what is the accounting treatment of grant? Simple, sir, reversal. Suppose when you receive the grant, you adjust it from the asset. Now you need to add back to the asset. That means fixed asset account data to bank. Suppose when you receive the grant, you transfer to deferred government grant. Now when you are giving the refund, whatever the unamortized balance in the deferred government grant, first you need to adjust it. Remaining balance we need to transfer to bank or P&L account. Remaining balance we need to transfer to P&L account. Suppose when you receive the grant, you have created to capital reserve. Now you debit to capital reserve. So there are only three possibilities now. Either when you receive a grant, you adjust it to the asset. Now you add back to the asset. Or when you receive the grant, you transfer to deferred government grant and every year you create it to P&L account. Now whatever the unamortized balance is there at the time of refund, you just reverse it. And you are giving refund in excess of the unamortized balance that will be debited to P&L account. And when you receive a government grant, you have created to capital reserve, now debit to capital reserve. So that is the accounting treatment. See this. If government grant is created to capital reserve, now debit to capital reserve when you are refunding. So that is capital reserve to bank. When government grant received is transferred to deferred government grant. Now deferred government grant, unamortized balance. Suppose you are refunding 10 lakhs. And the unamortized balance in the deferred government grant is 6 lakhs. So what is the balance? 4 lakhs. That is debited to P&L account. And see, when you receive a grant, you have adjusted to the asset. Now, you add back to the asset to bank. Okay. So this is the accounting standard 12, sir. And finally, disclosure, sir. In respect of accounting standard 12, you need to disclose what is the accounting policy adopted by the company in respect of government grants, including what are the methods of presentation we followed in the financial statements. And also we need to disclose the nature and extent of government grants. Disclose the nature and extent of government grants recognized in the financial statements, including non-monetary assets given at concessional rate or free of cost. So that's it, sir. This is accounting standard 12, sir. So predominantly all the points I have covered, sir. So you see this ones, and questions also, very simple questions are there in the study material, sir. Nothing, I think you can easily solve all these questions. So you listen to this 40 minutes video and you try to solve the questions. I think all questions will be solved, sir. Okay. Accounting standard 2, sir. Valuation of inventories. Accounting standard 2, valuation of inventories. Basically, sir, accounting standard 2 will provide you the guidelines for determination of value of inventories. This standard will provide the cost formulas also to determine the cost of inventories. Sir, why valuation of inventories is important? Because you know, when you are preparing the financial statements of a company, you take balance sheet or P&L account. You are showing items relating to inventory. Suppose you take balance sheet of a company, sir. Asset side, current assets. In current assets, you are showing inventory value. Imagine if you are unable to determine the value of inventory properly, what happens? Your financial statements are not reflecting true and fair view. And also take P&L account, expenses side, cost of materials consumed, change in inventories of finished goods, work in progress, stock in trade. You know, the items relating to inventories are directly impacting my financial statements. So if I don't determine the value of inventories properly, my financial statements are not reflecting the true and fair view. So to ensure inventories are valued properly and to enhance the true and fairness of financial statements, so they brought accounting standard 2. That's why we need to learn accounting standard 2 and its principles for determination of value of inventories. So basically AS2 provides what? Guidance on how inventories should be measured, valued in the financial statements, including the cost formulas used. This standard will give you the formulas also, cost formulas also, FIFO method, weighted average cost method, like that it will provide you some cost formulas also to determine the cost of inventories, which we will see in the later part of this standard. Next, inventories. Sir, what is inventories first of all as per accounting standard 2? See, the inventory definition has 3 parts. First one, inventories are assets held for sale in the ordinary course of the business. Inventories are basically assets, sir, which is held for sale in the ordinary course of the business. Suppose if I am a furniture dealer, I kept furniture for sale in the ordinary course of the business. So it is my inventory. Suppose for example, I have one medical shop. In that I kept medicines for sale in the ordinary course of the business. So that is my inventory. Suppose if I am a car manufacturer, I manufacture car for sale in the ordinary course of the business. Sir, it is not once in a while, sir. It is my ordinary course of business. In the ordinary course of the business, what I kept for sale, that is my inventory. A kind of a finished goods. Finished good, I kept for sale in the ordinary course of the business. So that is my inventory. Or in the process of production for sale. Anything which is in the process of production, in the semi-finished stage, work in progress stage. For example, I am manufacturing calculators. So at the end of the year, 1 lakh calculators are in work in progress stage. They are also my inventory. And also anything for consumption in the production of goods or services. Suppose if I am a manufacturer, anything I consume in the production of goods. And suppose if I am a service provider, any materials I kept for consumption in my services, they are also my inventories. For example, you look at this diagram. See, in the factory, lot of lubricants, small equipments, they will consume in the production process. Loose tools, they will consume in the production process. They are also inventories. Or suppose for example, if I am a service provider, imagine suppose for example, I am in education and training services. So I am an educator. So to provide my teaching services, I use teaching materials like papers, pens, markers, chalk piece, whiteboard wipes, and other cleaning supplies for classroom maintenance. And also student supplies like books, handouts, and study materials. And also technological resources I required like ink for printers, photocopiers, computer accessories, cables, other consumables used in training setups. Or for example, I am providing beauty and personal care services. In providing my services, I required lotions, oils, creams, shampoos, hair dye, nail polish, other beauty treatment products. And also I need cotton pads, tissues, makeup remover wipes. All these things were what? Nothing but my inventories, which are I kept for rendering my services. And also for example, I am a Blinkit. So Blinkit for delivery of their services. So paper bags they use, plastic bags, box, labels, all these things they are using. So they are also inventory. So therefore the definition of inventory not only covers a manufacturer but also service provider. If you are a service provider, for providing your services, whatever the materials you are consuming, so whatever the materials you held for consumption in the production of goods or services, that is also your inventory. So therefore inventory definition has 3 limbs. First, anything held for sale in the ordinary course of the business is your inventory. And also in the process of production for such sale, anything is in the semi-finished stage, work in progress stage at the end of the year, that is also your inventory. Or anything you consume in the production of goods. In the production of goods, what you are consuming? You are consuming small equipment, loose tools, lubricants, oils, so molds, dies, jigs, features, all these things you are consuming, they are also your inventory. And suppose if you are a service provider, for providing your services, you consume some materials, they are also your inventories. So this is inventory definition, sir. So understand the scope of this definition. And types of inventory, sir. See, actually, sir, types of inventory means, if I am a manufacturer, sir, I will manufacture the items, right? So for me, raw material, work in progress, finished goods. Like this, inventory is in three forms. Like first I will purchase raw materials, and at the end of the year, I will put this raw material into the production process. Now some of the goods, some of them in the work in progress stage, and those which are completely finished, they are called finished goods. So first raw material is converted into work in progress, then finished goods. So therefore, if I am a manufacturer, sir, for me, there is finished goods, there is work in progress, there is raw material, there is any consumables which I consume in the production of goods. Suppose, sir, if I am a trader, if I am a trading concern, trader means I am not doing any manufacturing. I will just purchase and sell. I am a dealer kind, for example. I will purchase the items from the manufacturer and I will sell. So for me, there is no raw material, there is no work in progress, there is no finished goods. For me, what is there is stock in trade. Stock in trade. Anything I kept for purchase and sell in the ordinary course of the business as a trader, that is my stock in trade. Okay. So types of inventories includes goods which is purchased for resale. So any merchandise, land or property for resale. For example, I am a real estate company. I will purchase and sell the land. For me, this land is what? Inventory. Or if I am a manufacturer, finished goods, work in progress, materials are supplied, which is relating to production. And exclusions from inventory, sir. Sir, spare parts, servicing equipment, standby equipment, which are classified as property, plant, equipment as per AS 10. They are not covered under AS 2. If they don't satisfy the definition under AS 10, then they will come under accounting standard 2. For example, spare parts, sir. What is this spare parts? Suppose, for example, you have a large plant and machinery, sir. You have one plant and machinery. Okay. One plant and machinery is there. In this plant and machinery, there are small parts which need to be replaced regularly. Otherwise, this plant and machinery will not work. So therefore, what we have done is, we have purchased the spare parts and we kept it in the factory. Now, whether those spare parts which is replaced or which is used in the plant and machinery, whether it will be inventory? See, the answer is, if the spare parts are satisfying the definition of PPE as per AS 10, then classify under AS 10. If they are not satisfying, then treat it as inventory. And any servicing equipment, any service equipment which we use in the factory, so if they satisfy the definition of AS 10, then classify under AS 10, otherwise AS 2. And also standby equipment. Any standby equipment you kept in the organization, spare equipment, extra equipment. So because the existing equipment may fail at any point of time, we don't know. So that's why we purchased a standby equipment and we kept the standby equipment. Whether this standby equipment is inventory or PPE. So simple, sir. If they satisfy the definition of PPE, go there. Otherwise, AS2. Next, types of inventories by business. Just now I told you, if I am a manufacturer, I have raw materials, work in progress, finished goods, and also consumables, supplies, all these things. If I am a trader, for me, whatever the products I kept for resale, like for example, wrapping papers, cartoons, and stationery. For example, if I am a trader, sir, so whatever the items I purchase and resale. See, at the time of resale, for providing my services, whatever the materials I am consuming, like Blinkit. See, Blinkit is purchasing items from the manufacturers and they are selling to the customers. When they are delivering the goods to the customers, they are delivering in a bag, na? So cotton bag or maybe paper bags. So all these paper bags they are purchasing, na? They are also inventories. Because I told you in the inventory definition, so inventories are not only items which is held for sale or in the process of production for sale. Anything you consume in the production of goods or services for sale is also covered under the definition of inventory. So understand the scope of definition of inventory, sir. Very, very important. So therefore, sir, if you see comprehensively, this definition of inventory not only covers the manufacturer, sir. Even if you are a service provider, whatever the items you consume for providing your services, they are also inventory, sir. That is the important point you need to understand here. And scope of the standard, sir. Sir, accounting standard 2 has some exclusions. This standard does not applicable in the following cases. There are 4 exclusions from the standard, sir. For these situations, AS2 is not applicable. Always, sir, specific versus general. Specific versus general. See, when you have a specific standard, always follow that. Don't follow the general standard. So, first one, if you see construction contracts, any work in progress under construction contracts, including any related service contracts. Suppose if I am a construction contractor, whatever the projects I am undertaking, those are covered under AS7. So therefore, for me, accounting standard 2 is not applicable, because for me, AS7 is a specific standard. And also any related service contracts, any contracts directly related, any service contract directly related to the construction, like for example, services of a manager, services of an architect, services of a project manager, directly related to the construction business, they are also covered under AS7 only. If you read accounting standard 7, sir, they clearly said even the contracts, service contracts which is directly related to the construction is also part of the construction contract, and accordingly AS7 is applicable. Therefore, any service, any construction contracts in work in progress, and also any related service contracts relating to directly to the construction, they are not covered under this standard. And also, sir, suppose if I am a service provider, any work in progress in the ordinary course of business for service provider. For example, I am providing you the consultancy services. At the end of the year, whatever the consultancy services which is in work in progress stage, how I need to value it? Can I follow AS2? Answer is no. This standard basically does not cover services. And also, suppose if I am providing software development services, any kind of service you take, this is not covered under this standard. Example, shipping services, software development services, any consultancy services, they are not covered under this standard. And also, sir, if I am if I am held any shares, debentures, any securities for sale in the ordinary course of the business. So, shares, debentures, other financial instruments held as stock in trade. Which if any shares are held for stock, held as stock in trade, any debentures or any other financial instruments, for me AS2 is not applicable. Because for financial assets, there is a separate standard. Accounting standard 13 is there. So there we will follow. And the last one, very, very important one is this one, sir. See, listen to me carefully. This standard says, sir, producers' inventories of livestock, agriculture and forest products, minerals, to the extent if they are measured at net realizable value, then this standard is not applicable. So producers' inventories of livestock, animals, livestock, agriculture and forest products, any agriculture products, paddy, jowar, wheat, so all these agriculture, forest products, maybe bamboo, honey, so all these agriculture and forest products, and minerals, any kind of minerals. Generally, they are measured at NRV as per the industrial practices. As per the industrial practices, sir, these items generally measured at net realizable value. Because see, for these items, livestock, agriculture and forest products, minerals, so for these products, sir, what is the current relevant price? That is what most important. So generally, these items are valued at net realizable value only. Now the standard says, if these items are valued at a net realizable value based on the industrial practices, then don't apply accounting standard 2. Because see, accounting standard 2 basically, believes one principle, sir, that is cost or NRV, whichever is lower. That means you compare the cost with NRV, whichever is lower you take. That is the value of inventory as per AS2. AS2 is the classic example for prudence concept. Because how, I will tell you, wait. But since you are valuing these items at net realizable value as per the industrial practices, see this, we have separate industrial practices are there in that particular industry. These items are generally valued at their NRV. So therefore, we don't want to disturb you. Since you have an established practice of valuing them at NRV, you follow them. So no need to comply with accounting standard 12, but accounting standard 2. But remember guys, If you are not valuing them at NRV, then obviously you need to apply this standard. To the extent you are valuing them at NRV, these items, then this standard is not applicable. And also you need to understand, you should be the producer of these inventories. You should not be the middleman. You should be the producer. That means you are the producer of this livestock, agriculture, forest products, minerals. Directly you engaged in this business. Only for him only these things, to the extent they are measured at net realizable value, this standard is not applicable. So there is a question possible from this. So remember, producers inventories, producers inventory of livestock, agriculture products, forest products and minerals, if they are measured at net realizable value based on the industrial practices, this standard is not applicable. Okay. Now, most important part is measurement of inventories. Sir, how inventories will be measured, sir? See, generally this standard says inventories are measured at cost or NRV, whichever is lower. That is the principle, sir. Inventories are measured at what? Cost or NRV, whichever is lower. Cost or NRV, whichever is lower. Net realizable value, whichever is lower. See, cost or NRV, whichever is lower. This is the classic example for prudence concept. This standard is the classic witness, sir, prudence concept. For example, sir, you take cost 100, NRV 110. That means the asset net realizable value 110 if I sell it in the market. So whichever is lower I am taking, that means I am taking 100 only. I am not taking 110. That means I am not anticipating the 10 rupees profit. Even though I can sell it in the market at 110, but I am not anticipating profit. Or for example, the cost of inventory is 100, sir. Cost is 100 and net realizable value is 90. Whichever is lower, that means I will take 90 only. I will take 90 only. That means I am recognizing the loss. I am reducing the inventory value from 100 to 90. So what is prudence, sir? Prudence means anticipation of all possible losses but not profits. That is what exactly I am doing now. When my NRV is less than cost, I am reducing my inventory asset value by asset value to its NRV. That means 100 I am bringing into 90. So 10 rupees is my loss. I am recognizing it in my books. I am reducing the inventory value by 10. Suppose when NRV is more than cost, I am ignoring it because I am taking whichever is lower. Therefore, I am not anticipating profits, but I am anticipating all the possible losses. That's why this principle of inventory valuation is supporting what? Prudence concept. So importance of inventory valuation, sir. The valuation of inventory affects P&L account. In the beginning itself, I told you. A higher closing inventory value lowers the cost of goods sold, increasing the profit. See, suppose for example, if you are increasing the value of closing stock, what happens, sir? Obviously, your gross profit, obviously your net profit will increase, sir. And principle of prudence, sir. According to the prudence principle, profit should not be anticipated while foreseeable losses should be recognized. If the net realizable value of inventory is lower than its cost, it is valued at NRV only. If NRV is lower than the cost, we need to value the inventories at NRV only. And if the NRV is higher than cost, then inventory is valued at cost, ignoring the anticipated profits. In short, inventory is valued at lower of cost and net realizable value. So this is the valuation principle of inventories. Cost or NRV, whichever is lower. Okay. Cost or NRV, whichever is lower. Now see, so there are two things we need to determine the value of inventory. One is cost, another one is NRV. First, we will try to understand what is cost. Sir, cost of inventories comprises first cost of purchase, second cost of conversion, third any other cost which is incurred to bring the inventory to its present location and condition. So the cost of inventory comprises three stages, sir, or three elements. One is cost of purchase, sir. Another one is cost of conversion, sir. Another one is any other cost which is incurred to bring the inventory to present location and condition. First, you take cost of purchase, sir. Suppose, for example, you have purchased the inventory, sir. How to determine the cost? Take purchase price, add all the taxes and duties which must be non-refundable in nature, and any other expenditure which is directly related to acquisition, like for example freight cost, maybe octroi cost, loading cost, unloading cost, whatever directly attributable to the acquisition of inventory, add back, minus any trade discounts, rebates, duty drawbacks, any discount given by the supplier, trade discount, rebates, duty drawbacks, any other similar items, deduct it, then you will get the cost of purchases. Cost of purchase. Next, cost of conversion, sir. Sir, what is cost of conversion? Cost of conversion is nothing but converting your raw material into finished goods. That means there is a raw material, sir. For that, if you apply labor and overheads, then you will get finished goods. That means you put them into the production process, then they will be converted into the finished goods. So therefore, cost of conversion means it includes cost directly related to production, such as direct labor and overheads. Overheads can be fixed or variable, incurred to convert the raw material into finished goods. So therefore, see, suppose raw material you purchased. Later, this raw material is put into the production process. Now, in the production process, labor will be involved, overheads will be involved, and finally finished goods will be generated. So, to convert this raw material into finished goods, what are the costs we are incurring? That is called cost of conversion. Cost of conversion. Nothing but direct labor and overheads cost. Next, other cost. Any other cost. See, they are not cost of purchase, they are not cost of conversion. Any other cost. But those costs must be necessary to bring the inventory to its present location and condition. Don't add all unnecessary cost as cost of inventories. So other costs are included in the inventory if they are incurred to bring the inventory to present location and condition. To bring the inventory to its present location and condition, what cost we are incurring? For example, designing cost. To manufacture any particular inventory, so design cost incurred. So that cost is necessary to bring the inventory to present location and condition. So therefore add it. And also interest and borrowing cost. Very, very important. For long-term inventory, accounting standard 16. Sir, accounting standard 16 says any borrowing cost directly related to acquisition, construction, production of qualifying asset is capitalized. That means suppose if you are producing a inventory which is qualifying asset as per accounting standard 16, then even the borrowing cost, that is interest, will be included in the part of inventories. Otherwise, generally interest cost is not should not be considered as a part of cost of inventory, sir. But when inventory is qualifying asset as per accounting standard 16, what is qualifying asset, sir? Qualifying asset means an asset which takes substantial period of time to get ready for its intended use or sale. For example, if I am manufacturing wine, maybe wine may take substantial period of time to get ready for intended sale. Therefore, wine is a qualifying asset. So to manufacture this wine, if any borrowings were incurred, on these borrowings, any borrowing cost is incurred, sir, that borrowing cost will be added to the inventory cost. So therefore, other cost includes interest cost also, provided your inventory should be qualifying asset. That's why here I said long-term inventory. Long-term inventory means qualifying asset as per accounting standard 16. Okay. Next, very, very important, sir. There are certain costs which is excluded from inventory. Standard says there are certain costs which should be excluded from the cost of inventory. That means these costs should not be included in inventory. Rather, they will be charged directly as period cost. That means they will be charged directly to P&L account. First one, any abnormal waste of materials, labor and other production cost. Abnormal waste of materials, labor, other production cost. Abnormal wastage. Normal wastage, no problem, sir. We can't do anything. But what about abnormal waste? Abnormal waste of materials, labor, other production cost. So abnormal wastage, if anything happened in the material, labor, other production cost, don't include in the inventory cost. Why, sir? Why we cannot include abnormal waste? Sir, wastage is your inefficiency, sir. How inefficiency will become your asset? Because inventory is basically an asset. For example, your labor is there, sir, labor. Okay. So, in a day, we have given, 120 minutes break, sir. 120 minutes break we have given to labor. But labor has taken 180 minutes break. That means how many minutes wastage, sir? 60 minutes wastage. Now for this 60 minutes inefficiency, we are paying salary. Now, whether that is also included as a part of cost of inventory, answer is no, we cannot include, because this 60 minutes we can consider it as a abnormal wastage. Of course, if it is normal wastage, not a problem, we can't do anything which is normal as per the business. But if it is an abnormal wastage, how your wastage, your inefficiency will be considered as a part of inventory, as a part of your asset. Therefore, think about it. See, your inefficiency cannot be your asset. Your weakness cannot be your strength. So that's why. So any abnormal wastage of material, labor or other production cost, don't include it. And also next one, sir, storage cost. Sir, for example, materials we stored, sir, in a warehouse. Now, whether the storage cost, rental cost we paid for storage of the inventory, whether it is included in the part of cost of inventories, answer is generally we need to ask whether this storage is necessary. If the storage is necessary for further production, if the storage is necessary to make the inventory, so to bring it to the present location and condition, then it is okay, it can be included. But otherwise, storage cost cannot be included as a part of cost of inventory. If the storage is necessary for further production process, for example, I am manufacturing hybrid seeds, genetically modified seeds. I kept them in the cold storage under certain circumstances. Then only they will be ready for the next stage of production. Then storage cost can be included as a part of cost of inventory. But otherwise, the storage cost shall not be included as a part of cost of inventory. Next, any admin overheads which is not contributing to the inventory condition, and any selling and distribution cost, any marketing expenditure, distribution. For example, we are distributing our finished goods to different shops. Whether the transportation cost, distribution cost also include as a part of cost of inventory? No, because see, we will add only those costs till the inventory is brought to its location and condition. That's it. Once the inventories are ready, later on whatever the cost you are incurring for selling and distribution, any administrative cost, for example, you have office, head office or any office which is the salary you are paying, so to the employees in the administration office, whether those salaries will be included in the production cost, inventory cost, answer is no. So tell me, when you are determining the value of inventories, how many types of cost are there? 3 types of cost. One is cost of purchase, another one is cost of conversion, another one is other cost. Cost of purchase means purchase price, duties and taxes, other expenditure which is directly attributable to the acquisition, minus trade discounts, rebates, duty drawbacks, less other similar items. Cost of conversion means the cost which we incur to convert the raw material into finished goods, that is direct labor and overhead cost, and any other cost which is incurred to bring the inventory to present location and condition. Example, design cost, any interest on borrowing cost, if inventory is a qualifying asset as per A16. But there are some costs which will exclude from the determining the cost of inventories. One is any abnormal wastage, because your inefficiency cannot be treated as your asset. Any storage cost, any administrative cost, and also selling and distribution cost. These costs we should not include as a part of cost of inventories. So therefore, next one, sir, there is one more item, joint products and byproducts, sir. Listen to me carefully. How to determine the cost of joint products and byproducts? First of all, what is joint products? What is byproducts? See, through common production process, if you are able to generate 2 or more products, each with significant market value or presence, they are called joint products. Through common production process, if you can able to generate 2 or more products, so each with a significant value, they are called what? Joint products. For example, you see bread and cake baking. So bread and cakes are joint products, sir. Both are made from the same ingredients, flour, sugar, etc., and have their own value. You go to bakery, for example, how they will manufacture these cakes, bread, same process or production process. They will take flour, sugar, and they will do the processing, and after it reaches to the particular stage, then out of that certain portion will be make as cake, certain portion will be bread will be done. That means through a common production process, so they are able to generate 2 products. Each one is having its own value. Cakes will have its own value, and then bread will have its own value. And also, sir, you take fruit juice production. So for example, orange juice pulp, which is used in the food products. See, suppose for example, both are made from oranges and have a significant value. For example, you are a fruit juice production company, sir. Now you take oranges and you are put them into the production process. Now a point of time you split two things. One is juice, another one is pulp. Even pulp is also we can sell in the food industry, sir. Different food products, this pulp is used. Of course, orange juice can be sold separately. That means orange juice, food pulp, full pulp. Both are significant items generated from the common production process. So that can be joint products. Or for example, crude oil refining. Both are produced from crude oil and are valuable products like gasoline and diesel. Gasoline and diesel both are generated from what, sir? Common production process. They are processing of the crude oil. They will be generated. So they are called what? Joint products. So in the production process, if you are able to generate two or more products, each one have its own value. They are called joint products. They are called what? Joint products. Then what is byproduct, sir? See, byproduct means through a common production process, you are able to generate two or more products, but only one of them is the major product. Another one is not major product. It does not have that much value. It can be sold only as a scrap. It can be sold as a scrap. Okay. For example, you see, fruit juice production, byproduct is fruit peel. So leftover fruit juice extraction can be used in making jams or as animal feed. Or crude oil refining. Suppose for example, if you refine the crude oil, you will get tar. So tar is what's the byproduct. Okay. So therefore, byproducts, joint products, sir. And in case of joint products, first, sir, joint products, what we need to do? In case of joint products, sir, see this. Suppose this is the production process. At this point of time, split up happened. So whatever the cost we incurred in this production process, this is called common production cost. So whatever the cost we incurred up to the split of point of time, it should be allocated between the joint products based on any consistent and reasonable method. You select the method. What is the best method to allocate? You select it. Maybe based on the sale value of these products. So whatever the different bases are there, sir, you can use those bases for allocation of common cost between the joint products. So in case of joint products, what we need to do is whatever the cost you incurred up to the split of point should be allocated using consistent method. Example, based on the sale value at split of point. Maybe based on the, for example, you see, suppose for example 1,000 rupees we incurred in the common production process. Now we able to generate two products, product X and product Y. Now between product X and Y, you allocate this common production cost. How you are allocating? Maybe based on the cost you incurred, maybe based on the sale value, maybe based on sometimes after further processing they can be sold in the market. So maybe based on the sale value after further processing or any other method. So see this, joint cost is allocated based on sale value at split of point or sale value after further processing or maybe sale value after further processing minus further processing cost. Now, so what about byproducts, sir? If you generate any byproducts, sir, what you need to do is whatever the amount you generated by sale of these byproducts, it is reduced from the common cost of production, and the remaining value, whatever is there, that is the cost of the main product. So they are typically valued at NRV. So the main product cost is equal to joint cost, that means common production cost minus net realizable value of byproducts, scraps or waste. So therefore, tell me, joint products, byproducts. Joint products, whatever the cost you incur, joint cost, it is allocated between the joint products. On what basis? Maybe based on the sale value of the joint products, or maybe sale value after further processing of the joint products, maybe sale value after further processing minus further processing cost. Whatever the basis you select, whichever is better and consistent, fair reflection, you take it. In case of byproducts, what you need to do? Byproducts, whatever the sale value came, scrap value, that is reduced from the joint cost. The remaining is what cost of the main product. Okay. Now, sir, here one more important point, sir. See, in the discussion we have seen conversion cost. Conversion cost is direct labor cost as well as factory overheads. Overheads cost. See, overheads are basically two types, sir. Fixed, variable overheads. whenever fixed overheads are there, na sir, fixed overheads, normal capacity or actual production. Normal capacity or actual. So when will you use normal capacity? When actual production is almost equal or lower than the normal capacity. Or you follow actual production when actual production is higher than the normal capacity. So in case of overhead, sir, how the cost will be allocated to the inventories? See this. Overheads you take, sir. Any factory overheads we incurred. There are two types of overheads, variable, fixed. You take fixed first. Fixed overheads means they will not change along with the production. Example, factory rent. Now, how you are going to allocate this fixed overheads to inventory cost? Actual or normal, whichever is higher. That means actual production or normal production, whichever is higher. Normal production means with the installed capacity, how many units you can generate. Actual capacity means actually how many units you generated. So you compare both actual or normal. Whichever is higher you take. Whichever is higher you take. In case of fixed production overheads. In case of variable overheads, sir, always based on the actual production. Variable overheads may be fuel cost, power cost, which is incurred in the factory for production of inventories. So when you are ascertaining the cost of inventories, cost of conversion includes labor cost, overheads cost. Overheads are basically two types, variable, fixed. Fixed overheads are allocated based on actual or normal, whichever is higher. Example, factory rent. Variable overheads are absorbed based on actual production. Actual production. Because see, variable overheads are directly related to production. So therefore, they will be absorbed based on actual production. But what about fixed overheads, sir? Actual or normal, whichever is higher. Sir, why whichever is higher? Why can't whichever is lower? For example, sir, you see here. Suppose your factory overheads are 10 lakh rupees, sir. Suppose your normal capacity is or normal production is 1 lakh units. But if your actual capacity is 90,000 units. Okay. Now, standard says whichever is higher. Instead of whichever is higher, if I take whichever is lower, what happens? What is the fixed overhead recovery rate? 10 lakhs divided by 90,000. 10 lakhs divided by 90,000, it is 11.11. That means per unit fixed overhead recovery rate is 11.11. That means how much cost is absorbed into the inventory? How many units you produced? 90,000. Each unit 11.11. That means total 10 lakhs cost you are including in the value of inventory. Correct? If you take whichever is lower. Suppose for example, if you take whichever is higher, what happens is fixed overhead recovery rate is equal to 10 lakhs divided by 1 lakh. That means you will take 10 rupees is the fixed overhead recovery rate. Correct? If you allocate fixed overheads based on the normal capacity, whichever is higher, 10. Therefore, how much cost will be absorbed into the inventory? 90,000 units you produced, each unit 10 rupees. 9 lakhs only absorbed. Look at the difference. Sir, actually your normal capacity is 1 lakh, sir, but you produce 90,000. That means there is a inefficiency, sir. Inefficiency. How can your inefficiency will be treated as your inventory? I mean, as a part of cost of inventory. Actually, your normal capacity is 1 lakh, but you actually produce 90,000. That means there is an abnormal wastage happened in the organization. Because of that abnormal wastage, inventory value should not increase. That's why the standard says whichever is higher you take. Whichever lower you take, you absorb 10 lakhs cost. That means your inventory value increases by 10 lakhs. But if you take whichever is higher, it is only 9 lakhs cost will be absorbed. That means 1 lakh cost will not be absorbed. It will be treated as period cost and it will be charged to P&L account. That is the intention of the standard. That's why standard says in case of fixed overheads, how inventories will be valued, sir? Normal capacity or actual capacity, whichever is higher you take. Whichever is higher you take. Whichever is higher you take. So I have given this example also here. Okay. So this is the concept of allocation of overheads, sir. I covered. Next, cost formula, sir. Sir, the standard says inventories are valued at cost or NRV, whichever is lower. So to determine the cost, there are certain formulas which is given in the standard, sir. So these formulas are, see this. You need to ask one question, sir, whether the inventory items are interchangeable or not. Suppose you are producing large number of similar items. That means inventories are ordinarily interchangeable. Then you follow FIFO method or weighted average cost method to determine the value of inventories. Suppose I am the manufacturer of, for example, calculators. So that means calculators I am manufacturing. Large number of similar items I am manufacturing. That means the inventories are ordinarily interchangeable. Then I need to follow which method? Either I need to follow FIFO method or weighted average cost method to determine the cost of inventories. Because see, in my godown, lot of stock is there. Now this stock is produced in different dates with a different cost. Therefore, at the end of the year, what will be the cost of the inventory? Cost of the closing inventory. I need to follow either FIFO or weighted average. Sir, LIFO is not suggested, sir. Why LIFO is not suggested? Because LIFO method last in first out. That means latest stock you assumed sold first. That means at the end of the year, old stock is there in your books. Old stock is reflecting at old cost, which is not correct now. That's why LIFO is not suggested, because LIFO is not reflecting the current cost of the inventories. Because in LIFO, the assumption is latest stock first out. That means you assume that whatever the latest stock you produced, you sold first. That means at the end of the year, whatever the stock there with you is nothing but old stock. Old stock is reflecting at old cost. How it is reflecting the current cost of the inventory? That's why the standard is not suggesting LIFO. It is suggesting FIFO and weighted average cost method. Okay. And so if the inventory items are ordinarily interchangeable, then you follow FIFO or weighted average cost method. Ordinarily interchangeable means you are producing large number of similar items. Suppose, sir, if the items of inventory are not ordinarily interchangeable, so that means you are not producing large number of similar items, then you follow specific identification cost method. That means you identify the cost of those items separately. For example, luxury cars. A company is manufacturing luxury cars. So will they produce 10,000 cars? Luxury cars, maybe 1 or 2 cars they will produce, or maybe 3 cars. Make luxury brands of watches. So specialized machinery, high value jewelry, diamonds, gold necklaces, all these high value items. Sir, these high value items are there, na sir. They will not be produced in large quantities. The company will manufacture only specific pieces, maybe 2 or 3 pieces. Now they are called inventories, not ordinarily interchangeable. Then in such a situation, how I need to value those inventories? That is specific identification cost method. I need to identify the cost of those items specifically. That's why specific identification cost method. So therefore, cost formulas. You need to ask whether the inventory you produce is ordinarily interchangeable. Yes, you follow FIFO or weighted average cost method to determine the value of inventories, cost of inventories. If the answer is no, then specific identification cost method. Okay. Next. So cost formula, sir. Whichever formula you want, you can choose, sir. That is your organization, depending upon the organization circumstances. And there are other techniques also, sir. Other techniques also to value the inventories. See, apart from these things, there are 2 other techniques are also prescribed to determine the cost. That is standard cost method, retail cost method. So standard cost method, you know, we will take the standard cost of the product and based on that we will determine the inventory value. So standard cost of each product we will consider at the normal levels and we will determine the inventory value. For example, to produce one item, what is the standard cost per unit? 10 rupees and closing inventory is 1000. So therefore our closing inventory value is 10,000. Okay, but primary methods are FIFO and weighted average, sir. If the primary methods are not suitable, then you come to the other methods. Like for example, secondary methods, standard cost method and retail cost method. Sir, this retail cost method, who will follow? Those concerns, those entities which is dealing large number of rapidly changing items. Daily they are changing so many items, inventory is changing rapidly. For them, retail price method is the best method, retail cost method. Like for example, DMart. Now how DMart will value the inventory, sir? How they will determine cost at the end of the year? Very difficult, na, sir. So what they will do is they will follow retail cost method. That means they will take the sale value of the unsold items. From that they will reduce the gross margin. Then you will get the cost of inventory. Important, sir. What is retail cost method? Retail cost method is nothing but sale value of the unsold items minus gross margin. So this is the concept relating to cost, sir. So other techniques of cost measurement is standard cost method, retail method. And then, so we completed the determination of cost, sir. Then NRV, very, very important. How to determine the value of NRV? So NRV means what, sir? Net realizable value. If I sell the asset in the market, inventory in the market, how much amount I am going to get? That is called NRV, right? So suppose, for example, how to determine the NRV, sir? What is the estimated sale price minus what is the cost to make the sales? Then you will get net realizable value. But sir, if you are determining the NRV of the finished goods, then very easy. Estimated selling price of the finished goods minus selling cost. Then you will get NRV. How to determine the NRV of work in progress? Because at the end of the year, we need to find out the cost or NRV, whichever is lower. And work in progress, how to determine the NRV, sir? You need to take the sale price of the finished goods, sir. From that, you need to reduce what is the further cost we need to incur to complete the work in progress into finished goods. And also what is the cost to complete the sale. Then you will get the NRV of the work in progress. And raw materials, how to determine the NRV. Regarding raw material, I will tell you weight. So therefore, how to determine the NRV of the finished goods? Sale price, estimated sale price minus estimated cost to make the sale. How to determine the NRV of work in progress, sir? Sale price of the finished goods you take, sir. Because work in progress does not have ready-made market. Then how will you take the estimated selling price of the work in progress? So therefore, take the estimated selling price of the finished good. From that, you need to reduce what is the further cost we are going to incur to convert the work in progress into finished goods. And also what are the further costs we are incurring to make the sales. So you will get the work in progress, NRV of the work in progress. So you compare the cost, you compare the NRV, whichever is lower, you take it. But when it comes to raw material, sir, raw material, very, very important, sir. Sir, generally, the principle, what is the principle of accounting standard 2? Cost or NRV, whichever is lower. That principle is not correct for raw materials. Why? Because raw material is not meant for sale in the ordinary course of the business. Why you purchase raw material? You want to sell in the ordinary course of the business? Huh? No. You purchase raw material for use in the production, not for sale. Therefore, the standard says raw material valuation will not be done based on cost or NR, whichever is lower. So therefore, the principle is raw material is always valued based on cost. The general principle is raw material is always valued at cost. General principle is raw material is always valued at cost. But there is one exception. The raw material is used in the finished goods. If the finished goods in which the raw material is valued is finished goods in which the raw material is valued or used, the finished goods in which the raw material is used is valued at cost or above cost, then raw material is valued at cost only. If the finished goods in which this raw material is used is valued below cost, then raw material should be valued at replacement cost, provided it is less than the cost. So raw material valuation, very, very important, sir. Understand, sir. Raw material is always valued at cost. But one exception, sir. The raw material, the finished goods in which this raw material is used, the finished goods is valued at cost or above cost, then raw material is also valued at cost only. No problem. Suppose if the finished goods in which this raw material is using is valued below cost, then raw material is valued at replacement cost, provided it is less than the cost of inventories. That means, see, for example, there is a raw material. I am using this raw material in the finished goods. At the end of the year, if I value the finished goods, I will compare cost or net realizable value. Whichever is lower, I will take. For example, in this case, the cost of the finished goods is 100. NRV is 110. Whichever is lower means 100. That means finished goods is valued at cost. Therefore, raw material is also valued at cost. Suppose the cost is 10 rupees. Suppose I have a raw material I am using in the finished goods. Now the finished goods cost or NRV, whichever is lower. Suppose the cost is 100. NRV is 90. That means tell me finished goods are valued at 90, whichever is lower. That means it is NRV. That means raw material finished goods is valued below cost. If the finished goods in which you are using raw material is valued at below cost, that means your value will also reduce. If the finished goods value reduces, that means your value will also reduce as a raw material, because you are using in this finished goods. If the finished goods demand down, then your value will also be checked. Therefore, suppose you see in this case, suppose cost is 10, but right now if I purchase this raw material in the market, the replacement cost is only 9. Therefore, now I need to value this raw material at 9 rupees only. So therefore, raw material is always valued at cost, but there is one exception. What is that? The raw material, the finished goods in which this raw material is used, valued below cost, then raw material is valued at replacement cost, provided it is less than the cost of the inventory. So therefore, the final conclusion is what, sir? Finished goods is valued at cost or NRV, whichever is lower. Work in progress is valued at cost or NRV, whichever is lower. But raw material is always valued at cost. But the raw material, finished goods in which this raw material is used, valued below cost. Then raw material is also valued at replacement cost, provided it is less than the cost. Suppose if the replacement cost is 11, then value at cost only. Cost only. Okay. So that means we have completed the NRV topic also. And then disclosures. At the end of the day, sir, you need to disclose in the financial statements relating to inventories, the accounting policies, what we follow to measure the inventories, including the cost formulas applied, and also what is the total inventory value and classification based on the nature of the enterprise. And also we need to disclose information on inventory classification and changes in their values. Helps the financial statement users to understand inventory trends. That's it. So this is accounting standard 2, sir. Please revise it. So I have covered each and every point. Once you listen to this, so try to solve the questions. I will try to put the questions also. So in the YouTube, I will try to put the questions also. You try to solve them. Okay. Now let's start accounting standard 17, segment reporting. Accounting standard 17, sir, segment reporting. See, accounting standard 17 is a disclosure oriented standard. Disclosure oriented accounting standard. The disclosures which are prescribed in this standard are very crucial, which has to be reported in the financial statements. We have quite a few disclosure based standards, sir. Accounting standard 18, accounting standard 24, accounting standard 1. One among them is accounting standard 17. Sir, what is this segment reporting is all about? See, if you want to know the performance of an entity, you will see the standalone financial statements at the end of the year. And if you want to know the performance of the group, you see the consolidated financial statements. Tell me, if you look at the standalone financial statements or consolidated financial statements, any key information is missing? Definitely. What is the performance of the entity? What is the performance of the company business wise? I mean, products or services. What is the performance business wise? What is the performance area wise? That information is not available from the standalone financial statements or consolidated financial statements. Suppose, for example, there is a company which is doing textiles business, software business, and electronics business. So if you look at the balance sheet and P&L account of that entity, will you know what is a textile business performance, what is software business performance, what is electronics business performance? You don't know, no? So that means key information is missing from the standalone financial statements or consolidated financial statements. Overall information we know, all businesses together, but we don't know the individual business wise, individual area wise, how you are performing. So isn't that information is also very necessary for users of financial statements to assess the risks and rewards of the entity, to take a decision whether to invest in this company or not? Definitely. So that's why, see, the key information is missing in the standalone financial statements and consolidated financial statements. The answer is yes. So we want to know the individual performance of the product and services country or region wise. So that's why they brought accounting standard 17, and through this standard they're saying that every organization, so they have to disclose the performance, the financial performance, financial position, so business wise as well as the area wise. That is called segment reporting. The segment here is either business segment or geographical segment. Basically the idea is business segment means the products or services, group of products or services you are dealing with, and geographical segment means where you are operating your businesses or where is your location of customers. Based on that also you need to report the performance, right? So because if you give this information also, then users can better understand the performance better of the entity, and also they will assess the risks and rewards of the entity better. Hope you understand what is the logic behind introduction of accounting standard 17. So segment reporting, what is the object of segment reporting, sir? So many enterprises offer group of products or services or operates in different geographical areas. You take Reliance Industries Limited, sir, they are doing textiles business, they are into the retail business, they are into the telecom business, oil and gas. So different kinds of businesses they are doing, right? So at the end of the day, at the end of the year, we know the overall performance of the Reliance, but we don't know the business wise performance. We don't know the area wise performance. See, they are doing business in different countries. So what is the performance in India? What is the performance in, for example, Russia? What is the performance in China? So we want to know, users want to know, because if you want to understand the risks and rewards of your organization, so you must provide this information to the users of financial statements. Because see, varying profitability, growth opportunities, future prospects and risks. Each business profitability is different, growth opportunities are different, future prospects is different, risks are different. Each area you are dealing business is different, right? So what is the object of this standard? The goal of this standard is to prescribe the principles for reporting financial information about products and services of an enterprise offers and also the geographical areas where it operates. So the products and services the enterprise offer. So the performance of those products and services, business wise, nothing but geographical areas where it operates. So to provide the principles for financial reporting of the business of the organization, product or service wise and geographical area wise. So that is the main object of this standard. So what are the benefits if a company presents information, financial position, financial performance, products or services wise or area wise? Because see, you can gain better understanding of the performance of the enterprise. Suppose for example, there is a company which is doing software business, which is also doing electronics business, also doing textiles business. Now suppose for example, only textiles business they are getting profits, remaining 2 losses. But overall, if you look at the financial statements of the company, you are seeing profit only. Because the textile company profits, the revenues are compensating these losses. So overall, you look good. But if you want to better understand the performance of the enterprise, you need individual breakup. So when users came to know that no, only textile business is performing, electronics and software business are not performing up to the mark. So in future, these losses may accumulate and it may affect the going concern of the organization. It may affect the longevity of the organization. So to gain better understanding of the performance, definitely segment wise reporting will help. Next, make better assessment of risks and returns. Sir, if you want to understand the risks and returns of the enterprise, definitely you need to report or you need to know the information, performance, position, product wise as well as area wise. So better assessment of risks and returns you should do, sir. For that, this segment reporting helps, and also make more informed judgments about the enterprise as a whole. So if you want to make more informed judgments, if you want to take any decisions relating to the company, which business we will continue, which business we are not performing well, for that segment reporting helps. So this is the benefit of segment reporting, sir. Now scope of this standard, sir. This standard must be applied by the enterprise when they are preparing general purpose financial statements. Okay, not specific purpose financial statements. When they are preparing the general purpose financial statements, this standard must be applied. And when any entity selects that they want to apply accounting standard 17, they must apply the requirements of the standard fully, not selectively. So requirements of this standard fully, not selectively. And suppose you are preparing consolidated financial statements, and suppose in the annual report you will present both standalone financial statements as well as consolidated financial statements. Then segment reporting will be done based on the consolidated financial statements. So if the financial report includes both consolidated and separate financial statements of the parent, segment information should be presented based on the consolidated financial statements. And that to see this segment reporting standard, accounting standards 17, is applicable only for big companies, that is non-SMCs, other than small and medium size enterprises. And whereas non-corporate entities is concerned, level 1 entities, this standard is applicable. So for companies, this is applicable to non-SMCs. For other than companies, non-corporates, level 1 entities, so this standard is applicable. So I can say that this standard is applicable only for big companies. For small companies, this standard is not necessary. Okay. Now, sir, according to Accounting Standard 17, every business organization in the sense to whom this standard is applicable, they need to report product wise and area wise how they are performing, right? So the overall standard, if I want to sum it up, this is like this. There is a company. First of all, what company need to do is they need to identify what are the businesses they are doing and where they are operating the businesses. So they are called segments. These segments are basically divided into two. One is business segment, another one is geographical segment. Business segment means basically products and services. Geographical segment means where you are doing the business, different countries or regions. Now the standard says you need to first identify the segments and divide them into two, business and geographical segment. Once you divide them into the business and geographical segment, you identify which one is primary, which one is secondary, which one is primary reportable segments, which one is secondary reportable segments. Of course, they have prescribed the how to identify the reportable segment and when a segment will become primary segment. So if it is primary and reportable, then we need to make disclosures in respect of that segment. More disclosures are required. If it is reportable but secondary reportable segment, then less disclosures are required to be made. And if you look at the overall picture, this is what this standard is. Very simple. I summed up in a very simple manner. So there is a company, sir. Every company will have different businesses and different geographical areas they are operating. So they are called segment. So segments are basically divided into two categories: business segment, geographical segment. For example, here I have given, say this. Business segments means the products and services. For example, this company is dealing with the product A, B, C, D, E. 5 products. And geographical segment. This company is operating in India, operating in China, operating in UK, operating in USA. 4 places they are operating the businesses. So that is geographical segment. Now what business organizations have to do is they need to identify out of this business segment which one is reportable. See, this standard is saying that only reportable segments information is required to be disclosed. So first you need to identify which one is reportable from the business segments and from the geographical segment. After that, out of business and geographical segment, which one is primary? Suppose if business segment is primary, in that business segment, what are all the segments are reportable, they will become primary reportable segments. And if it is a primary reportable segment, what disclosures you need to make? So generally the intention of the standard is if the segment is primary reportable segment, more information need to be disclosed. If the segment is a secondary reportable segment, for example, if business segment is primary, then obviously geographical segment is secondary. If geographical segment is primary, then business segment is secondary. So whenever your segment is secondary, suppose if business segment is secondary, then in that which are reportable. So they are called secondary reportable segments, and in respect of them also we need to make some disclosures, but very less disclosures when compared with primary reportable segments. Okay, so this is the idea of this standard, sir. Now, at the end of the year, I need to disclose information relating to reportable segments, either from business segments or geographical segment. If business segment is primary, then in that what are all the segments are reportable? They are called primary reportable segments. For example, you see, we have A, B, C, D, E, 5 products. In that A, B, C, these 3 are reportable. Now we can call them as reportable segments. Suppose if you come to geographical segment, suppose India, China, UK, these 3 are reportable. For example, these 3 are reportable. Now we can call them as reportable segments. Now see, if business segment is primary, then A, B, C are called primary reportable segment, A, B, C, because which are reportable and their business segments. India, China, UK, geographical segments, which are already reportable, and if business segment is primary, then geographical segment is secondary. Now they are called secondary reportable segments. Okay, secondary reportable segments. So primary, secondary reportable segments. Okay. Now, sir, in respect of each segment, we need to disclose the information, right? What information we need to disclose? We need to disclose segment revenue, we need to disclose segment expenses, we need to disclose segment result, we need to disclose segment assets, we need to disclose segment liabilities. Generally, balance sheet and P&L account consists of what? Revenues, expenses, profit or loss, as a balance sheet consisting of assets and liabilities. This information we need to report each segment wise. So that's why we need to understand now, according to the standard, what is segment revenue, what is segment expenses, what is segment result, what is segment assets, what is segment liabilities. These definitions we need to understand. Okay. Later we need to understand which segment will become reportable. See, they have prescribed one criteria to identify the reportable segment. By applying that criteria, you need to see whether that segment is reportable or not. After that, they have prescribed which segment is primary, how to identify. So if it is become primary, in that whatever the segments are reportable, they will become primary reportable segments. And in respect of primary reportable segments, what disclosures to be made? If one particular segment is primary, obviously the other one is secondary, and in that whatever the reportable are there, they are called secondary reportable segments. And in respect of secondary reportable segments, what information we need to disclose, that is also prescribed under accounting standard 17. But see, in the definitions, first we need to understand business segments, geographical segment, because this standard has classified the segments into two categories, that is business segment, geographical segment. What is business segment? See, the standard says business segment is a distinguishable component of an enterprise, and that provides individual product or services or a related group of products or services whose risks and rewards are different risks and rewards compared to the other segments. So what is business segment? Business segment is a distinguishable component. So it's a separate, identifiable, independent component, part of an enterprise, that provides what? Individual products or services or group of related products or services, and which has risks and rewards which is different from other segments. For example, I told you now, suppose we are doing software business, IT, electronics business we are doing, and also textile business we are doing. Now you tell me, so whether they will become business segments or not. First of all, distinguishable component, definitely software, electronics, textile, distinguishable component. Provides individual product or services, definitely software is providing different products, electronics different products, textile different products, or group of related products or services, definitely. And different risks and rewards. See, software business risks and rewards are different, electronic business risks and rewards are different, textile business risks and rewards are different. So we can say that this is one business segment, this is another business segment, this is another business segment, because business segment is a distinguishable component that provides individual product or services or group of related products or services whose risks and rewards are entirely different from each other. Suppose if the risks and rewards are not different, they are same, then we cannot say they are two business segments. For example, sir, we are dealing in batteries. So two types of batteries we are dealing. We are dealing batteries for automobiles, the batteries which we use in the cars, or all those things we are manufacturing, and also we are manufacturing the batteries which is used in the household. Now tell me the batteries which we manufacture. So for automobiles we are manufacturing the batteries, and for households, like for example the inverters, the generators where batteries will be used, now there also we are manufacturing. Now tell me whether they will become two business segments or single business segment. First of all, see, the batteries we are manufacturing for automobiles, the risks and rewards are entirely different from the batteries we are manufacturing for UPS and generators. So therefore, they will be treated as two business segments. So understand, to classify any segment as business segment, the risks and rewards of that business must be different from other businesses. And sir, how to identify, sir? You see the nature of the products or services. You see the nature of the production process, how they are manufactured. You see the type or class of customers. You see what are the methods they will use to distribute the products or provide services. And you see the nature of regulatory environment where they are operating. So banking, insurance, public utilities. Then you will get an idea whether they have risks and rewards which is same when compared with other segments or different. So what is business segment, sir? Business segment is a distinguishable component of an enterprise that provides products or services or group of related products or services whose risks and returns are different when compared with other segments. Now what about geographical segment? Sir, suppose business wise, okay, area wise, where you are operating the business. See here, geographical segment means there are two two ways. One is point of sales. Point of sales. Another one is point of operations. For example, you take Apple company, sir. Now, Apple company is having manufacturing plants only in two places, USA and China. But their sales are in different countries. They are selling products in India, Russia, China, different countries. So geographical segment can be from the point of view of sales, can be from the point of view of operations. Now, Apple company, if you see the point of operations wise, USA, China are the geographical segment. If you say point of sales is the base, then they have different geographical segment. So what is geographical segment? This is also distinguishable component. This provides individual products or services within a specific economic environment. Within the specific economic environment. For example, you take Reliance Industries Limited. Reliance Industries Limited operating in India, operating out Singapore, operating Switzerland, operating Canada, operating USA. So, specific economic environment whose risks and rewards are different when compared with other economic environment. See, the risks and rewards are different in USA when compared with China, when compared with India, when compared with Russia. So, in order to identify the geographical segment, you need to see where you are operating, whether the risks and rewards are different when compared with other areas where you are operating. Then you can say it is your geographical segment. How to identify them? Simple. Similarity of economic and political conditions. How the political conditions, economic conditions in these different countries. And what is the relationship between operations, proximity of operations, special risks associated with the operations. Suppose if, for example, if you are operating in Japan, maybe environmental, climatic conditions, tsunamis, all these things will affect. So therefore, the risks and rewards are entirely different. So exchange control regulations and also underlying currency risks. So these are the factors which is going to affect your geographical segment. So what is geographical segment? Geographical segment is also a distinguishable component of an enterprise that engaged in products and services within a particular economic environment whose risks and rewards are different when compared with other economic environments. Now, next to reportable segment. I told you na, first you identify the segments, which can be business or geographical segment. Now, within this business segments and geographical segment, which one is reportable? Which one is reportable? They have prescribed one criteria. If any segment satisfies that criteria, that is called reportable segment. So a reportable segment is either a business segment or a geographical segment that requires segment information to be disclosed under accounting standard 17. So in respect of which segment the information to be disclosed, only reportable segment, not all segments require disclosure. Only the segments within the business or geographical segment which are reportable, and this standard says you need to disclose the information relating to those segments. Now, what we need to disclose? Segment revenue. So we need to understand the definition of segment revenue. What is segment revenue? See, the standard says segment revenue is the aggregate of three things. One is directly attributable revenue. Second one is enterprise revenue that is reasonably allocated to the segment. Third one, revenue from transactions with other segments. Directly attributable. So exclusively sales done by the particular segment. Second one, enterprise revenue. Enterprise revenue means sales to external customers. Organization revenue. In that, how much is allocated to the particular segment? Allocated revenue. And the last one is transactions with other segment. Suppose one segment has sold goods to another segment, one segment has provided services to other segments. So the transactions with other segment, they are also be included as a part of segment revenue. So segment revenue is aggregate of three things, sir. One is directly attributable, another one is reasonably allocated, another one is transactions with other segment. But remember guys, segment revenue does not include, when you are calculating the segment revenue, don't include extraordinary items as per accounting standard 5, and also any interest or dividend income. This is very important. Any interest income, dividend income, including loans, interest on loans and advances given to other segments, please don't include it as a part of segment revenue. But of course, if you are finance segment, if you are engaged in financial operations, predominantly giving loans and advances, then for you, interest is part of your operations, then you can include interest and dividend as a part of segment revenue. But if you are a non-financing enterprise, if you are a non-financing segment, then don't include interest and dividend income as a part of the segment revenue. And also any gain on investment or debt extinguishment. For example, you sell the investment, you got the gain. Can I include gain as a part of segment revenue? Standard says no. you cannot include any gain on sale of investment as a part of segment revenue. But of course, if you are finance nature segment, then you can include gain on investment as a part of segment revenue, unless the segment is primarily engaged in financial operations. So tell me what things we should not include as a part of segment revenue. So extraordinary items, please don't include it. Second one is any dividend income, interest income, we should not include it, including interest on loans and advances given to other segments. Please don't include it as a part of segment revenue. And also say that if the segment is basically primarily financial in nature, finance segment, then include interest and dividend income as a part of segment revenue. And also any gain on sale of investments, any debt extinguishment, so you cannot include it as a part of segment revenue. But of course, if the segment is primarily engaged in finance business, then you can include gain on investment or debt extinguishment as a part of the segment revenue. And what is segment expenses? The segment expense is the aggregate of direct operating expenses of the segment and any expenses of the enterprise which is allocated to the segment, reasonably attributed to the segment, and also inter-segment transaction expenses. Any expenses incurred for transferring transferring goods or services to other segment, in that inter-segment transaction cost or expenses we incurred, that is also part of segment expenses. And what we will not include as a part of segment expenses? Extraordinary items we will not include, interest expense we will not include, but of course including interest on loans and advances taken from other segments. If you take any loans and advances from other segments, whatever the interest you are paying on those loans and advances, that is also not part of segment expenses. But if your segment is primarily financial in nature, then you can include it as a part of segment expenses. And also any losses on investment sale or debt extinguishment. So any loss on sale of investment or debt extinguishment, you cannot include as a part of segment expenses. There we have seen in the segment revenue, gain on sale of investment we have not included now. Similarly, loss on sale of investments we will not include as a part of segment expenses. But if your segment is primarily finance in nature, then you can include it as a part of segment expenses, the loss on sale of investments. And also very, very important, income tax expenses. Any income tax expenses, don't include it as a part of segment expenses. And also any general administrative and enterprise level expenses. So unless they are directly related to the segment and reasonably allocated, reasonably attributed. So any general administrative enterprise level expenses, like any head office cost, any general administration cost which is incurred at the enterprise level, don't include it as a part of segment expenses. Of course, if these expenses are directly attributable or reasonably allocated to the segment, then we can include it as a part of segment expenses. Otherwise, we will not include it as a part of segment expenses. So tell me, what is segment revenue? Segment revenue is aggregate of three things: directly attributable revenue, reasonably allocated revenue to the segment, third, revenue from transactions with other segments. What we will not include as a part of segment revenue, and we will not include any extraordinary items. Second, we will not include any interest income or dividend income. Of course, if you are finance nature segment, then include interest and dividend income as a part of segment revenue. Next, any gain on sale of investment or debt extinguishment, we will not include as a part of segment revenue. Of course, if you are finance nature segment, then you include it. And also, when it comes to segment expenses is three aggregate of three things. One is direct operating expenses of the segment and any expenses of the organization allocated to the segment on reasonable basis, and any inter-segment transaction expenses. So these three will be included as a part of segment expenses. What we will not include as a part of segment expenses? Extraordinary items, interest expenses we will not include. Of course, if any interest expenses incurred by the finance nature segment, then we will include it as a part of segment expenses. Any loss on sale of investment, don't include it. Income tax expenses, don't include it. Any general administrative enterprise level expenses, that means any head office expenses, any expenses which is incurred at the head office level, don't include it as a part of segment expenses. Then once segment revenue and segment expenses is over, then segment result. Segment result is what? The difference between segment revenue minus segment expenses. Then you will get segment result. So therefore, when you are reporting information about this segment in the financial statements, in the notes to accounts, basically first you report segment revenue. You know what is segment revenue. Then minus segment expenses. You know segment expenses. Segment revenue minus segment expenses, you will get segment result. So that means P&L account is over. Now come to the balance sheet. In balance sheet, first one is what? Assets. Segment assets. What is segment assets? See this. Segment assets are operating assets that are directly attributable to the segment or which is allocated to the segment on reasonable basis. Direct assets of the segment. Which assets? Operating assets of the segment, which is directly attributable to the segment or head office expense, head office assets which is allocated to the segment on reasonable basis. These two things we will include it. So segment assets are two things. One is direct operating assets of the segment and assets of the enterprise which is allocated to the segment. Okay. And then if the segment result include interest and dividend income, then its segment assets include the related receivables, loans, investments, other interest or dividend generating assets. Sir, when you are calculating the segment revenue, if you include interest and dividend income as a part of segment revenue, then the corresponding assets, receivables, from where this interest and dividend income you are generating, that is also included as a part of segment assets. Suppose if you are not including interest and dividend income as a part of segment revenue, the corresponding assets from where this interest and dividend generated, don't include it as a part of segment assets. Fair enough, B. Because in segment revenue definition, we have seen clearly that so interest and dividend income generally we won't include it as a part of segment revenue. Of course, if you are finance nature segment, then we will include, correct? That means if you are a finance nature segment, obviously interest and dividend income we will include as a part of segment revenue. Therefore, the corresponding assets, the corresponding investments, the corresponding loans and advances, the corresponding receivables from where this interest and dividend income generated, obviously we can include it as a part of segment assets. But remember guys, this is very, very important. Segment assets does not include. Accounting standard 17 says you cannot include income tax assets. Like any advance tax is an income tax asset, any deferred tax assets, don't include it as a part of segment assets. And also any general enterprise or head office assets that are used for overall enterprise or head office functions. So suppose for example, head office is having one office, head office, corporate office. So that is enterprise office, which is used for all the operations of the enterprise, which cannot be treated as segment assets. So any assets at the enterprise level, head office level, don't include it as a part of segment assets. So two things we will not include as a part of segment assets. One is income tax assets. Second one is general enterprise or head office assets. So this is segment assets. Come to segment liabilities. What is segment liabilities? Segment liabilities are operating liabilities. Either they are result from the operating activities of the segment, that particular segment, what are the operating activities they are doing, relating to them, what are the liabilities. So those liabilities are part of segment liabilities. And also any liabilities of the enterprise that is directly attributable to the segment or can be allocated to the segment on reasonable basis. So sometimes enterprise will incur the liabilities. Those liabilities which can be allocated to the particular segment, they will also be part of the segment liabilities. So segment liabilities are two things. One is operating liabilities of that particular segment. Second, any liabilities which is allocated to the segment on reasonable basis. And also when you are calculating the segment liabilities, sir, if the segment result includes interest expenses, then its segment liabilities also include the related interest bearing liabilities. Sir, when you are calculating the segment expenses, generally I told you interest expenses we will not include, right? Of course, if you are a finance nature segment, then interest expenses will be included as a part of segment expenses, right? When you include interest expenses as a part of segment expenses, the related liability on which you are generating this interest expenses can also be included as a part of segment liability. So there is an interconnection, very simple. If you include a particular income, interest income as a part of segment revenue, then corresponding asset also include in the segment asset. If you include segment expenses, interest expenses as a part of segment expenses, then the corresponding liability also include as a part of segment liabilities. And don't include income tax liabilities. Remember guys, they may frame one question on this, very simple question. This is, see, if at all there is a question from this standard, easily you can get full marks. So very simple. So remember, segment liabilities do not include income tax liabilities. And also any financing liabilities, any borrowings and other liabilities incurred for financing rather than operating purpose. If you observe, sir, they are talking about operating liabilities. Only operating activities of the segment, whatever the liabilities generated, that we will consider as a part of segment liabilities. And even in assets also, you see, operating assets they are talking about. And according to AS3, accounting standard 3, so activities, cash activities are three types: operating, financing, investing. So therefore, you cannot consider the financing liabilities. For example, you have taken a bank loan. Now, bank loan is a financing activity. Don't include as a part of segment liability. Only operating liabilities we will include as a part of segment liabilities. So borrowings and other liabilities incurred for financing rather than operating purpose, don't include it as a part of segment liabilities. That means we have completed all the definitions. So therefore, tell me, what is business segment? What is geographical segment? What is segment revenue? What is segment expenses? What is segment result? What is segment assets? What is segment liabilities? So these are the main important definitions, sir. So business segment is a distinguishable component. That is offering in individual product or services, group of related products or services whose recent rewards are entirely different from other segments. What is geographical segment? Distinguishable component, providing products or services within a particular economic environment whose recent rewards are different from other segments. And what is segment revenue? Segment revenue is an aggregate of three things: directly, the direct revenue of the segment, allocated revenue, and revenue from transactions with other segment. What is segment expenses? Three things: direct expenses, direct operating expenses, allocated expenses, expenses on transactions with other segments. Segment assets, segment result means revenue minus expenses. Segment assets, combination of three, aggregate of three things: operating assets directly related to the segment, and any assets which is allocated to the segment, but you cannot include income tax assets. And also, when you are calculating the segment revenue, segment expenses, extraordinary items, we will not consider. Any interest incomes there, we will not consider. Interest expenses, we will not consider. Any gain on sale of investment, any loss on sale of investment, these things we will not consider. Similarly, when you are calculating the segment assets and segment liabilities, income tax assets and liabilities, we will not consider as a part of segment assets or liabilities. Now, I think this is very, very important point, sir. Treatment of interest for determining the segment expenses. Sir, generally tell me whether interest will be considered as a part of segment expenses. The answer is no. When it is included, if the segment is primarily financial in nature, then interest will be included as a part of segment expenses. But there is one more exception, sir. That is, if you are manufacturing inventory and if your inventory is a qualifying asset as per accounting standard 16, we have seen one standard called accounting standard 16, which says an inventory, if you're taking substantial period of time to get ready for intended use or sale, that is called qualifying asset. If it's a qualifying asset, then borrowing cost like interest will be directly attributable, directly included in the inventory, right? So if the interest is directly included as a part of inventory because it is a qualifying asset as per accounting standard 17, then obviously interest expenses is part of segment expenses only, because segment expenses means direct operating expenses. So since interest is included as a part of inventory, inventory is part of operating activities, operating asset. So definitely interest will be considered as a part of segment expenses. So remember guys, they can test this. Interest generally not part of segment expenses, but there are two exceptions. One, when your segment is primarily financial in nature, then interest can be included as a part of segment expenses. Second one is, if your inventory is a qualifying asset as per accounting standard 17, then interest can be included as a part of segment expenses, because inventory is basically operating activity, operating asset. Therefore, the interest, since it is a qualifying asset, we are directly including it. So therefore, it is part of segment expenses. See this. Exclusion of interest expenses. Interest expenses from overdrafts, other operating liabilities specific to the segment should not be included in segment expenses. I told you now, financing liabilities are not included. So only liabilities which is directly relating to operating activities and the related expenses, interest expenses, we will include it, unless the segment's primary operations are financial in nature and the interest is included in the cost of inventory. Look at this. If the interest is included as a part of cost of inventory as per accounting standard 16 and AS2, then interest cost is also part of segment expenses. So if the interest is capitalized as a part of inventory cost, those inventories are part of segment assets, the interest should be treated as segment expenses. So that generally interest we will not include as a part of segment expenses, but if your segment is primarily finance in nature, then interest is obviously part of your operating activities. And also when your inventory is a qualifying asset, then interest is obviously included as a part of inventory. That means inventory is basically an operating activity, it becomes an operating asset. So therefore interest is also included as a part of segment expenses as well as segment assets. Inventory includes segment assets, right? So that is the thing. So disclosures, when a segment results includes such interest, disclose the interest amount and also note. Not important, but important point I told you. Now important. So as I told you the basic idea of this standard, sir, first we need to understand segments, two types, business and geographical segment. Once you identify, then you need to identify which one is primary, which one is secondary. See, the standard says, sir, which segment is primary, which one is secondary. For that, you need to see the risks and returns. Predominantly, your organization is affected by risks and rewards of products, services you are doing, or predominantly you are affected by the area of operations. Which is affecting more? So, if that one will be your primary. Primary segment reporting format depends on which factor mainly influences the enterprise risks and returns. Business segment, risks and returns are depend on different products and services. When business segment is primary, sir, if the risks and rewards are depends on different products and services we are offering, then obviously secondary is geographical. Sir, when geographical segment is primary? When recent returns are depend on different locations where you are operating. For example, you take McDonald's, or for example, Starbucks, or for example, you take McDonald's, for example. So McDonald's basically is offering what food products, right? So therefore, the recent rewards or depends upon the different locations where they are operating. Because each place, each country, region, the food habits, the culture will be different. So the food items which is preferred in USA may be not preferred in India. So therefore, predominantly they are influenced by, or their recent returns or depends upon the different countries or regions where they are operating. Therefore, geographical segment is primary for them. Obviously, business segment will be secondary. The products and services where they are offering, business segments will be secondary. Similarly, for some companies, the products and services plays a major role, not the country where they are operating. Or for example, Apple you take. So for example, recent returns depends upon the different products and services. So then that will be the business segment. And geographical segment will be secondary. So therefore, how to identify which one is primary, which one is secondary? Recent returns. Your business is influenced by the recent returns of products and services. Then business segment is primary. Geographical segment is secondary. Your business is predominantly affected by the recent rewards of the recent returns of the different places or countries where you are operating. Then geographical segment is primary. Then business segment is secondary. Okay. So now we identify which one is primary, which one is secondary. Okay. Now the most important topic of this standard is how to identify the reportable segment. Sir, this standard has prescribed certain criteria, sir. If the segment, whether it is business segment or geographical segment, if it satisfies this criteria, then that is called reportable segment. If the segment is primary, then that is primary reportable segment. If the segment is secondary, basically, so it is secondary reportable segment. So first of all, understand A17 asks disclosures only for reportable segment. Now, which segment will be reportable? So if it satisfies any one of the criteria, so reportable segment criteria. So if any one of the following test is met by that particular segment, whether it is business or geographical, then that is reportable segment. First test is revenue test. If the revenue from that particular segment is 10% more, 10% or more of the total revenue, both internal and external enterprise, both internal and external revenue you take, on that apply 10%, you see the segment revenue. If the revenue from sales to external customers and from transactions with other segment is 10% or more of the total revenue of all segments together. For example, all the segments together, the total revenue of the organization is 100 lakhs. In that 10% is 10 lakhs. So if any particular segment revenue is 10 lakhs or more, it's a reportable segment as per revenue test. If the particular segment revenue, either internal revenue plus external, both together, is 10% or more of the total revenue of the enterprise, that is called reportable segment. Second, segment result test. This is important test. Most of the students confuse here. You see this. Segment result test says, if the segment result, either profit or loss, is 10% or more of combined result of all segments in profits or combined results of all segments in losses, whichever is greater in absolute amount. So I will explain you. See this. Segment result test, sir. For example, sir, see this. These are the segments, business segments. For example, A, B, C, D, E. 5 segments are there. So profit, loss. Suppose for example, segment A, 150 lakhs profit. Segment B, 70 lakhs loss. Segment C, 20 lakhs profit. Segment D, suppose 150 lakhs loss. Segment E, minus 70 lakhs. So segment result test, how to apply? Segment result test, very simple. See this. First you take segments profits. So profitable segments, combined result of all segments having profit. Which segments are having profit? A, C, 2 segments only. So add 150 plus 20, 170. Now take segments having losses. Which segments are having losses? B, D, E. 70 plus 150 plus 70. So 150 plus 140. So total 290. Correct? 70 plus 150 plus 70. 290 losses. In absolute numbers you need to take. in absolute numbers. See this, combined result of all segments in profits or combined results of all segments in profits, all segments in losses. Whichever is higher in absolute amount we need to consider. So whichever is higher means which one is higher? 290 into 10%, 29. So this is the base. So if any segment in absolute numbers having a profit or loss 29 or more, so that is called what? Reportable segment. For example, A, is it a business segment? Yes. Business reportable segment? Yes. B, is it a reportable segment? Yes. In absolute numbers, forgot about the minus. In absolute numbers, 29, 70. So it's a reportable segment. C, it is not a reportable segment because it is having only 20. So D, it is a reportable segment. This is reportable segment. So you understand how to apply segment result test? Simple, sir. Combined all the segments having profits. Combined all the segments having losses. Take whichever is higher in absolute amount. Absolute amount. Forget about the minus. Forget about the minus. Absolute amount, whichever is higher is 290. 290. On that apply 10%. So 29. So if any segment is having 29 or more in absolute amount, ignore minus, then that will become the reportable segment as per segment result test. Now asset test. If any particular segment assets are 10% more of the total assets of the segments. See, these three are very simple. First one, segment revenue. If the particular segment revenue is 10% or more of all segments revenue, that is reportable segment. Segment result test, little bit tricky, important. Combine result of all segments having profits, combine results of all segments having losses, whichever is higher in absolute amount, 10% or more. If any particular segment in absolute amount having a profit or loss, 10% or more of this one. So this, whichever is higher, then that one is considered as segment reportable segment. Segment asset test. Asset test means if a particular segment assets are 10% or more of the total assets of all the segments. So these three. Okay, then management discretion. Sir, if management wants to include any segment as a reportable segment, it is their discretion. They can include that segment as a reportable segment. And this is important test, sir. Overall test. 75% test, overall test. What is this overall test? After identifying the reportable segment as per the above criteria, if the total external revenue of all the identified reportable segments is 75%, if it is less than 75% of the total enterprise revenue, if the total external revenue, see this external revenue means revenue, so goods sold to outside customers from all the reportable segments. Till now, whatever the reportable segments you identified, all the reportable segments you see the external revenue. If the total external revenue from the reportable segment is less than 75% of the total enterprise revenue. Enterprise revenue means sales to external customers. If the overall enterprise revenue external customers, if the reportable segments revenue is 75%, less than 75%, then management can add some more segments as reportable segments. So additional segments should be identified as reportable. Even if they don't meet 10% threshold, until reportable segments cover at least 75% of the total revenue. So till now, whatever the segments we have identified as reportable segment, all the reportable segments we identified together, their revenue is less than 75% of the total enterprise external revenue. Then you designate some more segment as reportable segments, because the idea is whatever the segments you are saying as a reportable segments, all of them together must represent at least 75% of the enterprise revenue. So these are the criteria to identify the reportable segments. And then finally, what are the disclosures we need to make in the if it is a primary reportable segment, sir, following disclosures we need to make. Say this. If it is a primary reportable segment, we need to disclose if it is a primary reportable segment, if business segment is primary, in that any particular segment is reportable, then primary reportable segment. In respect of that segment, what disclosures we need to make? First, segment revenue from external customers and transactions with other segment we need to disclose. Segment results we need to disclose. And also the total carrying amount of the segment assets we need to disclose. And also the total carrying amount of the segment liabilities. I told you, what we disclose generally relating to that particular segment. What is the revenue? What are the segment result? Result means revenue minus expenses. What are the segment assets carrying amount? What are the segment liabilities? And what is the total cost incurred during the period to acquire the segment assets, tangible and intangible, which is expected to be used for more than 1 year. that particular segment during there, what is the carrying amount of the assets, any segment assets they have acquired. So they need to disclose how much cost of assets they have acquired during the year, and what is the depreciation and amortization expenses during the period relating to that particular segment assets, and any significant non-cash expenses other than depreciation and amortization. And also we need to show the reconciliation of the revenue, result, assets, liabilities. So these are the points we need to disclose in respect of primary reportable segment: segment revenue, segment results, segment assets, segment liabilities, and total cost incurred during the period to acquire the any segment assets, and also what is the depreciation, amortization expenses, any other non-cash expenses, significant non-cash expenses, and reconciliation of the revenue, results, assets, liabilities. Now, if the secondary segment reporting information, sir, this is important, sir. Suppose if the business segment is primary, then which segment is secondary, sir? Geographical segment. As I told you, in geographical segment, we have geographical segment based on customers, geographical segment based on location of assets. So if the business segment is primary, relating to the secondary segment, geographical segment, what information we need to disclose? See this: segment revenue from external customers by location of customers, if 10% or more of the enterprise revenue. There, secondary segment information is disclosed only if the revenue from that particular secondary segment is 10% or more of the enterprise revenue. Otherwise, no need to disclose. And also, what is the total carrying amount of the segment assets by the location of assets? That too, 10% or more of the total assets of the all geographical group of assets of the segments together. And what is the total cost incurred to acquire the segment assets, which is expected to be used for more than 1 year if it is 10% or more of the total assets of all geographical segments. So if the business segment is primary, relating to geographical segment, what information we need to disclose? So geographical segment, what is the total external revenue from the customers, if it is 10% or more of the total enterprise revenue? And what is the total cost of segment assets, carrying amount of the segment assets relating to that particular geographical segment, we need to disclose if it is 10% or more of the total assets of all geographical segments together. And what is the total cost incurred to acquire the assets for that secondary geographical, geographical segment, secondary geographical segments. And also, if geographical segment is primary, then relating to business segments, we need to disclose 3 things. Same: segment revenue from external customers, if it is 10% or more of the total enterprise revenue; total carrying amount of the segment assets, if it is 10% or more of total assets of all the business segments; and total cost incurred to acquire the assets. What is the total cost we incurred during the year relating to that secondary segment, if it is 10% or more of the total assets of all segments together? So that's it. So basically, you need to remember two important things. One is, relating to secondary segments, you need to disclose information only if the criteria is 10% or more. If it's the revenue, 10% or more of the total enterprise revenue. If it is assets, 10% or more of total assets of all the segments together, then only disclosure is required. And 3 points: revenue, total carrying amount of the assets, what is the cost incurred during there to acquire the assets. So these are the 3 points we need to disclose in respect of secondary segments. Okay, so this is the accounting standard 17, sir. And my suggestion is 50 minutes it has took us. At least see these 50 minutes. So this standard you will get an idea. And go to the study material, solve the questions relating to reportable segments. Small questions only. See, with this knowledge you can easily solve. Whatever the knowledge I provided in this 50 minutes, more than sufficient to solve the questions. Try to solve the questions. So in examination, if they ask any question relating to this, you can easily answer. Okay. So that's it. This is segment reporting. So it's a completely theory based standard, sir. Most of the faculty does not choose to revise this standard, because the idea is that it is very difficult. Most of the students want to leave this standard. So my suggestion is, you don't want to leave it. So you just have to spend 50 minutes, 1 hour time on this standard. Believe me, this is one of the easiest standards. I have provided you the enough knowledge, and you are going to cover it definitely. Thank you.